Happen with players like us. Uh,
US President Donald Trump says that he has postponed an attack on Iran that was scheduled for Tuesday at the request of Saudi Arabia, UAE and Qatar. Adds that serious negotiations are underway. Iran's foreign ministry has also said that talks are underway with US through Pakistan. Stocks on Wall Street closed the session mixed amid a tech-led sell-off, and Nasdaq as well as S&P 500 lose, while Dow Jones closes in the green. Markets in Asia opened broadly higher following Trump's announcement of dealing strikes on Iran. The GIFT Nifty is indicating a slightly higher start for the Indian market. Brent crude prices slip after US President's latest comments fuel optimism that negotiations could restart. US extending a waiver on sanctions against seaborne Russian oil to offset supply disruptions also helped lower prices. Gold climbs towards $4,600 an ounce as inflation concerns ease. A US jury rules against Elon Musk in his lawsuit against OpenAI and founder Sam Altman. The federal court said that Musk brought his case too late. Musk calls decision against him a calendar technicality and he could appeal. Oil marketing companies hike fuel prices for the second time within a week. Diesel prices increased by 91 paise per litre and petrol by 87 paise per litre. Premium fuel sees the same hike. Hello, good morning. You're tuned into CNBC TV 18. You're watching Power Breakfast with me, Vinny Motiwala. Thank you so much, as always, for tuning in. Now, again, what we're seeing a reaction coming in terms of the markets is to US President Donald Trump's commentary. While over the weekend it was a commentary that we would see attacks, that changed. And now he's saying that he will hold the attack that he was planning on Tuesday on Iran. And we saw that recovery come in on the US markets and on the Wall Street. And we did see that happening in the Asian markets this morning. Most of them have opened up with a mild bit of a green coming in across the screen as well, right? Nikkei is holding on to gains of 0.1%. We have Hang Seng that's holding on to gains of 0.6%. Taiwan index almost flattish, 0.03% decline that we're seeing. So mild negative there. Shanghai gains, ASX 200, that's the Australian index, we're seeing gains as well. So most of the markets have opened up in the green on the Asian front or muted for Taiwan index as of now. What's the Nifty implied open indicating for us? We're indicating a bit of a positive start, or muted to a slight bit of a positive bias. 14-point uptick as of now is what the Nifty implied open is indicating for us. But let's talk about that update that's coming on the West Asia front as well, right? US President Donald Trump, in a post on Truth Social, said that he has delayed an attack on Iran that was scheduled for Tuesday, and that is today, on the request of leaders from Saudi Arabia, Qatar and UAE. The US president added that serious negotiations are underway and that if a deal wasn't made soon, Iran could be attacked in moments' notice. When asked by reporters on what he meant on the post, this is what he had to say.
We were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also. We've had periods of time where we thought pretty much getting close to making a deal, and didn't work out, but this is a little bit different. Now, we're ready going tomorrow very big, and not something I wanted to do, but we have no choice because we cannot let Iran have a nuclear weapon. It seems to be a very good chance that they can work something out. If we can do that without bombing the hell out of them, I'd be very happy.
Meanwhile, Iran's president said that the dialogue does not mean surrender and that Tehran had entered the dialogue with dignity, authority, and preservation of nations' rights. Iran's foreign ministry also confirmed that it has received US feedback on its latest peace proposal through Pakistani mediators, and talks between the two sides are still underway. Meanwhile, former US Treasury Secretary Jacob Lew says that the conflict between US and Iran has to be won by political means, and it is important for both parties to get something. Listen in.
I think this is hard, but it's achievable. What can't be the case is that a war of words will win this. The Iranian people are proud. They're tough negotiators. One can think they're evil, as I think many of the things they've done are evil, and I spent a number of years of my career trying to break their economy to get them to the table to negotiate. So I understand the impetus of this, but that's not how you're going to get an agreement with the Iranians. To rub the salt in the wounds, it is going to have to be through a political dynamic. And in any negotiation, both parties have to be able to say they got something.
Okay, on that note, let's bring on board Manisha Gupta this morning to take us through what's happening in the world of commodities, what we should be keeping an eye out on. Manisha, good morning. And Trump commentary keeps the needle moving for Brent crude as well, and what's going to be happening in West Asia. Over to you.
Oh, absolutely. And that is the reason after those comments that we've seen from U.S., the crude oil prices have slipped below $110 a barrel, but holding quite strong there even as of now. So what we know is that the U.S. will hold off on a planned attack on Iran on today, that is Tuesday, and the attack is put on hold after requests from Saudi Arab, Qatar, and UAE. U.S. also allowing sale of Russian oil and products on tankers till June 17 also have eased fears, especially for the Asian markets, in sense of availability of crude oil prices. So some bit of an ease is what we are working with into the markets right now, but this is developing condition. What we also have seen is some bit of an increase coming in for many of the metal prices. Some decline in energy definitely has supported gold and silver prices. Hopes that the U.S. and Iran may return to negotiations. Markets in the meanwhile also are awaiting the FOMC minutes and flash U.S. PMI data. This would set course for further direction. We've also seen copper come back a bit. Aluminum, in any case, has been an outperformer with the high crude oil prices, and aluminum being an energy-intensive metal. Remember, 40% of aluminum input cost is energy, and that is the reason you've seen aluminum prices continue to hold quite strong. HRC steel is trading at a 28-month high as well. So as I said, with the energy prices slightly declining, everything in metals is trading on the positive.
Okay, Manisha, thank you so much for taking us through what's going on in the world of commodities this morning. But on that note, we're going to slip into a very short break. After the break, we'll come and tell you how the overnight cues are going to be impacting our Indian markets. So stay tuned in. Thanks for staying tuned into Power Breakfast on CNBC TV 18. Now, let's talk about the US market, right? It closed a bit mixed in terms of what happened on Wall Street, largely hampered by the tech stocks. Nasdaq was lower by over 0.5%, while S&P 500 ended with marginal cuts. Dow Jones, on the other hand, added around 160 points in the trading session and managed to close in the green. We're CNBC's Christina Patsanevelos, who's joining us to give us a wrap on what happened on Wall Street.
U.S. markets were mixed across the major indices in Monday trading as tech stocks fell and oil prices did climb higher. The Dow gained about 160 points, S&P 500 fell 5, and the tech-heavy Nasdaq down about 0.5%, which equates to 134 points. President Trump and his family dropped a $10 billion lawsuit against the IRS on Monday. The president originally sued over the 2019 leak of his tax information. In exchange, the Department of Justice is creating a roughly $1.77 billion fund to compensate people who allege they are victims of so-called lawfare. Democrats have actually blasted that move, calling it a slush fund, and its creation is likely to face legal challenges. And a jury in Oakland, California rejected Elon Musk's lawsuit against OpenAI and its CEO Sam Altman Monday, finding that Musk did not bring the lawsuit until after the statute of limitations expired. Musk accused the AI startup of stealing a charity when it shifted from a nonprofit to a for-profit company. The verdict came from a so-called advisory jury, with the judge having the final word. She accepted the decision and immediately dismissed the lawsuit. Musk's lawyer told the judge he reserves the right to appeal. That's what's happening here in the United States. Back to you in Mumbai.
Thank you so much for that. Now, moving on, Rockefeller International's Ruchir Sharma says that China has disappointed on the financial front and explains why investors will choose America over China. Listen in.
America's lead financially is way greater than even its economic weight in the global economy. And China is lagging behind because no one really trusts its currency, and also because of the fact that the Chinese equity market has offered such poor returns over the last 10 to 15 years. So I think that this is a real problem, also because it allows America then to get away with a lot, right? The reason why America is able to even make some policy mistakes and still have so much capital come to its shores is because people look around and say that, hey, we can't put this money in China, so where else are we going to go? We're just going to stick with America.
Okay, now let's move on and talk about how these overnight cues are going to be impacting our Indian markets. We have a team of research joining us to set you up for trade, tell you which are the important stocks to watch out for, as well as cues in the world of F&O. First up, Vivek, over to you. Important cues that we're keeping an eye out on for the markets today. Good morning.
Good morning. Absolutely right. Well, geopolitical tensions appear to have eased, and that's actually aided a bit of a rally as far as Asian markets are concerned. Overnight, like we heard, U.S. markets have managed to end on a mixed note. Oil prices have cooled off, which is a positive, and Brent now down a little over 2%, hovering around the $109 a barrel mark. When you're talking about Asian markets, most of these markets have managed to open the green, which also indicates that the GIFT Nifty is indicating a mild positive start for our own markets. Now, in terms of what our markets did yesterday, remember it was an extremely volatile trading session, a sharp gap down open, post which we managed to stage a very sharp recovery. In fact, the Nifty managed to end near the flat line. But on the other hand, broader markets continued to underperform. Market breadth was in favor of the declines. The IT pack clearly outperformed. And in terms of the top movers, remember, Pharma was a clear outperform. Very strong earnings led to a significant up move as far as the stock price was concerned. On the other hand, earnings reactions that were quite negative were Amba Enterprises, Tata Steel, as well as ICICI Prudential Life. Remember, fell quite significantly. This is on the back of the fact that there are fears of significant supply overhang. Advanced decline ratio, as far as the NSE was concerned, was in favor of the declines at 1:3. What is it that we'll be watching out for today? Well, earnings reactions continue. IOC, GE Vernova, TND, Afcons, as well as Astral will all react to results today. On the other hand, some key results today include Bharat Electronics, PPCL, as well as PI Industries.
Okay, Vivek, thank you so much for that. But let's go across now to Ria, who's here to tell us which are the important stocks to keep on your radar this morning. Good morning, Ria.
Good morning. Let's start off with all of the quarter 4 results. The first one is IOC. Revenue has gone up by around 1.5% compared to the previous quarter, slightly below the estimates that we were working with. In fact, an EBITDA has been flat at around 20,716 crores in this quarter. This has been above the pole of around 14,900 crores. For GE Vernova TND, the margin expansion has continued in this quarter. Margins have come in at 27%, better than what its peers have reported. and order inflow has also gone up by around 188% for quarter 4. For IGL, the overall volume growth has been at 5.6% compared on a year-on-year basis and 2.8% sequentially, and this has been slightly above the estimates that the street was working with. For Astral, the quarter 4 numbers have been below the estimates on all fronts, and however, the volumes in the plumbing business have been quite strong at around 16% compared to the previous year for the full year of FY26. For Apollo Micro, the FY26 revenue growth has come in at around 60%, and this compared to the guidance that the company had given that the revenue growth is expected to double in FY26, and the order book has also come in at around roughly 1400 crores compared to the company's guidance of an 1800 crore order book by the end of this year. For Afcon's infra, revenue has seen a decline of around 19% compared to the previous year. EBITDA also down quite significantly by around 85% compared to the previous year. For JK Profit as well, the net profit has gone up by around 36% and revenue also seeing an increase of around 17%.
Okay, Ria, thank you so much for that. But in the final update, let's go across to Sudarshan, who's here to tell us the important cues in the world of F&O. Sudarshan, yesterday we did see those recoveries coming in for the market from the low as well. Today, what are we watching out for in terms of levels, F&O cues? Over to you.
Good morning, Vinny. So it's Nifty weekly expiry day, and the best thing for anyone to do in the current environment is to stay away from the market, because the changes we are seeing not in few minutes or few hours, things are changing within few seconds. And yesterday, like whole day, the similar pattern we had seen. Now talk about the broad range for Nifty. Tracking all the indicators, broad range for Nifty remains from 23,400 to 23,900. Coming to F5 flows, they were buyers in the index futures, but in the stock futures, they were the sellers. They have reduced short positions by more than 7,000 contracts. They have reduced long positions by 900 contracts. Long exposure remains around 12%. In the options data, 23,400 and 23,600 remain the most active put options. And on the call side, 23,950. That's the reason I'm telling you the range from 23,400 to 23,900. So support 23,400, resistance 23,900. Two stocks remain in the band, and those are SAIL and Keynes Technologies. And PV Fintech for the last few days has been seeing fresh longs. Yesterday was up almost 3 to 4%. JSW Energy for the last 2 days has started seeing fresh shorts. So keep an eye on that. And Solar Industries after Q4 earnings has seen short coverage.
Okay, thank you so much for that, Sudarshan. But on that note, we are going to actually slip into a very short break. Up next, we'll get you the updates from the world of AI. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now getting you the latest updates from the world of tech in our special segment AI Pulse. We have Rachna joining us as always to take us through all those details. Good morning, Rachna.
Good morning. Here's what is shaping the world of artificial intelligence today. We begin with a landmark verdict. A federal jury in Oakland has ruled against Elon Musk in his lawsuit against OpenAI and CEO Sam Altman. The jury deliberated for less than 2 hours, finding Musk waited too long to file his case. Now, this clears Altman, Brockman, and Microsoft on all claims. But Musk vows to appeal, calling it, quote, a calendar technicality. For OpenAI, the ruling removes a major legal cloud ahead of its anticipated IPO this year. Turning to big tech, Meta is simultaneously cutting and rebuilding. 7,000 employees move into new AI units this week, while 8,000 jobs go on Wednesday. Meta is funding its $145 billion AI push by reshaping its workforce around it. But on infrastructure, we have Google and Blackstone, who've come together and formed a new AI cloud company on Google's specialized chips. Blackstone puts in $5 billion for a majority stake, targeting 500 megawatts of compute by 2027. Now, to compete directly with CoreWeave on cybersecurity. But on cybersecurity, we have Anthropic, which is opening up its Mythos, the most anticipated and dangerous model yet, the threat findings of it to partners including Amazon, Microsoft, Nvidia, Apple, and JP Morgan. The Pentagon is also deploying Mythos across US government systems, and Anthropic has now agreed to brief the G20 Financial Stability Board on risks to global banking. Then there's Intel. Intel CEO Lip-Bu Tan says Foundry is gaining real traction, with Apple and Google and Tesla all circling its 18A process. Multiple customer deals are expected in the second half of the year. In the AI supply chain, 47,000 Samsung workers strike this Thursday for 18 days. Samsung controls a third of global DARMs, and its full 2026 HBM4 output is already sold out. A prolonged stoppage hits the AI build-out directly and to a much larger audience and clients. But coming closer to home, Prime Minister Narendra Modi's visit to Sweden has yielded a strategic partnership and the launch of India-Sweden AI Corridor, linking startups, researchers and industries from both the countries. A joint action plan for 2026 to 2030 covers AI, semiconductors and defense. Bilateral trade stands at $7.75 billion, with both sides targeting a doubling within 5 years of that number.
Thank you so much for that, Rachna. But let's move on. And Prime Minister Narendra Modi attended the India-Norway Business and Research Summit in Oslo as both countries look to deepen economic ties under the India-EFTA trade pact that is there. Now, the summit saw participation of over 50 companies and more than 250 businesses and research leaders, with several agreements signed between Indian and Norwegian entities. Now, PM Modi highlighted India's green energy push, including renewables and green hydrogen, while praising Norway's leadership in clean energy and climate finance. The Prime Minister was also conferred with Norway's highest civilian honor, the Grand Cross of the Royal Norwegian Order of Merit. Okay, but with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, Tipas our morning call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. Welcome to Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Nigel. And how many times, Nigel, have we started the show saying that there will be progress soon to end the Iran war? But at the end of the day, the US-Iran war narrative continues. It offers a lot of headline volatility. But so far, there has been a little progress towards resolution. So just to quickly take stock of what happened on Wall Street overnight, the Dow recovered about 300 points from the day's low. It ended up in the green, 160 points higher. The S&P 500 also managed to recover, but still ending just below the flat line. Nasdaq was the key underperformer on account of underperformance from memory stocks. The reason is Donald Trump wrote on Truth Social that he's holding off a planned attack on Iran on Tuesday. And this came after some requests coming in from 3 regional powers in West Asia. Let's just quickly pull up the Asian markets to see if there is any kind of a reaction coming through on Asia this morning. You've got the Taiwanese markets down nearly 1%. Hang Seng is holding up in the green with a gain of about 0.3%. We got the economic data coming out of Japan. The Q1 GDP was better than what the street was anticipating. It came in at 2.1% annualized versus an expectation of 1.7%. And the Korean markets, there's so much news flow about Korea that how the retail traders are now getting very aggressive in the margin, the leverage funding, the margin funding is going up in KOSPI. So KOSPI will also come up. But Prashant, lots of headlines once again coming
lots
in
of
from
traffic
Crude.
also.
But you know, at the end of the day, crude is still at 109, right? Exactly where we left off yesterday.
Yeah, absolutely. Morning, guys.
Good morning.
Well, it's a hurried morning, absolutely. And I think let's just take it from the top because oil's the big worry, what has been the big worry for a while. And we are at about $110 odd a barrel this morning. I mean, almost $110 odd. So small fuel price hikes coming through again. So diesel is up about 91 paise, petrol is up about 87 odd paise or so. And this is after, of course, the 3% hike, the 3 rupee hike that we saw earlier. You know, these are demand management measures. I mean, prices have to go up. Yesterday, Sanjeev Prasad was with us saying that, you know, 20 rupees is the difference. 20 rupees is the hike which is needed to plug the losses OMCs are making every day. And they're expecting a cumulative hike of 10 rupees, including the 3 we've seen, but perhaps another 7. I mean, you know, roughly that is their expectation. So for now, the government, of course, is taking it with, is being very, very gentle about it and taking it up slowly in that sense. And we'll talk more a little later on this strategy. Staggered, as we said, when the 3 rupee hike came through as well, that perhaps there is more coming, but the quantum has gone down. Now, U.S. equities basically swung between gains and losses. Nasdaq finally ending about 0.5% lower. S&P was kind of flattish. Iran, of course, offered an updated peace proposal, and Trump on Truth Social essentially, you know, said that they're going to hold off a large-scale military attack on Iran, which was scheduled for Tuesday, which is scheduled for today, and essentially saying that his Persian Gulf allies, America's Persian Gulf allies, have all come together and have basically persuaded Trump that there is a real diplomatic pathway off-ramp to this, and hopefully, you know, a deal will be made. I mean, the Post goes on to say, well, you know, the military is ready to attack at a moment's notice if this does not materialize. I mean, more of the same. But for now, it's kind of stalemate, status quo in that sense. Just to talk about oil and what's happening, U.S. issued a 3rd extension of the Russian oil waiver, which is, of course, you know, India yesterday, for example, at a press conference, government press conference said, well, waiver, no waiver, India continues to buy oil from Russia. And I think we said it absolutely emphatically. The news on the oil waiver came later in the evening. So, you know, it is worth what it is. But I think the government made it very clear that India will buy and is buying Russian oil. And this is before the sort of waiver for countries to be able to buy Russian oil came through. Interestingly, Iran has launched a Persian, basically an authority for the Strait of Hormuz, simply put. And it's called the Persian Gulf Strait Authority, PGSA. This is going to manage the Strait of Hormuz. And, you know, there's Bitcoin involved, there's insurance on offer, et cetera, et cetera. We'll see. They've got their own, Twitter handle, X handle as well. Equities yesterday here in India rebounded, a pretty sharp rebound, 300 points off the lows. But here's the thing, rupee did not. Absolutely kind of, weak close, and we closed almost at the record low. 96.33 was the low. I think we left off there. So with that kind of setup, the levels don't change very much. It's a flattish close on the index, so the levels are the same, 23,800 on the upside. It's basically Friday's high, 23,839. And of course, the gap zone on the way down is about 23,153. So not very much new in terms of cues to sort of be able to push us up or down in a meaningful way, I guess, as we begin this session. GIFT Nifty gives you a sense of how we like to start. I think it's absolutely flat. Nothing really on it. About 4.5 odd points lower. And then we'll pick it up from there. Nigel is spoke to Cross to the Wall with the futures and options positioning and how things are looking. Nigel, take it away.
Well, we'll take a flatter start to kickstart trade today. But yesterday, it clearly indicated a big intraday recovery is what we saw. And it seemed like the bulls, they sensed that Trump may back off a little bit. And that's why probably we saw a big intraday recovery on the Nifty itself. Or probably they were sensing that something will be announced from the center. At least overnight, you've seen Trump back off just in the near term, which is good news for equity markets, us included. In terms of cash flows, the DIs and the FIs, well, they both thought alike yesterday. Both of them were buyers in trade. But you need to keep in mind that the flows were skewed because of the JSW Steel large trade that we saw. GQG Partners, they bought big, into the company at around 1,260 rupees, while SBI Mutual Fund, on the domestic front, they were buyers as well, bought closer under Crow shares at around 1,260 rupees. So the flows yesterday were positive on the institutional side, but they were skewed because of the large trade that we saw in JSW Steel. But there was clearly short covering that played out in trade yesterday because the Nifty from the low saw a good recovery and the open interest was low as well in yesterday's trade. And it perfectly tallies with actually what the FIs did because there was open interest that was down. If you look at the FI activity on index futures, you'll see that, they covered some shorts. Yesterday, 7,500 contracts is what they covered on the short side. And now the short positioning continues at around 88%. But let's pull up a trend chart because you see the way the FI short positions have come down. Just to pull that up for you on the screen, you'll have the FI short positions that have come down from around 2.4 lakh contracts. It's come down to around 2.10 lakh contracts. So closer to 30,000 contracts have got covered on the short side. On the client side, well, they have been booking some profits, in terms of that bounce that we saw from around 23,250 or thereabouts. And they're still net long. But this sort of a combination actually is not such bad news from a market perspective. The FI is being aggressively net short while the clients being net long. You'll want to see more of the same in terms of those covering of short positions, which helps the market to move up. But in yesterday's trade, the FIs didn't just cover the shorts. The calls that they wrote earlier, that as well got covered out because these call writers, they got stuck on the wrong side with the way the markets recovered from the lows of the day. And there were some signs of put writing as well in trade yesterday. 1.7 lakh contracts on, in terms of put writing is what we saw. And pull up a couple of strikes. 23,600 call, that had a good amount of open interest build up. The 23,400 put as well, good amount of open interest build up. So just punching in this premium that we saw at around the 23,600 call, we'll get the near-term level. So in terms of resistance, the 61.8% retracement, that's the first level that you'll be looking at for today's trading session, which comes in at around 23,680 approximately. Then all eyes will be on the 50 DMA, and then you look at the 20 DMA. So in terms of resistance levels, these are the three levels that you'll be keeping an eye out on. Support levels, the recent low as well as yesterday's low, well, they become the important support mark at around 23,250 to around 23,320 approximately. Well, the headline index, hopefully it sees some kind of, buying from lower levels. But yesterday, though we saw some kind of improvement in the number of stocks advancing, you'll want this graph actually to be better because that's what we saw for the last 45 days or so. The number of stocks advancing need to be better than the number of stocks declining. So breadth of the market should improve. And also the India VIX, you don't want it to get past the 20-odd mark. Last few trading sessions, it's gone numerous times till then, but it's got rejected. So that's good news. You want it to trend towards that 15-16 mark. And finally, the Indian rupee, hopefully some signs of stability. Yes, the equity markets rebounded, but you'll want some stability on the Indian rupee as well. So net, we have a work cut out. It's the weekly expiry today. Volatility in the last 60 minutes on the Nifty. But the bulls will hope that after yesterday's rally, you see some kind of follow through as well.
All right. Thank you very much for that. Let's get back to the updates then from West Asia. US President Donald Trump, in a post on Truth Social, has said that he has delayed an attack on Iran that was scheduled for Tuesday. That is today. This is on the request of leaders from Saudi Arabia, Qatar, and UAE. The US president added that serious negotiations were underway and that if a deal wasn't made soon, Iran could be attacked in a moment's notice. When asked by reporters on what he meant by the post, this is what the president had to say.
We were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also. We've had periods of time where we thought pretty much getting close to making a deal, and didn't work out, but this is a little bit different. Now, we're ready going tomorrow, very big, and not something I wanted to do, but we have no choice because we cannot let Iran have a nuclear weapon. There seems to be a very good chance that they can work something out. If we can do that without bombing the hell out of them, I'd be very happy.
All right, let's get William Lee, Chief Economist and Managing Director at Global Economic Advisors, on the show. William, how many times have you started the interview on hope that there will be progress to end the war? But unfortunately, a lot of headline volatility continues, lots of news flow coming in from Donald Trump. But so far, there has been little progress towards resolution. What's your overall assessment of the situation now that the war has gone on for, perhaps 12, 13 weeks now?
I think it shows that the China visit is something that was, I think, an important event because President Trump was saying, we'd like to end this without bombing the hell out of them, right? That was the operative statement. He was prepared to say, let's bring this to an end, one way or the other, and he preferred not to use military force, but he was prepared to. I think that's the message he delivered to President Xi. And let's face it, President Xi could open up the strait with one phone call. Iran is the China client state. Iran is the major seller of oil to China, and China is the only customer for Iran. So in many ways, President Xi could have just said to President Trump, look, if you want this thing, me to end this, I'll end it for you by making the phone call. But I think it's in China's interest also to see the United States squirm, to show the world that the United States is not capable of opening the straits regardless of its military might. And I think the discussion was a nice back and forth between President Trump and President Xi, where President Trump said, look, I am going to start up military action again. And once I bomb out their facilities, you're not going to get any oil. So I think that was the back and forth that went on between them. And I suspect after Donald Trump left, and now with Putin there, China has decided to place a phone call, perhaps indirectly through the Middle East nations that you mentioned, to say to Iran, let's start negotiating seriously. So I think that's the development that might make markets more optimistic if Iran becomes serious. But with Putin on the scene, I think there's a second play going on, which is to say Putin is telling China, we will supply you with all the energy you need. So you don't really have to rely on the Middle East. You don't have to rely on Iran. And I think the pressure now is on the rest of Asia, India, South Korea, Japan. What will you guys do if there is no peace and if the strait is not open? And I think the pressure has to come from you guys, the rest of the Pacific Rim, to China to say, if we are going to be your trading partners in the future, you're going to have to end this situation, and you have to end it very quickly.
I think you answered why China is not helping, right? I mean, as the old saying goes, never interrupt when your enemy is making a mistake. Now, if it's a mistake, not mistake, we can argue, William. But I mean, I think we've spoken about this in the past. But let's just sort of go back to markets, William, if you will. And the new Fed chair is going to be in the hot seat soon. There's apparently a ceremony at the White House later scheduled for later this Friday. So unusual. We don't usually see those. How different will this new Fed chair be, and what does it mean for things like precious metals, gold specifically, and of course, I mean, risk assets like equities as well?
I think that the question for Governor Warsh and Fed Chair Warsh to be considered is whether or not inflation really is going to be a longer term process that is unanchoring the inflation expectations in the marketplace. So far, the long-term inflation expectations are starting to rise, but they've only risen by about a quarter point or so, and they've kind of flattened out. And I think the jury's out as to whether or not the energy situation, the shortage situation that's developing, will persist beyond any kind of in any significant way that monetary policy has to act. And that puts Warsh in a very awkward position where he cannot implement the Warsh maneuver I've talked to you about many times, which is to say lower rates and contract the balance sheet very quickly. The argument that he's going to have to make isn't going to be very effective if actual inflation doesn't come down or stabilize. So in terms of monetary policy ahead and for investors, it'll be more of the same. It'll be more on hold. I think that all this talk about a rate hike is ridiculous. Unless if we see the inflation expectations start to unanchor and rise by half a point or more in the long term, in the 5 years and the 10-year forwards, I don't think we're going to the market should consider a rate hike to be very serious.
All right, short conversation, William, but thank you very much for joining us on CNBC TV 18. Let's tell our viewers then the interactions lined up on the show today. 9 a.m. we'll be joined by Dayanand Mittal of JM Financial Institutions to put the spotlight on the oil and gas sector, the price hikes, the earnings. 9:20, Nimesh Chandan of Bajaj Finserv AMC will be a market master for the day. 9:40, the management of Genus Power Infra will join in. And we'll get into details about the smart metering, what's happening across various states. Towards the end of the show, Yves Bonzen of Julius Baer, the global CIO, will join in to talk about the impact of the ongoing geopolitical tensions on markets and more.
Well, time to slip into a short break. We've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, I give you a sneak peek. IOC, OMCs, GE Vernova TND, IGL, Astral, JK Paper, Adani Group stocks, Eicher Motors, and JSW Steel. All of them will be reacting to positive news flow. On the flip side, you have Afcons Infra that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Our entire research team is standing by with CNBC TV 18's list of top stocks for the day. Good morning, girls. Sona, let me begin with you. First on the IOC numbers. How did they look? How did it compare with HPCL? And then even on oil marketing companies, 1 week, 2 price hikes.
Okay, let's start with the numbers first. IOCL numbers like HPCL were a beat on all parameters. Of course, it's led by a lot of inventory gains, some of the compensation they would have received on LPG, and the petrochemical segment did well this time versus an expectation of a loss. So revenues up 1.5% sequentially. EBITDA was flat at 20,716 crore rupees, but much better than the poll. Margins at 9.9% versus a poll of 6.3%. Profits were down 6%, but again, they were better than the poll, coming in at 11,377 crore rupees. The GRMs, they have not been reported by the company yet, so we'll understand that in the conference call at 3 p.m. today. In terms of EBIT, petroleum products increased quarter on quarter. Petchem was a profit this time versus a loss in the quarter gone by. Gas business saw loss. That was also an impairment that the company had taken in the quarter gone by. Now to the price hike. Calibrated price hikes have come back. After 3 rupee per litre price hike last week, diesel prices have been increased by 91 paisa per litre. Petrol prices increased by 87 paisa per litre across the country. And OMCs, remember in yesterday's briefing, the oil ministry did indicate are making losses of 750 crore per day now versus 1,000 crore per day that they were making before the 3 rupee price hike. So yes, the losses have reduced, but the losses are still there. So maybe more price hikes would be needed. The calculations indicate around 11 to 12 for petrol, around 20 rupees for diesel. But yes, this will come as a breather for oil marketing companies because finally they are able to recoup some of the losses that they were making on the marketing front.
Got it. Okay, all right. Thanks a lot for that, Sonal. Well, let's across to Vinny. She's here to tell us about GE Vernova TNT. Morning, Vinny.
Hi, good morning. So the company has actually reported a good set of numbers in Q4 FY26 as well. Revenue came largely in line with expectations, but saw growth of around 42% on a year-on-year basis. Now, what came in as a positive surprise was the margins. EBITDA margins that came in at 27% versus last year of 21.8%. And expectation was somewhere around 25%, so much better than what the street was expecting. And this is a main indicator that we'll keep an eye out on because the street was worried that maybe the margins for the company had peaked. Now, they've still managed to do well. Gross margins overall supporting the overall performance, so operating performance very strong. Apart from that, order inflows that grew by around 188%. 8,610 crores is what the order inflows stood at for Q4 FY26. But do not forget, we know that big order, HVDC order of South Olpad, that is also included in this, and that was known to the market. So that has come in Q4 FY26. Now, apart from that, the company has also made an announcement of 55 crores incremental capex that they are looking at. So that is something we'll keep an eye out on. More details will come in only from the con call. But as of now, good numbers, margin beat coming in, and maybe we could see some green here despite the run-up that the stock has seen in the last 1 year.
Okay, all right, Vinny, thanks very much for that. Well, let's move on and let's focus on IGL because Sonal is here with details. Sonal, morning.
Good morning, Prashant. Well, going with green on IGL because of that mild volume beat that has come by for the company. Overall numbers were quite mixed. Revenue slightly higher than the poll at 4163 crore rupees. EBITDA was higher as well at 423 crore rupees. Profits lower at 277 crore rupees and margins came in at 10.2%. As I said, overall volumes, they were at 9.7 MMSCMD, slightly better than the poll of 9.5. They were up 5.6% YOY, around 3% on a sequential basis. Gross margins were flat on a YOY basis, a slight decline on a quarter-on-quarter basis because of a higher gas cost that the company saw this quarter. Nomura also says while overall the numbers were mixed, overall volumes were higher than the poll and they have a buy rating on the stock. Now, do remember margins, they are trying to recoup that because the company has increased CNG prices by 3 rupees per kg in 2 steps in last week, in the week gone by itself. So that will help margins a little bit. We'll speak to the management today and understand what the price hike trajectory is going forward. But for today, could see some green on IGL.
Okay, all right. Thanks a lot for that, Sonal. Well, let's go across to Upasana. She's here to tell us about some more earnings that came in overnight. Morning, Upasana.
Good morning, Nigel. First up, let me start with Astral. Well, the Q4 numbers were much below the poll estimates on all fronts across board. Now, net profits saw a growth of about 20% on year-on-year basis, while the revenue growth stood at just about 24% versus the poll of 30% growth that the street was factoring in. Margins saw an uptick of just about 30 basis points at 18.3 versus the poll of 19.2, so much below as compared to the poll numbers. Now, plumbing business, which is the key of the company, FY26 volumes here saw an uptick of nearly about 16% on year-on-year basis. Next up is Afcons Infra. Overall, it's been a weak set for the company. Company has missed its own reduced FY26 guidance. Revenue down about 19%. Margins stood at just about 1.6% versus 9.1% on year-on-year basis. Company has also reported a net loss this time around of nearly about 89 crores versus the net profit of 111 crores. Order book of the company stands at 32,496 crores, and FY26 order inflow has come in at nearly about 4,100 crore with a guidance given by the company earlier in Q3 of 20,000 crore. So a big miss on that front as well. And if we talk about the FY26 revenue growth, it is down 5% versus the guidance of 5% growth that the company had guided in Q3. So overall, it's a miss on a big time. Now coming to JK Papers, overall it's been a good quarter for the company. Revenue has seen an uptick of 17%. EBITDA margins have also expanded from 13% to 14%, and PAT has also seen an uptick of nearly about 32% on year-on-year basis. Company in terms of volumes have also achieved its highest ever paper and board sale volumes in terms of 8.19 lakh MT during FY26, and company has also maintained its leadership position is what they have highlighted. So overall, going a green with JK Paper and red for both, that is Astral and Afcons Infra.
Thank you very much for that. For more earnings, for more stocks and news, Sudarshan now joins in.
So first one, I'll start with Adani Group. There are two cases for which we have got the outcome from US court. So in the first case, US court has dismissed the criminal charges against Adani's Gautam Adani, Sagar Adani, Vineet Jain and other defendants, and that is done with prejudice. So with prejudice is a legal term meaning an action or decision is final, permanent and binding, and this comes after US DOJ, that is Department of Justice, had submitted the motion seeking dismissal of indictment with prejudice. It has said it has reviewed and decided not to devote further resources to these criminal charges. In the second case, which was related to Iran's sanctions, US Department of Treasury has agreed to a $275 million settlement with Adani Enterprises. So will be positive for entire Adani Group companies. Second news related to Eicher Motors. Royal Enfield is going to secure a land parcel in Tirupati in Andhra Pradesh for a greenfield manufacturing facility with an investment of 2,500 crore. So company is currently operating 4 manufacturing facilities in Tamil Nadu, and recently it had said that one of the facilities will be expanded, and with that capacity expansion will increase to 2 million units from the current capacity of 1.46 million. So that is also positive for Eicher Motors. Last one is JSW Steel. Yesterday it had seen block deals of almost 3,150 crore rupees, in which JSW Energy had sold 2.5 crore shares. Yesterday in the evening we got the block deal data and we got to know the name of buyers. GQG had bought 1.5 crore shares at a price of 1,260 rupees per share, and another buyer was SBI Mutual Fund, which bought 1 crore shares. So I'm going with green for JSW Steel.
All right. Big capacity expansion plans there, and we had the management with us earlier. Thanks very much. So for that, here's a quick recap of the stocks with positive news flow. IOC, oil marketing companies, GE Vernova, TND, IGL, Astral, JK Paper, Adani Group's names, Eicher, JSW Steel is Sud mentioned. Afcons is the only name with some negative news flow. So that's a lineup of top 10 names. Manisha is here with a roundup of the commodities space. Manisha, good morning.
Morning, and thank you for that. I'll start with the crude oil prices because we've seen that slipping below $110 a barrel. Yesterday, overnight, there was a point that we traded around 112 as well. With U.S. holding off on a planned attack on Iran on Tuesday, and then this is being done on request from Saudi Arabia, Qatar and UAE, is something that has led to some geopolitical premium coming off the prices. U.S. also allowing sale of Russian oil and products on tankers till 17th of June seems to have done the trick as well, because much of Asia will get that oil in now. So availability is something that the prices are seeping in. With the slight decline in energy, the money seems to be rotating back in case of the metal prices therein. So you have the gold and silver prices trading on the positive side, with hopes growing that the U.S. and Iran may return to negotiations. Markets also are waiting for the FOMC minutes that comes in this week, and the flash US PMI also will tell us on where the markets are headed from here. HRC steel is trading at 28-month highs. Copper prices gained up by 2% overnight. Aluminum continues to outperform. Zinc is trading in the positive as well. So energy has seen a decline, but metals back in favor.
Thank you very much for that update. We will get into a break. On the other side, we'll connect with Hindustan Copper Sanjeev Kumar Singh to discuss the company's performance in the quarter gone by. Later, we'll connect with Mayuresh Joshi for some fundamental stock talk. Stay tuned.
Well, Hindustan Copper, that's the first management on the show. It reported a good set of numbers in quarter four. It also recorded record profits, in the past quarter. To discuss, though, what's the way ahead, we're joined by Sanjeev Kumar Singh, the Chairman and Managing Director of the company. Hi, Mr. Singh. Thanks a lot for joining in here on CNBC TV 18. It was a record quarter, but tell us about the way ahead. What's the copper ore volume guidance you're giving us in FY27 from around the 3.7 million tons you did in FY26? And more importantly, will the MIC grade improve from approximately 0.75%?
The production is concerned, from 3.67 next year, we'll be producing about 4.7 million tons. And the breakup is that 3 million will come from Malanchkhan, 1.2 will come from Khetri mines, and 0.5 will come from Ghatshila mines of Jharkhand. In fact, in the last interview, I said in 26-27, the full portion of the Ghatshila mines will come in our results. It will give you the full picture. The full picture of the Ghatshila will come in 26-27. So this is my growth plan. It is about 25 to 28% with respect to current year. And as far as grade is concerned, we are trying to improvise, but see, it's a nature's deposit. Whatever we get, we mine it. But we'll try to see that it is around 0.76, 0.77. We improvise on that. But as you know, we are going down. It's a worldwide phenomena. If you see that grades have gone down as you have deepened the mines.
Got that, Mr. Singh, in terms of ore production, at around 4.7 million tons. But what grade are you factoring in, and what will it mean in terms of metal in concentrate volumes for the coming fiscal?
Yeah. 36,000 tons. In fact, it will be slightly, not 35, but it will be in the range of 33, 34, 33 plus. And 33 plus, yeah. That should be, because see, suddenly if a grade comes down, that hampers a lot. We assume at the initial year, in the April, we assume X grade. And suppose it comes to 0.9X, then the direct effect of the grade is on the production of MIC.
Okay, so we've got the volume factor then out of the way. 33,000 tons is what we're looking at in terms of MIC volumes. What is the copper price range, though, we should work with for the coming fiscal? Is there a bit of a shortage in the global markets?
Well, that is true. In fact, I had promised you that we'll maintain the EBITDA margin around 40%. We have maintained that. And similarly, the momentum which has been started in 25-26, I can assure you this will go on, and we expect to continue this momentum, even in the Q1 also, or the whole year of 26-27.
Yes, sir, but what is the LME price range you're working with? And if you could, tell us about the margin outlook, because in the past quarter, the margins are already at 50%. You're talking about 40%.
The price I can't say as of now because it's very volatile. But as far as margins are concerned, EBITDA margins, we will maintain that 40% plus. Will maintain that.
Okay, got that. You're being conservative, I think, yet again at around 40% margins, but I'll take that point on board. In terms of the rupee depreciation, the street is a little bit cautious. Everyone's a little bit somber with regard to the way the rupee has been moving. But I understand it's a positive for Hindustan Copper, I guess, because your costs are in rupees, but the weaker rupee will aid your realizations. So could you give us a number with regard to how it helps you? And also, do you export any concentrate?
See, definitely the depreciation of rupee is very good for Hindustan Copper. But as a SCL team member, I can say it's good. But as an Indian, I think it's not good because we are paying more dollars outside. And the economy is in real trouble, I should say. But as far as Hindustan Copper is concerned, really, we are in good picture. And 1 rupee depreciation of a dollar, I had told you last time, we get an effect of 15 to 20 crores plus. Secondly, you had asked me about this, the grade or what you mentioned. Nowadays, we are not exporting. We used to export even in the last year, in the third quarter or second quarter, we had exported some material. But we don't try to export because here there is a huge demand in the country itself. And it's sold on the LME, so no question of to export when there is a huge demand in the Indian market.
Okay, so domestic focus is what you're telling us, and the Indian rupee depreciation is actually good for you, 15 to 20 crores. Got that. Is there a fundraise, though, in the works? You've laid out an ambitious CapEx plan. Is there a QIP that you're looking at?
See, as of now, I can tell you for 26-27, the funding is there through internal accruals. We have good amount of money with us. 27-28 also, the majority of the fundings will be through internal accruals. We have got our own money, so we'll be spending on that capex. But we have made the provisions for QIP, for bonds, and we have taken, there is a provision, but I don't think that will be needing in this year or even the next year also.
Okay, all right, Mr. Singh, that we've got most of the details with regard to the copper business. Now, reports suggest that tailings in Jharkhand have uranium. And there are reports also that are suggesting that you're looking at extracting uranium and you're partnering with the Uranium Corporation of India. Give us some details on this particular venture that you're looking at.
We have reached to an agreement with UCIL that we will give them our tailings, which we are mining there in those 3 mines as of now. And if any of the other mine also comes in near future, we'll share the tailings with them. And they will make up a uranium recovery plant. And from that recovery plant, they will extract the uranium which is there. That will be free of cost because all mining costs will be incurred by Hindustan Copper. And then they will return back the tailings which we will put in back to the mine. So this has been already agreed and they are moving to these proposals to their boards and all that. And soon they will be putting up a plant in Kachila. We have provided the land and other things. Already it is there. It was earlier also the same area we have given. Even if they need more area, we are ready to give that. So that will be given to them. So this is one of the important things which we should think from the country's perspective, from the India's perspective, I should say. If you generate uranium from these tailings also, that will come to country's help.
Got it. Okay. Mr. Singh, it all boils down to what net profit you're going to do. So what is the guidance for FY27 on net profit? For the next few years, you've laid out this guidance of 600 to 700 crores. It doesn't cut, sir, going by the production levels, the current prices as well. In fact, Anand Rathi is a brokerage that is estimating around 1,650 to around 1,700 crore rupees of net profit. Is it gettable?
No, don't commit any figures from me. But I tell you, as a SCL team member, I can rather promise to you that we will definitely do better than this year. This is 100%, I'm sure we will do it. See, SCL team is a wonderful team. In fact, you are monitoring us for last 2 years. We will do something definitely better than 25-26. But don't ask me for any figures on PAT.
Push you a little bit, sir. Can we assume, that your net profit goes up big time in FY27? For example, last year you did around 1,000 crores. So 50% higher in FY27 versus FY26?
I'm not that good in mathematics, but I can tell you one thing, we are expected to do much better than what we have done in 25-26. I can assure you from this particular platform.
I think, sir, you're following that mantra, under-promising and over-delivering, but we'll take that point on board. It'll just be better. So it'll be more than 1,000 crores in this year. Final question, sir. It's always a temptation. When things are looking so good, a promoter entity could look to take off some money off the table. Have you heard about a probable OFS from the government of India?
No, Nigel, I don't have any information and I'm not capable of answering these particular questions. I'm just after production, MIC, and the support which I'm getting from Government of India and respective state governments. I'm after that. I don't have any answer to this.
Well, it's a pleasure talking to you, Mr. Singh. Thanks a lot for speaking to us exclusively to CNBC TV 18. And thanks for giving us the guidance. We'll hold you to some of these numbers. And I think on the profit number, that could be a surprise in the works. But thanks for giving us those details. Well, let's get in Mayuresh Joshi, Director of Research, Markets Midinda, who joins us on the show. Hi, Mayuresh. Good morning. Good to see you in. Let's talk about Hindustan Copper then. That was one of the metal stocks that did well in yesterday's trading session. Numbers look good. The management is, talking about very, very subdued estimates going by what they're saying. Not just guiding for a better FY27. It should be much, much better going by the prices and volumes. What is your take on the stock?
Morning, Nigel. I think very conservative in my opinion as well. And I think you've asked all the right questions to the management right now. I think the expectations in terms of the LME spot prices as far as copper is concerned at this juncture, and if you probably take an average of the past quarter at around 13,500 metric ton, and even if one probably assumes that a lot of mine shutdowns that you've seen globally over the past few quarters, partially I think the production starts coming up, supply starts improving as we speak over the next few quarters. And there is some element of a correction in terms of the spot LME prices as we see right now. With the expectations of volumes ramping up for Hindustan Copper quite significantly, and the value adds that they're probably also entering. My own sense is that it's a very, very conservative estimate in terms of both EBITDA as well as the profitability that the management is probably putting forth. I think it's more in terms of having a cautious stance, whether there is accelerated supply that probably comes through and copper prices come down quite significantly, offsetting all the gains that we've seen in the recent few weeks. But in my opinion, I think a pure copper play, expectations in terms of demand applications, the drivers probably remaining AI, data centers, etc., EVs, I think that will prop up copper volumes over the next few quarters and years as we speak. So anybody putting in this copper insurance.
156% rally in the last 1 year for Hindustan Copper. Mayuresh, Adani Group stocks. Adani Power has rallied 53% since the start of the year. Adani Green is up 35%. Adani Enterprises Ports have moved up 20-25%. And now it looks like all that litigation, with the US DOJ, SEC now seems to be dropped with prejudice. But do you still think that this was an overhang on the stock prices or not really? Because you can see the way the stocks have moved up and therefore it doesn't matter too much, or it does matter in terms of capital raising, foreign capital raising from the US. How would you assess this news and the impact?
Morning, Rima. No, I think a large part of this news was getting gestated into the market. And again, I think a big overhang is probably now done and dusted with. Now, what this also does is that a lot of plans in terms of raising capital overseas had been put on hold. And therefore, once we receive a complete resolution of sorts on this issue, and this is put to rest, I think the Adani Group probably has far more options and optionalities available to raise capital. They had dropped a lot of these plans in lieu of a lot of charges coming through, starting from Hindenburg to the latest one. And therefore, I think the cost of raising capital at a much diversified means in the first place, and more in terms of a more cost-effective manner in terms of the blended cost of capital raise, both from domestic and global sources combined together, will put them in a strong position across the capex plans that they've got. Obviously, I think the leverage position across the group has improved quite significantly as we speak. And therefore, this news is sentimentally very, very positive for the Adani Group stocks. But again, a lot of that is already in the price.
Okay, all right. You told us about Hindustan Copper. What about Tata Steel? Actually, the numbers looked good. It came out on a bad day and the stock had already seen a run-up. But going by the numbers, going by the way steel prices have firmed up, I think there's a bit of a structural change that's taking place in China. They're producing less and they're exporting less. That's good for global steel prices. And in India, the per capita consumption of steel has moved to 100 kgs. Now, that's a sharp uptick from what we're seeing, and the global averages is 220 kgs, which we will start heading in that direction since we have crossed the century mark. What's your view on Tata Steel among the Ferris pack? What do you like?
I think SAIL also gave a good set of numbers. Yes, therefore, I think my own sense is that Ferris has performed really well. Tata Steel is something that we continue holding in our global portfolios. And you are absolutely right. I think the expectations in terms of its overseas operations, specifically what happens with the UK and Netherlands, I think the entire push mode that is probably happening in terms of producing green steel, Tata Steel has probably embarked upon that. In lieu of both the global regulatory standards as well as ensuring that they probably also stick to their strategic goal plan of producing green steel over the next few quarters and years. In terms of expectations of realization growth, obviously, I think the Chinese factor when it comes to steel production and consumption, and generally the metal space as a whole, becomes a very, very critical point. As we see it and as we are interacting with our Chinese team, I think the expectation is that over the next couple of quarters, to say the least, I think it will be more inward focused as we speak, rather than dumping a large part of these commodities across the globe. And therefore, I think LME prices should remain relatively stable. The integrated operations and the mining part of it, specifically when it comes to the domestic part, should see significant amount of value addition as we go forward. And therefore, I think expectations of domestic volume stroke standalone revenue and EBITDA growth should be reasonable. And the subsidies have also performed reasonably well. So I think we see no cause of concern as far as numbers are concerned and continue holding Tata Steel.
Got it. Okay, all right. Thanks a lot for that, Mayuresh. Request you to stay with us for the time being. We'll slip into a short break. Come back. Mayuresh will continue our chat that we were having. We'll also be joined by our technical experts. Nitesh and Sudarshan are waiting for us.
Welcome back. There's 12 minutes to go for the pre-open session. Let's just quickly look at the GIFT Nifty. Any change? Whoa, this is a big 1.5 point change on the index this morning as we are looking at the market open. So lack of triggers, I mean, and no real new information, news flow, as I was saying, which helps things around and will move things around in a significant way. Well, in terms of single stocks, there's lots of action. Crude yesterday put out a long list of stocks which have seen big moves post earnings. I mean, day zero moves. So there's been no dearth of those. Hormuz is here, as always, with the big movers from just yesterday. Stuff which saw price action with heavy volumes as well. Hormuz, take it away.
Morning, Prashant. Unsurprisingly, their earnings reactions as well this time around. Amber Enterprises was the big loser in yesterday's trading session. In fact, the stock was down 16%. It's the biggest single-day fall that the stock has seen in 4 years, back all the way to May of 2022. The premiums on the 7,000 put option, it was the most traded option yesterday, up almost 5x in yesterday's trading session as well. The volumes yesterday were the highest in 6 months. Over 21 lakh shares were traded. The 20-day average was around 3 lakh shares, so 7x its 20-day average. And 20% of those shares on mark for delivery. So 4.5 lakh shares for delivery. The 20-day average is less than a lakh. So it's sort of 5x their 20-day average on this regard as well. The stock is down 20% from its 52-week high of close to 9,000 rupees that it had hit just on the 7th of May. Of course, most of it came in yesterday's trading session. GE Shipping was the one that the stock did well on Friday, extended those gains on Monday as well. Here too, it was the biggest single-day gain in 4 years. And it was the stock is up 14% in the last 2 sessions. It snapped a 4-day losing streak on Friday. In fact, Monday's volumes were almost double that of last Friday. And the volumes, if you put together Friday and Monday's volumes, they are the sum total of the last 44 sessions combined. In fact, on Monday, we had less than 2 crore shares that were traded. The 20-day average is less than 11 lakh shares, and 11% of those were marked for delivery. So around 20.5 lakh shares for delivery. The 20-day average here is just 3 lakh shares. And in fact, GE Shipping was the most traded stock on the Nifty 500 on Monday, and the stock in fact hit a 52-week high, up over 50% so far in 2026. And another earnings reaction yesterday was Gland Pharma. On the positive side, the stock was up 15%, with the biggest single day gain since August of 2023. In fact, it was the first time in almost 9 months that the stock closed above the mark of 2100. It was the top Nifty 500 gainer on Monday. In fact, the volumes yesterday were the sum of the last 67 sessions put together. The volumes were the highest since June of 2024, and over 70 lakh shares traded. The 20-day average is only 1.5 lakh, and out of those, close to 20% were marked for delivery. So 13 lakh shares for delivery. The 20-day average is less than 1 lakh here as well, and this too hit a 52-week high in Monday's trading session, extending its 2026 gains to over 25%.
Thank you very much for that. Mayuresh, you want to comment on Amber? That was the big miss yesterday. What's the call?
No, Remus, I think we have not added that in our portfolios, and we are waiting and watching. Again, I think the expectations in earnings delivery for Amber, I think that was a huge miss as far as the numbers are concerned. And therefore, I think the hope is that with a lot of PLI expected to come through, the added benefits in terms of orders flowing, the way of these EMS manufacturers to a large extent, and the expectations in terms of their own products actually improving the market share and the margins as well is something we watched out for. But that is actually really shine a bit.
Okay. What about the other momentum stocks that Hormuz was talking about? GE Shipping is one, which saw its single biggest day gain yesterday, up since May of 2022. Stock has gained about 14% in the last 2 trading sessions. And the other one is Gland Pharma. Do you all track it?
Absolutely. I think as a clear disclaimer, G is something that we continue holding in our local and global portfolios. And in fact, this entire gamut, right? If you look at Shipping Corporation, G Shipping, CMAC has come with a great set of numbers as well. And in fact, it all started with Bari, I think the South Arabian oil tanker company, which has a large VLCC and gas and chemical tanker business. I think outstanding set of numbers, and their commentary was mind-blowing as well. So the expectations in terms of the after effects of the Middle East crisis has actually put up or pushed up spot prices when it comes either for bulk shipping, bulk ships, VLCCs, gas tankers as well, sheerly by the shortage of it. But even if you go beyond this crisis, I think the expectations of fleet addition are expected to be marginal in nature. The expectations of scrapping of old ships might probably just go up a tad bit. And therefore, the dead fleet, or the cold fleet, as they call it in the shipping industry, is significantly higher as we speak. Again, the offshore business for both the G, CMAC, as well as SCI I think that can have some element of an accelerated run. Because what we've seen probably emerging from this crisis is that a lot more exploration will start probably happening, giving a lot more impetus to the ancillary segment of the offshore segment as we see it. So yeah, I think a little biased, but continually being positive on this. Gland is obviously one number from the pharma space, which was outstanding as well. I think the expectations in terms of more launches coming through the semaglutide launch and the management being very, very hopeful of higher EBITDA margins is something that can keep the stock in good stead. But we don't hold this stock in our portfolio.
Okay, all right. Any view on the cement pack, Mayuresh? You have some of these smaller guys that have delivered pretty okay numbers. The big boy Ultratech Cement, well, that execution has been par excellence. But what's your view in terms of a pecking order? Ultratech has been the big daddy. Shree Cement has been a big underperformer of late. And Ambuja Cements as well has come off drastically from the top. Would you go with some of these big boys or would you look down the order?
So I feel as far as the cement pack is concerned, I think we still continue remaining with the leadership stocks because our belief is that the industry is clearly consolidating as we speak. In terms of both organic and inorganic growth, when it comes to capacity additions, I think it will be very, very calibrated, and therefore I think pricing should remain in favor of these cement players. Obviously, input costs have gone higher, and therefore the Q1 numbers will be a little bit on the softer side. They will be passing it through, but not completely. But they're trying to compensate that in terms of both the power consumption that is probably happening internally as we speak, and creating these hubs close to delivery centers, which reduces the overall logistics costs as well. Having said that, I think Ultratech is something that the ratings and rankings at Markets with India still exhibit very, very strong growth levers. And therefore, this is one stock that we still continue remaining optimistic about. And within the mid-cap pack, as I've always maintained, JK Cement, which has a good mix of white and grey cement, should continue to grow.
Thank you. Stay on, Mayuresh. We need to slip into a very short break. We'll come back and connect with Dayanand Mittal of JM Financial Institutional Securities. We'll put the spotlight on the oil and gas sector. Stay tuned.
Welcome back. 17 minutes to go for the market open, and we'll get a sense of the rupee before we'll get a sense of the actual open on the market. And I guess the number one cue is what's happening with the currency. Mitesh is with us. So Sudarshan, gentlemen, good morning. Great to have both of you here. Thanks for joining. And so yesterday, of course, from the lows, there was a powerful 300-point move. Sudarshan, where does it leave us, and how would you trade it?
Well, yesterday's decline was okay, but that powerful move was completely unanticipated, at least for me. So I remain surprised.
For everyone, Sudarshan.
All right.
Yeah.
Now, the Nifty has a trading range
and the upper end of the range is 23,800. It's very difficult now to create a trade inside this range. And therefore, for me, if a breakout above 23,800 happens, I would like to go long. Till then, this is not even a shorting opportunity. There is a news event which we know nothing about. So the only trade is a breakout above 2300 is a long trade, otherwise nothing.
Got that. Mitesh is also joining in. Mitesh, the action on the index was very strong with that recovery that we had, but the small caps underperformed. The small cap index was down 1.5% nearly. The advanced decline ratio was 1:3. What's your call for today? Do you sense a breakout above?
See, my understanding is that very clearly, I think, this is a market which is slightly kind of ranged and not giving a directional bias. So yesterday we kind of, on the Nifty, hit the lows or close to the lows which we made on the 13th of May, which is Wednesday, which is around 23,260 was the low then, and 23,300 was the low yesterday. So 23,300, 23,800 is what I'm looking at as the potential range. There's also condition of moving averages around this 23,850, 900 zone. So basically 23,800, 900. I think once this is cleared, then we'll have a stronger move. Otherwise, it will still be choppy and a range kind of market.
All right, let's talk stocks then. Mitesh, what would you go with?
Yeah. On the stock side, I have a mix of buys and sells. On the buying side is Page Industries, which is a buy with a stop below 37,000 for targets of around 38,500. Coforge is a buy with a stop at 1324 for targets of around 1,400. A sell on NTPC with a stop at 390, targets of 375. And a sell on Delivery, which kind of declined after good numbers. That's not a very positive sign. So Delivery is a sell with the stop at 462 half for targets of 440.
Got that. Sudarshan, what about you?
I'll have two buys and two sells. Nykaa is a buy with a stop under 265. The stock is consolidating after a very decent up move. That consolidation gives the impression of breaking on the upside. PI Industries is also a buy, absolutely similar pattern, uptrend, consolidation, likely breakout on the upside. Buy with a stop under 3,040. Paytm is a short with a stop above 1130. And Dabur is a short with a stop above 465. So two buys and two sells.
Okay. Got that. Any breakdown that you're seeing in Amber Enterprises? That's the big stock which collapsed yesterday, 15% lower. Sudarshan, would you have a trade?
Well, I have a trade, but that would be a buying trade because the stock chart is otherwise very conducive. Now, you see, sometimes stocks react to news events and then perhaps overreact. So once the dust settles down, it's a buying opportunity.
Yesterday, Amber, Sirma sold off. Keynes is down some 30% in 6 days. CG Power was down sharply. So lots of these, players in the EMS manufacturing kind of spaces. I mean, actually, even names like Uno Minda, Data Patterns, they was just generally selling in a lot of these names. Mitesh, any of the other names that I mentioned apart from Amber strike out to you?
Yeah. Amber is something, which had a big breakdown yesterday, and I was looking at the charts and it opened some 7% gap down, and then I didn't give a sell, but I think the breakdown suggests that the stock will head towards 6,600 to about 6,500, 6,480. I think that's the zone which I'm looking at. On the others, I think Silma has come to its support levels after correcting from 1150 to about 960, 970 now. That's where the 34-day exponential average is placed. That's also, a little below is weekly pivot at about 900 levels. So around 950, 900 in the stock can do some base building. I think it will go through a good reversal.
Got that. TVS Motor, Mitesh, any thoughts? There was news yesterday as well. It was ended slightly lower. It's been a very strong stock otherwise. How are the charts looking?
Yeah. TVS Motor has had, some negative crossovers, which is not positive, which is obviously, means that the stock price could go through correction. But if you look at the historical price, in the month of March, the stock did some good consolidation around this 32.80, 32.70 mark. And I think if it breaks that, then I think it would start at least a negative or a corrective trend with a minimum target of 30.60 to about 38.
Okay. Gentlemen, we'll come back to you. The rupee continues to open on the weaker side, 96.37. I think the low yesterday was 96.39. So we're pretty much there with the opening today, 96.38. Let's put the spotlight now on the oil and gas space. Dayanand Mittal, oil and gas telecom research analyst at JM Financial, now joins in on the show. Dayanand, morning and thanks for joining in. This is Rima here. Second price hike for the oil marketing companies in terms of petrol and diesel in a span of 1 week. And this time the quantum is lower, 80, 90 paise. So it doesn't make splashy headlines. But if you continue to do these periodic hikes, it will go a long way in recovering the under recoveries. Do you expect more such smaller hikes, but coming more frequently?
Yeah, good morning. Yes, so this is positive for OMCs. So original expectation when this fuel price hike rumor was going on that given OMCs are losing somewhere in the range of 15 to 17 rupee per liter to get back to normalized earnings, there would be at least a 5 rupee hike or so. So given 3 rupee hike came in, 90 paisa today, maybe some small follow-ups which won't happen. So it will at least help to bridge at least 1/3 of what they would ideally like to do. Can government do sharper price hike, let's say 10 rupee price hike? Maybe yes, over the next couple of months, if let's say the Strait of Hormuz issue continues to remain a challenge for us and oil remains upwards of 110. So broadly at $90 Brent is where OMCs earn their normalized earnings, and at $100 or $102 Brent is where they reach a position where their EBITDA is zero. Currently, obviously, they're incurring huge EBITDA losses.
So you expect another 10 rupee price hike over the course of the next few months if crude remains at current levels of 109?
No, definitely not 10 rupees. Given OMCs have a strong balance sheet after last 2-3 years of strong earnings, the net debt to equity is down to 0.5, 0.6 versus peak net debt to equity of 1.2. So they have the ability to take almost like a 2 lakh crore debt in case the worst were to be factored in. So they can absorb this 70,000-80,000 crore of quarterly losses for 2-3 quarters. And hence, I think if let's say crude stays upwards of 110, consumers will take about 1/3, maybe 40-50% of the hit. OMCs will have to absorb 5, 7, 10 rupees hit. So I think another 2-3 rupee hike maybe over next few weeks, but not 10 rupee for sure.
I mean, they are backed by the sovereign, so they can take they can see losses for long periods of time. That's fine, but they're also listed, and that's where the problem from a shareholder point of view. This argument there, Anand, which is made, and I was wondering if you've thought about it, which is like prices were unchanged, even as retail prices were unchanged, even though international prices fell for the last few years. So they made gains, and now they should actually pick up the burden. How would you respond to it? I mean, at a basic level, I mean, it's not as if the money accumulated is sitting there, right? I mean, it was paid out. Share of profits, dividends, etc. I mean, just your thoughts.
Yeah, so to your first question in terms of sovereign and its unlimited debt raising ability, but point to note here is they are the ones who are incurring huge capex to set up refining petrochemical plants, many of which are strategic from a country perspective and maybe not be a commercial in entirety. So they need to have a decent balance sheet size to do those kind of capex despite being sovereign. Second, to your point of, yes, they made good money last 2-3 years, FY24 to 26, but that was on the backdrop of they're losing almost like 80,000 to 90,000 crore in FY23 when crude jumped upwards of $100 post-Russia crisis. So a large part of that last 3 years' earnings went to recoup those losses. Yes, but still on a net basis, they still earned higher money. Difficult to put a number, but yeah, they earned higher, and hence next, probably FY27 is where probably it would be partly used by the government to kind of rescue consumers to some extent. So yeah, partly the argument makes sense, but a large part was to recoup the FY23 losses also.
And that FY23 losses perhaps was maybe justified because there was a period of gain sometime in the past. It depends on how far you want to stretch that timeline too, right? But it's always short bursts of profits and then losses, and this of course been a problem with oil marketing companies. But across your coverage universe, Dayanand, for investors, is anything looking like a opportunity? Is anything looking like it's pricing in the worst I'm not just talking about OMCs.
Yeah, so we continue to like ONGC, Oil India. We think one thing which government has realized is oil and gas exploration. We can't just leave it as it is. We need to get serious. This crisis is further exposed at risk. Government has been taking measures to attract global oil majors like BP, Shell, Exxon. So far, there haven't been much success. Maybe BP partnership with ONGC in the Mumbai high field was one example. We need much more similar kind of a partnership or investment with global oil majors, so that at least we should be sure that if we genuinely don't have oil and gas reserves, or we haven't explored much, and maybe our companies, because they're not technologically as similar to ONGC BP. So is it because of that? So windfall tax for ONGC All India, which is a key market concern, we don't see that risk playing out. So we think ONGC All India is still discounting about $70 odd net crude realization. I think market should, given our view that crude will remain around $85 for a year, even after Strait opens, and maybe 75 thereafter. I think ONGC All India still has a 15% upside even after recent up moves.
Do you want to quickly comment on the numbers? The numbers that came through from IOC and IGL and BPCL is later today.
Yeah, so IGL numbers, given the muted expectations, were slightly better. Volume growth has been a key challenge because of EV-related impact in Delhi, but volume growth was up like 6% odd YOY, so some shy of relief. Needs to understand from today's call, afternoon call, whether this is sustainable. Can they do 8-10% or not? Margin, they had a couple of one-off gains because of cut in transmission tariffs, so margin was also slightly better. IOCL, they haven't declared the GRM numbers as of now. The overall headline numbers were better than our sense street expectation, maybe similar to what HPCL did because of marketing earning, and probably largely because of low-cost inventory that all these OMCs have during Feb month, which they would have accumulated and used during the quarter. So decent number. For OMCs, obviously, the key challenge is the losses that we are incurring right now. So probably last quarter numbers may be largely ignored by the market as of now.
All right, we'll leave the conversation here. Thank you very much for joining in. It's 9:10. Time to get back. Sudarshan and Mitesh back on the show. Sudarshan, your call?
It's Nykaa. Buy Nykaa with a stop under 265.
Okay. Mitesh, yours?
I'll also go with a buy call, and that, sorry, just one. And that will be paid industries. So buy here with a stop at about or below 37,000 for targets of 38,000.
Okay, so two consumer names on your list, Nykaa and Page Industries. Gentlemen, thank you. We'll come back to you. For now, let's go across to our Sudarshan for the brokerage call of the day.
So we have two brokerage notes on Vodafone Idea from Nomura and CLSA. Both these brokerages have downgraded Vodafone Idea but have increased the target price. So first talk about Nomura, downgrade to neutral and target price is increased to 12.60 rupees per share. It says subscriber and average revenue per user trends will be key monitorables going forward. And as far as key catalysts are concerned, first one, successful debt capital raise that if company manages to do. Second, if there is industry-wide tariff hike. Third, reversal of subscriber loss trend, and fourth, strategic equity investment if company announces going forward. CLSA has downgraded to hold and target prices increased to rupees 13 per share. Next one is CLSA has also returned Coforge. It maintains high conviction outperform with a target price of 2,075 rupees per share. It sees company as a top beneficiary of the AI cycle and strong execution reflecting after the Encora acquisition is also reflecting in this guidance that company has given for FY27, and exiting Indian government project help company improve free cash flow to profit conversion guidance, and that's the reason. There are some of the factors why CLSA is positive on the stock.
Okay. All right. Thanks for that. Just want to also address the Adani Group companies, and there's been a fair bit of news flow around it. So back to you on this.
So there are two cases for which that we have got the outcome from U.S. court. So first case, U.S. court has dismissed criminal charges with prejudice against Sagar Adani, Gautam Adani and Vineet Jain. And with prejudice is a legal term, which means an action or decision is final,
permanent and binding. And this comes after US DOJ, that is Department of Justice, had submitted the motion seeking dismissal of indictment with prejudice. And it has said it has reviewed the matter and decided not to devote further resources to these criminal charges against these defendants. In the second case, which was related to Iran's sanctions, US Department of Treasury has agreed to $275 million settlement with Adani Enterprise. So overall, outcome from both these cases can be taken positively for Adani Group companies.
All right. Thanks very much for that. So, well, just a quick recap of the stocks that we've put out since the morning and where they're starting. JK Paper is up 6%. iShares is up about 1/3%. Astral should come up with 1/3% lower start. JSW Steel is up 0.5%. Afcon's negative 6.5%, 7% lower. There is IGL. It's all small actually, small up and small down. GE Vernova is down about 1.75%. IOC, BP, HP. We've seen small price increase. And of course, the Adani Group names will come up. So they're all starting mostly in the green. Adani Enterprises, Ports, Power. And I think there's a broader read-through for other names as well. Energy Solutions, Adani Total, Adani Green. Some of these stocks, of course, have rallied quite a bit this month and from the lows last month as well. We've got the first rates which will start to come up on your screens, and we'll have that up coming up. 25 points, by the way, is where the Nifty is left off at the end of the pre-open session. And we'll have some of these rates start to come up. We'll keep an eye out on the EMS companies because that was the pack which saw a fair bit of selling pressure. So that and more in a few seconds from now. So 23,675. The low yesterday was about 23,300. 23,314 or so was the low. And then, of course, we bounced 300 points. So starting at about 23,700 this morning, it's about 0.25% higher. Nifty Bank is up 1/3%, 53,740. The Midcap index is up about 0.5%, 270. You got the small cap index which will come up, and there is about a 90-odd point pop there as well, 17,745 on the small cap index. So about 1150 stocks are higher and about 560 stocks are lower. The Nifty heat map is telling you how we are starting up. So Infi, Adani Enterprises, TechM, TCS, etc. starting up. And on the other side, you got Ultratech, Titan, Hindalco, which are starting in the red. So it's a more balanced kind of start, but more up than down right now. And 70 points on the Nifty to show for it. Rima.
Well, I think for the second day in a row, IT is leading the gains today. And as you could see on that heat map, it's largely the IT names right on top. So Infosys, 3% up, top gainer. Yesterday and today combined, it's added about 5.5%. Tech Mahindra, if you add yesterday's and today's gains, we're looking at a near 7% pop. TCS is moving up nicely, 2%. HCL Tech, Wipro also inching up. Maybe the street sees this news about TCS and the fact that the wage hikes have been fairly subdued as a pragmatic cost control, cost discipline shown by the company, which will go a long way in helping the company protect margins and profitability in an otherwise tough environment. So top 4 Nifty gainers are IT. Then you've got Adani Group stocks. Adani Enterprises has opened up nicely. So that's got a gain of 1.8%. If you skip the Adani Group stocks and IT, you've got an ITC, HDFC Life, Bajaj Finance, L&T. There are no banks which are featuring in the top gainers. The Nifty Banking Index has opened up with a gain of about 0.2%. But you've got an SBI up 0.5%. So no big moves. Kotak Mahindra Bank, in fact, has opened up in the red. On the way down, you've got Titan, you've got commodity names selling off. So ONGC is slipped. Hindalco is under pressure. Coal India is down. Ultratech Cement is down. Nestle, Power Grid, JSW Steel. So largely some consumption and these broad commodity metal plays have opened up in the red.
Well, that's right, Rima. A few stocks that are doing well from the broader markets. Puravankara, stock is up 14%. Big move is what we're seeing on that particular name. So a spike up out there. I'm guessing maybe in fact numbers would have come out on that one, or there could be some kind of positive news flow on this name. But that's one of the big volume movers in today's trading session. Up and about in today's trade. So big move out there. It swings to profit actually. The revenue is up as well on a year-on-year basis. So that's the reason why that stock is reacting to its numbers. The other one is Finiotex Chemicals. Yesterday, the stock was up close to around 20%. Today, it's up another 5%. Volume's very, very high. Spark's another stock that's up close to around 4%. Big move out there. Good volumes as well. Apollo Microsystems, my colleague Ria had told us that those numbers in fact look quite good. And that stock as well is doing pretty well in today's trading session. Afcons, the stock is down close to around 5% in trade today. Big downtick is what we're seeing out there. And Prime Focus as well is down close to around 2.5% in today's trading session. So that's about some of the big movers. What else is moving? Tejas Networks returning back to its winning base. The stock had a big rally and then it saw a correction. Now that's back up close to 7%. Coans is up close to around 6%. And CMAC as well up 5.5%. So fair share of winners from the broader market. So tell you what, the Nifty has started above that crucial mark, which is the 61.8% retracement level. That came in at around 23,680. Now all eyes will be on the 50 DMA, which is around 50 points away from here. Whether or not we can get past that, that's going to be important because it can trigger a further round of short covering. So keep an eye out on that market.
Well, yeah, I mean, if there's short covering afoot, I mean, there's a lot of shots in the system, and that can do a fair bit of heavy lifting as we go forward. But you got to have some of these headwinds, swords hanging, etc., start to disappear a little bit, look a little less onerous, and then those shots will run to cover. Otherwise, I mean, it's going to be a little bit of up and then a little bit of down kind of session as we've had for many days now. The indices are back up on your screen. Small cap index is up about 70. Mid cap index is up that much as well, about 0.5% or so. And the Nifty is holding up as well. Nimesh Chandan is with us, Chief Investment Officer at Bajaj Finserv AMC. Nimesh, good morning. Great to have you with us here. Thanks for joining in. So are we at that point where now we kind of sort of, wait for other markets to crack because they've done so well, and then, investors start to look at other markets which have not done so well? I'm talking about some in markets like Korea. There was some chatter yesterday that there was some rebalancing happening. I mean, a little bit of rebalancing out of markets like Korea into India. Is that the kind of are those the kind of triggers now to look forward to, Nimesh? I'm not talking about micro opportunities, and there are always micro, which we'll get to. And with or without help from foreign investors, there is money to be made. But just on that question of foreign flows, is it going to be waiting for pain elsewhere to show up for money to come back here?
Good morning, Prashant. We are all waiting for an event, actually, the conclusion or some peace treaty in the Middle East. I think that's what will decide the path of the market and the sector or the stock selection also. A few other things help, like, more often than not, we are reminded of the cycles in the market that at some point people become excessively pessimistic and excessively optimistic. In some of these markets, like the AI trade or so, maybe people are over-optimistic and now you can see some corrections there. And maybe in the Indian market, people have become too pessimistic. And that's why we've seen the markets climb this wall of worry.
Nimesh, hi, but equity markets generally globally or in India have never been linear, and we've gone through long periods when at the index level we've done nothing. So if you go back 1994, post Harshad Mehta, the Sensex peaked at about 4,500 and it didn't convincingly break above that level till that 2003 to 2008 bull market came. So you had a long period of 9 years where at the index level it did nothing. So is there a risk, because we are now seen as anti-AI, now we're getting hit on account of crude, is there a possibility that we could be in for a longer stretch of muted returns?
I believe that the fair value for Nifty would be around 27,000, which means we are ready to break to the previous high. And the pointers, when we look at, say, the fundamental cycle, whether you look at economic growth, whether you look at earnings growth, whether you look at credit growth, all were pointing towards the improvement. Now, because of this crisis, we've hit a speed breaker. The question is, how much time will it take to resolve? But otherwise, this crisis somehow has hit the Achilles heel of India. And that has led to recalculations of growth and inflation. But otherwise, there is everything in this market to break out to a new high. So I would say we may not move sideways. We may actually move upwards, but it depends on this one event to get over.
Hi Nimesh, good morning. Good to see you, Ben. 27,000. Well, the bulls will give anything to get to that mark, sooner rather than later. We've gone through a period of consolidation, a pullback, and a big underperformance as well. What earnings growth are you factoring in to get to that mark?
So for FY27, actually, not much earnings growth has changed. I was just looking at the estimates. The consensus estimates are hardly changed between 1.5–2%. The result season has been very good. Most of the companies have guided that they may see some excess costs on, say, energy-related chain of raw material in the first quarter. But see, if the moment this crisis is over, Nigel, people start focusing on FY28. They will not even look at FY27. This will be all discounted. So we can do our calculations and say, okay, this quarter we will probably see some downgrades coming in, that is Q1. And we will see some downgrade in the 1230 or 1240 EPS for the Nifty. We will see some downgrade there. But then the next year you see 15% growth. You are at around 1420 to 1440 range. And then the market looks cheap. And then the growth estimates for some of these high, fast-growing sectors start playing on the valuation. And then you see up move there.
So, when we last spoke to you, you were bullish on, you said 50%, the way you said you'll construct your portfolio is 50% cyclicals, which includes financials, materials, industrials. And then you would also have a balance in defense, healthcare, and consumption very selectively. Has that view changed in the last 2 months, Nimesh? And if yes, why? In what way?
So we have kept actually the portfolios the same. We haven't changed anything. Yes, there are some bruises in the portfolio, but April was generally a kind month for us, and cyclicals have done well, and we've done well on that. But we are not changing anything. We are just waiting. Of course, the longer this persists, this issue, and oil prices remain high, we may have to look at certain sub-segments on some stock-specific calls we have to take. But also, one of the things I'll highlight here, there are many businesses that thrive on crisis. They can actually shift market share towards them when their competition is struggling. So when costs are going up, sometimes you see unorganized to organized market shift. Sometimes you see market shifting from weak competitors to a stronger player in the market. So those things you will see. Companies that can take price hike, can defend market share, those will do well. So on a bottom-up basis, we may change something, but overall strategy doesn't change.
What's your dark horse sector for the next 6 to 12 months?
So we've been looking at construction, metals, these sectors as deep cyclicals to do well, and we continue to hunt for ideas there.
Tell us a little bit more about that. From the metals pack, what do you like? Non-ferrous did very well. Now ferrous seems to be catching up. And the pieces are coming together. But though we know metals is about momentum, some of these stocks are trading higher than the averages. So give us a little bit of clarity on the metals pack.
Nigel, we are going with two main assumptions that from here on, commodity up move is like a mega trend because the world will shift from just in time to just in case, where you want to depend on certain countries or certain suppliers for your commodities. Rather than that, now you're shifting to just in case, where you actually want inventory of everything which is critical to you, whether in defense, whether in technology, whether in, say, construction. So this will lead to hoarding of certain commodities. The second trade that we are looking at is all the technology changes that are happening are energy guzzling. They are using a lot of these rare earth metals like copper in their supply chain. So those things will actually create a huge demand. Last few years, there has not been a great supply addition to many of these commodities. So these are the trades we are working with, whether it is ferrous, non-ferrous, even cement to some extent in India. Right now, we are going through probably a slow patch, but we had begun to see double-digit growth. So that's another area. Again, you have to choose your players right, but that's another area that we are bullish on. And anything related to that, whether it is commodity exchanges, whether it is consumables for these metal companies or commodities, even those companies, whether in mid-cap or small cap, have a good trajectory of growth in the next few years, and we are betting on those.
Got that. So when you said construction, that is cement, etc., right, Nimesh?
Even construction companies, Prashant. So
just pure contractors.
Contractors also. Yeah. They are trading at very cheap valuation, waiting for a trigger. The order books
There are in terms of pure contractors, there are not very many, right? I mean, you can.
Very few.
There's Ahluwalia, there is a Delhi, there is one, there is very few in that sense. Is that what you're looking at?
Very few large ones, very few good balance sheets. Some of them are currently stuck because they have either Middle East exposure or the labor has gone to vote in Bengal. So many of them may come back and start showing some good numbers from Q1.
Yeah. No, absolutely. You know, you have a multi-asset fund as well, Nimesh. What is the positioning there?
We are positive on gold and silver both. Silver is definitely high beta compared to gold. In one of our studies, we saw that whenever oil prices go above $100, there is pressure on both, on silver and gold, because there is pressure on overall liquidity in the world. People expect interest rate rises, people expect liquidity tightening, and then it takes a risk off, and that impacts even the gold and silver prices. But if we expect that this Middle Eastern issue will resolve soon, we may see some bounce back in gold and silver also. So we are positive on that. We invested on those.
And what about fixed income there? I mean, are we at the cusp of changing expectation? Global yields are up. Here in India, it may be the last measure, but at some point, if this does not resolve, you'll have to resort to some hike in short-term rates, etc. I hope it doesn't come to it. But what does that mean?
So again, fixed income is a good point. Two issues. One, US yields went up to about 4.63, and generally India and other emerging markets maintain a spread over that. So I think that puts an upward pressure on the yields here. And second, we need to do something about the rupee, the way it is depreciating, and that is actually hurting us on the inflation side. We have a El Nino forecast for August and September, which means there will be higher inflation for the second half also. That means the interest rates may remain at a higher range bound at this range, at this higher range.
Super El Nino, Nimesh, if you were to believe some of the weather guys. I hope it's not. And nowadays on social media, everything is so hyped up that you struggle and you got to read it first, and then you got to go back and check whether it is right or wrong.
You are absolutely right. Absolutely right.
Yeah, but it's an issue, and I think it's been our weather agencies have confirmed it, and some other credible agencies have confirmed it as well. Just one thing on if this is agri and fertilizer and that part of the market. Do you have any exposure there, Nimesh? Just to get back to equities once again.
We are hunting for certain soft commodities which can benefit from this. So companies that are into soft commodity side that benefit from this. Obviously, not really betting much on rural demand side then. If there is a increase in inflation on the rural side and if there is impact on crop, not betting on areas like tractors or fertilizers or seeds right now. But betting on companies that can say benefit from if the soft commodity prices move up. I'm not right now forecasting a super El Nino or doomsday here. The August and September scenarios are towards still the fag end of the Kharif season. So I'm not expecting a huge impact, but at least providing for those risks currently in the portfolio.
One final question then on IT. Just for the last 2 days, the rupee level is providing some support to the IT names. So they've been moving up. But, what's the take now on Indian IT stocks? Are they cheap enough to warrant a play, a look in?
So issues remain the same. Valuations remain cheap. This is a bottoming out process, a classic bottoming out process that happens. Again, once the Middle East crisis is done, maybe the sectoral preferences of people will change. But right now, a lot of people may take a defensive position in IT, and some benefit from rupee will definitely come. There are also arguments that if the AI bubble bursts, you see IT companies doing better in terms of stock prices. I think this is a bottoming out process, not expecting a huge run up from here.
Okay, Nimish, we are waiting. We are waiting. We are waiting. We are approaching the three-month mark. The US, I guess, when they attacked, they thought it would be like Venezuela. They thought it'll be over in 3 days, 4 days. The rest of the world thought it perhaps will last a week, and we are now 2.5 months into this thing, with at least at this point no resolution, but hope, most definitely. Thank you very much, Nimish, for joining in. Fingers crossed. Okay. Well, let's talk about the macros for a quick bit, because that's the overhang, right? Sameer Narang is head of economics research group at ICICI Bank, and Upasana Bharadwaj, chief economist at Kotak Mahindra Bank. She's with us as well. Upasana and Sameer, good to have both of you here. Thanks for joining in. Let's just divide this between the short term and the long term. So there is maybe a little bit of firefighting required right now. So let's start with the firefighting and what could the firefighting look like. And then, of course, we can talk about what needs to be done, beyond this firefighting. So we've done 3 or 4 things, right? There is the fuel price increases which are happening. We've done this, the $100 million net open market position for banks. They've tightened rupee derivative rules. We've done dollar facility for oil refiners. We've, of course, moved on import duty on gold and silver, right? And now this market is waiting and watching to see what else. What will be done, and there's a bunch of things. I put out a piece last Friday looking at 5 things which perhaps could be done. Sameer, are you expecting anything imminently? And what would the government start with in terms of sequencing?
I think, again, we have seen, Prashant, a small petrol and diesel price hike today. Right. So we are seeing these incremental steps. So there are 3 or 4 things that we need to do. One is, of course, raise the price of petrol and diesel at the pump, which should ideally bring down some demand for these products, because keeping the prices at where they are when international prices have moved around 50% may not work out well. So we need to gradually do it. That is one. So some of that will continue. The second is that we have seen some compression or steps towards compression of gold and silver imports. They put together around $84 billion.
Sorry. All this has already happened. I'm asking for what's next.
Next steps will be similar, Prashant. We need to compress it even more.
Okay.
We need to compress it even more. So oil prices need to go up at the pump more. Imports of gold and silver need to get compressed more. So as a percentage of GDP, if they are around, say, 2% of GDP, slightly northwards of that, can they be brought down by, say, 0.5% of GDP? That brings down the CAD materially from, around or northwards of 2% to around 1.5%. And then that is a much more sustainable level. The third thing is, whatever requires to be done in terms of incrementally regulatory changes that the government has done. So more steps need to be taken over there. And that's the way forward. I don't think so there is, any knee-jerk reaction required. We have adequate amount of reserves. We need to tackle it gradually, and we don't know how long this, crisis lasts. As you were pointing out, it was supposed to end in a few days. It's lasted very long.
Sorry, that 2% number, this is gold and silver imports as a percentage of GDP from 2%.
Combined.
Yeah, from 2%, how can it bring it down to about 0.5%? So you're saying that perhaps more is required on this?
Yes,
on this
that
front.
would, solve the current account. This is a short-term measure. It will solve the short-term problem. As oil prices come down, then you're going to, revert back to the normal policy.
Upasana, I just want to draw your attention to the op-ed written by Geeta Gopinath earlier today, where she said that perhaps we should just let the rupee take its course instead of trying to defend it and use our forex reserves. Well, that all sounds good, because she said that it works much better than these austerity measures. But the flip side is, as Sameer was talking about, the inflationary impact of that. At some point, it gets passed through. All our vegetables are all transported through, using petrol and diesel. And you've got price hikes. And then if the rupee continues to weaken, that's only going to hurt inflation. What's your assessment? Do you agree that we should just let the rupee find its own course?
See, I think fundamentally, of course, normally what happens is the external sector imbalances that are being created at this point in time. It is necessary probably to allow at least some segment to take its course, and that in this case is rupee. Having said that, one needs to be cautious because inflationary pressures is one, the vicious cycle that one gets into, wherein this could just not necessarily come back to its levels. So there has to be a little cautious approach towards just letting rupee fall free flow. So I would also appreciate, or I would also agree to the extent that rupee should be allowed to weaken. But probably, a little controlled in the sense that RBI should be managing it very closely as well in order to avoid any major shocks coming through a vicious cycle that we're talking about. Having said that, I would just like to say it is better to address this entire issue through an entire holistic balance of payment issue, wherein going back to your previous question, I think Prashant was asking, there are more steps which in the past have been explored, like some curbs. They may sound regressive right now, but I think in the short term, we might be preferring these kind of tools so that current account deficit can be in check through LRS constraints that we can look at. Even on the capital account side, if we can think of certain restrictions to ODI, restrictions to caps on ODI, and parallelly allow rupee to also weaken so that the fundamentals are working in place, and we are also trying to curb the balance of payment deficit, which is widening significantly right now. Thirdly, only when we see some normalization that would come through is when we can expect capital incentive measures to materialize. So I think at this point in time, we should try and take some quantitative restrictions on the current account side to manage it. Just an import duty hike on gold and silver may not be effective. I think a GST hike on gold could also be explored, and alongside further quantitative restrictions to curb current account deficit pressures and allow rupee to depreciate too.
Yeah. Samir, just sorry, on that gold and silver import, you said to bring it down to 0.5% of GDP, or you said 1.5%?
1.5%, 0.5% is enough, Prashant. So if you bring it down by even 0.5%,
okay, so from 2 to 1.5. Okay, I just wanted to clarify since we're putting that out. Upasana, the point about ODI, right? Are you talking about LRS, etc.? Is that what you're saying?
Yes, absolutely. So LRS, I mean to say, is remittances. Yeah. There can be a cap to remittances. We've explored this in 2013 as well. And I do agree that these are not the optimal measures to be taken. But I think in the short term, it can be explored.
Yeah. From the current $250,000 to something lower. But is that going to make that big a difference? Or you think, as you said, maybe a bunch of steps altogether?
It has to be a cumulative impact. I don't expect any one measure to have a very fruitful. We won't be seeing fruits by just one or two measures. So I think we will have to do a bunch of measures together.
Yeah. Sure. Are we? You said. I mean, there's no need for crisis-like measures. Samir, I think you said you used a different phrase. So a deposit scheme or a bond issuance, etc., that would qualify as crisis time measures?
Prashant, when global interest rates are so high, I mean, the US 10-year is 4.6% plus. It might as well touch 5% the way things are going right now. Bond yields across Asia, across Europe, UK 30-year is at highest level since 1997, 98. At such higher interest rates, if you do an issuance, you'll have to also pay top interest rate because there'll be a spread on top of where the global interest rates are. So that will be expensive, but it can be explored as commercial borrowing issuances by some public sector banks or public sector enterprises. We are seeing record issuances, Prashant, as we speak, by the mega caps in US and Europe to fund their capex. So I think that perhaps would be, in order for funding the BOP deficit this year. But it has to be a mix of measures to curtail the current account as well as, usher in more capital inflows.
Yeah. Just both of you, if you can, talk to us about, there is, of course, other measures on the reducing the withholding tax on foreign bonds. Again, the point is the total holding is about $35 billion. So even if you bring it down, how much of a difference is going to make? The other thing, perhaps, is taxation on the equity front, right? That's also capital outflows. Now, that's a much larger pool of capital. I mean, at least it impacts a much larger pool of capital, and the sentiment value of such a move, perhaps, many argue, is also large. Do you think, Samir, we should revisit that?
Well, it's a tough one, I think, Prashant, because the tax policy has evolved over a period of time. You can argue it either ways, that countries like Indonesia, Philippines, where perhaps there is no capital gains on equities, they're also seeing an outflow, and India perhaps is seeing slightly bigger outflow because of the prevalence of IT services. Philippines, that way, would be very similar because they also have a large BPO or IT services network. So I think, irrespective of that, given the way the macro outlook is, at the margin, it will benefit, but at the end of the day, it is your underlying, macroeconomics, structural drivers, impact of AI, whether you have chip manufacturing or not, or manufacturing exports in general, which can be sent to the US, is some of these markets which are doing well. So perhaps it will help at the margin, particularly for bonds. I think, inclusion in global bond indices is very helpful. We've seen the money that has come in is very sticky. So if you can get that done, it will be very, very helpful indeed.
Sorry. So on equities, you're saying it's kind of you would say the bar is very high, that the government goes there.
Because this policy has been made after a lot of back and forth, and we've come around to it. Domestic and foreign investors are charged the same rate. So then you'll have domestic investors being charged a different rate than foreign investors. That's the norm globally. But then it's a change in what we've been doing over the last few years. It's up to the government if they want to do it.
Upasana, just that same question to you.
I would also agree. I think in this environment, what is the cost involved? What are we sacrificing versus what do we expect to gain? I think that is a big question to ask. We may still not really benefit much by even tweaking the taxation front, on the taxation front, given the kind of adverse sentiments that we're seeing globally. So I think at this point in time, we should not really expect the government to tweak the taxation and rather focus on other aspects in how, in the way we can manage this crisis. Because, we might be just about loosening some of the belts, as Samir mentioned, from previously held, beliefs. And then we may still not really necessarily get what we are really expecting. So that will not really be beneficial even from a balance of payment perspective, and that would not benefit rupee. So I think, we have to weigh the pros and the cons while really looking at such measures.
All right.
There's one thing, Samir, before we sort of come to here and now, and it's just sort of going on with measures, some firefighting, some long-term firefighting. I think we've done, at least we've done the whole thing. But anything out of the box, anything, we keep talking about reforms and, big signaling kind of changes. Samir, anything out there which perhaps change, sort of, says, well, here's a change in thinking, a fresh start, something, right? Because the underlying issue is that net FDI, it's a capital account problem, and there the net FDI has been negative for 3 years, right? 3 years or 4 years? So
it's been very low, yes. It's been very low, yes.
So how do you change that sentiment? Is there anything we can do?
No, Prashant, I think the work that we've been doing, we have to continue doing it. And at some point in time, it'll get noticed. That's about it. And nothing much can be done. A couple of years back, we never had a semiconductor plant as well. So we've started that semicon fabrication facility. We need to do more of it. And the sentiment will turn eventually. It's a cycle. It's a sentiment issue. It's being plagued across markets. And as you've been pointing out, right now, global commodities cycle is on an upswing, and oil prices are higher, so importing countries will be at the other end of the cycle.
All right, before we wind down this conversation, Samir, let me get your estimate on growth for the year. It's going to be a challenge. You've got various headwinds up ahead of us. We're hoping for some measures, but growth is going to get impacted. So what are you penciling in terms of growth for this year?
See, we were earlier at 6.9, Nigel. We've brought it down to 6.5% because the crisis has continued. So, I would say 6.5% if prices remain here. Otherwise, we were at 6.9.
Okay. All right. What about you, Upasana?
We were already at 6.5, and we are looking at this with a significant downside towards 6 to 6.3% range.
Okay, all right.
Just one more thing, Samir. Yesterday we had the management of KEC International on the program, right? They said that, and they gave specific numbers on the labor front. They said, again, on the civil front, on the civil side of their business, against a demand requirement of 30,000 workers, right? They're at 15,000. People have just not come back. They promised they'd come back at a certain date, but there's a shock. I mean, the numbers had fallen to about 10, 12,000. They're up to about 15,000, but that's where, so half of what is required. Across, I mean, you have a bird's eye view at the bank in terms of, you lend across sectors, etc. Is this a big issue, Samir?
It's in bits and parts, Prashant, you're right. Some of the people have gone back. They typically do go back, during this period of time, and then they do come back. Could be a little bit of delay because of the overwhelming heat conditions, or they've stayed there for slightly longer. I don't think so. Structurally, it will change. People will come back. It's a matter of time. In bits and parts, probably it is true anecdotally that some people have not come back.
Yeah, it is anecdotal, absolutely. But I mean, I just mentioned that since we got absolute exact numbers from a company. But you're right. I mean, this is when, and I did mention this point that maybe there's a heat, maybe people do go back. We've heard it from other companies as well. We'll see. Thank you very much, Samir and Upasana, for joining us here on the program. Really appreciate your time. We'll see what, measures, if so, the government chooses to, decides to bring forward. But we've had a bevy of suggestions, if you want to call it, or thoughts from both Upasana and Samir right now. We'll take a quick commercial break here. We have the management of Genus Power. Jitendra Kumar Agarwal joins in. We'll talk about the fourth quarter performance, and that's the conversation coming up next.
Welcome back. Nifty is holding above 23,700. The Midcap index is now up 1% and the advanced decline ratio 3:1, a complete reversal of what we had yesterday. But let's invite Genus Power Infra on our show. Mixed set of numbers. Top line growth strong, 62%. But margins have missed the guidance. Jitendra Kumar Agarwal, joint MD of the company, is now joining in. Mr. Kumar, morning. Rima here. Let me start with your margins. Your standalone and consolidated margins have come in below your FY26 guidance of 20%. So can you explain what impacted the margins, what led to the compression, and what is the outlook for FY27 on margins? And can you hold on to that earlier guidance on revenues, so 5,500 to 6,000 crore that you had shared with us earlier?
Hi, good morning, everyone, and thank you for calling me again. It's always a pleasure to be part of this conversation. So on the margin side, there have been some pressure because of the raw material prices and the dollar fluctuation. That is the reason you see the EBITDA margin has gone down in the fourth quarter. That is the prime reason. And on the guidance, I'm more than confident that 6,000 crores is minimum what we will do in the next financial year, and we can go up to 6,500 crores. That over the period of time we'll get to know even better, but I'm pretty confident of 6,000 to 6,500 crores. And on the margin for the next financial year, I'll give a guidance of around 18% because yes, there will be pressure on the raw material because of the ongoing situation.
Mr. Agarwal, good morning. There is a more structural issue which we've been made aware of by companies we've spoken to. I mean, we spoke with Sirma recently. We've had the management of Keynes. They all do a lot of things, but also manufacture smart meters. And there, they've both companies and more. I'm just citing two. Have told us that. The business is not what it used to be even 2 years ago because of at the ground level there have been some protests, governments perhaps changing their mind about how fast rollouts should happen. So working capital cycle, etc., in terms of receivables from the government has stretched out. Could you give us a sense of what is happening, sir? An overall perspective because you're one of the largest players in that space.
So just to give you the heads up on this, last year we installed around 87 lakh meters. And this year we'll definitely install more than 1 crore meters. I see no doubt in that. And from last financial year, there's almost an average of 35 to 40 lakh meters are being installed every month across the country, which reached up to 50 lakh meters. I see the same run rate going this financial year. And regarding this protest on the ground, this has been going on in small nook and corners in the past also. There were some issues in Gujarat, there were some issues in Rajasthan, there were some issues. So I have seen this problem from electromechanical, the whole country went to electronic meter in 2001 to, even at that time there was some resistance. Almost 7 crore smart meters are installed in the country. The consumer is getting benefited, and there's a clear-cut indication of that if there is a political will against smart meters. Assam is the classic case study. So more than 65% consumers are in Assam, the smart metered, and the same government is repeated with a thumping majority. So there is a bill everywhere. There's absolutely no question of it.
So you're saying from a government side, there is no change in thinking, nothing at all. So it's a rolling cycle of maybe, it gets highlighted around the time when a particular state, there is elections or something, and then kind of sort of it settles down and you move on. That's what you're saying.
Absolutely. And you can see that in last 2 years, and you can see that from the historically in last 2 decades. So it is, I'm more than confident on that.
Okay. All right. Hi, Mr. Agarwal. Good to see you. And as always, you're sounding very upbeat. That will be good to see from your shareholders' perspective. But let's get a couple of crucial details out of the way. One is your cash flows. The last time you chatted with us, you say that in FY27, your cash flows will turn positive. Is that on course? And also your working capital days, I'm noticing, has come down from the peaks that we saw earlier. Where does that number stabilize at?
So cash flows are improving by the day. There is no doubt about it. The number, as you rightly said, this working capital days has also come down. But as I guided earlier, that we will be positive by 2027. That is not, that will be a little unlikely. We will be definitely positive by 2028. I have no doubts in that. 2027, the further the cash flow will improve, there will be a lot of reduction in the working capital days, but we will be positive. I have my doubts.
Okay, so now you're saying that you turn operating cash flow positive in FY28, not in FY27. Is that correct?
Looks very unlikely in 27.
Okay, got it. And working capital days, you're saying it comes down a little bit. Where does it stabilize at?
So it will come down significantly. It has already come down from almost, I would say 343 days. It has come down to 275 days. I see it going down below 200 days and even more by the end of this financial year.
Okay, all right. So sub 200 days by the end of this financial year. The chart that should come up for our viewers on the screen is the other worry. You have a very good order book, but the street wants to see a lot of order inflows. And since we spoke about state elections, Tamil Nadu is out of the way in terms of the election results. So is there a tender likely to open up in Tamil Nadu or in Delhi? Because you've spoken about that in the past. Where does the new tender open up at, and what is the opportunity size?
Well, the opportunity is fairly large. It is not only Tamil Nadu. The few states which will come with a smart meter tendering, which has already come out with the tenders. Almost 18 lakh meter tender is going on currently in Madhya Pradesh. More than 3 crore meters in Tamil Nadu. And Punjab is already out with the tenders. Haryana has come out with a 40 lakh tender. In total, in this financial year, more than 8.5 crore smart meter tenders will be decided.
Okay.
Now it comes as a very positive outlook now. So earlier they were thinking of a tender of around 50 lakh meters. Now already the work, I'm pretty confident that they will come out with a tender of more than 1.5 crore meters. So
1.5 crore meters from where, sir?
From West Bengal.
From West Bengal. So cumulative, what will be the new tenders that will come out in this year? If you could give us that number.
Cumulative, currently ongoing tenders and the new tenders put together will be around 9 crore meters.
9 crore. And your market share is what? Approximately what?
Currently, we are maintaining the market share of 22-23% meters as a AMISP and more than 35% meters. If you put AMISP and meter manufacturing together, we are confident that we should be able to maintain our market.
You will be hoping for 1.5 to 2 crore meters in this year? Out of that, all that comes out?
As a AMISP, yes, we are very confident that we should be in a position to maintain our market share.
And there's no risk to the Tamil Nadu tender because of the change in the government? Because that's sizable 3 crore tender.
I don't think so.
You don't think so. What's the reason, sir, for the sharp decline in your order book? There you have it, 30,000 down to 25,000?
Because one thing everybody has to understand, all this order book, once they start executing, you have to understand that we have installed 87 lakh meters. All the projects have gone operation go live. The 20% revenue from this order book moves to the platform. So as on that, out of 25,000 meters, 25,000 crore order book, 23,000 crore comes from the AMISP business. Out of this 23,000 crore business, 22,000 comes from the platform. So once the order starts executing, 80% revenue of this 22,000 crores will come to GS. So that is, people have to understand it more correctly.
And what is your debt, sir, as of now? And what is the target for peak debt and the timeline to bring it down?
So we were always a net debt positive company in the past. But of lately, because of so many projects and the revenue going up significantly, we have taken the working capital loans. But maximum it will go up to 2,000 to 2,500. That is the maximum level we see. Currently, we are in the range of around 1,500 crores, and we see it going up to 2,200, not more than that.
Okay. In the near term, sir, which is the next tender should we look forward to that will come out first? From which state government? Sorry, I interrupted you earlier. You mentioned Tamil Nadu, West Bengal, and various other states, Madhya Pradesh as well. So near term, next 3 to 6 months, what are the states that open up for tenders?
So 3 tenders which I feel are going to get most fast will be Madhya Pradesh, which is already an ongoing tender of around 18 lakh meters. Haryana, they have 40 lakh meters is already tendered, and further 40 lakhs will come. So almost 80 lakh meters in Haryana and around 3 crore meters, this 3 crore meters of Tamil Nadu. I see these 3 tenders to be finalized fastest in next 3 to 6 months.
Okay, all right. And does it boil down all then to, besides operating cash flows, what about net profit? The last time I pushed to, I said, is 900 crores of net profit possible in the coming year? For this year, should we be looking at that number, around 900 crores of net profit?
This financial year looks difficult now because of the lot of pressure on the margins, as I'm giving the guidance of 18% EBITDA, so looks difficult. But next financial year, 900 crores is definitely on the card. And I'm pretty confident that we will achieve it. If not this year, we will.
All right, we'll leave it there. Thank you very much for joining us, Mr. Agarwal. And you know, we'll touch base as we go through the year, that is financial year 27. Well, let's just move on, right, and take a look at what the index is doing, and let's take a look at the rupee and what that is doing as well before we move any further. So it's still 40 flattish kind of day so far. Rupee is also I think come up a little bit. 96.32 is where the dollar rupee is right now. Well, there's more view coming in from BSE's MD and CEO, Mr. Sundaraman Ramamurthy, sharing how BSE is navigating these challenging times. I mean, the stock's goes down phenomenally well. It's a record high. Mr. Ramamurthy highlighted the sharp rise in market participation over the last year or so, saying, well, there's a lot more distance to cover. Listen in.
Somewhere it used to hover around 2 digits. 10 to 12% used to be the domestic one, and 15% used to be the FPI holding, 15 to 20. Today it is reversed. If you look at last year, given the global situation, there has been an outflow, net outflow of around $36 billion by FPIs. But to compensate it, the net investment by the domestic institutions has been 91 billion. This has not only taken care of the outflow, but also strengthened the Sensex to a great extent and has prevented it from a free fall, notwithstanding the severe geopolitical tensions. So it's a very healthy mix at this point of time. Of course, there is a flight to safety by FPIs, and I'm sure once things normalize, the attraction of India as a growing destination will bring them back in big numbers as it was always before. When there is a turmoil like this, not necessarily the volumes go down. The economies get into difficulties, but volumes do not go down. For example, if you look at my cash market, last 1 year it saw around an increase of 30% and derivatives market around 40%. That is one point which we need to reckon. The second is, India is growing and a significant amount of population is yet to come into the capital markets, and slowly they are starting to come in. Last year alone, I have seen 35 million Indians coming and joining the BSE bandwagon by registering with their unique client codes. There's a second point which we need to reckon. The third is, more and more improvements need to be done and innovations need to be done in terms of products, considering which are all the sectors which could be seeing great volatility and where there is a need for product to hedge the positions of the individuals who are investing the money. We have introduced an index called Focused IT in the derivatives market, considering the turmoil in the IT industry because of supply chain issues and also because of AI, the demand for memory, and therefore the increase in prices. So IT stocks in India have become very volatile, and to take care of the hedging need, we brought this index. It is 5 days of trading we have seen till now, and it is really showing a lot of green shoots of growth. To keep up the momentum, I'm sure at some point of time when things settle down, the credit growth will increase, and therefore the corporates will be able to show better earnings with a better credit growth and better demand and supply and eased out supply chain situations. And that should fuel back the enthusiasm. And of course, Japan, Korea, and all our economies which need to be looked into, and they can be growing faster once things become clearer. And a collaborative approach which India today is having towards multiple nations, and the principles and policies of ease of doing business which Indian government is pursuing should help in keeping up the enthusiasm and bringing it forward.
Okay, all right. Well, that's a stock that's been on steroids, up 4% even in today's trading session. BSE currently at the high point of the day. Let's hop across to Chandan Taparia, Head Derivatives and Technicals, Wealth Management at Motilal Oswal Financial Services. Hi Chandan, good morning. Good to see you. When the markets are showing some sign of life. From the lows, we've seen a good bounce yesterday. In fact, we're up, I think, close to around 250 or 300 points. Your view on the index, what are the levels we should track? And then fill us in with your trading calls.
Good morning, Nigel. Thanks for having me. So yes, Nifty took support near 23,333 marks on the last trading session. It formed a bullish price pattern similar to Hammer, and at the same time, put-call ratio witnessed recovery. And the good part is that FIs are buying from last 2 trading sessions. That is also supporting some sentiment for recovery mode. So as of now, I believe that the momentum or bounce could extend. As of now, an immediate support of 23,500, one can buy for an upside move towards 23,850 to 24,000 in Nifty. And if I look at the Bank Nifty index, that is slightly underperforming, but it also bottomed out. Momentum is missing, but as of now, if it manages to hold above 53,500, one can buy with support of 53,200 for a recovery towards 54,000 to 54,250 level. Looking at the stock wise, first is buy on policy bazaar. It has seen a strong momentum. In fact, the longs are being built. Recently, it has taken support at 50-day exponential moving average. It has been making a high top, high bottom on the daily chart. Just 2 days back, it gave a major breakout above 1,750. So momentum could continue. One can buy with support of 1,755 for an upside target towards 1,880. Second trading idea, that is buy on Oracle Finance. One of the strongest counter when entire IT was falling down. This was comparative resilience. And when the IT sector is recovering, it is all set to give a fresh breakout. In fact, we are observing an early sign of fall and flag breakout on the weekly chart. So one can buy with support of 95.20 for an upside target towards 10,100 level. And positive view on the capital market theme, whether we talk about the BSE or exchange infra theme, MCX, we are positive. Our stock rallied well, but still trend is positive. and we would suggest to chase the trend as of now. Use any small dip with support of 4,120 for an upside target towards 4350 to 4400 level.
All right. Thanks very much, Chandan, for that. We will take a break. We will come back with Manisha with a focus on commodities. Stay tuned. Coming up.
Welcome back. Let's turn our attention now to commodities. Manisha is now joining in. Manisha.
Thank you so much for that. Well, I'm looking at the agriculture commodity prices today because we've seen a constant rise into this one as well. The FAO data that came out in the month of April suggested that agriculture commodity prices are now trading at a 3-year highs. This comes in on the back of elevated crude oil prices. You have higher shipping, higher insurance costs, logistic costs. There is also, availability of tankers an issue, and all of that seems to be building its way in case of agriculture commodity prices there. The other thing really is about the press note that we saw from White House suggesting that China is now committed to buy U.S. agri products worth $17 billion annually over 2026 to 2028, absolutely supporting many of those commodity prices which China is now going to buy from US, which is basically soybean, wheat, corn, etc. And all of these commodity prices have seen a surge in the overnight markets there. So when you look at palm oil prices, we are trading at around 4,500 Malaysian ringgit above those kind of levels. This also comes in because of fifth month of gains in prices, and there are supply concerns coming in from Southeast Asia supporting those prices. Soy, sunflower have been elevated due to biofuel demand and supply tightness in the major producing countries therein. You have wheat prices which gained 4.5% in the overnight markets. There is high input cost and also the Black Sea tightness continuing to support the wheat prices in the global markets for the last 1 year or so. And then you have cotton prices here as well gained up by 4% in the overnight markets. The US production is projected lower by 600,000 bales in this year as compared to last year, keeping those prices on the higher side therein. It is also about the fertilizer shortage that the markets are looking at. For India, there is fertilizer coming in, but that is heavily subsidized. Government seems to be paying a big chunk of that. In the international markets, well, 39% of the world's fertilizer transits via the strait. And when you look at the Middle East as countries, nearly 50% of world's urea export comes in from that area as well. And that's exactly the kind of shortage that the markets are looking at. If you look at biofuel mandates, that food versus fuel of a debate just about continues. So what we do understand is that the 65 countries as of now either have implemented or announced already in sense of biofuel mandates. Now, this also is about biofuels and ethanol in some sense. So if I take the top 5 countries herein, and the most relevant one, of course, is India, where we already are looking at E20 in focus right now. And it's not just about sugar, ethanol, it also is about rice and corn, all of those commodities in use there. Indonesia is really leading with nearly B40 right now. They already have announced B50, which is blending of 50% in sense of biofuels from August 2026. Malaysia stands at B15 as well. You have countries like Brazil, which are looking at E32 and B15. Argentina, B12 to B7.5% is what these countries already are putting in. Australia, just about newer country when it comes to blending, have started with E2 and B2 as well. So as I said, 65 countries already announced and implemented. 85 also are looking at various policies when it comes to biofuels there. And most important factor when you call about agriculture is going to be about the Indian monsoons. Now, we do understand that there is early progress, and in Bay of Bengal, Kerala onset is projected on 26th of May. Bombay could be looking at rains starting by the 5th or 6th of June as well. But what we do also know is that whether it is about IMD or SkyMet, both of these agencies have suggested that it's going to be a below normal monsoon at 92 to 94% of a probability, and much of El Nino impact would start coming in for the second set or the second half of the monsoon season, and that is where the concerns really seem to be arising from. Even as for 54 to 56% of India's irrigable land is irrigated, but it is 45% which is all completely rain-fed, and that is where the major concerns come in from, suggesting that many of these agriculture commodity prices perhaps would continue to surge higher.
All right, Manisha, thank you very much for that. The markets are looking better. I think we're up 114, 115 points. 756 at this point in time. Market breadth, I think, is also pretty positive. 2,200 stocks are up and about 700 stocks are lower at this stage. And look at what BSE is doing. We had the BSE management with us. It's up another, 3.5 odd percent. Right now. And if you can pull up the Nifty IT index. So Nifty IT last Friday, the Friday before basically last week was down 6%. Yesterday, the Nifty IT index was up 2%. It's up another 3.75%. So, this is not small up. This is large. TCS, Infosys, and a bunch of others, Tech Mahindra. Some of the moves, if you can at least pull up the 4 large IT stocks. 3, Infi, I think, was up 4, TCS and HCL Tech also, maybe a Tech Mahindra. So across the board, there is buying which seems to have come in, maybe short covering buying, but most certainly that is appearing.
The INR is quite a tailwind, right? The average in the Jan to March quarter, rupee dollar average was about 91.5. And since then, we're now talking about 96. So straight away, that's a 5% rupee depreciation. So that's going to help, right? At least absorb some of the costs.
91 in Q4.
91.5 on an average, not end to end. On an average was about 91.5. Now we're looking at straight away a 5% depreciation. So at least that gives the companies some buffer to absorb the incremental costs that they are making, or at least show up partly in the P&L. So not everything, as we saw in the Q4 numbers, that not all the rupee benefit shows up in the P&L at the bottom line, but the companies are using it as a buffer.
I think nobody's buying IT because rupee is down. I think it is just some, because it just falls a lot, and then, there is some buying at the margin which starts to come up. Just some short covering, that kind of. We've seen this. I mean, just go back last 2 years and track the IT index. Falls very sharply, especially in the last 3-4 months or so. Falls very sharply, and then it's got weeks when it starts to come up, and then it sort of falls again. But at some point, enough will be enough, and that no one knows, right? We'll be wiser in hindsight, and then we'll point and say, well, that was the low, but I don't think it's the currency which will be the reason for it. We'll take a quick commercial break here. We'll have the group CIO at Bank, Julius Baer, to talk to us about the impact of the ongoing geopolitical tensions in markets and more. Stay tuned, coming up. Welcome back. Let's get a perspective from one of the top wealth managers. Yves Bonzon is Group Chief Investment Officer at Bank Julius Baer. Yves, great to have you with us here on the program on CNBC TV 18. Thanks for your time.
Good morning. For having.
Good morning. So, you know, there is a bull market in the US, especially on the AI chip-related names. There is a bull market in North Asian markets like Taiwan, in Korea, and maybe in markets like Japan, etc. as well, right? So it's all AI and chips and that part which has been doing phenomenally well. Whereas elsewhere, the situation is not as bright, and perhaps I can categorize India in that second bucket, Yves. So just sort of talk to us a little bit about what you are telling clients globally at Bank Julius Baer about where to allocate, really.
Thank you. Well, look, first of all, I think it's important to understand the fundamental environment we are navigating. We've had the post-financial crisis, more than 15 years of private sector deleveraging in the United States and in Europe. So we deal with private sector balance sheets that are extremely healthy and resilient. In other words, there is no structural imbalance endogenously in the system, which means we live in a world where the risks are outside the system. We've seen the tariffs, we've seen the start of the war in Iran earlier this year, and it's extremely difficult to hedge one's portfolio against these shocks. In the background, you have the AI capex cycle, and the single most important number is probably the AI capex guidance by the US hyperscaler building the infrastructure enabling AI. As long as the capex is resilient and the numbers are revised upwards, the market is likely to stay firm. One of the important pieces of anecdotal evidence later this year will be how well or not the market absorbs the equitization that results from a landmark IPO. You know that we have 3 major companies lining up for market introduction in the US. So their equitization, which has been a very, very important feature of US capital markets in the last 15 years, is temporarily at a standstill, potentially turning to equitization with a significant amount of supply, and that will be a big litmus test for the market.
Eve, morning, and thank you very much for joining in. You know, when you started the year 2026, and you laid out the investment horizon for your clients, war was not on the horizon, a Middle East war, and that's gone on longer than anyone's imagination. So how has this war changed your investment thesis and the advice that you're giving your clients? If you could share the before and then after.
Well, look, first of all, of course, we did not expect that war to happen. And it had a pretty dramatic impact on the short term on asset allocation trends. Essentially, if your positioning in January and February was right, from March onward, as the war started, and the phenomena was compounded by the return of the AI trade from April onward with the earnings season, your asset allocation positioning was actually very unfavorable across most of March and April. So that's the environment in which we operate. And that's what I mean by the risks are outside the system, because the Iran war is an exogenous shock, not something that anyone can predict. And the only way we can navigate this is through proper portfolio construction, barbelling the theme. So typically, India is not working as a trade right now. This is a small allocation of ours, but it's an anti-AI and an anti-oil price trade, because the situation is very fluid in the Middle East and things could go into reverse pretty swiftly.
And Eve, I believe you're here in India, where you're going to meet all your large clients out in Mumbai. So what's the advice? India is a very small part of your portfolio. As you said, it's anti-AI, it's anti-energy, anti-crude. So what's the call now that collectively at Julius Baer, you all are taking on India?
Well, the call is to stay diversified in a barbell manner. So typically, our US allocation in portfolio are focused on what is truly exceptional to the US market. And here again, there is a bifurcation, because you have the AI spending beneficiary and the potential AI revenue beneficiary, cost efficiency beneficiaries, which, as you know, have been tremendously derated in the market. We think it's too early to move back to those that have been hurt by the AI trade. For now, the momentum is still with picks and shovel, those who build the AI infrastructure.
Hi, Eve. Good to see you in. This is Nigel on this side. You know, quick word with regard to the Kospi. That's been the big outperforming market. It's outperformed most indices by a mile. And in the last few trading sessions, it's showing some signs of nervousness. And I'm looking at the flows. There have been some outflows, actually. And coincidentally, at the same time, India suddenly be getting a trickle of the flows. Do you think if the Kospi, you know, goes through a bit of a correction, it may not be such bad news for a market like India that's been starved of any kind of FI flows?
It sure would be, and that's why we think that barbell portfolio construction is important. Now, with regards to the memory stock trade that has been particularly favorable for Korea, it's really a function of the fundamentals of that trade. And you have an industry here, memory chips, which has consolidated into an oligopoly structure. It's an industry that was characterized by a lot of cyclicality. And the fact that those chips are now in high demand for agentic AI as part of the CPU architecture is a complete game changer. In the meantime, those companies producing those chips are certainly reluctant to add to capacity, which means that the bottleneck the imbalance between supply and demand for this chip is probably a long-lasting phenomenon. That as long as the AI trade keeps on going, and that resonates with my point on the AI hyperscaler capex number, as long as that trade is on, those companies are fundamentally very well supported. Now, in the short term, the market gets ahead of itself. Too much money is flowing into leverage ETFs that buy those semiconductor stocks. And at any time, you're due for, at the faintest hesitation, you're due for some profit taking. But I don't think we have witnessed at this point already early evidence of a trend change in fundamentals.
No, you're absolutely right. So far, so good. And no one wants to be the first person out, right? And let it ride. Ride it as long as it goes on. Thanks very much, Yves, for joining us. And we look forward to more conversation here with you and your team on CNBC TV 18. It's a wrap on Bazaar. Thanks very much for staying with us. Markets are doing quite well. Advanced decline, the IT index, lots of stuff happening. So we'll pick it up on Chartbusters on the other side.
Stocks open higher, but off highs, and the market is still volatile as the US President Donald Trump says he's delayed the planned attacks on Iran at the behest of Gulf allies on the back of serious negotiations between the two countries. The Nifty hovers around 23,750. The broader market outperforms. The IT pack is the one that stands out.
Oil marketing companies trade higher as fuel prices are hiked for the second time within a week. Diesel prices see a 91 paise per litre hike, while petrol prices are raised by around 87 paise a litre. OMCs are now making losses of around 750 crore rupees a day versus the 1,000 crores a day last week before the initial 3 rupee price hike.
Puravankara returns to profitability in a strong fourth quarter performance. Sales volume doubles while margins expand to 20% from 5% year on year. The stock up 14%.
Astral trades with a cut of around 5% as the fourth quarter numbers widely miss estimates on all fronts. The margin for the full year is also at the lower band of the guided 16 to around 18%. Brokerages, CLSE and Jefferies both issue hold ratings on the stock.
Afcons Infra, that's the one which is under pressure. 3.5% lower on the back of a weak fourth quarter. Revenue declines nearly 20%. Margins contract significantly in a loss-making quarter.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And things looking good. There's only one man in red on the screen. That's Mangalam. Otherwise, the screen is quite green, Mangalam, and things are looking good. I think, this from yesterday's move actually is encouraging.
Yeah.
There is an expectation something's got to give. And I think, the bulls are coming to terms with that because yesterday we saw a big recovery. And if I put yesterday's recovery and today's together, we have recovered 300 points on the Nifty itself. On the Nifty Bank, it's even bigger. And the bottom of your screen, the rupee move, that's encouraging. You'll want to see more of the same. That's going to be very, very important to track from here. Stability in the rupee, some kind of a pullback. On a day-to-day basis, it's been sliding one way. Last few days, some hope with regard to the FI flows. Let's see how that goes. But stability in the rupee is good.
Stability in the rupee is good. Nigel, you're saying the market would, hope for some sort of recovery coming in the markets and maybe some respite on the peace front. I think, they're making peace with the fact that oil will remain around these levels itself and the market's contending to that. The fact that fuel prices have been hiked as well. So all these factors working for us. The last 2 days, the star has been the IT pack. The IT index is up nearly 6.5% over just the last 2 trading sessions. And as we speak, it's crossed the 20-day moving average. So if you pull up the 20-day moving average and the Nifty IT chart, it's close to around 29,200 thereabouts. And the 50-day moving average is 29,755. So let's see whether that comes about or no at some point in time. But this recovery definitely for the IT pack is heartening, more so for the mid-cap IT as well. So there you have it, the 20-day moving average on the Nifty IT index, which has been crossed right now. The 50-day is the orange line, which is just above where we are. So where does it go? The Nifty 2, very close to its 50-day moving average of 23,769 thereabouts. That's what the high of today has been. Perfect time to get in Dharmesh Shah of ICICI Securities for a quick technical check on the market. Dharmesh, the kind of recovery that we've seen over the last 2 trading sessions, do you think this sustains and we break above, or maybe we are testing the higher end of the range and now maybe something gives and we sell off?
So yeah, good morning, Mangalam. Absolutely, I think so. The way the recovery happened yesterday, trading sessions, almost from the bottom of around 61% retracement of this entire fall. We believe I think the market seems to be looking for some better news or some positive news going forward. The way the yesterday structure seems to be building up. Yes, absolutely, I think so. 23, 100, 200 remains to be the very strong support which we expect to hold in this current corrective phase. Thanks to IT sector, I think so. Yesterday clearly outperformed even in today's trading session. What is important is we are seeing the follow-up of the yesterday trading session, which was not visible for last so many trading sessions. So yes, IT from the closed territory seems to be looking much positive going forward for target on index level 34,500. But as far as Nifty is concerned, we believe I think so Nifty should eventually breach this level of 23,800 on the higher side, and we should be looking for target around 24,400 in the days to come. So we remain positive for the market. Any dip towards 23,200 to 500 should be looked as a buying opportunity.
Got it. Okay. All right. Dips to be used as a buying opportunity. Dharmesh says we're heading to around 24,400 odd. That's the possibility. Dharmesh, what about individual stocks?
As far as stocks are concerned, Nigel, we remain to be positive for Pidilite. I think so. Pidilite is something, the stock which has done nothing for last 4 years. The stock has been trading this trading range of 1,400 to almost 1,000 rupees. But we believe, I think so, the way the post results, the structure seems to be forming on the weekly chart. The stock has witnessed a falling trend line breakout of last 8 months, indicating the end of the corrective phase. We expect stock to head towards 1570, keeping a stop loss from 1395. So Pidilite is one which we like among the FMC, among the consumption side. Apart from Pidilite, pharma space clearly outperforming, I think so. Inside the pharma again, Kaplan Point, the stock has witnessed a faster time of retracement. Also, the corrective phase seems to be ending with a strong sets of volumes. We expect the stock to head towards 20 to 30, keeping a stop loss of 1875. So Kaplan Point and Pidilite remains to be at top.
As we speak, a lot of these EV players are doing extremely well. Ola Electric, for one, has moved higher to the high point of trade Aether Energy also has recovered about 2% from the lows and currently is at the high point of trade. So both these counters doing extremely well. Obviously, Aether has been a far bigger outperformer as compared to Ola, and Ola, as we speak, is off its highs, but finding some buyers at lower levels. Could this be because oil prices are higher right now and people are genuinely looking at EV as a solution or not? Well, we don't know, but what we know for sure is that our fuel costs will increase, and that's because oil marketing majors have have a reason in today's trade. That's because the government has gone ahead to and increased the prices on petrol and diesel by about ₹1 per litre. Sonal joins in with all the details. Sonal.
Well, that's the detail, right, that the price hike has come by. That's the second one that we've seen in a week. The last week it was done by ₹3 per litre. There's another hike that has come in for both petrol and diesel, which was required as well. The estimate suggested that the price hike had to be anywhere between 10 to 12 rupees per litre for petrol and around 20 to 21 rupees per litre for diesel, and some of it has come by now. Additionally, we do have IOC's numbers as well, which the company reported yesterday. The numbers were better than what the street was working with. Revenues up 1.5%. EBITDA was absolutely flat, but better than what the street was working with at 20,716 crore rupees. Margins at 9.9% versus 6.3%. Profits were down 6% on a quarter-on-quarter basis, but better than what the street was working with. The internals are strong because their petroleum products has done well. EBIT has come in at 19,218 crore rupees. This, of course, has a lot of inventory loss because crude inventory gains because crude oil prices surged. Petchem reported a profit versus a loss in the quarter gone by despite headwinds that the sector saw, and gas business saw an impairment loss, which is the reason why we are seeing a big loss here as well. Now, OMCs, as per Oil Ministry briefing, are incurring losses of around 750 crore rupees. This compares with 1,000 crore of loss that they were making per day. So yes, losses have come down, but more is needed definitely in terms of price hikes for them even to break even. We'll have to see whether we continue to see calibrated price hikes or not. If that happens, that of course is bad for consumers, but that's a good news coming in for all marketing companies.
Got that. Okay, good news for OMCs, but Sonal, we can't let you go so soon. Tell us about IGL. We understand they delivered a mixed set of results for the past quarter. Take us through details on that front.
Well, for IGL, yes, it was a mixed set versus what the street was working with, but it's the volume growth that the street seems to like. First, let me take you through the numbers. Revenues at 4,163 crore rupees, slightly higher than the poll. EBITDA has come in higher than the poll as well by around 20 odd crores. Margins absolutely in line with estimates, but profit has seen a decline versus the poll at 277 crore rupees. Overall volumes at 9.7 MMSCMD is an increase, around 5.5% on a YY basis, 2.8% on a sequential basis. This also compares with an estimate of 9.5 MMSCMD. Gross margins, they did see an increase on a YY basis, around 0.7%, but they did decline on a sequential basis. Understandable because of West Asia crisis, gas price hikes, something that impacted their costs and INR depreciation as well. Nomura likes their overall volume growth. They have a buy rating on the stock, but other than that, according to them, EBITDA was a miss versus their estimates. Now, in last 1 week, the company has increased CNG prices. There has been a calibrated price hike there as well, 3 rupees per kg by them. So it will help them make up for the losses that they are seeing on the EBITDA front. That is the other reason why the stock is higher in trade. We'll be speaking to the management today and get more details on what the outlook is going forward. For now, higher on IGL as we speak.
Higher on IGL as we speak, and as we speak, stocks moving higher as well. We do have Thangamel Jewelry. Remember, the management joined us here yesterday saying that it was a good performance that they've seen in the first quarter so far, especially demand. As far as demand is concerned, the recent commentary coming in and the recent, duty increase on import, gold import notwithstanding, because Akshaya Tritiya saw a 76% increase year on year, and the company is confident of maintaining their volume momentum going ahead as well with the next 2 years lined up for expansion around Chennai.
Well, that's right, Mangalam. A few stocks in the broader markets are making a bit of a move. Ola Electric, as you pointed out, tomorrow's the results. So I'm sure whether the street is finally expecting something because the stock has been a big underperformer, but that's moved up and it's moved up on large volumes. Another one that's moved up is dredging. Just pull up the intraday chart out there. Sharp up move is what you're seeing on dredging. I'm not sure whether there is any news flow, but that as well has seen a bit of a spurt in the last few minutes. So big uptake out there. Latent View is another stock that's now up close to around 8%. So individual stocks doing a thing of their own from the broader markets. I think dredging now up close to 10%. Unsure if there's a news flow out there. Latent View is the other one that I'm talking about. That as well has moved up. And remember, these are stocks that saw a sharp correction from the recent peak. And also Hind rectifiers. Yesterday when we were on the show, it was, I think, down close to 10 or 15% or thereabouts. It seems the commentary was quite good on the call. That one as well up close to around 10% as we speak. V2 retail as well, Mangalam. So quite a few stocks from the broader markets doing a thing of their own. I'll tell you what, we'll slip into a short break. We'll highlight a few more stocks that are moving around. Stay tuned. Welcome back. You did speak about V2 retail, Nigel. A couple of other retail companies, in fact, the ones particularly with the RPSG group are doing extremely well as well. Pull up the intraday chart of Saregama. That's a big spike that we've seen from the lows in just the last few minutes or so. The stocks moved to the high point of trade, 4% off this morning's low. And currently, in just the last 15 minutes or so, the stock has rallied about 3%. The other one is Spencer's Retail, doing decent volumes for this time of the day as compared to what we've seen in the last 10 days on an average. And the stock as well, nearly halved from the top that we see in the last 1 year itself. And that stock too is seeing a gain of almost 9%. So a bunch of these stocks, particularly belonging to the RPSG group, doing extremely well. But let's shift focus to the IT pack, because no move bigger than that this morning on the street, and none bigger than Coforge as well. It's one of the top F&O gainers today. That's because CLSA has come out with a high conviction outperform rating. Rima joins in with the details of that report. There you have it, the stock up 6.5%.
Thanks so much for that. Well, as you said, the entire IT pack is doing. Coforge is leading. CLSA high conviction outperform. Target is 2075. They see the company as the top beneficiary of the AI cycle. Strong execution reflecting in a better than expected FY27 margin guidance. And exiting the government project has helped the company improve the FCF, that's free cash flow to PAT conversion guidance that the company had given out post their quarterly numbers. So the company has been delivering well. The company was very confident about their FY27 guidance. They'd upped the free cash flow to PAT conversion guidance, and CLSA once again reaffirming their faith in the company.
All right, Rima, that's about Coforge, but TCS, that too has rolled out annual salary hikes. They've revised their salary structures as well.
Well, yes, indeed. But let me broadly talk about the IT sector and the up move that we're seeing today. So reason number one is the INR tailwind. When we ended Q4, the average rupee rate between the Jan to March quarter was about 91.5. Now we're looking at a rupee level which is below 96.5 nearly. So straight away, you've got a 5% rupee depreciation, which benefits the entire sector. Maybe it doesn't reflect completely in the P&L, because generally we had that math. 1% rupee depreciation benefits margins by 15-20 basis points. It may not reflect directly, but it acts as a cushion to absorb any cost pressures. So INR is acting as a tailwind. So even if the rupee, the top line growth may be flat for the company, as has been the worry, maybe the EPS growth looks a lot better with that. Secondly, as we know, IT stocks have been ranked underperformers. Till just 10 days back, the index was at a 3-year low. And, individual stocks are down 35, 40% in the last 1 year. And thirdly, the TCS price hike, the wage hike, right? It's caused a lot of anxiety amongst employees. Maybe employees are disgruntled because at an average level, Money Control reports, TCS has doled out a hike of nearly 5%. The top performers have got, just about 10%. Some of the lower end, the underperformers maybe have got no hike. People are complaining that actually because of the new labor code, my CTC appears to be on the lower side. There's a Mint report that talks about TCS asking managers to classify 5% of their employees as underperformers. But what it means perhaps from a stock market point of view is that IT companies are showing pragmatic cost discipline. They know the environment is tough, and which is why if you see the last 3 years, many companies have chosen to even defer their wage hike cycles by a couple of months. So TCS had deferred it between April 2024 to September 2025. It was a 17-month deferral. For Wipro, it was a deferral from September 2024 to March 2026, so nearly 18 months over there. Infosys has still not announced a wage hike for FY27. So yes, from an employee point of view, confidence point of view, it's not great, but from a company point of view, this does show some sort of a cost discipline. Back to you.
Got it. Thanks a lot for that, Shrima. By the way, just pull up the Nifty. The Nifty has now suddenly moved to the high point of the day, and it went very briefly to around the 50 DMA. Pull up a chart on the Nifty. It's crossed that 61.8% retracement mark, and now it's on the verge very, very close to the 50 DMA. That's the level you're tracking next. And after that, you look at the 20 DMA, which is ballpark around 24,000 odd. So keep an eye out. Nifty is getting to a very, very crucial zone. But let's turn our attention to another group of companies. That's Adani Group. The Trump administration has dropped charges against the group following a settlement deal. Sudarshan joins us to explain all of that to us. Sudarshan?
So there are two cases related to Adani Group companies, and for which the outcome has come from the US side. So US District Court has dropped the criminal charges against Gautam Adani, Sagar Adani, Vineet Jain and others with prejudice. So with prejudice here means it's a legal term, and it means an action or decision is final, permanent and binding. And this action has come after US DOJ had submitted the motion seeking dismissal of indictment. And it has said it has reviewed the matter and decided not to devote further resources to these criminal charges. In the second case, and that is related to Iran-related sanctions, US Department of Treasury has agreed to $275 million settlement with Adani Enterprises. And all these group companies are reacting to these matters and largely trading in the green.
Right, Sudarshan, thanks a lot for that. Market continues to do well. We have seen some up moves in the last few trading minutes. PB Fintech has moved to the high point of trade. Tata Tech is doing extremely well as well. In fact, the top 10 gainers today in the F&O pack, 9 of them belong to the IT pack. And the second spot goes to Angel One, which has actually seen an up move of nearly 5% from the lows as well. That stock too has moved to the high point of trade. What we'll do is take a short break, come back, speak about a lot of these stocks which are buzzing around. Keep it with Chartbusters.
Well, BSE stock has seen a big rally and it's up another 3% today. Earlier today, BSE MD and CEO Mr. Ramamurthy spoke to CNBC. He shared how the exchange is navigating challenging times given the geopolitical and the market environment. He also highlighted that the sharp rise in market participation over the past year. Let's hear out that conversation.
Somewhere it used to hover around 2 digits. 10 to 12% used to be the domestic one and 15% used to be the FPI holding, 15 to 20. Today it is reversed. If you look at last year, given the global situation, there has been an outflow, net outflow of around 36 billion US dollars by FPIs. But to compensate it, the net investment by the domestic institutions has been 91 billion. This has not only taken care of the outflow, but also strengthened the Sensex to a great extent and has prevented it from a free fall, notwithstanding the severe geopolitical tensions. So it's a very healthy mix at this point of time. Of course, there is a flight to safety by FPIs, and I'm sure once things normalize, the attraction of India as a growing destination will bring them back in big numbers as it was always before. When there is a turmoil like this, not necessarily the volumes go down. The economies get into difficulties, but volumes do not go down. For example, if you look at my cash market, last 1 year it saw around an increase of 30% and derivatives market around 40%. That is one point which we need to reckon. The second is, India is growing and a significant amount of population is yet to come into the capital markets, and slowly they are starting to come in. Last year alone, I have seen 35 million Indians coming and joining the BSE bandwagon by registering with their unique client codes. There's a second point which we need to reckon. The third is, more and more improvements need to be done and innovations need to be done in terms of products, considering which are all the sectors which could be seeing great volatility and where there is a need for product to hedge the positions of the individuals who are investing the money. We have introduced an index called Focused IT in the derivatives market, considering the turmoil in the IT industry because of supply chain issues and also because of AI, the demand for memory, and therefore the increase in prices. So IT stocks in India have become very volatile, and to take care of the hedging need, we brought this index. It is 5 days of trading we have seen till now, and it is really showing a lot of green shoots of growth. To keep up the momentum, I'm sure at some point of time when things settle down, the credit growth will increase, and therefore the corporates will be able to show better earnings with a better credit growth and better demand and supply and eased out supply chain situations. And that should fuel back the enthusiasm. And of course, Japan, Korea and all are economies which need to be looked into, and they can be growing faster once things become clearer. And a collaborative approach which India today is having towards multiple nations, and the principles and policies of ease of doing business which Indian government is pursuing should help in keeping up the enthusiasm and bringing it forward.
All right, so that is the management of BSE. With that, what we'll do is get you some ideas for profit from our colleagues at Money Control Pro. And today we do have Varsha, who joins in with a stock that she's tracking very closely. Varsha.
We are talking about Kajaria Ceramics, which is now seeing a strong recovery after a transition phase over the last year. The company reported a strong Q4 FY26 performance with revenue growing 12% year-on-year. More importantly, profitability improved sharply with EBITDA margin at 19.2%, supported by price hikes and better operating leverage. FY26 was a transition phase for Kajaria, marked by sales and distribution unification along with inventory correction, which had an impact on growth. But that phase now seems largely behind. Q4 volumes were up 11%, with demand improving steadily from January onwards. A key factor now is the disruption in the Morbi cluster. Higher gas prices have increased costs for unorganized players, reducing their pricing advantage and tightening supply across the industry. This is improving pricing discipline and supporting better realization for organized players like Kajaria. Kajaria also benefits from a diversified manufacturing base and fuel flexibility, helping it to manage cost pressure more efficiently. Overall, Kajaria is well placed to benefit from stronger pricing power, improving industry structure and steady market share gains going ahead.
All right. Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting for you. Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangala Malu, with me, Hormaz and Ritu. If you're a bull, it looks like a beautiful screen right now. The Nifty hovering closer to that 23,800 mark and making its total move from yesterday's low closer to 500 points, 450 to be precise. The mid-caps have it a lot better, with 2,300 stocks advancing for less than 600 stocks which are declining. That index has moved to the high point of trade as well. Add to that, the India VIX is lower, telling you that the fear may be subsiding, even though we're not out of the woods yet. Brent is contained around that $110 per barrel mark. The rupee is stable near record lows. And at the same time, the IT pack is the one which is doing all the dancing over the last two trading sessions. The Nifty IT index up 4% today, up nearly 7% in the last two trading sessions. The only question, whether this sustains or not. Good looking screen, Ritu.
Very good looking screen indeed, Mangalam. Good morning. And IT, like you said, that is the star today, helping the markets with those gains. The Nifty near the 50-day moving average. The Bank Nifty not doing as well as the IT index is still up, though, about 120 points as we speak. And the broader markets also looking good. But apart from IT, there are some other sectors that are also doing relatively better today. The realty pack, the FMCG, media, the private banking space is seeing a bit of a pressure. ICICI Bank, for instance, is one of the large cap stocks, that is seeing some pressure. It is exerting some downward pressure on the frontline index, but Infosys, TCS, TechM, all of these names are helping the frontline index look a lot better. But Hormaz, as always, has walked by to the wall to put a spotlight on the top movers in trade.
Well, it's been a good start to this weekly options expiry session for the index, and what was promising to be a soft beginning has now turned into a decisive move, at least as of now. The dips getting bought into. We are nearing the higher end of that 23,300, 23,800 range now, so it remains to be seen whether more supply emerges as we get closer to that. Of course, the currency opened lower, made a record low again, and then saw some recovery from the lows, still at 96.36, so still no major difference that you have seen on the currency. It's traded in a 10 paisa range all through the day, but the currency proxy IT continues to do well, and it did well yesterday, it does so today. So how? Look at Coforge, Oracle, Persistent, all of them have gained in double digits over the last two trading sessions. Coforge, of course, had a positive brokerage note as well earlier in the day. Now, take a look at the large cap IT names. They are not far behind either. Tech Mahindra is the top gainer among the large cap names, 9% higher here. Infosys is up almost 6.5-7%, and TCS2 has done fairly okay for itself, gaining around 4% in the last two sessions. Now, take a look at the earnings reactions. Now, the negative ones first. Jain Resource Recycling, the numbers came in just before market close yesterday, and the stock was down around 17-18%, and it's down another 16% in today's session. Astral is down 5%, and Afcons Infra at one point was down around 7% has seen some buying at lower levels, so still down 2% and well below its issue price. You take a look at the oil marketing companies in today's session. They continue to remain in the spotlight as well, easily gaining anywhere up to 3% for all of these: HP, BP, IOC, Indian Oil, of course, a result reaction as well. One stock that I wanted to mention, though, was PN Gargil. Barring a couple of sessions in between, the stock has been in a bit of a downtrend, and the circuit filters have also been revised lower. 5% lower circuit now on the stock. The 100 crore worth of shares had changed hands in a block deal that took place today, and the stock is now nearing its issue price as well. So it's now back to around 518 as is a PN Gargil. And lastly, capital market names that continue to do well. BSC, another day, another record for the stock. Market cap now almost quarter to 2 lakh crore rupees. Angel One in light also doing well, and MCX2 doing a fresh 52-week high in today's session, Ritu.
Thanks very much, Hormaz, for running us through that list. But let's focus back to the macros, because the rupee, new headlines every day. It's been on a downward trajectory. Bit of a stability today after that fuel price hike. But, it's made that record low of 96.39 against the dollar yesterday. Again, it opened weaker at 96.37 today, now trading at around those levels as well. We started the year at 89.97 against greenback. So we've seen a near 7% depreciation since then. That makes rupee one of Asia's worst performing major currencies this year. What's been worrying the market, like we've been telling you here, is the speed of the fall. I mean, that move from 95 to 96 took barely 15 days. Typically, a 5 rupee move would take as much as 5 years. So the depreciation is clearly accelerating. And what's putting so much pressure on the rupee is nothing new. The biggest factor remains oil prices because of what's happening in West Asia, and oil prices have remained above $100 a barrel Brent crude for nearly 2 months now. That inflates our import bill, and each rupee there, it affects the bill and, of course, pressures the rupee. At the same time, of course, the dollar itself has been strengthening. There's higher U.S. bond yields we've been talking about here. Foreign investors have pulled out more than 2 lakh crores in 2026 so far, 27,000 crores in May. Of course, they've been buying for the last 2 days here. Let's hope that trend continues. But all of that has added pressure to the rupee, and that's why that fall has intensified. The government and the RBI have taken several steps so far. For instance, the fuel price hikes we've been seeing. There are 2 hikes that have happened. RBI has been intervening heavily in both the spot and forward markets. It also capped the net open position of banks at $100 million a day to curb any speculation against the rupee. And of course, import duties on gold, etc., have also been raised. Could more measures be on the anvil? We'll have to see. But for now, the rupee looks like it remains under pressure. Let's go across to Dheeraj Nim, from ANZ, who is joining us here to decode this rupee move. Dheeraj, thanks very much for your time here. We know the fundamental factors have not changed. It's not new that, oil prices are very high. It's not new that foreign investors have been selling, although they have been net buyers the last 2 days. What explains this constant fall in the currency that we've been seeing? And, as a trader, while RBI has been intervening, clearly no line has been drawn, no level is being defended in the market.
I think the fundamental challenges remain, like you pointed out quite efficiently, in the sense that your current account widening is very much a pressure on the currency now, because the oil prices are possibly 50% higher than where they were before the war started, and they persist at those levels. I also think that, there is an expectations loop playing out in the market at the moment where the expectations of further rupee depreciation are so widespread that they have kept exporters at bay from converting their dollar receipts, which means that the RBI has to contend with a larger import bill, perhaps to stem depreciation pressures or control them. And I think that becomes a bit problematic, because once those expectations are as widespread, you may see further one-sided moves or accelerated depreciation, as you pointed out, continue for longer than you would have imagined.
But would you say we are in a structurally weaker phase for the rupee? Let's assume and let's keep our fingers crossed, the escalation in the West Asia, that comes to an end. Let's say oil prices settle down as well. How quickly can rupee come back to the kind of levels we'd seen, 12 months back? Or will this structural weakness, you think, continue? Because the problem is, on the capital, not just on the capital account front that we're trying to solve for, but also on the current account front. I mean, not enough dollars are coming in.
I do think there is a structural problem underlying the balance of payments. And our hypothesis has been, when you look at the stable capital flows that can fund, current account deficits on a going basis, it's just about 0.5% of GDP. And much of the problem lies with the decline in net FDI and other stable flows in the BOP. So if you were to take a step back and understand what really is a sustainable level of current account deficit for India currently, it's just about 0.5% of GDP. Now, oil prices added to that pressure. Oil prices added to the pressure that was already there because capital flows had virtually dried up, both on account of FDI and FPI, and also on account of banking flows as well, if you were to look at the BOP data. I think there's a broader ecosystem in which all of this is happening. When you look at the yields at both the ends of the world, the US and Japan, you understand that the cost of every penny in the world right now is very, very high. And in that case, if India does not have sufficiently scalable, investable themes, it would be very difficult to pull in a sustained amount of foreign inflows that can really fund the current account deficit on a going basis. So yes, in short, I do think there's a structural problem for the rupee, which is underlying the BOP configuration at the moment, and which is why also we think that the rupee's path from here on will continue to be on depreciation. Even if the oil prices problem were to resolve itself, I don't think the rupee can revert to levels where it was, let's say, 10 or 12 months ago. I think there is a structural problem here.
Right. There is a structural problem here, Dheeraj, but in light of this, how much weightage would you give to the government steps which have already been announced to, being effective enough to stem this decline? Because, the Prime Minister at best can only request the citizens to go ahead and try and save, forex expenditure. What are the other steps do you think that can be announced to perhaps increase our forex deposits as against, just stemming the flow out?
I think we need to take a step back here and understand that we got into this oil price crisis amidst a cyclical recovery in growth. Domestic demand was strengthening while we got into this oil price crisis, which means that, whatever steps that have been taken so far, in my opinion, are a fraction of what may be required to sort of tame the current account pressures to a level which is sustainably fundable. Now, if you're asking me, will they be enough? I think more such measures would be required, but I think the targeted measures, we may have seen much of that play out already in terms of, precious metal import duty hikes or import curbs, or now the gradually increasing domestic fuel prices. I would like to see more of such measures. Look, in cases like this, when you're facing an oil price shock, you need both expenditure switching, which is via a weaker exchange rate. You want to promote domestic production and consumption than imported. And you also need domestic demand compression, which is expenditure compression. For that, generally, you would need higher interest rates, etc. So I think that the government will have to give more of those macro changes rather than micro changes to actually contain the BOP shock, as it were, that we are currently facing. So perhaps somewhat weaker exchange rate, a freer exchange rate, higher domestic fuel prices that force households to recalibrate their consumption portfolios, as it were.
Okay. Dheeraj, very quickly, in just a couple of words, 96 has been breached. What is the next level you're watching out for in the near term, in the next few months?
Well, I'm very carefully watching the 97, 97.5 range, because I think that's when, again, alarms will ring again. And I think you can expect more unconventional measures from the central bank or from the government to support the currency. But 97.5 is also my year-end forecast for now, which looks very, very likely to be reached sooner than, the year-end itself.
97.5, the next level to watch on the currency. Dheeraj, thank you for sparing time and joining us today with your views on the currency, which continues to depreciate, but there is some recovery that you are seeing from lower levels as well. Take a short break, put the spotlight in the bond markets with Manisha Gupta on the other side. Stay tuned. Welcome back. As promised, shifting focus to the bond markets, then Manisha Gupta is here with the latest. Manisha.
Thank you so much for that. Well, see, we've seen a bit of a decline in the bond markets. Higher yields have continued just yet again, even as we haven't seen much of a change in the international markets when it comes to crude. But remember, they still continue to be at elevated levels. So even after that bit of a profit taking, you still are looking at 110 holding for the Brent prices therein. The US Treasuries also have, yields also have remained on the higher side, and that seems to be impacting the Indian markets therein as well. A lot of dealers and various reports from the industry do suggest that everybody is looking at benchmark 6.48% 2035 bond yield to continue to trade somewhere between 7.10 to 7.15%. Well, the elevated crude oil prices clearly is a major and a biggest concern for a country which imports nearly 90% of its crude oil requirements. It really is seem to be impacting the rupee as well, where we have seen record lows. It's trading very close to those levels even in the markets today. It is expected to widen the current account deficit. It also is going to complicate the government's fiscal calculations and maths, and that is where the concern seems to be coming in from. The street also seems to be working with, as of now, a 40% probability that the US Fed will hike one interest rate in the month of December. It also is about the corporate bonds. When you look at the overall overall behavior in the last 24 hours, we have seen the yields gain onto this one as well. Paper maturing from 1 to 3 years has been the most actively traded. Nobody wants to look too far away. And then the mutual funds were very active participants within the corporate bond markets yesterday. The spillover effect from the withdrawal of NABARD bond issuance on Friday is also something that seems to be impacting the markets therein. So when you look at the overall bond issuances, Monday was 45.5 billion, much higher than what we saw on Friday at around 29.25 billion. And finally, the private issuances today should come in on your screen. You have Bajaj Finance, which is looking to raise nearly 30 billion, and they're looking to do this via 10-year bonds. Kalpataru Properties is also looking to raise nearly 16.35 billion, and they are doing it through 4-year bonds. You also have MAS Financial Services. They are seeking bids to raise nearly 3.6 billion, and they are also doing this through 5-year bonds. Then you have Muthoot Mcred. They're looking to tap the markets to increase or raise nearly 3 billion. Indian Money is also looking to raise money of around 1.5 billion. All of these biddings are in the day today.
All right, Manisha, thanks a lot for that. So those are the updates coming in from the bond market. But, you know, the story of the day so far has been the IT pack. Even though the Nifty is marginally off highs right now, 23,700, that's where we are. And it's led lower by, you know, the Nifty Bank. And the IT stocks also, while off highs, while gaining well, are marginally off highs right now. So we'll monitor how this goes along. But that's the big story of the day. For one, let's go across to Rima. She joins in with why these stocks are abuzz, and also there has been a salary hike which has been announced across the board for TCS. What does this mean for the space? Rima.
One is the INR tailwind. When we ended Q4, the average rupee rate between the Jan to March quarter was about 91.5. Now we're looking at a rupee level which is below 96.5 nearly. So straight away you've got a 5% rupee depreciation, which benefits the entire sector. Maybe it doesn't reflect completely in the P&L, because generally we have that math. 1% rupee depreciation benefits margins by 15-20 basis points. It may not reflect directly, but it acts as a cushion to absorb any cost pressures. So INR is acting as a tailwind. So even if the rupee, the top line growth may be flat for the company, as has been the worry, maybe the EPS growth looks a lot better with that. Secondly, as we know, IT stocks have been ranked underperformers. Till just 10 days back, the index was at a 3-year low. And, you know, individual stocks are down 35-40% in the last 1 year. And thirdly, the TCS price hike, the wage hike, right? It's caused a lot of anxiety amongst employees. Maybe employees are disgruntled because at an average level, Money Control reports, TCS has doled out a hike of nearly 5%. The top performers have got, you know, just about 10%. Some of the lower end, the underperformers maybe have got no hike. People are complaining that actually because of the new labor code, my CTC appears to be on the lower side. There's a Mint report that talks about TCS asking managers to classify 5% of their employees as underperformers. But what it means perhaps from a stock market point of view is that IT companies are showing pragmatic cost discipline. They know the environment is tough, and which is why if you see the last 3 years, many companies have chosen to even defer their wage hike cycles by a couple of months. So TCS had deferred it between April 2024 to September 2025. It was a 17-month deferral. For Wipro, it was a deferral from September 2024 to March 2026. So nearly 18 months over there. Infosys has still not announced a wage hike for FY27. So yes, from an employee point of view, confidence point of view, it's not great. But from a company point of view, this does show some sort of a cost discipline. Back to you.
Rima, thank you for that update there. Let's continue this conversation forward with Sandeep Agrawal of Solo Investment Managers, who's joining in. Sandeep, good morning. Thank you for taking out time. You know, the one factor, the currency weakness, has been one of the biggest reasons why these IT names have moved up 10-12% in the last 2 sessions. You know, the question that first comes to mind is for how long can these names keep piggybacking on the currency weakness? Because the currency was weak in the fourth quarter as well, yet it did not reflect any significant margin benefits in the previous quarter. Do you believe that this recovery that you are seeing, because you can't call it a rally considering the sell-off that you have seen, is going to be short-lived, or do you believe that, okay, the valuations are cheaper, so you may want to buy into this?
Hi, thanks for having me on the show. So, you know, there are 3 things which are working together. So as rightly highlighted by Rima earlier, there is obviously a currency benefit which cannot be denied, and the number could be 15 to 25 basis point per 1% depreciation. So we are looking at 125 basis point of margin improvement just quarter on quarter, which is between 5 to 15% EPS jump depending on what is the percent operating margin of each of these companies. So that is one part. Second part, which is I think very, very fundamental, and if you recall 15 months back, since then I was expecting a 40-50% correction in the index level and a sharper correction in some of the names. I have been positive for last 1 month, and we have openly said that we are very constructive on the sector now, and I continue my stance, and I will tell you the most fundamental reason to be constructive is that, all this AI trade and this thing, you have to go and see the context. You see the data of last 25 years. The hardware cycle has started after 2002. So we have 22, 23 years of hardware cycle, which was very muted, low growth or negative growth. And now because of AI, the GPU demand and other RAM demand, memory demand, all of these things have suddenly, led to very sharp spike in hardware replacement, new hardware purchase. And that is the reason some of the front runner of the hardware companies like the NVIDIAs and others have done well. I think the second will be, the distributors who will build on these capabilities and will be able to distribute. And that is the reason you see this Microsofts and other players doing well, GNAI and others. I think the third in the chain is always the service providers like us, which are outsourcers, which are basically doing work for the distributors of the technology to the enterprise and to the retail, which in most of the FANG companies do participate, and also there is Grok and there is GenAI and few other names. So I think, our benefit always comes at the last, and I think we are at the beginning of that cycle where we will start getting benefit. Now, I'm not saying that we will see a 15-20% growth at the industry level or all that, but I think that the last 2-3 years, which have been very muted, I think the next 2-3 years will be more exciting and better. I think that at industry level, we should see 6-7% growth, and depending on each company, the growth could be little up or little below that. But there will be a growth which will come back after 2-3 years. Add to that the currency benefit, and add to that 40-50% correction in the valuation. So all these three things put together, if you do the maths, you will feel that the stocks are actually 70-80% lower than what they would have been if these things would not have happened. So from that perspective, it is very, very good level to buy in my view.
All right, good level to buy, Sandeep. So just a two-part question here. One, what should you buy? What would your, pecking order be here in the large cap and the mid cap names? And secondly, you said that there is growth which is likely, but there is also valuation derating which has happened. Could you expect valuation re-rating to happen? If yes, how much would the multiples increase by?
So, I don't think anyone is willing to give a valuation re-rating today because everyone is worried about the uncertain future, how AI will disrupt. While we have a very clear view that, and this is from beginning, that AI is disruptive, it will cut down 20-30% effort spread over 4-5 years of the contract period. So 4-5% deflation every year. Now, if you are able to do 6-7% net growth after that deflation of 4-5%, which I think Indian IT companies will be able to do, it is a great number, to be honest. And I don't think anyone is going to re-rate the sector in terms of multiple, but definitely there will be a lot of earnings surprise because most of the people have written down the sector as zero growth or negative growth. From that perspective, 6-7% growth in dollar and then currency benefit. I think next 3 years, the PAT number, whatever we have today, it should be broadly 75% higher than that. Now, for 75% higher PAT, even if you don't get any benefit of rupee, then also, any benefit of re-rating, I think, the stocks can move up 75% in next 3 years. That is the way I look at it, which is a very good return from a mature sector and a good cash generating sector, good corporate governance and all those perspectives. So I think good money will be made in next 2 to 3 years. Now that if that 60-70% return happens in 6 months, then this call is gone. But if it happens, the maximum time it should take is 2 to 3 years. Generally, market is very smart. They always upfront all the benefits. So I don't know when you will get that return, but I think that the time ahead will be very, very positive and good.
Mention stocks. The stocks.
Well, stocks is very hard. We run a PMS, so I won't be able to, but I will give you an idea. I am still not positive on the ER&D companies because I think they are insanely expensive. So I am positive on the large caps. I am positive on the mid caps in the IT services, the traditional services space. Some of the names have corrected very, very meaningfully, so they should do phenomenally well. The ER&D companies, I think that multiple challenges. One, they are very, very expensive. Second, they are also dependent a lot on the auto cycle. So I will avoid them because the chances of disappointment there is very high. So the ER&D and that space, product engineering space, I will be a little cautious. The traditional, the sector which is not liked by anyone, the traditional IT services, I will be very, very positive. I look forward to that. And also I look very positively on the distribution companies because I think the shortage of all the memories and everything, they will lead to huge benefit going forward. Not immediately. Immediately there could be some negative, but in next 1 or 2 years, they will generate huge wealth. That is the way I will look at it.
Got it, Sandeep. We're out of time, so we'll have to bid goodbye. Thanks very much for your time here, and we hope to have you back again sometime in future. On that note, we'll slip into a break, but when we return, we're going to discuss market technicals with Sachit Anand Uttekar from Trade Bulls and also discuss his top trading bets.
Well, the market's higher, but slightly off highs. What explains that? It's the Nifty Bank which is underperforming. Perfect time to get you the update coming in from the F&O space. Look at that. The Nifty Bank is marginally in the red. The Nifty is doing extremely well, and that's courtesy the index on the third plate out there. That's the IT index, which is up 4%. The IT index, after today's move and the move yesterday, has conquered its 20-day moving average. The question is whether it goes past its 50-day moving average or not, which is close to around 29,755, a couple of hundred points from where it currently is right now. The Nifty, however, twice this day has gone ahead and crossed the 50-day moving average, but refused to stay above that. So that's a level that we have to cross and close above for it to then look at the next level, which is 24,000. There is declining fear, which is good. The India VIX is lower by about 5.5% in today's trading session. Macros are contained. The oil is hovering near that $110 per barrel mark, along with the dollar rupee near the record low, consolidating around these levels. Market breadth is firmly in favor of advances. Midcap IT, that's where a lot of fresh longs and short covering positions are being taken. So you have Coforge, Emphasis, Birlasoft, OFSS, First Source, Persistence. Among the top 10 F&O gainers, 9 belong to the midcap IT space. But because there is still some congestion around levels where we are on the frontline index, the option writers are writing both a call and a put together at 23,750. So that straddle comes up for you. The 23,750 put has a premium of 56 rupees. The call comes up for you. That has a premium of around 40 rupees. So, the call and put together are trading at around 100 rupees. So if you're selling that straddle, both the 23,750 call and the 23,750 put, you are playing for a level between 23,700 at the lower level to 23,800 at the upper level. That's the narrow range that we're trading with. In case you want to broaden that, the 23,700 put comes up for you, as does the 23,800 call. 30 points, 50 points on either side. So if you're writing all these options, the level that you're playing for is 23,650 at the lower level to 23,850 at the upper level. But a lot of long positions added on the IT pack, as we spoke about. TechM, PB, FinTech, both of them stand out. But Astral, post its poor numbers, the stock has seen some sell-off and currently at the low point of trade.
All right, thanks, Mangalam. Now, with that set up, let's invite Sachidanand Uttekar from Trade Bulls to join us for a quick technical check of the market. Sachidanand, we've seen a rebound from the lows, some bit of improvement in the market today, now near the 50-day average. Do you think it consolidates at these levels, goes up from here? Do we sustain these gains? What are the near-term levels you'll watch out for? And in the current environment, are there any particular stocks that you'd want to highlight?
Good afternoon, Ritu. Good afternoon, Mangalam. Clearly, when we look at the Nifty and the Nifty Bank, the bias for both the indices remain neutral to negative. The primary reason being that both the indices are still trending below their 20-day exponential moving average support resistance. If you look at the overall construct, even last week on Tuesday, we saw a very sharp cut in the Nifty, wherein it breached below that 23,800 support, and we saw a very significant decline towards 350 kind of a zone. After that, the last 5 trading sessions are concealed within this particular price range itself. Again, we have seen the Nifty, elevating itself towards the upper end of the range. But if you look at the overall structure, there are no major signs of a higher top, higher bottom sequence or a change in sequence on the bullish side. So we believe that the Nifty is still stuck in that particular range. We need a very confirmed closing above that 23,840 mark on closing basis. Only after that we could assess that there is a trend change in motion. But else we are expecting that this particular range may hold for next few trading sessions. And since the Nifty is trending near the higher side of the range, it is better to create some fresh short positions here. The stop loss for the trade can be placed at 23,820 on closing basis. From a trading perspective, we are again expecting a swing back towards 23,640, 23,550 kind of a range. When we look at Nifty Bank as well, the data is much more significant here because the daily ADX has given a breakout above that 25 level. So we are expecting that there could be fresh momentum on the lower side, which can unfold in a day or so. And hence, even on Nifty Bank, we are, advising building fresh short positions. One can keep a stop loss at 23,760 on closing basis and expect a move back towards 52,700.
Well, in light of that, Sachidanand, what are the specific stocks that you're recommending?
Good afternoon, Hormoz. Since we have a bearish bias on the Nifty Bank, ICICI Bank could be a significant contributor. Disclosure would be that we have recommended this particular trade setup to our clients as well. We have a sell recommendation in ICICI Bank today, keeping a stop loss at 1248 on closing basis. Fresh short positions can be deployed for a trading move towards 1210, 1200 kind of a support, which could be seen in a day's time. So we are expecting fresh weakness in ICICI Bank. If you look at the outperformers, clearly Nifty Pharma is something which is still very steady. And within that particular space, Zydus Life has given a fresh breakout from a bullish flag formation. The long auditions are also significant, and hence we believe that sooner or later we may see this particular outperformance extending towards its September 2025 highs, which are placed at around 1,060. So we are expecting this particular move to unfold soon, and hence we are recommending building fresh long positions in Zydus Life. One can keep a stop loss at 990 on closing basis and expect an immediate swing towards 1,035, followed by a positional target of around 1,060.
All right, Sachidanand, we'll leave it at that. Thanks very much for joining us here today. Let's take another short break, but don't go anywhere. Up next, we're going to be discussing market fundamentals with Srinivas Rao Ravpuri from Bajaj Life Insurance. Welcome back. We have Srinivas Rao Ravuri from Bajaj Life Insurance, who's joining us now to discuss market fundamentals. Srinivas, thanks very much for your time here. Let's start with the IT pack. That's been the star performer of the day, up more than 4%. Of course, the weakness we've seen in the last 1 year, that remains. But the tailwind is coming from the rupee. In the near term, given this yo-yo we've seen, big, underperformer last year, some, now help from the rupee. How long does this last? And, would you say this is an opportunity to consolidate, to buy the sector?
First of all, thanks for having me, Ritu. Yes, I think IT sector is seeing a bounce back. I think this is a tactical play at this point of time. I think IT is now become an anti-AI play. We've seen Korea down, AI play down, and then IT sector actually gaining from this. But when I'm seeing IT sector per se overall, where we are today, after this sharp correction in the last 12 months or so, today they are available at 4% dividend yield. And I think if you see the guidance, the large companies have given a guidance of about 2 to 3% volume growth. But thanks to INR, I think we will end up with a close to 10% plus earnings growth for the IT companies in the current year. So in the environment that which we are in right now, I think macro is looking vulnerable actually, and that is actually reflected in the way INR is behaving. So IT is a safe bet right now, given all these factors, and there is a visibility of 10% plus earnings growth. Will it mean we will see a re-rating of the sector? I don't think we are talking about a re-rating, but definitely there is a tactical trade right now here.
Light of these uncertain macros, Srinivas, where are the areas that you would look to put money to work with or look to generate alpha there? Because with a lot of these names that are beaten down right now, do you see a pocket that has emerged as an attractive bet in these times?
Yeah, hi, Amos. We are in interesting times. So I was just seeing the numbers. About 300 plus companies of the Nifty 500 declared results, and all of them reported fairly decent number. I think the aggregate growth is close to 17% for the fourth quarter. However, when we're talking to companies, we are clearly getting a sense that the first quarter is going to be not so good. The real impact of the war in terms of increase in the input prices, supply chain disruption, we will actually see that getting reflected in the first and second quarter numbers. So to that extent, I'm still positive on financials, domestic plays, but it has become extremely, a stock-specific story. I think overall, sectorally, it's becoming a challenging as things stands today.
Right. I'm looking at some of your top holdings, and they do include some of the consumption names spread across both discretionary and staples. You have HUL, there's Britannia, there's LG Electronics, there's Maruti, there's Eternal. Auto stocks obviously under pressure right now. Discretionary consumption under pressure on fears of inflation, whereas staples right now, again, there is not enough growth out there. So what are your thoughts here, and what could the impact of this war be over the next 2 or 3 quarters when it comes to their margins and likely demand because of inflation?
So Mangalam, I think staples for I think almost 8 quarters, we've been seeing a lower single-digit volume growth. And from there is some pickup. I think actually, before this war, we were in a very, very good spot thanks to GST cuts, etc. We would have seen a very healthy growth in numbers and earnings. However, I think post this recent events, we will see some impact. However, I think the secular steady growth story that staples offer is where some people are taking comfort. We are also taking, given that the name that you have taken are also part of our indices. So we are not that negative on staples, and that's why we've added. Coming to the discretionary, I think this is space where we are a lot more positive. And as numbers are coming, even for the month of April, May, what the sense that we get is auto numbers are holding up pretty well. I think that's where the discretionary is playing out when it comes to the consumer durables. The extended heat wave that we are seeing will have a positive impact on consumer durables. I think we will see overall domestic plays doing better in the coming months and weeks.
All right, Srinivas, we'll leave it at that. Thanks very much for joining us here today. We appreciate your time. We'll step into a short break, but up next, we'll be joined by Karan Taurani of Elara Capital to discuss the impact of the fuel price hike, especially on the quick commerce sector. Stay tuned.
$23,750. So the Nifty is touching both the lower and the upper ends of the range. 23,700 to 23,800. The narrow range is what we're looking at, but a bunch of stocks doing well, of which Eternal really stands out in terms of gains, among the top gainers that we've seen on the Nifty in today's trading session. Karan Taurani of Elara Capital joins in. He's written a note this morning to discuss the fuel hike and its impact that it can have on both quick commerce and food delivery. Karan, welcome to the show. You've done this sensitivity analysis. Fuel prices have increased by about 4 rupees per litre. Chances are, given the crude prices, they could increase by a couple of more rupees going forward as well. So, basis your analysis, could you give us a sense on how much could the impact of this be on the EBITDA margins? Were the companies to not pass it on? And if they were to pass it on, how much the impact could be on, demand? So, basis your report, the analysis, what is the scenario for both Zomato or Eternal and Swiggy?
Hey, Mangalam, good morning. So I think if you look at the math here, we'll have to firstly break up the per order cost. It's quite different for food and the quick commerce business. Food is somewhere close to 60 odd rupees and QC is somewhere close to 40 odd rupees. Assuming a 45 to 50 rupees per order cost, what happens in this is in terms of breakup, 20% is fuel cost, 80% is labor cost. So effectively, you've got 10 to 11 rupees of fuel cost, which is priced into this per order math. Now, the fuel prices have actually gone up by 4 rupees, which is around 4% on a pan-India basis on an average, which means that effectively there's a 40 paisa of hike on a per order basis for these companies. Assuming that you do see further inflationary pressures on fuel and probably it goes up by 10%, which is 10 rupees per litre, there is a 1 rupee negative impact on a per order basis. Now, assuming that this is not passed on to anyone in the ecosystem, whether it be the gig workers or to the customers, the platforms have to bear the entire brunt of this cost. Now, this cost ideally, in terms of absolute number, is around 150 to 300 crores, which is 150 crores for Swiggy, basis FY27, given the number of orders that we assumed for both QC and the food side. And it's higher towards 270 crores out for Eternal, right? But one caveat here is that around 20 to 40% of the orders today are through EV. So on the food side, what we have assumed that 20% of the orders are through EV. But in the case of QC, that number is close to 40 odd percent. So a blended EV penetration is about 30 odd percent, which means the number comes down further in terms of the effective impact, right? So in a worst case scenario, you see a negative impact of 5 to 10% on absolute EBITDA for Eternal and Swiggy because of this fuel price hike.
Okay. Okay, 5 to 10% EBITDA hit because of the fuel price hike. But Karan, given that Zomato or Eternal's customer base is a little more, I don't know, would you say tolerant of these price hikes if the company does take it? I mean, do you see it as that? I mean, more able to pass it on to customers? And this second order effect that you've spoken about in your note, has that already been priced in by the market or, not yet?
There are two things to play out here. Firstly, there are three people in the ecosystem here. One is the platform, second is the worker, third is the customer. So what we spoke about in terms of 5 to 10% EBITDA downgrade impact, first caveat is that this is basically a worst case scenario wherein you're talking of a 10% fuel price hike. That is there. Second thing is that we are talking of a scenario wherein the entire negative impact will only come to the platform and not come to the customer, right? So if you look at some of the proactive measures, specifically by the likes of Blinkit, they have increased 1 rupee handling fee in the last 2 to 3 months on the QC side. Both Swiggy and Zomato on the food side, they've raised the platform fee by 3 rupees in the last 2 odd months. So I think these are some levers to kind of protect this fuel price hike going ahead, which means that the negative impact on the margins will not be extremely high in the range of 5-10% as pointed out by us. And there will also be some bit of compression from the gig worker side as well. Because effectively what's going to happen here is that even they'll have to take some kind of cut in terms of their margins. And they're not liable to pay the fuel price hike to the gig workers. So there could be some kind of noise, some kind of strike, some kind of higher payout. But effectively, it's not that the entire fuel price hike will be passed on, from the platform side to the gig workers. So it will be spared partially between these three players in the ecosystem. So fuel per se is not like a huge negative impact for Zomato and Swiggy at this point of time. We believe the bigger negative impact is something else here. One, of course, is the consumption pattern, right? So because of fuel prices increasing, we may see inflationary pressures, which might impact discretionary wallet spends, right? So obviously, a quick commerce, as you know, specifically for Eternal, it's more premium in nature because they do have handling charges. It's got a premium AOV as well. So this can impact frequency, both on the food and the QC business, and eventually have some bit of impact on the growth rates if this inflation issue persists for the next 3 to 6 months. That's the first impact. I think the second big impact is ad revenue. I think we have to look into point here that for many of these platform companies, 80-90% of their EBITDA comes from ad revenue, even more than that in certain cases. So very clearly, because of the situation right now, the smaller QSR chains, the smaller standalone restaurants, may not be able to spend aggressively on ad revenue, which can impose some bit of pressure on the margins. Of course, there's LPG issue, there's food inflation, there's oil inflation for the food companies as well, which will also have a negative impact from their probably assessing a lot of ad budgets to the food tech platforms. And second impact is on D2C brands. So quick commerce, as we all know, D2C brands do draw a large chunk of the traffic and ad revenue, right? So I think if there's an inflation in packaging costs, if there are inflation issues on their business models, which are going to be challenged, ad revenues may not flow through in the QC business as well. So that's a bigger margin pain than fuel price hike.
Well, in that case, Karan, it's almost as if it's a lose-lose situation, right, for these platform companies right now, because it's not a situation which is flaring up today and will be resolved tomorrow. It's a problem that may go on for a while, and it's not as if even if the war ends tonight, the situation is going to come back to normal the very next day. With such kind of a scenario, do you believe that the first quarter numbers for both Eternal and Swiggy could turn out to be slightly challenging, considering the risks that you are highlighting?
Yes, absolutely. I think invariably on the growth side, there could be a certain amount of challenges as far as order volume growth, customer growth is concerned, even frequency to a certain extent. What we saw in Q4 was no big impact because the war actually started off in the first week of March. And it was just a 1 month impact. But given the situation where we are in, there could be some bit of negative surprises, especially for Q1. But as I said, on profitability front, there are levers intact in the form of handling fee, platform fee, and eventually these kind of impacts being passed on to the customer. But if at all ad revenue environment change in a very big manner, we may not see a big negative impact then as well. But growth rates, yeah, there could be some bit of negative surprise for Q1 FY27.
All right, Q1 FY27, there could be some negative on the growth rates, not so much for the operational performance. Thanks a lot, Karan, for joining in. We'll obviously continue our conversation around this through the course of this quarter, try and get a better picture on how demand is on the ground as well. We take a short break, come back, get you more on the markets on the other side. The Nifty now moving once again towards the high point of today's trading session with a gain of almost 111 points. The only alternating factor between red and green for the Nifty is the Nifty Bank, which is now marginally in the green by about 55 points. So the Nifty Bank is the one which ensures whether the Nifty moves to the lower end of today's narrow range or the upper end of the range. Take a break, come back.
Welcome back. Today in the macro signal, we're looking at the latest data that has been released by RBI in its payments report, and it finds India now processes 77.6 crore digital payment transactions every single day. So over the full calendar year 2025, the total payment volumes actually hit more than 26,800 crore rupees against just about 6,400 crores in 2021, which is a four-fold jump in 4 years. In value terms, the system processed about 3,250 lakh crores in 2025, which is nearly double of what we've done in 2021. And digital payments, unsurprisingly, they account for 99.8% of the share of the total payment volumes. Now, a few other trends that we'd like to highlight that stand out. UPI, of course, is the dominant force. It accounts for more than 85.5% of payment transactions by volume, and that's not at all a surprise. But in value terms, UPI still accounts for just about 9.5% of payments. And what's more worrying is that UPI's average ticket size has been falling over the years. Now, why we're looking at this is because as UPI scales to hundreds of crores of transactions every day, every month, the individual transactions are getting smaller, not larger, and that is important because UPI is going deeper into micropayments. You know, your chai, your auto rides, your kirana bills, all of that is UPI, and that's great for inclusion, but it raises a fundamental question about the viability of the system because we're still running with zero MDR, ticket sizes also coming down, and so the unit economics for every UPI payment service provider that is riding on UPI is pretty much moving in the wrong direction. Another interesting trend that stands out in the report is the complete unraveling of the debit card. In 2021, we processed about 408 debit card transactions that were worth about 7.4 lakh crores. By 2025, that collapsed to about 133 crore transactions worth 4.5 lakh crores, volumes down 67%, value down nearly 40%, and yet we have about 103 debit cards that are outstanding in India, which is more than ever before. So cards are being held, but they're not being used. So UPI has done to debit card pretty much what email did to facts. The implications for public sector banks particularly are significant because these banks hold 63% of all the outstanding debit cards. Now, credit cards, as we've been telling you, here is the exact opposite story. Transaction volumes are up, from 216 crores in 2021 to 570 crores in 25. Value has more than doubled as well in this period, with a compounded growth of 27%, both volume and value. And the market structure shifted as well, where private banks have tightened their grip. Their share of outstanding cards has gone up to 71.1%. Foreign banks have been effectively wiped out, just about 3.8% share now. Small finance banks are entering, but they're still very much at the margins. So what's emerging from all of this is a pretty bifurcated payments economy. UPI dominating the low-ticket daily commerce. Credit card is consolidating the high-value consumption and lending, and the middle layer, especially your debit cards, they're pretty much getting hollowed out. So that's the macro signal for you for the day. And on that note, we're also going to wrap up Trading Hour. From Hormaz, Mangalam and me, it's a goodbye. Stay tuned. Halftime report will be up next.
Midcaps charge up as hopes of a deal between US and Iran rise. IT and realty are prominent gainers while financials cracks.
Oil marketing companies push up petrol and diesel prices by less than ₹1 in what seems to be an effort to pass on some of the crude oil inflation in a calibrated manner.
Leading economists tell CNBC TV 18 that more steps will be needed to curtail India's current account deficit. They, however, did not expect any change in taxes for foreign investors.
Oil cools after Trump calls off planned strikes on Iran after heads of Gulf nations urge restraint in light of progress in talks and extension of waiver on Russian seaborne oil also eases supply concerns. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it is turning out to be a session where we are seeing the Nifty up around 0.4% at this point in time. And what we are seeing is that the mid-caps are doing much better in today's trading session. So the mid-cap index itself is up around 1.4% at this point in time. We have an advanced decline ratio, which is positive as well. So over 2,700 stocks advancing to 1,200 to 1,300 stocks declining at this point in time. Separately, just want to point out that we have, if you look at it from the time the West Asia conflict began on the 27th of Feb, you have a couple of these indices which you should probably just have a check on. Brent crude is up around 50% from those levels. When the conflict started, Brent crude was at around $72 per barrel. Now it's at around $108, $109 per barrel. The rupee has depreciated almost 6%. The Nifty is down around 6% but the mid-cap index is up around 3.6%, and the BSE 250 small cap index is up around 6%. So there's been more resilience and outperformance which has come in for the broader markets as compared to the frontline indices. But Brent crude and rupee obviously continue to remain on the boil. Hi, Vinny.
Hi, Ekta. Good afternoon. So in terms of the markets and obviously rupee, Brent crude oil, all that is what we'll keep an eye out on even going forward as well. But today, Nifty IT surely is managing to hold on to very strong gains, right? And the last two trading sessions, it's up more than 6%. As of now, most of the sectors are trading in the green. Realty, IT, media, auto are the gainers over there, and a lot of individual movers on the back of their earnings as well. But we have a very exciting lineup for you all on the show today. We'll be focusing on Q4 FY26 earnings. We'll be speaking with the management of Sanathan Textiles as well as Latent View Analytics. So stay tuned in for that. And in our What's Trending segment, we will be putting the spotlight and focus on macros and talk about rupee as well as the fuel price hikes from OMCs. And Vivek will also join us on the show, and he will be taking us through the buzzing stocks and big movers in today's trading session. So stay tuned in for that. But we'll go to Vivek first up and take the list of stocks that are there moving around in the trading session. Afternoon, Vivek.
Good afternoon. Well, thank you so much for that. Quite a difference 24 hours has made, especially in terms of the market breadth that you're seeing as far as the broader end of the markets are concerned. First on the list, of course, has to be the entire IT pack. Most of the IT names, a bit of an unwind as far as the AI trade is concerned in the US markets, seeing a bit of a positive rub-off on the Indian IT names. Most of the names, especially mid-cap IT companies with high growth visibility, doing very well. Coforge up almost 6.5%, and all of the other names up anywhere between 2 to 5%. Policy Bazaar, this particular name, continues its up move. Saw quite a bit of volatility in the week gone by, but continues to remain one of the top F&O gainers even in today's trading session. Latent View Analytics, numbers came in over the weekend, but post the call yesterday, stock higher by almost 5%. Realty pack seeing quite a bit of a strong comeback. Names like Godrej Properties, Prestige, Estate, DLF, all of these stocks doing quite well in the session. Godrej Properties up over 3%, Prestige to almost 4% higher. And the entire exchanges capital markets team continues to do quite well. Despite most of the curves in terms of F&O trading, what you're actually seeing is that increased volume activity, especially BSE look almost 3.5% higher. Angel One up 5%, both are also doing quite well. On the other hand, quite a few laggards as well. Strides Pharma, one of the top drags today. Astral, muted Q4 miss across most of what the street was anticipating. So that particular top F&O laggard, Astral, is the one that we're talking about. Triveni Turbines, this particular stock has seen significant margin contraction in Q4. That particular stock has seen significant selling pressure. Uno Minda is the other name on our radar. Yesterday was one of the top laggards. This was after the management guided for 100 basis point compression as far as margins are concerned. Today lower by another 2.5%. And Afcons Infra weak across all metrics. The company missed even the revised lower guidance, and that stock lower by another 2.5% today.
Okay, all right, Vivek. Thanks very much for bringing us all of those buzzing stocks which are in focus. But let's talk about one particular company. Sanathan Textiles is the first management on the show. The EBITDA sees a strong expansion. And however, there is some pressure with regards to higher depreciation and finance costs, which have weighed down on the bottom line. The Punjab unit ramp-up has also boosted volumes. We have Samir Dattani, who's the executive director of Sanathan Textiles, joining in. Samir, hi. Thanks very much for joining in. Well, you know, the last time when you had joined us, you had told us you were quite confident of doing, say, around 4,000 crores in terms of FY26 revenues. You've just closed shy of that figure at around 3,800 odd crores. Tell us what took place this quarter, what resulted in the shortfall, what were the challenges that you might have seen?
So the increased revenues were obviously going to be because of the Punjab facility that we have started. Very exciting for us that we have finally managed to commission the entire facility. It's a greenfield project, and the entire team has been working on this for more than 3 years now. The little bit of shortfall of revenue from what we anticipated was only because it took a few months more than what we anticipated in terms of commissioning of such a large facility, which has a revenue potential of almost 4,000 crores, phase 1 and phase 2 put together in the coming years, additional revenue potential. So that's the only reason. But what you can see in our numbers is that the facility is fully up and running. We haven't been able to utilize much of it in Q4 in terms of the install capacity. And Q1 of FY27, we'll be now stabilizing this facility, improving our product mix, improving on our efficiencies. So we'll definitely see a better capacity utilization in Q1 of FY27, and we'll see the full thing kick in and stabilize, and the potential of Punjab will be visible from Q2 onwards in FY27.
Sameer, last time you spoke to us, you gave a guidance for FY27 in terms of revenue of around 6,000 crores. Does that still hold?
Yes. I would say conservatively 5,800 would be a good indication to give. But to be very honest, in our business, revenue is also a function of the selling price. And how we track things are EBITDA per ton. Because when cost goes up, like they have gone up recently in our PFY, polyester filament yarn segment, because crude has been up almost 50%. Our raw material costs have gone up 30-35% in the last 2 months, which is quite abnormal. It's not normal. We see an annual raw material movement of 10%. Here we've seen a movement of 30-35% in 1 month. What's good is that demand still holds up. We are able to ramp up Punjab. We are able to utilize it fully, sell it fully. We are able to increase our wallet share and market share with customers, especially in North India, where our new facility is stationed. And the pass-through of raw material has happened. Though it's happened with a lag, like it always happens, because it's been quite volatile, like we all have seen. So the pass-through has happened of the increased raw material cost, increasing our product price upwards, which will, if it sticks at these levels, it potentially could give us a much higher revenue. But what we track is our EBITDA per ton. And
what is that right now?
Right now, EBITDA per ton for last year was close to 9,500 rupees.
Okay, so you closed FY26 with 9,500 odd rupees. What are you guiding for in FY27 based on what you are seeing, how much you've managed to pass through?
So, see, the EBITDA increases because of operational efficiency. It's not totally a function of the increased raw material cost. And I think we are aiming to do an EBITDA of between 10 and 11,000 rupees a ton on a console level for FY27. So a decent improvement. Punjab coming in will give us that economy of scale, improved efficiencies. It's a new facility. So at a console level, we will have that. Plus, we're also seeing that if you see our Q4 EBITDA standalone numbers, we've managed double-digit EBITDA for Q4 standalone. That is also an indicator of the margins being at its bottom and demand being strong enough. So if there is a bit more stability in terms of economy, raw material pricing, etc., we are definitely seeing an improvement in that as well.
So just on the bit with regards to margins, because your guidance was 10 to 11% EBITDA margins for FY27.
Double digit, yes.
Yes. So how exactly are you placed in terms of the margin guidance going into FY27? Are you sticking to that figure?
So I think more than giving a margin percentage, which could be a bit misleading, like I said, because it's a function of the selling price. We are definitely aiming at doing an EBITDA of more than 500 crores for FY27, which will be a 75% increase from our FY26 numbers.
Okay. Sameer, while Punjab is done, we've spoken about it as well, right? Phase 1 is done. What about Silvassa? You touched upon it last time. That's coming, and investors are waiting to know more in terms of the contribution that comes in from here. You've spoken about it being high margin as well. So when does that start actually coming into your revenue? What is the revenue expected maybe from Silvassa as well?
So, when we were setting up Punjab, there was a lot of curiosity regarding Silvassa continuing to deliver, especially because we're increasing our capacity by more than double in Punjab at a total level. But if you see, the Silvassa revenue in FY26 has been rock solid and consistent at about 3,000 crores. Q4 standalone Silvassa has had a margin improvement, a double-digit EBITDA for Q4. So I think this indicates that Silvassa will continue to operate at a steady state. We're utilizing that facility fully, more than 95-96% capacity utilization. Also, I'd like to add that at Silvassa, in this FY27, we're going to be doubling our yarns for technical textiles. So that expansion project is very much on track. By end of Q1, we are hoping to commission that new small additional facility, and that is expected to give us an additional revenue, annualized revenue of about 110 to 120 crores in Silvassa. We'll get about 3/4 of that.
Sure. Just wanted to get a more granular perspective from you with regards to demand, because you are guiding for a strong FY27. But are you seeing any kind of diversification to, say, China, Bangladesh, much more than what you were probably seeing in FY26? Give us what you are projecting in terms of demand and what's happening on the ground.
So in FY26, we definitely saw some diversion in the export market, and we very consciously pivoted our export down to as much as 5% of overall revenue. But with these latest developments and the government support and positive push that we've had from the government with the new FTAs, whether it's UK or EU, we are very confident that India, as a textile manufacturing hub, will be able to capture new markets and new demand in the coming years. So even at Sanathan Textiles, our direct exports, so we have direct and indirect exports. Obviously, indirect exports is a much larger bucket where customers who buy our yarns manufacture the fabrics and garments and then they export them globally. But we also have direct yarn exports, and we are definite that there'll be an increase in our export revenue. Compared to FY26, FY27 and 28 revenues will be stronger. These new FTAs and arrangements will put India at a far more stronger position globally and make us more competitive compared to other peers around the world.
But are you in talks with any global players?
Yes,
and
yes.
UK, where is it from?
Yeah, since UK and EU have had the most excitement. Even after the tariffs rationalized for US, we've seen an increase in US buyers again. It had taken a hit in Q3, largely in Q3, a little bit in Q4, but by the middle of Q4, we've seen US orders coming back.
Okay. If you had to just highlight quickly, Samir, what might be the one big headwind that you think would probably be something that the company is bracing itself for in FY27, what would it be?
So I'm discounting any external economic impact. That there is a murmur around us. Geopolitical issues around the world are not in our control. I think more than headwind, our biggest focus, how I would put it, is on stabilizing our operations at Punjab. Because once that happens, you will see a massive bump up in our PAT margins as well, because the entire depreciation and interest cost that's now fully hitting the books gets absorbed across the entire capacity for the entire year. So our Q1 is important for us to stabilize Punjab's and make sure that we're able to fine-tune our product mix, improve our production efficiencies that we are already seeing at Silvassa to bring Punjab at par. So that's totally in our control, and that's what we are gunning for, and our target is to do that. The second thing that we are now preparing internally is phase 2 expansion at Punjab, because the phase 2 expansion at Punjab is going to give us an additional revenue of 1,000 crores, and we are hoping to start execution of that sometime this year. We'll make a formal announcement once we start our journey on phase 2.
Okay, sure, Samir. Thank you so much for joining us in the studios, taking us through the outlook of the company going forward as well. That's the management of Sanathan Textiles for you all. But let's shift focus. And now, sources say that Standard Chartered is likely to exit bancassurance partnership with ICICI Prudential Life. Yash is joining us to give us more details on this one. Yash.
Well, Prudential's exit from ICICI Prudential Life does not only give some sort of supply overhang on ICICI Prudential Life Insurance, but it is also expected to bring some sort of business overhang when it comes to the company. That's because what we've been given to understand is that Standard Chartered Bank is expected to exit the bancassurance partnership which it has had with ICICI Prudential Life Insurance. This is happening after Prudential is expected to make an exit from the company and go towards Bharti Life Insurance. What we've also been given to understand from our sources is that Standard Chartered Bank could establish the same bancassurance agreement with Bharti Life Insurance. This is what our sources are telling us at this point of time. Why is this important for ICICI Prudential Life Insurance? Because a sizable business comes from bancassurance and under bancassurance from Standard Chartered Bank. About 5% of the total annualized premium equivalent comes from Standard Chartered Bank to ICICI Prudential Life Insurance. About 6% of the retail annualized premium equivalent comes from the bank. So, of course, in absence of Standard Chartered Bank, that portion of business could get impacted is what we've been given to understand from our sources. On this particular story, we've written to all the parties involved, ICICI Prudential Life, ICICI Bank, Bharti Life, as well as Standard Chartered Bank. A response from all the parties still remains awaited. But there is another development that we are picking up on the regulatory side as well, and this again pertains to Prudential's exit from ICICI Prudential Life Insurance. What we've been given to understand is that the insurance regulator, IRDAI, may give about 12 to 18 months to Prudential PLC to sell that entire 12% stake which it intends to sell as far as ICICI Prudential Life Insurance is concerned. Of course, 2% out of that total 12% could be bought by ICICI Bank, but Prudential PLC will have about 12 to 18 months. That's expected to come from the regulatory timeline when it comes to selling that entire 10% stake in ICICI Prudential Life Insurance, which could be sold through various block deals in coming days. Responses again on this particular story from ICICI Pru Life, ICICI Bank, IRDAI still remain awaited.
Okay, all right. Yash, thanks very much for bringing us that important story. So ICICI Pru, as you can see, stock is up around 1.3% at this point. For the markets, the Bank Nifty is just about flat, just holding up with a gain of around 65 odd points. But all of the interest seems to be in the broader markets today. So the Midcap index at the high point up around 1.4%. We'll take a short break, but up next, we'll connect with the management of Latent View to discuss their Q4 numbers. Stay tuned. Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty continues to hold on to 23,740 levels, around that level at what it continues to trade at. But let's put the spotlight on Latent View Analytics. The management of the company is joining us on the show now, and we'll be speaking with them about the Q4 numbers. That's a quarter gone by, as well as the outlook of the company going forward. This time, the margins largely in line. Slight bit of a miss that came in terms of the revenue. But what is the data center opportunity, AI services? How is that shaping up for the company as well? We'll understand all of that with Rajan Sethuraman, who's the CEO at Latent View, joining us right now. Rajan, good afternoon. Thank you so much for joining us on the show. In terms of numbers for Q4 and FY26. Actually, for FY27, what you've guided is an 18 to 20% revenue growth. You've also mentioned in your con call that, there will be a 12 to 13% visibility that is coming in currently from your order book right now. 18 to 20%, 12 to 13% visibility that is already there. Where is the remaining going to be coming in from? Maybe what segments do you think will do well? AI services, what is your thought on that?
Sure, yeah. No, good afternoon. Thanks for having me on the show. So this is typical of what we see in most years. At the start of the year, typically we have somewhere in that range. And over the course of the year, we look at converting from the opportunities that are at a slightly lower probability, and then also look at adding more opportunities into the pipeline. And that's what we are witnessing this year as well. So the high visibility number of 12 to 13% corresponds to line items where we have significant confidence, right, that they will come through. Now, in terms of where the balance is going to come from, it's fairly broad spectrum. We did talk about technology having a slight sluggishness because of the headwinds that we faced last year. However, we are clawing back even with the one large account where we had some setbacks. Otherwise, we're expecting the technology sector to grow somewhere in the range of 6 to 8% this year. But the growth in consumer as well as in financial services is expected to be fairly strong this year. So we are expecting a lot of action in both those segments. From a nature of work perspective, last year, almost 28% of the work that we did, revenues, were in AI in particular, meaning traditional, generative, as well as agentic AI. I'm only expecting that that will continue to increase in FY27 as well. In addition to that, Databricks has been a fairly strong partnership for us. We did about 17 million of revenue in FY26. I'm expecting that to grow anywhere between 50-60% right this year, just contribution on the back of work that we're doing for Databricks. These will be very strong pillars of growth for us in FY27.
Okay. Rajan, point taken there. I just want to touch up on the tech segment point, right? You highlighted there was some concern. There was one client issue that was going on in terms of some vendor issue that happened in FY26, but that is why we saw a decline. So for FY27, have those issues been resolved, or what is the process right now going on here? What is the timeline of everything normalizing?
Right. Yeah, this was specifically with one stakeholder, somebody who was brought in afresh in that group that we were working with. And while coming in itself, they had indicated their preference to work with full-time employees, as in moving from vendor to insourcing the work. There was a little bit of consolidation that happened as well. All of that is behind us as far as this particular stakeholder is concerned. The same account, we have been now opening plenty of new opportunities on the back of AI pilots and POCs, as well as other conversations. In fact, I just spent 3 weeks in the US meeting multiple stakeholders in that account, as well as several other accounts. And we are happy to note that there are fairly large, high-value opportunities that we are pursuing. One of them should come through even within the next 2-3 weeks timeframe. I'm expecting that with that account itself, we'll be getting back to about 90-95% of the revenue that we did last year. And if I look at the rest of the tech sectors, while there are structural changes and there is all this talk about AI and the impact, the interest levels, the conversations indicate a fair degree of optimism. Most organizations are looking to use their budgets available, but do more work with the money that is available. And all this productivity unlock is helping them move in the right direction. So we're expecting to capitalize on that as well.
Okay. Just give us a little more about the AI drive that the company might be looking at, Mr. Sethuraman. It comprises of around 55 to 58% of your gross margins versus, the company average of around 50%. So just give us a sense in terms of what is taking place now. Where do you expect it to contribute in FY27? What is the project pipeline looking like? And how much of it is, in fact, AI projects versus others?
Right. So the nature of the work, just to give some color first, like I said earlier, it's traditional, generative, as well as agentic AI. When we look at the work that we do, we kind of classify into primary and secondary. Primary AI is work where the AI aspect of what we are doing is very visible to the client, meaning that they are experiencing a generative AI interface or wrapper, or they are actually seeing the impact of the agentic architecture or the solution, right? And it's a very felt kind of solution, right, in their hands. Secondary AI is work where the AI is helping under the hoods, meaning that if you're building dashboards or pipelines or models, we are utilizing AI to do it, but the impact or the view for the client will be more in terms of what they see from an optimization or from a business decision perspective. Now, the work itself is fairly broad spectrum. It ranges all the way from work that we are doing related to financials, payment processing, fraud, counterfeit measures, warranty claims, all of these where the process is understood and the parameters and variables are known, and they lend themselves to some amount of deterministic guardrails. These are the places where we are seeing the implementation of agentic solutions. From our internal perspective, we are focused on building capabilities, hiring the right kind of expertise, certifications across all the major platforms. So therefore, internally, for example, we're working with Codex of OpenAI, we're working with Claude Code and Claude Cowork, we're working with Gemini as a platform. Given that we have a fairly broad spectrum of technical and other clients, and their own tech stack. They have preferences, right, in terms of what they want us to use. So we're going to be really upskilling and further pushing, right, the pedal on how our people are able to make use of all of this stuff. I'm expecting that the work itself, I mean, last year, almost half the work that we did had either the primary or the secondary AI. I mean, 28% was primary AI work. I'm expecting that percentage will continue to grow just on the back of the interest that we are seeing. And our intention is to double down not only on the certification, but also the partnership. Anthropic is the big partnership that we are focused on. Again, on this trip, I was able to meet with the senior leadership of Anthropic on that. And we are going to be pushing the pedal on that.
Mr. Rajan, if you could tell us, you spoke about how you're expecting good growth coming in from consumer side as well, right? In FY27, that's something you believe will do well, and financials. What is the mix then that we could expect in terms of your industry-wise? Tech obviously accounts for around 55% of that revenue. How do you see that moving?
So the tech contribution will obviously come down a bit because of the growth rates that we are experiencing. I'm expecting financial services will continue to grow. I think for last year, about 18 million, close to 17, 18 million of our 120 came from financial services. Next year, I'm expecting that financial services will grow at about 40% from there on, right? And that should be the kind of contribution that they will be having. Consumer goods, again, fairly strong growth for last year. We are again seeing momentum on many of the conversations that we have initiated. I'm expecting growth of the order of 20-25%, right, in consumer goods. Tech is where there'll be a bit of a sluggishness, but even there, I would be able to give better commentary, right, at the end of Q1, stepping into Q2.
Okay. All right, Mr. Rajan, we're going to leave it on that note. Thanks very much for joining in and giving us all of that perspective. Just want to point out that the rupee has now hit a fresh record low in today's trading session as well. So 96.40 is currently where the rupee is at. Remember, it's almost a 6% depreciation that we've seen for the rupee since the conflict began on the 27th of Feb. There were levels of around 91 where the rupee was at, and during that time, and even if you look at it, on April 8th, the best level that we saw for the rupee was around 92.5, and since then also it's been a rapid depreciation to 96 plus levels, and today hitting a fresh low, and in fact depreciating further as we speak. 96.42 is currently where the rupee is at. We'll take a short break. Ajit Mishra of Religare Broking will join in with some trading calls. Stay tuned. Welcome back. Well, it is a good day for the mid-cap, so good time now to get in a tech check on the markets. Ajit Mishra of Religare Broking joins in to tell us what he's strategizing today. Ajit, hi, welcome to the show. Well, Nifty is holding up above 23,700 at this point. We have the Bank Nifty up around 100 odd points, but the mid-cap index up almost 1,000 points right now. So just give us a sense, what exactly are you, strategizing for today?
Yeah, good afternoon, Ekta. So, Ekta, yes, the last two trading session, in fact, as you were mentioning earlier, that the rupee is at the record lows. Crude is still like holding above $110 mark. The volatility index has witnessed a jump. Still, we are seeing that bulls are making an attempt of recovery. But having said that, I feel that this zone, which was earlier acting as a support, 23,800, 24,000, will continue to be the area where we have the immediate resistance in the index. So until we decisively reclaim 24,000 mark, I doubt that there is going to be a very decisive uptrend or recovery in the index. So one needs to be careful closer to this zone. On the downside also, what we are seeing is that the gap area close to around 23, 150, 250 zone is what is acting as a support. So it seems like that market is forming a lower range from what we were seeing earlier. At the same time, the interesting aspect is banking has filled the gap. IT is almost up by around 6% in this week so far. The selective opportunities across sector is something that one should be focusing on. And basis that, like you were mentioning about mid-cap, definitely means after making a new record high, we were seeing a bit of a consolidation. But largely the tone looks positive. So selective opportunities across sectors, pharma, healthcare, that's the first preference that we have. Then we have counters from like energy basket, metal counters, select auto, ancillary space, something that you should be focusing on.
Ajit, any specific trades and names that you're looking at this afternoon?
Yeah, so considering the overall strength in the pharma and healthcare basket, we believe that Apollo Hospital is a good choice. After this recent up move, we are seeing a bit of pause consolidation around the daily chart. So we expect this move to further strengthen. 84.90 is what we are eyeing in the next leg with stop at 78.80. And then we have BBL from the consumer basket, wherein post the reversal, the stock has formed a fresh buying pivot and looks set to resume the uptrend again. So with the stop at 495, one can accumulate VBL at current levels with 555 as a target.
Ajit, thank you so much for joining us on the show, as always, taking us through individual names as well as market levels that we should keep an eye out on. But let's move on and put the spotlight now on our What's Trending segment. We are focusing on oil marketing companies. We'll focus on earnings, fuel price hikes as well. And Sonal is joining us to bring us more perspective into both these. Sonal.
Well, that's the detail, right? That the price hike has come by. That's the second one that we've seen in a week. The last week it was done by 3 rupees per litre. There's another hike that has come in for both petrol and diesel, which was required as well. The estimate suggested that the price hike had to be anywhere between 10 to 12 rupees per litre for petrol and around 20 to 21 rupees per litre for diesel, and some of it has come by now. Additionally, we do have IOC's numbers as well, which the company reported yesterday. The numbers were better than what the street was working with. Revenues up 1.5%. EBITDA was absolutely flat, but better than what the street was working with at 20,716 crore rupees. Margins at 9.9% versus 6.3%. Profits were down 6% on a quarter-on-quarter basis, but better than what the street was working with. The internals are strong because their petroleum products has done well. EBIT has come at 19,218 crore rupees. This, of course, has a lot of inventory loss because crude inventory gains because crude oil prices surged. Petchem reported a profit versus a loss in the quarter gone by, despite headwinds that the sector saw, and gas business saw an impairment loss, which is the reason why we are seeing a big loss here as well. Now, OMCs, as per oil ministry briefing, are incurring losses of around 750 crore rupees. This compares with 1,000 crore of loss that they were making per day. So yes, losses have come down, but more is needed definitely in terms of price hikes for them even to break even. We'll have to see whether we continue to see calibrated price hikes or not. If that happens, that of course is bad for consumers, but that's a good news coming in for all marketing companies.
Okay, all right, Sonal, thanks very much for that. So that's a big trending story for today. We'll take a short break, but on the other side, Manisha Gupta will join in. She has with her Jatan Singh, who is from SkyMed. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty has come off from where we started the show, right? Now it's at 23,720 levels, still holding on to 73 points of gain, almost 90 points of gain now. 740 is what it's moved at. But broader run of the market, that continues to do better in the trading session. IT leading the charts as well. So that's what we'll be keeping an eye out on. But that's about the markets. Advance decline ratio a bit more in the favor of advances versus declines. A lot of individual names also moving around. Himadri Specialty, Blue Jet, all these buzzing around from the broader end of the market. But Manisha Gupta is here with us, and she's going to take us through a conversation with Jatin Singh, founder and chairman at SkyMet. Manisha, over to you.
Thank you so much for that, Winnie, and welcome to the show, Jatin. And it really, from where we stand right now, it's all about heat wave. Almost everybody complaining about the kind of temperatures that we are looking at. And there have been certain reports suggesting that from 19th to 22nd, 23rd May, we could be looking at above normal temperatures yet again. How are you looking at to begin with on this week?
I think the hot weather will continue. There are no interruptions by any further summer thunderstorms that I can see. So yes, I think the summer, I mean, and frankly, you know, it all has to even out. The first fortnight of May was cool because of these rainfall and summer thunderstorm events and that. So this will even out. We're looking at, you know, heat waves happening. Heat waves generally have a trough and hyper, you know, it becomes 40, 45, and then you come down to 40, and then you go up. So I don't think this is, I mean, it's a heat wave. We've experienced these things before.
How are you now looking at El Nino and the monsoon onset dates? Has SkyMet come out with that yet?
No, actually, IMD has come out with 26th. And I mean, yes, technically, it probably is a good date for an onset, but it'll be a very weak onset. The monsoon starts on June 1, so you only start counting rain from June 1. So, you know, it's the onset itself is not looking either both structured or strong right now. So that would mean that hot weather will continue into the first week of June.
Jatin, also, how are you looking at the, I mean, I take your point of an early onset, but not a very strong onset is what you're anticipating it to be. How is June, July looking like? Because I remember in the previous conversation, you told us it's the second half of monsoon that is expected to be on the weaker side. How are we as of now looking as we step closer to June?
You say it's very difficult to pontificate on a month-wise distribution. We still stick to the second half. Could be, you know, is more likely because ENSO will be stronger. But do understand one thing: there is no direct pattern between weakness in Indian monsoon rainfall and strength of the El Nino. So I'll give you two contrasting years: 14, 15 back to back. 15 was a strong El Nino like this. 14 was El Nino. Both of them were drought years. I think it was minus. 2015 is, I think, minus 14, and 2014 is also, I think, minus 12, 10 or 12. And I remember in 2014, the June was minus 55%. The onset was so weak. And then a quarter later, in 2015, the ENSO June was plus 17%, and then failed in July. So there's a lot of variability. You really can't, there is no systematic regression here. So its impact can be either way.
Jatin, are you also thinking that, you know, as was the case in 14, 15, are we heading towards that same thing yet again, 26 and 27 as well? Because most people right now are more concerned about the Rabi crop than the Kharif crop.
Manisha, there's a lot of projections here. The Rabi crop is generally an insulated crop because it's an irrigated crop, especially for Punjab and Haryana, where bulk of your rice is going into Western UP and all, you know, and all these places where you have all the basically all the wheat crop. It is too soon to say, depending on, you know, how the moisture and how the distribution of rainfall will be. Sometimes you have late rainfall in September and August, so it's too soon to say that. I think we should worry currently about our Kharif crop. Because you have the, you know, you're looking at an, so if we are lucky, it could be like 2023. 2023 is also El Nino and a below normal year. This could also be low normal. There's a probability. If you look at the strong so-called super El Ninos since 1950, there have been 5, out of which only one of them, which was 1972, was a severe drought. Rest was into 1982, which was minus 15. 2015 was minus 14. 1992 is a below normal at minus 7. And 1997 was actually a normal at plus 2. So I would say that, it's not all bad news that you're going into a severe drought. If we are lucky enough to finish in a below normal year, like 2017 or 2018 or 2023, we should be lucky. And there is a probability of that happening too.
All right. You talked about Kharif, and would you say that there are concerns about water bodies as well? I mean, Mumbai is looking at a water cut, so are various other states and cities too.
Yes, because yes, there's a situation where you will get into hydrological stress going into the monsoon. There are 3 reservoirs in Bombay, and I think they're running at about 20% of their capacity, and water cuts are going in. That is soon going to be true for the rest of the country. Reservoir levels across the country are not very healthy. So that is this irrigation stress might come in if June starts tripping.
But then a final question then, and the onset, I'm just going back to that yet again. Onset is expected to be on the weaker side, but how is the progress looking like? Because, in our head, we start calculating 10 days, Mumbai, another 10 days, and you'll see perhaps Rajasthan and Gujarat as well. How is the progress looking like?
You see, it's first, as a average, the 1st June is Kerala, 10 June is Bombay, 27 June is Delhi, 1st July is Chandigarh. Okay, that is the rate at which it moves. Now, you do understand, because it is so political, the IMD tends to move it, okay? And sometimes you will see, especially in a year like this, probably a lack of precipitation. Generally, what in the so-called progress of the monsoon in a year like this, the progress is not systematic, it becomes spasmodic. So it will be stuck over a period for a long period of time, and suddenly, you'll see that line moving in. That is actually a consequence of 2 things. It moves up because it actually suddenly rain comes because rains have to move towards average. It also moves up because sometimes there's so much pressure that even for the slightest thunderstorms, IMD tends to push this upwards.
Okay. All right, Manisha. Thanks very much for joining in and taking us through that conversation with SkyMed. Just want to point out that a couple of stocks are doing very well in today's trading session. Puravankara is one case in point, where the revenue has jumped very substantially for that company on a year-on-year basis. So that stock is up around 9.7%. And remember that stock is just about lower by around 2.3% on a year-to-date basis. So let's see whether it extends its gains further and moves into the green on a year-to-date basis. Blue Jet Healthcare is also doing well, giving it company with a gain of around 8.5% at this point. So good going for a couple of these counters. We'll take a short break, but up next we'll get you a lot more on the markets and our movers and shakers segment. Stay tuned. Welcome back to Halftime Report on CNBC TV 18. Now, let's put the spotlight on some of these individual stocks in the trading session. And in our movers and shakers segment, we'll track
a whole host of these stocks that are moving around. So first up, we have Spark, and Ekta is here to take us through why Spark is moving around. It's up 15% today. Ekta, over to you.
Well, yes, it is a pharma heavy movers and shakers today, you'd have to say. So, interestingly, Spark, which is basically the R&D arm of Sun Pharma, has reported a revenue of 1,840 crores this quarter. This compares to 8.45 crores last quarter and 27 crores same time last year. EBITDA 1760 crores, and this is versus a loss both on a Q-on-Q as well as a year-on-year basis, and obviously the profit is coming at around 1761 crores. Now the reason for this is because the group has recognized an income of 1840 crores. This was with respect to a priority review voucher which was granted by the US FDA on Feb 3rd for one of their key drugs called Sezasbi. So that means that this particular priority review voucher, which was granted to them by the US FDA, can also be sold to other people. So what they did is that it's a transferable instrument, and hence it's sold, the group sold it on the 30th of April for $195 million, and that's the reason that they recognized it. So this also means that they have this cash on books for them, and since it is an R&D company, it is going to fuel their R&D investments for the next couple of quarters, or maybe the next few fiscals as well.
Absolutely, and that's why that run-up that has come in here as well. But Ekta, on the flip side, your Strides Pharma, that's not doing well in the trading session, down 2 to 3% odd. What's the reason for that one?
Well, yes, it's recovered from the day's low. It was down more sharply, and the numbers came out during market hours yesterday, but they held their conference call, and maybe a couple of takeaways that the street is not too happy with. So what they have said is that the flu season in the US was weaker than expected. Their Q4 US revenue, in fact, came in at $70 million, which was flat Q-on-Q and down year-on-year. And FY26 US revenue was at around $284 million versus $291 million year-on-year. But they seem to be quite positive on the guidance that they've given, with a revenue aspiration of $375 to $400 million by FY28, and the management is expecting US growth to recover from the second half. So the street seems to be a little disappointed, you would have to say, with the US business performance. But what is doing well for them is the ex-US business. That came in at $70 million. It improved year-on-year as well as on a sequential basis. The ex-US markets, in fact, is emerging as a key growth driver, and contribution has risen to 46% of sales versus 41% in FY24. The ex-US business is expected to grow faster than the US going forward. Margins also improved to around 19%. The guidance is of around 20% plus going ahead. So that's the reason why you're seeing Strides Pharma down, but having recovered from the day's low.
Okay, down, but having recovered from the day's low. That's coming in from both the pharma companies. Thanks so much for that, Ekta. But on that note, we're going to actually slip into a very short break, and we'll get you more on markets, more stock-specific action as well after the break. So stay tuned in. Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is at 23,700, 720, 40 levels. That's what it's been trading at in the last 1 hour. But slight bit off the point when we started the show at 12, and now it's seen a bit of a decline, but still managing to hold on to green. Broader end of the market, obviously we spoke about it, right? That continued to do well as well, and that's managing to hold on to strong gains. Now, what did well in the last 1 hour specifically from the broader end of the market? Triveni Turbine pulled that up, moved sharply in the green as well, and a bit of a spike up that we've seen specifically in the last 1 hour, 9-10% from the day's low. It's moved up. So, now it's holding on to gains of 5%, day's highest point. We have Blue Jet Healthcare, that's also moved up significantly in the last 60 odd minutes, and Alembic Pharma, Praj Industry, as well as Swiggy among the other names that have seen a bit of a move up. Blue Jet, also look at it, almost near the day's highest point at what it continues to trade at. Praj Industries, day's highest point. Swiggy, almost near the day's highest point as well. So all these stocks have moved up in the last 1 hour. Specifically, IT continues to do well, but with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next to Business Lunch.
Midcaps charge up as hopes of a deal between the US and Iran rise. IT and realty are the prominent gainers while financials drag. Oil marketing companies push up petrol and diesel prices by less than a rupee in what seems to be an effort to pass on some of the crude oil inflation in a calibrated manner. Leading economists tell CNBC TV 18 that more steps will be needed to curtail India's current account deficit. They, however, don't expect any change in taxes for the foreign investors. Oil prices cool after Donald Trump calls off planned strikes on Iran after heads of Gulf nations urge restraint in light of progress in talks. An extension of the waiver on Russian seaborne oil also eases supply concerns. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormus Fatakia. Well, it's been a fairly okay day for the markets after the recovery that you saw in yesterday's trading session from the lows. The index is now building on to that. So 70 points higher, although we have traded in a very narrow range today, 140 points to be precise, but still holding on to that 23,700 mark as of now. Mind you, today, of course, is the weekly options expiry of the Nifty as well. The index for now, 23,700 on the upside, 23,700 on the downside, 23,800 on the upside. This is the range in which the index has been moving along all through the first half of the trading session so far. A key determinant of that has been the Nifty Bank, and the choppiness in the Nifty Bank has percolated onto the Nifty as well. At one point, the Nifty Bank had moved into the red as well, but still holding on to gains of around 80 points. So no significant moves on the Nifty Bank. The Nifty is trading in a 150-point range. The Nifty Bank is trading in a 300-point range. So there is no range breakout that you're seeing on either the Nifty or the Nifty Bank. The outperformer, or the one that is ensuring that the index remains in the green, is IT. And the index, the IT index was doing well in yesterday's trading session. It is continuing to do well today as well. 3.5% higher on the Nifty IT, and led mainly by the mid-cap IT names, be it Coforge, Persistent Systems, Emphasis, all of them up anywhere between 10 to 12% this time over the last two sessions. And of course, the large-cap IT names, be it Tech Mahindra, Infosys or TCS, they too are doing well for themselves. But what's not doing well though is the currency. And of course, that currency weakness is one key determinant as to why the IT names are doing well. But as of now, 96.44 is where the currency lies. 96.47 is the low that it fell to just a few minutes ago. And now, courtesy of this fall, the currency is now down 7% against the US dollar in 2026 so far, and is the worst performing emerging market currency this year. Ritu is joining in to tell us what is driving this downward momentum and how the RBI is stepping in to protect the currency. Ritu.
Well, the rupee continues on a record-breaking slide. It opened at 96.38 against the dollar and has since made another record low of 96.47 against the greenback. We started 2026 with the rupee hovering at around 89.97, and since then we've seen a depreciation of close to 7% and almost 6% since the West Asia conflict started, making rupee one of Asia's worst performing major currencies in this year. What's also worrying the market is the speed of the fall. The move from 90 to 95, that took less than 5 months, and from 95 to 96, barely 15 days, whereas historically we've seen every 5 rupee fall against the dollar takes as much as 5 years. So the depreciation is clearly accelerating, and that tends to trigger panic hedging and speculative pressure to add on. Three forces, as we've been telling you, are driving this. Call it the unholy trinity of elevated oil prices, the foreign outflows, and the strengthening dollar on the back of all of this. The biggest factor, of course, is oil prices, with what's happening in West Asia and crude prices hovering above $100 a barrel now for nearly 2 months. That's inflating our import bills significantly and directly pressuring the rupee. At the same time, the dollar has strengthened, higher US bond yields and rising safe haven demand. All of that has boosted the greenback. Foreign institutional investors have also been selling. We've already seen more than 20,000 crores of outflows just in May so far, and more than 2 lakh crores for the full year. And these capital outflows, of course, hurt the rupee. Add to that the widening trade deficit. We just got the merchandise trade deficit data as well. The concerns around the current account deficit, all of that is adding to the pressure. Of course, the RBI and government have moved on multiple fronts to stem the slide. The government, for instance, has hiked the duty on precious metals. It's undertaken now 2 fuel price hikes. RBI has been intervening both in the forward and the spot markets. It has capped the net open position at $100 million a day for banks to curb any speculation. And as we have been reporting, more measures may be on the anvil if the slide continues.
More measures may be on the anvil. Ritu, thank you for summarizing that for us. Now, market veteran Ramdev Agrawal believes that it's time for policymakers to put focus back on bringing FIIs back to India. Speaking to CNBC, he talks about the falling rupee, adds that domestic buying is slated for strong growth over the next 2 decades. Take a look.
We have, as you said, worst performing currency from Asia right now. But India, unfortunately, is hit from 2 sides. One, the energy artificially prices have just shot up by 70-80% from $60 to $110. So that's putting a lot of pressure on the current account. Second is that on top of it is the FI outflow, because for two reasons. One, we don't have AI story. In fact, we have anti-AI kind of situation in India. And of course, we have a pressure on the currency. So, and that is exerting further pressure on the rupee, because there is a sustained selling of almost $500 million every day from FI side. So, twin effect of high oil energy prices and FI outflow is putting pressure on the currency, which the regulators are finding, the banks are finding, or central bank is finding it difficult to handle at this juncture. They are allowing the free flow of the currency till the crisis is over. We have been seeing very sustained outflow out of India. One, of course, because of the very strong local buying, which is going to become even bigger as we go forward. So the government, the policymakers, they have to think in the backdrop of very strong local buying, how do we console? And my local buying is decadal, in the sense that next 20 years, 25 years will become even bigger. In that backdrop, what do I do for the FIIs or FPIs, so that they have a little more positive view of India? They might be having some small demand about capital gains tax. Worldwide it is not being charged. Why we are being taxed out here? Why we are being charged capital gains tax? So whatever their demands are, I think the authorities should look at it very intensely, because it's a very changed environment. In fact, India's capex and the growth story is picking up. If you see this quarter, I think we might be doing 7.5–8%, and with the domestic elections way beyond, and we have gone through, and there is a further consolidation of the ruling party. I would think that the domestic growth will go beyond 7.5% in next 12 months, hoping that energy doesn't go out of hand. If energy remains within 100, I'm just hoping that this war will be over in next 2–3 months, 4 months. In that case, I think India has an amazing growth story of its own, and growing at about 7–8%. And there are very few countries of this size which are growing at 7–8%, and you can talk about 5–6%, 5 to 6 years, or maybe even 10 years of growth story between 6–8%. So I think India has a very unique secular growth story. The only thing which is missing out right now is we don't have AI story.
Ramdev Agrawal there in an interaction with the CNBC. Now, we spoke about IT and the fact that that sector has been leading the market recovery yesterday, and of course the move today as well. Now, our big giant TCS has rolled out annual salary hikes of around 5% on average. In fact, they have also revised the salary structures this cycle. Let's understand the specifics and get Rima in for more on this and the implications of this as well. Rima.
One is the INR tailwind. When we ended Q4, the average rupee rate between the Jan to March quarter was about 91.5. Now we're looking at a rupee level which is below 96.5 nearly. So straight away you've got a 5% rupee depreciation, which benefits the entire sector. Maybe it doesn't reflect completely in the P&L, because generally we have that math. 1% rupee depreciation benefits margins by 15–20 basis points. It may not reflect directly, but it acts as a cushion to absorb any cost pressures. So INR is acting as a tailwind. So even if the rupee, the top line growth may be flat for the company, as has been the worry, maybe the EPS growth looks a lot better with that. Secondly, as we know, IT stocks have been ranked underperformers. Till just 10 days back, the index was at a 3-year low, and individual stocks are down 35–40% in the last 1 year. And thirdly, the TCS price hike, the wage hike, right? It's caused a lot of anxiety amongst employees. Maybe employees are disgruntled because at an average level, Money Control reports, TCS has doled out a hike of nearly 5%. The top performers have got, just about 10%. Some of the lower end, the underperformers maybe have got no hike. People are complaining that actually because of the new labor code, my CTC appears to be on the lower side. There's a Mint report that talks about TCS asking managers to classify 5% of their employees as underperformers. But what it means perhaps from a stock market point of view is that IT companies are showing pragmatic cost discipline. They know the environment is tough, and which is why if you see the last 3 years, many companies companies have chosen to even defer their wage hike cycles by a couple of months. So TCS had deferred it between April 2024 to September 2025. It was a 17-month deferral. For Wipro, it was a deferral from September 2024 to March 2026, so nearly 18 months over there. Infosys has still not announced a wage hike for FY27. So yes, from an employee point of view, confidence point of view, it's not great, but from a company point of view, this does show some sort of a cost discipline. Back to you.
Rima, thank you for that update there. The IT stocks continuing to move higher, up anywhere between 6 to 12% over the last 2 trading sessions. Take a short break. More news and updates on the other side. Stay tuned. Welcome back. On to the latest updates from West Asia. US President Donald Trump, in a post on Truth Social, said that he has delayed an attack on Iran that was scheduled for Tuesday, that is today, on the request of leaders from Saudi Arabia, Qatar and the UAE. Now, the US President added that serious negotiations were underway and that if a deal wasn't made soon, Iran could be attacked in a moment's notice. When asked by reporters on what he meant of the post, this is what he had to say.
We were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that, where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also. We've had periods of time where we thought pretty much getting close to making a deal, and it didn't work out, but this is a little bit different. Now, we're ready going tomorrow, very big, and not something I wanted to do, but we have no choice because we cannot let Iran have a nuclear weapon. Seems to be a very good chance that they can work something out. If we can do that without bombing the hell out of them, I'd be very happy.
Meanwhile, Iran's president said that the dialogue does not mean surrender and that Tehran had entered the dialogue with dignity, authority and the preservation of the nation's rights. Iran's foreign ministry also confirmed that it has received the US's feedback on its latest peace proposal through Pakistani mediators, and talks between the two sides are still underway. Let's now listen to what the former ambassador to the US, Harshvardhan Shringla, had to say about the West Asia tensions and its impact on energy imports.
What the West Asia conflict brings to the fore is that you should not have an over-dependency on one region. So you need to ensure that your supplies, absolutely critical supplies of energy, come in from different geographical areas, whether it's Australia, Russia, the Middle East, or Africa and America. I think by America I mean the continent is very critical. Today you have Brazil, you have Guyana, you have Venezuela, you have Canada. Besides the United States that produce energy for export, we need to look at all the options and get the best possible options for us so that we have a diversified source of import of energy in our country.
Fresh off US President Donald Trump's visit, Chinese President Xi Jinping will be rolling out the red carpet for one of his closer allies, Russian President Vladimir Putin. CNBC's Elaine Yu has more on this.
So this is Putin's 25th visit to China, although the two leaders, Xi and Putin, have met more than 40 times. And this visit marks 30 years since China and Russia established a strategic partnership, although the timing that this is just 4 days after Trump's visit does make this very notable and shows how Beijing is in a complex stance with Moscow and Washington. Now, China's foreign ministry said that they'll take this opportunity to advance ties to deeper levels and higher standards. And in terms of the narrative that state media in China are telegraphing, on the front page of today's state-owned Global Times is the banner, "The more turbulent the world, the clearer the necessity for China-Russia cooperation." Now, in a video addressed by Vladimir Putin ahead of his visit, he said that Russia-China relations today are at a truly unprecedented level. And he said the two countries are ready to support each other on a wide range of issues, including national unity and the protection of sovereignty, although he didn't elaborate on what those mean exactly. And he also said Russia and China are actively expanding ties in the economy, in politics, and in defense. And perhaps tellingly, there is a tacit acknowledgement, it seems, of the timing of the summit, that this is just after Trump visited. Putin said that without aligning against anyone, we seek peace and universal prosperity. Now, according to a report, there is a delegation that is joining Putin. That includes the foreign minister, Sergei Lavrov, and also the chief of their central bank, but also the chiefs of Russia's oil, gas, and energy giants, from Rosneft to Gazprom and another nuclear power company, as well as the aluminum producer Rusal. But there are also representatives of banking, as well as the Russian Direct Investment Fund, which is Russia's sovereign wealth fund. So that is not unlike perhaps the high-profile CEO delegation that joined Trump on his trip. Now, Xinhua has also had some warm words about this relationship, highlighting how bilateral trade between the two countries have exceeded $200 billion in 3 consecutive years. And Xinhua also said that on the world stage, China and Russia coordinate with and echo each other. And you'll recall they both vetoed the UN resolution in April aimed at protecting Hormuz shipping, saying that the text was biased against Iran. And we do see Xinhua also saying the post-World War II order is now facing severe shocks, and it said that China and Russia's strategic coordination is of great significance in maintaining global stability and multilateralism. So we do see, as with this summit with President Trump and with this visit and with President Putin as well, the Chinese president is pushing his vision for a multilateral world order.
Just quickly pull up Dhanuka Agritech before we take this break. The company's board has approved a buyback of shares. The numbers are also at your screens. The stock is up 10%. The buyback price is 1,400 rupees. The first buyback in 2 years for Dhanuka Agri. 1,400 rupees, it's a 30% premium from yesterday's closing price. So 10% higher on Dhanuka Agri numbers and a share buyback as well. Take a short break. Back with more on the other side. Welcome back. Now, Prime Minister Narendra Modi is currently on a five-nation tour where he has visited the UAE, the Netherlands, Sweden and Norway. Now, in the next leg of his tour, the Prime Minister is headed to Italy. Abhimanyu joins in to tell us what we can expect from the Prime Minister's visit to Italy and the key developments from the tour so far. Abhimanyu.
Well, several key developments have unfolded in the past few days. The Prime Minister is going to be in Italy today, which is going to be the fifth country as part of his five-nation tour. Now, till now, he has toured several countries. Currently, he is in Norway, where he is going to take part in the India-Nordic Summit today. He's also going to meet several counterparts from different countries in the Nordic region. Until now, India has upgraded its bilateral ties with the Netherlands and Sweden to a strategic partnership. Also, the PM's visit had begun from the UAE, where an agreement was signed on strategic defense for bilateral security, on maritime defense, on strategic petroleum reserves, and also for LPG supply to India, apart from a $5 billion worth of investment which was to be committed in India. Next was the PM's visit to Netherlands, in which he and his Dutch counterpart took part in a ceremony where they oversaw a pact which was signed between ASML and Tata Electronics to support semiconductor fab in Gujarat. Also, bilateral dialogues focused on several key areas like green hydrogen, clean technologies and advanced manufacturing. Subsequently, he had gone to Sweden, where a joint innovation partnership was undertaken for AI, 6G, critical minerals and for space. And also, both the sides are looking to jointly develop a technology and AI corridor. Also, he held a meeting with several top CEOs from different European companies. He urged them to invest more in India for better returns. And now he is going to go to Italy, where he's going to meet his Italian counterpart and possibly is going to discuss more business cooperation. Now, several investment commitments have already been announced and several MOUs have been signed. Now, it remains to be seen how early this is going to translate into on-ground investment and on-ground jobs in India, even as the Prime Minister has promised more value for money as far as foreign investments into India are concerned, by virtue of the fact that not just the stock market, he has also cited several successes from the recent past across several industries, which he has given as a case study while seeking more investment into India.
Abhimanyu, thank you for that update there. Of course, all eyes on the Prime Minister's visit to Italy. The markets, though, continuing to do what they are. Well, there's a 270-point up move on the Sensex. The Nifty too, absolutely at the same levels as it was when we started off the show, still holding on to gains of around 0.3%. The Nifty Bank is, of course, the one to be monitored. We are entering a very crucial phase of the weekly expiry in today's session. So, holding on to gains of around 90 points is the Nifty Bank. But the action most likely begins in just a few minutes from now when we enter the last couple of hours of the trading session. Take your leave on this edition of Business Lunch from me and the team. Thank you for watching. Midcap Radar on the other side.
Good afternoon and welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. Good afternoon, I'm Vivek Iyer, and with me today is Sonal as usual. Good afternoon, Sonal. Well, it's a session where we're actually seeing, after a while, the broader markets outperform quite significantly, and that particular trend continues to do quite well. But, we'll go on to our first management of the show. IGL delivered a mixed set of results for the March quarter. Let's take a look at what worked and what didn't. The volumes came in at 9.7 SCMD, higher than street estimates. That's a near 6% sequential improvement. But margins contracted sequentially on account of the disruptions stemming from the ongoing conflict in West Asia. Sonal spoke to the managing director, IGL, Kamal Kushar Chatwal, Mr. Chatwal, and started by asking about IGL's gas sourcing mix from APM and spot LNG. Let's listen in.
As far as the gas mix is concerned, right now around 44%, 22% each is from APM and New Well gas, 8% is from HPHT, and the balance is from RLNG. So you can say 50-50 mix is there, domestic and imported RLNG gas. That's the mix for CNG segment. Domestic, as you know, is 100% sourced from APM.
And how much have prices risen by? Is gas supply on track? Considering that spot LNG or RLNG prices would have been impacted because of the crisis that we are seeing?
No, one good thing is that the situation is now normalizing, especially with respect to Henry Hub linked contracts, which were initially impacted due to the force majeure condition invoked by all the sellers. So now the supplies are getting normalized. And one good thing with respect to IGL is that 2/3 of our long-term contracts are Henry Hub linked. So that has really saved us in the sense that we have not seen much volatility in Henry Hub prices. They have been in the range of 2.6 to 3. Now, the major impact for us has been the New Well gas price, which is linked to Indian crude basket, and the Indian crude basket is really at elevated levels. And that has been the major impact, although HPHT has also moderated as compared to the last year. But New Well gas price has been the major dampener, I would say, as far as the sourcing is concerned, that there has been a close to 50% increase there. RLNG spot, we had to rely on a very small quantity because we had the long-term contracts, and that we were able to pass on to the industrial consumers.
Okay, you have been able to pass on the price hikes to industrial consumers, 50% increase in New Well gas prices. Now that you're saying that situation is normalizing, is the split changing between, say, APM gas to HPHT or New Well gas versus spot LNG? Are you able to source it more domestically, or APM gas allocation is still lower?
No, actually, in the first fortnight, the APM allocation was around 29%. Now, the new allocation, again, that has been reduced to 22%, and that makeup has been done with New Well gas. And RLNG remains at around 50%. So there has been not much change in the last 2 fortnights.
Okay, so there's not much change. 22% is the APM gas allocation. So overall, you have taken a 3 rupee per kg price hike in the CNG segment. How much more do you think is required to ensure that there's no more EBITDA per SCM decline? Or do you think you will not be taking price hikes because that could impact demand?
You see, our long-term guidance remains EBITDA per SCM of 7 to 8. That is the range of our long-term guidance. 1 or 2 quarters may get impacted, but we will make up in the balance of the quarter. Now, the price hike, the input gas cost has increased by roughly 25% as compared to the pre-war levels. So that has been the kind of increase. And a moderate hike has been taken of 3 rupees, whereas the competing fuels have also been increased. So we are mindful of the situation, watching the situation, and hope that the situation normalizes. And so that's the situation right now. But we are looking at both the growth as far as the conversion numbers are concerned and the long-term prospect of maintaining our EBITDA between 7 to 8 levels. So based on these 2 criteria, we will take a call as and when the situation arises. However, on daily basis, we are monitoring, and whatever will be needed to adjust among these 2 parameters, we will take a call.
You will take a call because, of course, it is a very uncertain situation. I do get that. But in terms of volumes, this for FY26 volume growth has been at 4.5%. You've done better than that before as well. Do you think you will be able to do better than 4.5% in FY27? What's your guidance? The long-term EBITDA per SCM guidance is something that you've told us. What about volume growth?
You see, one of the factors that has impacted our growth, especially in Delhi, has been the conversion of DTC fleets to EV. Now, that has been entirely done. Only 25 buses are remaining. So you can say 3,000 kg per day as compared to 3 lakh kg that we were doing. So that impact has been there. If we leave aside DTC DIMS, so the growth has been around 10%. Overall growth has been around 10%. Now that the impact is almost over, we may see the impact in 1 or 2 quarters, because quarter 2, quarter 3, quarter 1 to 3 of the previous year had some DTC volumes. So that impact will continue. But going forward, I think 10% growth, especially in the CNG segment. But one positive thing has been the kind of unprecedented support the government has given as far as the domestic PNG and commercial connections are concerned. So there, the control orders, you are aware, unprecedented support has come. And what the industry was asking, that we need support as far as the permissions are concerned, the time taken, as well as rationalization of the rates. So all those has been done. And LPG sunsetting, the control order is stating that those who are having PNG would have to surrender LPG in the next 3 months or so. So that has really given a strong push to the domestic PNG and the commercial segment side. So there we see more than 20% growth in next 2 to 3 years, the industrial, commercial and the domestic PNG segment. So that should grow in excess of 20% in the next 2 to 3 years.
Okay, that was going to be my next question, because 13% growth on a YOY basis in PNG volumes this quarter, and the appeal to move to piped gas coming in from the government as well. What would that mean for you? I also wanted to understand what is the update on Delhi EV policy. You did indicate that DTC has moved, only 10% is left. Are you going to see some volume loss from other places as well? Additionally, last evening we did see the Haryana government talking about the new policy where new aggregators will be given only CNG or EV. Does that bring in extra volume for you?
Yeah, these developments are very, very positive, and we have been advocating that there should be 2-3 categories. One should be the conventional fuels. The second would be the clean fuel category. And the third would be the renewable from EV. And in the second category, the coal-fired electricity and that being used in EV, that can come in the clean category. And the CNG also can be in that category. So we have been advocating. And now one positive thing about the EV policy is that the aggregator is not there in that. What they are saying is that three-wheelers registrations would stop, but existing would continue. But we have given our representation to Delhi. And this Haryana policy is a very, very positive step. And that should, I think, give a strong push to the conversion numbers.
Okay, all right. That's the word coming in from IGL. Mixed set of numbers, but they maintain their long-term guidance when it comes to EBITDA per unit at 7 to 8 rupees per unit, and the growth guidance in volumes as well at 10%. The stock is higher by 3%. We'll slip into a short break. When we come back, we'll get you more on the markets, and we'll talk about mid-cap movers, a lot of individual stocks reacting to earnings, and a lot more. 53 points higher on the Nifty. We are above the 23,700 mark for now. Rupee has hit a new record low, depreciated almost 7% versus the dollar in this calendar year. We do have the mid-caps which are outperforming today, 1.2% higher on the mid-cap index as we speak, and the advance decline ratio comfortably in the favor of advances. We do have a lot of stocks which are reacting to earnings. Neogen Chemicals is one of them. This is our special segment, Mid-Cap Spotlight. So let's talk about this one. Nothing wrong with the numbers, really. The stock, which is up around 34% this year, has come in for some profit booking for now. If we look at the numbers, revenues are up 22% at 246 crore rupees. The EBITDA is up 21%. Margins are flat, but the profits are up 372% because of an exceptional item as well. But what the street doesn't seem to like, one, of course, is the profit booking that we are talking about. The second, that some of their capex plans, they have been delayed. That was going to be the big trigger for the company. From calendar year 2026, first of them will be commissioned by February 2027. Second, the Pakhajan Phase 2 will be commissioned by March 2027. However, their long-term targets remain intact. For electrolyte salts, revenue target of 300 crore plus has been maintained. Their battery chemicals revenue will be between 2,500 to 2,900 crore rupees for FY29. The balance sheet continues to remain very strained. They have a gross debt of around 1,330 crore rupees. So yes, the P&L looks strong, but because of the delay in expansion plans, some sort of profit booking is something that we are seeing. Additionally, we have a note coming in from 361 Capital, where they've lowered their FY27 EBITDA revenue PAT estimates by 1.5 to 10%. FY28 EBITDA and PAT estimates have been lowered by 2.7 and 3.8%. So they are factoring in the delay in their recent estimates as well. They have a hold rating with a target price of 1,750 rupees a share. So nothing wrong with the P&L, but a delay in capex is something that the street doesn't seem to like.
Well, thank you so much, Sonal. One of the top drags as far as the index is concerned, but like I said, after a sharp run-up, a bit of profit booking seen. But TVS Motors is in the spotlight, and this on the back of that investment the company has made into Jana Small Finance Bank. Remember, that particular news came yesterday. Let's understand what brokerages are making of this particular investment from TVS Motors. So let's join in with more details.
So over the last few trading days, TVS Motor has been under pressure. If you talk about the last 8 trading days, the stock has fallen as much as 13%. It's mainly on the back of the investment that company is going to make in Jana Small Finance Bank. Remember yesterday when the announcement came that TVS Venu Group will be acquiring up to almost 10% stake, but of that 10%, 5% stake will be acquired by TVS Motor by an investment of rupees 193 crore. And brokers believe that this is the investment being done in the non-core investment, non-core businesses, and it can be a de-rating event also going forward. Now, what does Elara Capital say? So investment is negative in terms of capital allocation, and its investment in microfinance is non-core investment, and it's non-required when the capex was expected to be elevated in this year, that is FY27. And this elevated investments in subsidiaries has been a concern for TVS Motor. Even in the past, they have given in FY24 1,400 crore, 2,000 crore in FY25, but those investments in the past were in the core segment. This time, they are doing in non-core segment. That has become a concern. Axis Capital is saying investment in unrelated business raises concern on overall capital allocation policy of the company, and it limits cash generation ability. OCF to EBITDA remains healthy, but FCF to EBITDA, that is free cash flow to EBITDA, is relatively weaker for TVS Motor. So lack of well-defined capital allocation policy can lead to valuation de-rating. So over the past few years, TVS Motor has been investing in the subsidiaries, but in the past they have done in the core business. This is the first time they are doing the non-core business. That's the concern these brokerages have raised, and that's the reason the stock has been under pressure over the last few days.
Okay, yes, I recovered from the lows, but as Sudarshan pointed out, some concerns that brokerages have highlighted as well. Let's talk about our special segment, Midcap Movers. Ria is here to take us through the midcaps that are moving around in trade. Ria.
Well, yes, let's start off with the gainers first. We have eClerx Limited, which is gaining in trade today. But remember, this stock is down around 35% on a year-to-date basis. Today, it is up around 5%. Himadri Specialty Chemicals is also up around 4% in today's trade. And this stock is also up around 20% just in the last 1 month. Radico Khaitan has hit its 52-week high as well as its all-time high today. First Cry also trading on big volumes today, 10 times the 30-day average volumes traded today. But
this stock is down around 35% in the last 1 year. And IGI as well is up around 5% today, but this stock has declined by around 30% since its listing in 2024. Moving on to some of the stocks that have hit their 52-week highs today, there's Oracle Finserv, which is also up at over 50% in the last 2 months. Gland Pharma is continuing its strong move after yesterday's 15% move after reporting strong Q4 results. BSE has hit its all-time high as well as its 52-week high today, up 70% in the last 1 year. And interestingly, it is up 60% just in the last 2 months as well. Acutaas Chemicals has also hit its 52-week high and its all-time high. This stock up around 2.5 times in the last 1 year. And GE Shipping, this one has also hit its all-time high and it is up 80% just in the last 1 year as well. On the flip side, looking at some of the losers, there's Jain Resource Recycling, which is also down over 30% just since yesterday after reporting a weak set of Q4 results. Triveni Turbine also has reacted to its weak Q4 results, but now the stock has reversed some of those moves. KEC is down around 15% just in the last 2 days after a weak set of Q4 numbers, and it is down over 40% in the last 1 year. Afcons Infra also reacting to weak Q4 numbers, and Escorts Kubota also down around 3% in today's trading session.
Well, thank you so much, Ria, for joining us and giving us a comprehensive view of all the stocks that are moving around as far as the broader end of the markets are concerned. Well, we'll now slip into a short break. We'll get you more on the markets and focus on names like ICICI Prudential Life and Afcons Infra, which are buzzing on the back of news as well as result updates. Welcome back to Midcap Radar. Well, one particular company I'm focusing on is Afcons Infra. Afcons Infra, whichever way you look at Q4 results or FY26, it's been a very subdued year for the company, both in terms of execution and also in terms of order inflow. Remember, day first day, 1 day before the company declared its Q4 results, they had informed the exchanges that they had actually lost out on 2 railway contracts as far as the country of Croatia is concerned. Now, looking at the numbers themselves for Q4, revenues were lower by almost 19% on a year-on-year basis. EBITDA down 85%. Operational weakness deleverage as well as higher EPC costs is something that weighed down on the EBITDA. In terms of the margins at just 1.6% versus over 9% on a year-on-year basis. And this weakness translated down to the bottom line, a net loss of over 88 crore versus a profitability of over 100 crore last time around. In terms of the order book continues to remain quite steady at a little over 32,000 crore, where you're looking at the domestic order book of 88%, the remainder being the overseas order book. In terms of FY26 order inflow, it came at just around 4,100 crore rupees. So now, just looking at how FY26 panned out, the company started off the year saying that they will achieve a top-line growth in the range of 20 to 25%. As H1 passed reduced visibility, they said they should grow by 10%. At the end of Q3, they said they will grow by over 5%. But at the end of Q4, they actually saw a degrowth of 5%. So from starting off with an ambition of in the range of 20 to 25%, they actually saw a degrowth in the range of 5%. Order inflow target was close to 20,000 crore. They managed around 4,125 crore. The only metric that they managed to meet was the EBITDA margin metric, and they continue to be above peers in this particular regard. Over 11% is something that the company saw. The street clearly hasn't liked what Afcons has done, and the stock has been a significant underperformer, at least going into Q4 and especially in FY26.
Okay, so lower in trade. For today, it's down around 4%, but as Vivek pointed out, in last 7 days, it's down around 10% and has not done so well. Let's talk about something that is doing well, Deepak Nitrite, which is higher on the back of March quarter results. Now, do remember, this is also coming on the back of some weakness that the company has seen in the last couple of quarters. The expectation was maybe the company will continue to ride the wave of West Asia war crisis, but that hasn't happened. Revenues have increased. The revenue has increased on a sequential basis, but it has declined 2.7% on a YY basis. EBITDA is up around 19%, 78% on a sequential basis, and that is something that the street likes a lot. Margins have improved to 17.7%, again an increase on a quarter-on-quarter and on a YY basis. If we talk about profits as well, a big surge that has come by. So the sequential recovery is something that the street seems to like as well. Company said the phenolic segment, which is a big chunk of their profits, have seen strong pricing, volume stability as well. Nitric acid plant commercialized, but it is only working at 45% capacity utilization right now. So once it does normalize and reaches its peak capacity utilization, it will get a bid of around 900 to 1,000 crore rupees. They've guided for a better Q1 and Q2 versus Q4. So that's something that the street likes because they are giving some visibility. Of course, things are still uncertain. So not for the entire year, but Q1 and Q2, according to them, should be strong for the company.
Well, thank you so much. Very interesting. Q1 is expected to be slightly better, something that you've just highlighted. But remember, earlier today, we told you that Standard Chartered is likely to exit its bancassurance partnership with ICICI Prudential Life. Yes, the spate of bad news as far as iPru Life refuses to die down. Please update us with the latest details.
Well, as you rightly pointed out, of course, yesterday we had reported on the transaction which will bring a supply overhang as far as ICICI Prudential Life is concerned. And today, the development that we've been given to understand brings a business overhang as well. What we've been given to understand from our sources is that Standard Chartered is likely to exit the bancassurance partnership with ICICI Prudential Life Insurance. This follows Prudential's decision to exit ICICI Prudential Life Insurance and acquire about 75% stake in Bharti Life Insurance. What we've been given to understand is that Standard Chartered could establish a new bancassurance partnership with Bharti Life Insurance, which means that it would end selling products from ICICI Prudential Life and move on to selling life insurance products from Bharti Life Insurance. Also, what we've been given to understand is that there is unlikely to be any change which is expected on ICICI Bank's strategy, which so far has been selling only protection products and not selling non-protection products. So, there is expected to be no change in the bank's strategy as well when it comes to not selling non-protection products. What we've been given to understand is that Standard Chartered contributes about 5% to ICICI Prudential Life's APE and 6% to retail APE. So that is the part of business which might get impacted with Standard Chartered's exit as far as that bancassurance tie-up is concerned. Apart from that, we've also been given to understand from our sources is that IRDA may give about 12 to 18 months to Prudential PLC to sell its entire 12% stake in ICICI Pru Life. 2% out of the 12% is expected to be acquired by ICICI Bank. But if IRDA does give that 12 to 18 months timeline, then that 10% stake will be sold by Prudential in that time period through various block deals.
Well, thank you so much, Yash, for joining us, giving us an update on this very important story as far as the insurance space is concerned. But moving on, market veteran Ramdev Agarwal believes it's time for policymakers to put focus on bringing FIIs back to India. Speaking to CNBC, he adds that domestic buying is slated for strong growth over the next 2 decades. Let's listen in to what he had to say.
We have been seeing very sustained outflow out of India. One, of course, because of the very strong local buying, which is going to become even bigger as we go forward. So the government, the policymakers, they have to think in the backdrop of very strong local buying, how do we console? And my local buying is decadal in the sense that next 20 years, 25 years will become even bigger. In that backdrop, what do I do for the FIIs or FPIs so that they have a little more positive view of India? They might be having some small demand about capital gains tax. Worldwide it is not being charged. Why we are being taxed out here? Why we are being charged capital gains tax? So whatever their demands are, I think the authorities should look at it very intensely, because it's a very changed environment.
Well, prioritizing what FIs has to say is what Ramdev Agarwal believes that the government should focus on. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello and welcome to MF Corner on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Sonal Bhutra as well. Sonal, very good afternoon to you. And we're back with Know Your Fund Manager. Important to keep going with that and keep knowing where the investment strategy is, right?
And, you know, in a time like this, when things have been quite uncertain for the markets, the way flows are taking place and the way markets have been, different asset classes are seeing different kind of reaction. So we need to understand how do fund managers navigate different market cycles, with growth strategies the best, and a lot more. So let's get started, Vinny.
Absolutely. Let's get started with that. And today we are going to be bringing on board Anup Vijaykumar, who's the head of equities at Capital Mind AMCs, and we'll be discussing their funds as well as the strategies that he's keeping an eye out on as well. Anup, good afternoon. Thank you so much for joining us on the show. Like Sonal said, right, it's such times that we want to know what's going to be happening. It's volatile times, uncertain times. When we start about it, let's start by talking about valuations, which everyone worries about in India. The concern comes in at this time that do we have value today? If we do have, where is the value? Large cap, mid cap, small cap? How are you navigating all of this and how are you seeing value in today's Indian markets?
Thanks, Vinny. Thanks, Sonal, for having me on. Pleasure to be on your show. So, I mean, you asked the $100 million question, right? As in, where are we placed on valuations? So the way we tend to look at it is to look at the earnings yield of the major indices as one of the indicators of where we are at any given point in time. So if you think of earnings yield as the inverse of the PE multiple, which we often focus on, essentially we are looking to see how cheap or expensive different indices are. So if you look at that for the various Indian indices, we see that the Nifty 500 and the next 50 are at roughly about 5% yield currently, while the mid and the small caps are at low yields at about 3%. So there's clearly a difference there in terms of how the market is valuing the large versus the rest of the market. If you were to compare against history, and that's where it gets interesting. Like the large caps are currently at over 90th percentile in terms of where they are placed versus the last decade, which essentially means 90% of the time over the last decade, large caps have been cheaper or more expensive rather, which means they're cheaper than the way they've been over a large part of their last 10 years. That's not quite the case for the mid and the small caps. For mid caps, they're roughly at the 50th percentile. So, you know, half the time they've been more expensive, half the time they've been cheaper. Small caps, again, are slightly more expensive overall, where they're in the 35th percentile of earnings yields versus their last 5-10 years. So essentially, I guess in a nutshell, I would say that if you were to look at value currently, it lies somewhere in the large cap space, primarily maybe in the next 50. Having said that, though, we are currently in the middle of earnings season. About 60% of companies out of the top 750 have so far announced their results. And what we're seeing again is a slight difference in the kind of revenue and earnings growth that different market cap buckets are reporting. So the large caps have been growing at a little under 10%, while the mid and the small caps are doing comfortably in the mid-teens and the late teens. Small caps in particular, of the companies that have reported so far, reporting almost 18% in earnings growth. So that's an encouraging sign, in spite of the fact that they've been reasonably expensive. So what that essentially means is if you have to pick a segment today, the large caps make sense. Having said that, if small caps continue to deliver the earnings growth that they have this quarter, then they start to get more attractive from a valuation perspective.
I was actually looking at your FlexiCap fund as well, Anup, and it's interesting. You're talking about where value lies right now. Large cap is, of course, one of them. So let's actually take a look at Capital Mind AMC's FlexiCap fund and how the breakdown is really here. Of course, the fund manager, Anup Vijaykumar, Pratik Jain, Divyansh Agnani. The base expense ratio here is 2.07% for regular plan. For the direct plan is at 0.82%. Now let's come back to the portfolio breakup. In March, they had 39.2% allocation to large caps, which has increased to 43.66% in April. Mid caps have increased to, and of course that has happened because cash component has come off substantially. So they were actually, of course, it's a new fund, so they had cash of around 33.7%. Not all of it was deployed to different names, and now it has seen some deployment. So 14.8% is where the cash levels are at. Banks, the biggest weight. We have non-ferrous metals, pharma, industrials, auto. Some interesting segments that we are talking about here. So in that case, Anup, because we see so much volatility and FlexiCap funds flexible across market caps, we we'll of course understand that in greater detail. with the current global uncertainty that we are seeing, there's inflation, there are problems of supply chains. Every sector is talking about it. And nothing is really insulated here. How are you positioning the FlexiCap portfolio against these risks? Which are some of the sectors you think would be immune? If not immune, maybe will not see that big an impact?
So, great point. Like pretty much since the time we launched our FlexiCap, it was last August, we've seen some kind of geopolitical uncertainty. First, it was the tariff escalation with the US, and then the US-Iran war kind of broke out. So what we believe as an AMC is we don't really have any special ability to forecast geopolitics, right? We can't really tell what, who's going to attack who and what's going to happen to the price of oil. So given that, I mean, we prefer to think in terms of frameworks. And one, useful framework they've found is called the Sinofin framework. Is actually pronounced Cunefin, which is a Welsh word, by a researcher called Dave Snowden, which basically forces you to kind of look at any given situation and classify it into 4 different buckets based on the kind of complexity that you're seeing. So, and there's 2 buckets really that are of relevance to investors at any given point in time. There's the complicated bucket of situations where analysis works, right? I mean, when you're doing a DCF of a stable company, when you're trying to gauge the impact of a corporate action on the valuation of a company, those are things where, given the right inputs, you can work out the answer. And that's where most investing tends to sit. But then what's happening with geopolitics, the US-Iran war, the tariff escalation, all of that, to us, kind of falls in the complex or the chaotic buckets of events where there are multiple actors, there are daily shifting dynamics, there is very low predictability on what's going to happen next. And so there's essentially no right answer to say, okay, this is how you should be positioned. So in that kind of a situation, our philosophy is to stay agile and to take small steps and keep optionality open, which is what we've essentially done over the last 6 odd months. So even as the tariff escalation was playing out and the US-Iran war broke out, we had a significant amount of cash in the portfolio. We were deployed roughly to 70 to 75% going into Feb and March. And the cash was as a result of the fact that things had low predictability. And as the ceasefire has been announced, that cash has started to get deployed. And that's what you're seeing in the portfolio in terms of how it is evolving. And so our default position is to be agile and respond to especially geopolitical situations as and when they arise.
Absolutely, point taken there. Take small steps, remain agile. That's the focus also that I've been looking at, and deploying cash is what you all have done. Anup, when I'm looking at it for this category, right, your PE ratio, that stands at around 17 versus the category average is at 24.5 times approx. What does this mean when an investor is looking at this? And do you think there's more value still for you all? Is it more value oriented? How should one read this scenario?
So I should probably talk about how is it that we end up investing in that sense. So the Capital Mind FlexiCap fund is quantitative in nature. So what we essentially do is we're responding to the market regime to decide what we're going to own in the portfolio. So in uptrending markets, what we end up owning are stocks which have been showing strong earnings and price momentum, which is where the market tends to spend a fair bit of time. In more choppy sideways markets is where we favor companies that rank higher on value, quality, low volatility, and more defensive factors. And in downtrending markets, we are actually happy to hedge our positions and increase cash allocation quite significantly. So what you are seeing as the P ratio of the portfolio as of April is really a result of the regime we're in, which is where it ended up buying a lot of low P stocks. But then that is not always going to be the case. And as the market conditions themselves change, our factor tilt or our allocation overall is going to change along with it. So you would see probably a different P ratio 3 months down the line. That's what I would expect.
Okay, so Anup, we are talking about, of course, the FlexiCap fund from a valuation perspective, but this is a new fund with no 3-year track record yet. You just launched it back in August. If a retail investor is looking at it, how does one do it versus an established FlexiCap fund with 10-year track record? What is it that you are looking at differently versus the established ones?
So as an advisor to a retail investor, my honest answer would be, this probably should not be a core holding for you, given that it's new, so you really can't decipher too much about how good we are at doing this, especially if you are not very conversant with a quantitative style of investing, which is what we do. Instead, I would probably reframe the question to say, okay, what is different about this portfolio? And, does it add anything meaningful to your existing portfolio of, what might be 3 or 4 other funds, right? So a couple of points there. One is, like I already mentioned, we're a quantitative fund, which kind of differs significantly from the way most other flexi caps tend to invest, which is a discretionary bottom-up approach where you go deep into each company and then kind of decide for the long run. As opposed to that, ours is a quantitative model which has been backtested over 15 years of data in the Indian markets, which means over past corrections like 2008, the COVID crash, etc. And we've seen how it is done over that period of time. As a result, what we see is our active share has tended to be fairly high. In the time that our fund has been live, our active share has been about 80% or more, which is basically the difference between what's in our portfolio versus what's in the index. So if you were to look at existing flexi cap portfolios and ours, you would see significantly low overlap. I mean, you could literally pull up the top holdings side by side and see there'd be very low overlap between what the most other flexi cap funds hold and what's in our fund. So what this fund really brings is, in a sense, process, style, and holdings diversification. And if you're an investor with a 10+ year horizon, instead of holding a bunch of very similar type of funds, having different investment styles will probably give you longer term, better risk-adjusted returns.
Okay, point taken there, Anup. But on that note, actually, we have to slip into a very short break. We're going to continue this conversation after the break as well. So stay tuned and viewers. Welcome back to MF Corner on CNBC TV 18. We still have with us Anup Vijaykumar, Head of Equities at Capital Mind AMC. Now, we spoke about FlexiCap. Let's shift focus to the multi-asset allocation fund of Capital Mind as well. Fund managers Anup Vijaykumar, Prateek Jain, as well as Divyansh Agnani, who are the fund managers. AUM is around 28 crores, and this was as on 30th of April. This is relatively newer, right, versus previous other funds as well. Base expense ratio for regular is at around 1.76 and direct plan is at around 0.46. Where's the allocation that comes in? Multi-asset allocation means different categories that come in. There is equity, debt, commodities, as well as cash and others. Equities is around 43%, debt is at around 22% for them. And this is as of April fact sheet, and commodities at around 16%, and the remaining is in cash. Obviously, commodities classification, that's where it's interesting, right? Gold ETF, aluminium, as well as crude oil ETCD is what they have invested in. And sector allocation, pharma, IT software, non-ferrous metals, finance, and autos is where it is. Anup, when you talk about multi-asset allocation fund, what I'm finding interesting is your commodities basket, right? Because it's going beyond gold, including crude oil, aluminium, all of that comes into play as well. Plus, now with the scenario of you all having the option to invest in REITs and InvITs also that comes in, how should a retail investor actually understand the fund, and what is it expected of it going forward as well, given that multi-asset allocation is something that's investors are picking up like hotcakes right now?
Great question. So the core principle that we kind of set out to when we were designing our multi-asset fund was to group together as many uncorrelated assets as possible, because that is what enables us to get better risk-adjusted return. I mean, that is literally the core principles of diversification, which is where looking beyond gold kind of came in. We expanded our horizon to industrial metals, which means copper, aluminum, zinc, as well as energy, which is crude oil and natural gas. And each of them have their own demand and supply cycles. So industrial metals, obviously, they respond to economic activity. Different metals do so differently, some with a lag, some early on. Similarly, with energy, oil, as we are currently seeing, can go through supply and demand shocks. So all of that means that they behave very differently from what a typical gold does over any given cycle, and which is where it sort of makes sense in a portfolio together. And gold also, in spite of what it has done over the last year, which is what got a lot of people excited about multi-asset funds, can tend to stay flat for long periods of time. For example, between 2012 and 2019, someone holding gold would have got zero return. So given that, I mean, we've just expanded that basket of commodities to all of these that I just talked about. And then within that, we apply a trend following model, which picks the 2 to 4 of the strongest trending commodities within that. With the understanding that, as and when situation changes, we will shift between commodities in that basket itself.
Actually, that was going to be my next question. What happens next? Because now we have seen a big surge already in these commodities, and you've launched it at a time where maybe we have seen a big surge already. So as you said, as and when things change, you will make those changes in the fund as well. But Anu, for a retail investor who is trying to pick maybe between the two categories, at what point does a multi-asset fund make more sense than a pure flexi-cap fund, or both of them in tandem together make a great part of a portfolio?
So I've heard this question a few times over the last few months, and my answer is that the flexi-cap funds and multi-asset funds, they solve different problems. A flexi-cap fund gives you pure equity exposure across market caps to an asset which is historically the highest returning asset, albeit with high volatility. Multi-asset funds are meant to focus on risk-adjusted returns, which means a smoother ride by exposure to multiple assets, and by virtue of the fact that they're not all moving together. So they're really solving different problems for an investor. So instead of thinking about, okay, what has done better over the last, let's say, 12 or 24 months, it's better to think about what is my risk tolerance, or what is my tendency to do I tend to panic sell in a drawdown? Do I have commodity exposure? Do I have debt exposure elsewhere? So for an investor who has relatively lower risk tolerance and knows that they tend to panic when markets correct, a multi-asset fund makes more sense because it gives them slightly, probably a smoother ride in the markets. While if you already have significant alternate asset exposure by way of commodities, be it gold, other metals, etc., then you probably are looking for pure equity exposure, and that's what makes sense. But then, to your point, right, both can make sense in an investor's portfolio, especially if they're looking at a time horizon of 10 plus years. My final point on this would be that, best returns, and we all know this, just that the best returns come from staying invested, right? And the right fund is the one that you can hold through even difficult periods. So if multi-asset is the fund for you, then that might be the right answer that you should be holding versus a pure play equity exposure type fund.
Anup, I wanted your thoughts also on REITs and InvITs as well, because they are in that investable universe now. Is that something that you all are looking at? Any strategy on that?
Absolutely. I mean, for us, the more assets there are in the universe, the better, because they all have slightly different dynamics. So they tend to move slightly differently from each other. So REITs, for instance, have done exceptionally well in an environment where Indian equities have not. And the reason for that is, simply because they have a completely different business model, where they're relying on cash flows from commercial and retail rentals. So and InvIT similarly in the industrial space, right? So as the market sort of depth increases with more and more of these issues, I think they'll play a more important role in most portfolios, I would say, even in equity exposure as well as in multi-asset type of setups. And so they are part of our portfolios in some shape or form. Our flexi cap currently holds some exposure to REITs. And then, we are constantly evaluating them to see which ones make sense in our portfolio. So that'll continue to keep happening.
Okay, so that's about multi-caps. Let's talk about the short-term funds, the liquid funds that we have. We, of course, talk about the arbitrage fund as well that was recently launched. First, on the liquid fund, the asset under management here is 92 crores. The fund manager, Prateek Jain, they have modified duration of 31 days. The average maturity is 31 days, and yield to maturity here, more importantly, is 6.11%. Let's talk about the allocation here as well. It is mostly into commercial papers, their corporate bonds, certificate of deposit, government bonds and bills, cash and cash equivalents. Debt funds, of course, this has to be in a fixed income category. Arbitrage funds, of course, again, the similar case, they have equity as debt, so it's not entirely a debt product, so to say. Equity is 73%, debt 0.083%, and they have cash as well. The breakup there as well will come up for you on the screen. Anup, just trying to understand, for short-term parking, people use it liquid funds and arbitrage funds, but now there is a tax differential here. We have the STT hike that came by. Between the two, what makes sense for whom? And since arbitrage has a higher equity exposure, do you think it comes with a higher risk, and hence people with lower risk should stick to, say, something like a liquid fund?
So liquid and arbitrage funds tend to have fairly similar risk profiles, even though they have very different holdings, like you mentioned, arbitrage being an equity product. But because of the fact that an arbitrage fund is always taking a hedged position in each stock, which means if a stock is trading at 100 on the spot market and the future is trading at, let's say, 100.6, the arbitrage fund essentially buys the stock and sells the future, locking in that 0.6% spread between the two. And it keeps doing that on an ongoing basis as and when opportunities arise. In fact, the way we do it is to kind of systematically surface those opportunities and then take positions. So doing that effectively is where the arbitrage fund return comes in. And it has pretty much a risk profile of what a debt fund would have.
I think we lost the feed with Anup. Okay, Anup, continue, please.
Yeah, so the risk profile of arbitrage funds being similar to liquid, but at the same time, their taxation is that of an equity fund. So if you hold it for long-term capital gains, you're taxed at the equity taxation rate versus what you would be at in a debt fund like a liquid fund. Having said that, the liquid fund is obviously built specifically for capital preservation, just to maybe match or slightly do better than a bank savings deposit. And in our fund specifically, we focus on very solid short-term maturity papers. Bulk of the allocation is to sovereign debt, which means there is no credit risk, and the remaining is to top-rated, AAA-rated corporates and banks, which again means you're getting the highest quality paper in that instrument, which means no real risk involved in either of those two instruments.
Take that point. Thank you so much, Anup, for joining us today and taking us through your strategy, the new funds that have come by, and the outlook on investing in general. That was very helpful. And with that, we'll take your leave on this edition of MF Corner today. But stay tuned for Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Nikkei is holding on to gains of 0.1%. We have Hang Seng that's holding on to gains of 0.6%.
Very good chance that they can work something out. If we can do that without bombing the hell out of them, I'd be very happy.
So small fuel price hikes coming through again. So diesel is up about 91 paise, petrol is up about 9.
This comes after US DOJ, that is Department of Justice, had submitted the motion seeking dismissal of indictment with prejudice.
So starting at about 23,700 this morning, it's about 0.25% higher.
There has been an outflow, net outflow of around 36 billion US dollars by FPIs.
The estimate suggested that the price hike had to be anywhere between 10 to 12 rupees per litre for petrol.
They see the company as the top beneficiary of the AI cycle.
It looks like a beautiful screen right now. The Nifty hovering closer to that 23,800 mark.
The expectations of further rupee depreciation are so widespread that they have kept exporters at bay.
There are three reservoirs in Bombay, and I think they're running at about 20% of their capacity.
I think the authorities should look at it very intensely.
It's a session where we're actually seeing, after a while, the broader markets outperform quite significantly.
One good thing with respect to IGL is that 2/3 of our long-term contracts are Henry Hub linked.
Okay, that is the day so far. We are up about 60 points, actually around where we started this morning at 9:50, not very different. It's not a bad-looking screen. IT, of course, is the star after the falling 6% last week. It's up 6% so far this week. Rupee made a new low, but I think it's also holding around the 96.5 odd level. 96.4 or so, I think, was the low, the new low, which has been made. Nigel, afternoon.
Well, that's right. Final 60 minutes, Prashant. The bulls will want to go ahead and try to get closer to around the 50 DMA. We briefly went to that mark, and that number, in fact, got rejected. It's the weekly expiry, so things will pick up a little bit. We'll keep an eye out on that particular mark. I think we're close to around 65 points away from those levels. 23,770 is a crucial mark on the upside.
Yeah, absolutely. And, we'll keep an eye out on that. Market breadth is positive, significantly positive. So some almost 3:1 in favor of advances. So that is the broader market picture right now. At this stage. Well, let's just sort of, quickly run you through what's coming up here. So, IT, of course, is going to be a big talking point, which we will get Rima in for in just a bit. But, let's just get you the trading ideas top of the show. Mitesh is with us with exactly that. Mitesh, good afternoon. Good to have you here. So, yeah, 23,705. I mean, I think Friday's high was about 23,820, 830. And then, of course, so that's the near-term kind of level to take out?
Actually, yes, Prashant. I think, 23,800, 850 broadly, give and take few more points, I think has got multiple levels over there. There is a price gap. There are a couple of averages which are there. So it's a important pivot for the Nifty. And I think further or strong upside will happen only once we start closing above these levels. So I think for the timing, my view remains that the market will be choppy, but yet more of sideways kind of a movement will continue. And trading should be more stock-specific basis.
Okay, what about individual stocks?
Yeah, I have two buy calls. I think IT, Prashant was just mentioning that, and very clearly the Nifty IT is seen as an index which is rebounding well. Morning we had buy call on COFOs. Right now it's HCL Tech. HCL Tech is a buy with a stop below 1164 for targets of 1222. And after a long time, Tata Motors personal vehicle or TMPV, that's a stock which is on the buy radar. Keep a stop at 357 here, look for targets of 377.
Got it. Okay, let's talk about a couple of big boys then, Reliance Industries as well as HDFC Bank. How are both those two looking on the chart?
Nigel, I think, Reliance broadly has come down to the support area. If you look at the chart starting from April, in fact, even way back to 4th of March, I think there have been multiple lows on this 1320, 1300 mark. So it's getting close to the support area. And I think, if you get a reversal sign on hourly to hourly charts, then it might be a good trade on the long side. I think if it can hold these levels, good chance that we'll see a pullback to about 1380, 1400 zones. That's the last. Which was the other stock?
HDFC Bank.
For HDFC Bank, I think, again, the banking pack doesn't look very strong to me, and HDFC Bank is also very contracting. So for me, it's right now, it's a falling channel for the HDFC Bank stock, which is between broadly 780, 800 on the upside to about 740, 730 on the downside. I think wait for this range to break on either side and then take a directional call.
Okay, all right. Thanks very much for that. Mitesh, we'll have more a little later. Policy Bazaar is having a good week so far. It's up 8%. That is from last Friday's close. So half of the 8% gains coming in today. Now, there was an analyst day. I think this was the first analyst day at Policy Bazaar, which happened over the weekend. So I think it responded to it yesterday, but sort of, just to kind of revisit what was said and what the street liked. Yash is joining in with that read-through. Yash, take it away.
Well, absolutely, Prashant. As you rightly pointed out, it's been a good week for the company, for the stock, and especially the last 2 days have been very strong today and yesterday. And this is right after, the analyst day takeaways were getting known to the market. As far as the takeaways are concerned, there are 6 important points which I have put down as far as those analyst day takeaways from PB Fintech are concerned. I'll start with the first one, and that is with respect to market share. The company said that they will sustain market share accretion across most insurance segments backed by product innovation, vertical integration. This essentially means claims management, improving their underwriting journey, garage network which they've been establishing, and ramp up of technology capabilities. The second point is focus on transitioning to an ecosystem-based approach for product distribution compared to the traditional models focusing solely on insurance sales. We've of course heard from the company that they want to distribute debt products, also different kinds of other financial products. So that's also something that was mentioned as far as the analyst day itself is concerned. The third point is driving higher business growth through phygital channels. Digital, of course, having its limitations, restrictions, but the company has been moving forward with phygital, which is a combination of physical and digital distribution. That has also worked for the company so far, and the company expects to continue with that. The fourth one, investing in ramping up new business segments. The company did speak about Pension Bazaar. So segments like this, the company will invest more into them, grow them further, and that is something that was mentioned in the analyst meeting as well. Fifth one, multiple levers to contain any commission-related challenges to the P&L owing to diversified business model. Of course, we know that the distribution discussion paper from IRDAI is expected to come out soon, which is expected to have some impact as far as Policy Bazaar and PB Fintech is concerned, because it will directly impact their income. Here the company is saying that they have multiple levers to sort of tackle the disruption that might potentially come from this distribution paper and the eventual regulations. Final one, product co-creation with manufacturers to target untapped customer segments. The company has been identifying new segments where it can reach out to people to sort of go that extra mile when it comes to new distribution capabilities coming into the picture.
Okay, all right. Thanks a lot, Yash, for joining us and giving us this quick takeaways. Dharmesh Kant, Head of Research at Chola Securities, joins us on the show. Hi, Dharmesh. What do you make of these comments that are coming in there? The street clearly likes it. The stock is up more than 4% as we speak.
Yeah, Dr. Nigel, thanks for having me for the show. I mean, one thing is very clear, the management is trying to diversify the business model into different areas in forests. Just pure, digital platform for selling insurance products won't be sufficient or suffice their purpose. And that is why they are trying to diversify into other areas. So it's a hope rollout and, rollout from multiple segments to which, distribution segments to which they can earn revenue. But net, looking at the insurance space per se, with all the challenges and the disruption which is likely to come in the future, like Bima Sugam is one of them, and with open architecture and composite license, where insurance players will be becoming more competitive. So this will be eating into the revenue. So I'm not buying into this current, price surge, which has happened, some value bargain, some tactical or technical trades may be playing out. But other than that, I think long-term one is to wait for a couple of quarters before taking a reasoned call. And to that extent, I am willing to jump the gun and say insurance product providers are a better bet rather than the distribution players.
Yeah, no, got that. Just want to get a quick handle on a few other names today which are making large moves, and some of this, of course, is on the back of results, etc., which has come through. By the way, Dharmesh, any new initiations, etc.? I mean, I think every time there is one, we've discussed that. Anything new?
Yeah, Prashant, I mean, look at the difficulty of the problem right now. So there is nothing structural, damage which has happened to economies across the world. It just, to put it like this, just like a railway fatak which has been closed for the state of Hormuz. If it opens, it may take 2-3 months time to get on the regular course of business, but things can turn overnight. And as long as the pain continues, it's difficult to predict what can be the future trajectory on the operating margin and the growth outlook. Of late, we have been, penciling in many companies, and there I have spoken about Dixon Technologies, which we have initiated a trading bet as of now. But looking at the management commentaries and all, the only thing which was coming out, they themselves are not very confident about the revenue growth trajectory for FY27, and if things continue the way they are, this stalemate, then it would be actually impacting severely on the operating margins and the overall consumption themes. So that is the reason why we are holding the guns. I mean, it can reverse in a split second. A decision has been taken. Let's open it, and then market is forward looking, things may change very speedily. So we are having that in mind, but to that extent, nothing new. We are still, recommending the same old stuff, Aadhaar Housing, Majgaon Dog, Tata Technologies, and HALs of the world.
Got it. Okay, let's stick to stock discussions then. Let's get in Ekta. She joined to tell us about Zydus Life. The stock is reacting positively to its numbers, and also the board has approved a buyback. Ekta, take it away.
Well, yes, Zydus is in focus because the numbers have come in better than expectations. So the street was anticipating a revenue growth of around 9% margins 23%, and a profit of around 997 crores. So it's really beaten in terms of all of the parameters this quarter. Now, just want to point out that India did very well for the company this quarter. It was up around 14% year on year. North America was down 6% year on year, but the street was anticipating possibly a worse quarter because of drugs such as Revlimid generic seeing more competition. One of the other segments, the IM formulation segment, was up around 45%. APIs was down, a bit sluggish. It was down around 5.5%. Consumer wellness also did well. It was up around 61%. And MedTech, which is a new addition to the business, did see a Q-on-Q growth as well as a year-on-year growth. So that contributed around 327.5 crores in terms of total business. Separately, the companies approved a buyback worth around 1,100 crores with the price at 1150, with the promoters expected to participate as well.
Dharmesh, Ekta, thank you very much for that. Zydus Life, any thoughts?
No, Prashant, I mean, we have been tracking this company, but nothing on the recommendation side on this.
I see. Anything else in the pharma space? And actually, we've had lots of large movers. Gland Pharma is one. Newland has continued its rise all through this year. I mean, after doing very well last year. Anything you like in the space?
Yeah, I mean, Lupin is one which is a pure pharmaceutical play. The numbers has been very strong for the last 2-3 quarters, and valuation-wise is the cheapest among the lot. So that company has been doing fairly well. Though post the results announcement, there was a big correction happening into the stock price, but I think that was an opportunity to buy. So that is one we like. And secondly, CDMO players have been doing fairly well. So Lawless Lab is one of them which has moved quite significantly, and now their revenue composition around 30%-31% comes from the CDMO space, and antiretroviral is around 41%. It's coming down quite rapidly, and API from non-antiretroviral is again 27-28%. So the small molecule business there is the main growth opportunity, which last quarter was a bit muted, around 14% kind of a growth was there. But going forward, I think again the trajectory of 5% is gettable on there. So valuation-wise, it's a bit on the higher end, but again, that's a good opportunity. So Lupin, Arvindo Pharma, and Loss Labs is our preferred pick from the pharma space.
Okay, got that. But today, belongs to the capital market players, and Indian markets remain volatile among the ongoing geopolitical turmoil. That's the word that's coming in from BSE's MD and CEO, Mr. Ramamurthy. He shares how BSE is navigating these challenging times while staying resilient. He also highlights the sharp rise in the market participation of the past few years. Let's listen into the soundbite and then get Dharmesh's view.
Somewhere it used to hover around 2 digits. 10 to 12% used to be the domestic one, and 15% used to be the FPI holding, 15 to 20. Today it is reversed. If you look at last year, given the global situation, there has been an outflow, net outflow of around 36 billion US dollars by FPIs. But to compensate it, the net investment by the domestic institutions has been 91 billion. This has not only taken care of the outflow, but also strengthened the Sensex to a great extent and has prevented it from a free fall, notwithstanding the severe geopolitical tensions. So it's a very healthy mix at this point of time. Of course, there is a flight to safety by FPIs, and I'm sure once things normalize, the attraction of India as a growing destination will bring them back in big numbers as it was always before. We have introduced an index called Focused IT in the derivatives market, considering the turmoil in the IT industry because of supply chain issues and also because of AI, the demand for memory, and therefore the increase in prices. So IT stocks in India have become very volatile, and to take care of the hedging need, we brought this index. It is 5 days of trading we have seen till now, and it is really showing a lot of green shoots of growth. When there is a turmoil like this, not necessarily the volumes go down. The economies get into difficulties, but volumes do not go down. For example, if you look at my cash market, last 1 year it saw around an increase of 30%, and derivatives market around 40%. That is one point which we need to reckon. The second is, India is growing and a significant amount of population is yet to come into the capital markets, and slowly they are starting to come in. Last year alone, I have seen 35 million Indians coming and joining the BSE bandwagon by registering with their unique client codes. That's the second point which we need to reckon. The third is, more and more improvements need to be done and innovations need to be done in terms of products, considering which are all the sectors which could be seeing great volatility and where there is a need for product to hedge the positions of the individuals who are investing the money.
Okay, all right, Dharmesh, coming across to you to ask you about what do you like from these capital market plays? I had a chat briefly with Mr. Ramdev Agarwal, and he pointed out obviously that that's a sector that he believes will do very, very well. Could have some vested interest as well, because most of his wealth is in Motilal Oswal, so he took note of that as well. But just take a look at these themes. BSE, MCX, they are running very, very hard. Your view on these stocks, or do you prefer some of the other names, like an Angel One, that's also up close around 5% after correcting 25%?
Yeah, Nigel, I mean, as far as capital market plays are concerned, exchanges in particular are the best bet, because whether it is a bear market or bull market, and as long as the volatility is there, they tend to make more through the transaction charges, and that's most of an insulated kind of revenue stream for them. And if you look at the BSE and MCX, both for the last, say, 5 year or 10 year, they have been compounding at a CAGR of more than 50% on the profitability front, and that is phenomenal. And last year itself, like BSE gave year-on-year growth of 88% on the profitability, whereas NSE, which is not in the listed space as of now, but the unlisted space, the numbers which they rolled out was a minus 17%. It was a degrowth on the PAT front. So something, I mean, BSE is doing things right. They have been able to garner more market share, and derivatives, they have come up a long way from where they were. So product rollouts, as we just heard, the MD has been quite, more ferocious than as compared to that of NSE. What we like, if somebody has to play, I think this 50 plus kind of a PE multiple for both BSE and MCX is here to stay for next 2-3 years. So not to be worried about the PE multiples which these companies are commanding, but the growth at which they are growing, they will be making higher highs. So any declines out there, both the exchanges should be bought into. We don't like, I mean, brokers per se, because of the nature of the business they are into. But again, the infra players like CAMS, KFNs, CDSL, NSDL, they also make a good bet. Although we are also bullish on the wealth management companies.
Okay, all right. Interesting. The point that I was making on Angel One, that stock, I recall, it went from around 300 rupees to around 210 rupees. You pull up a one-year chart of it. And from that 210 bucks, now it's at around 327 rupees. This is today's chart. You pull up a one-year chart, that will tell you the picture out there. 320 to around 210, from 210 back to 327. By the way, take a look at the markets. There's a sharp fall that we're seeing on the index itself. This could be owing to the expiry, the contract expiry that will be taking place. But the Nifty has gone down very, very sharply. I'll look at this 23,625 is an important mark on the downside. But this clearly appears like a bit of a expiry-related, fall, along with the Indian rupee as well, plunging to the day's low as we speak. It just crossed the 96.5 odd mark. But Prashant, you want to come in with regard to this IT stocks?
We've been talking about IT, right, Nigel, over the last few hours or so in the morning as well. And index is up. I mean, so just a bunch of reasons perhaps. And one, of course, is a simple, straightforward logic because the sector had sold off hard. It was down 6% last week. And I was saying this yesterday as well. You get large falls and then small bounces. This has not been a small bounce. 6% recovery this week compared to the 6% fall last week. So we'll see what happens from here. But apart from that, there's just a couple of reasons. Overnight, and we kind of sort of, did not highlight this in the morning, actually all software companies were up. Cognizant was up 9%, Accenture 5%, EPAM, Globant, Gartner. These are US-listed, software companies. They all rallied. Number two, Cognizant has upped what they will do in terms of share buyback by about $1 billion or so. That also happened. I think the news hit the tape around US market close time. Raising hopes perhaps that, we'll see Indian IT follow at some level, or maybe, just an indication that the management does feel, and Cognizant is the big one, that business prospects are not all that bad. And number three, of course, is this rupee depreciation bid that when you translate dollars back into rupees, the export earnings, you tend to make more. I mean, just simple translation revenue gains. So, I mean, could be a combination of it, but the starting point, of course, is extremely beaten down levels, sold down levels from where this bounce is happening over the last two sessions or so. Dharmesh, I don't know if you have any thoughts here or anything you like.
Yeah, Prashant, I mean, I buy your first point that in a bear market, there are always ferocious pullbacks. That's the texture of the bear market. I think IT stocks are primarily into a bear phase right now, Indian IT companies in particular. And we will see days. I mean, currency tailwind is definitely there. Back of the envelope calculation suggests like 1 rupee kind of a depreciation. Post-tax translates to 10 or 11 paise of a gain into the PAT side. So that incremental benefit is there. But I mean, just to play a cautionary note here, we don't know what kind of measures government of India will take. But if it does take, 2013 being the case in point, that time the rupee depreciated from Feb to August from 53 to 69 rupees. And after measures were taken like FCNR and all, it came down to 61 rupees. So 10% kind of an appreciation was there. So we are penciling in a case where by the time we end FY27 or this calendar year, FY26 for that matter, we would be around 90-91 rupees on the rupee level. Because again, from FY25, January 25, if you see, dollar index has appreciated 11%. Whereas rupee from 86 has gone to 96 now. So these things won't exist for long. There will be resetting and again reversion to mean will happen. So this tailwind of IT companies benefiting from rupee may come under a big scanner. When it will come, I don't know. But that is what our thought process is.
Got it. Okay. All right. Thanks, Dharmesh. Have a good remainder of the day. See you soon. Well, let's do a quick check on the F&O markets because the markets are getting a little bit volatile. The Nifty went to around the 50 DMA. That 50 DMA mark actually got rejected, which is close to around 23,780 or thereabouts. That's the mark from where we got rejected. The 50 DMA as well will come up for you with the Nifty. Now, the options data is interesting, and that perfectly tallies with this 50-day MA. Because the 23,700 call, the premium was around 80 rupees, which is perfectly in line with where the 50 MA is at. That premium has come down to around 3-4 rupees because the writing has been very aggressive at that level. Now, the 23,700 put, interesting one out there. The premium is down to around 30 rupees. And, we started this day at around 139 rupees. Just punching in the levels and looking at an average for the day, you get a support mark. It's at around 23,625. And as the market saw a bit of a dip, it went very, very close to that support. This is just for the last 60 minutes, going by the data that we have in terms of technicals as well as the options data. The 50 DMA, that'll become a bit of a resistance mark. And some of the bulls can get to there, then you'll see a big short covering bounce that'll play out. The VIX is cooling off, and that's encouraging because that's down close to around 4.5%. I like what I see on that screen. I don't want it to go past the 20-odd mark from a bullish perspective. Stocks that have got hit, they're coming for a bit of a bounce. KPIT Technologies, there's a bit of a short covering bounce clearly that's taking place out there. A stock that's corrected big time from the peak, that's come off for a bit of a bounce. And Keynes continues to remain in the F&O band, but the shorts seem to be covering out a little bit. Let's see whether or not it has more in store. Maybe towards the end of this week, it could come out of the F&O band. We'll have to see how that goes. And PP Fintech, another stock that's seen good amount of delivery-based buying. It's been backed up by some fresh buying as well. So net on the downside, 23,625 is the crucial support mark, which we almost went to a few minutes ago. On the upside, the 50 DMA is the mark we're looking at. Tell you what, go into a short break, come back. Tushar Pradhan of XCon Partners is waiting to tell us what he thinks of the markets.
Welcome back. Markets coming back up a little bit. I think it slipped into the red, about 15 odd points higher. But of course, it's a sharp slide from the levels that we started with at 230. We started with about a 60, 70 odd point gain, but all of that is now been given up. Market breadth also slipped a little bit. It's 2:1. We started with about 3:1 advance decline ratio. I mean, that's also come off as we are making newer. By the way, actually, if anything, pull up the dollar rupee, that's continuing to go. We hit 96.50 and 96.55 as we look at that. The currency pair now, a little drop off maybe from that level, but this is once again a 20 paisa fall coming through on the dollar rupee. Tushar Pradhan is with us, Director, Hexagon Partners. Tushar, it's, you know, the rupee one, and I think we had Upasana, the economist from Kotak Bank in the morning with us, and she was saying, well, you know, you can let it depreciate, and that perhaps is a good strategy, as many say, but you got to watch it because, you know, it sometimes will depreciation warrants further depreciation. It kind of becomes a self-fulfilling prophecy. Then it goes out of control. But are equities reading what's happening to the rupee as a bit of a verdict on the state of the economy or the state of the macros in that sense, Tushar? Or you think, I mean, equities, the problem is different. Poor earnings growth so far and, of course, high energy prices.
Yeah, so I think these are markets which are fairly intertwined, and it's very difficult to kind of ascertain what exactly is driving, which market. But I think it's starting from the currency. I think I'll buy the argument that the currency is just an outcome of what the demand for the dollar versus the local currencies at any point of time. And I think if there is a lot of money coming into the economy, then it tends to appreciate the domestic economy. And when it's going the other way, or the expectation that there might be a lot of dollar demand is when it weakens against the dollar. I think it's a very logical conclusion. Now, how this impacts the equity markets is pretty complex. This will lead to certain companies which are export-oriented to actually report higher, essentially, earnings in the rupee. But on the other hand, if your country and your economy is very dependent on imports, then your input costs across the board go dramatically. And I think that's a reflection of what inflation is likely to be. And the higher the inflation versus the inflation of the currency that you're comparing it with is where your weaknesses lie. So in a sense, what our current dollar-rupee equation is suggesting is that inflation in India is going to be dramatically higher compared to that in the US. And if you saw in the last few years of relatively stable currency exchange rates, there was a reversal that we had fairly stable inflation rates for a long, long time. And the US, in fact, actually appreciated significantly on an inflation basis. So near zero, they started going up to 2, 3, 4%, etc., which was where the kind of relationship between the dollar and the rupee started to kind of become a little more stable. But I think what the current exchange rate is suggesting is that the input costs are likely to go up for the Indian economy as such, and that will have an impact on prices in general, and inflation is likely to go up. So I think that's an outcome of a fairly robust economy. So I don't think we need to control it in any way. Yes, of course, as a largely importing nation, we need to make sure that it doesn't go up.
All right. Hi, Tushar. Good afternoon. Good to see you, Ben. But which are the probable winners of this? You know, because India suddenly got a competitive edge with regard to exports because of the depreciation that we have seen in comparison to even, a nation like China. And there would be select sectors that could gain, just to name a few probable options: chemicals, ferrous steel, they're exporting less, currency as well as moving in our favor. Yet to see anything on ground, but these could probably be sectors that actually do well in the scenario that we're seeing.
Absolutely. From a reported earnings perspective, it is definitely the case. In fact, in metals, for example, it's a very interesting case that we don't need to really export metals to make the upside on the higher metals and the weaker rupee. Just the fact that global prices determine local prices as well, just the dollar price of any metal going up in terms of local currency itself translates into higher margins for Indian companies, because Indian companies, the raw material supply chain is very much demarcated in rupees. So that's clearly one area where you will see reported earnings grow. But I think it's easier to just kind of come to this conclusion that this is the case. But the fact remains that if you are incorporating significantly lower economic growth, and I think that's something that we need to watch out for, that all of these curbs on consumption, etc., will lead to some sort of a consumption slowdown in the economy. And maybe that's something that the market is currently not really happy about, rather than the upside in the earnings given weaker currency. So I think there is a broader picture that one can look at.
It's, look at the Nifty change, 1 point, 1.5 points. So absolutely undecided what to do. But I think a lot of it, of course, has got to do with this. The rupee, of course, is a signal, we're talking about, Tushar also pointing out. But I think there's also the expiry factor, as Nigel is pointing out, the Tuesday factor in that sense. So there is perhaps that element at play as well. Dhanuka Agrotech, big move at the bottom of the screen. There are large moves appearing as far as individual stocks are concerned, and that is absolutely the case, both on the way up and on the way down. We'll put some more names up in just a bit. Tushar, the one area where we continue to see a fair bit of excitement, and both in the listed and unlisted space, is defense. Lots of stuff happening, especially if you look at aerial, UAVs and drones, basically. Both listed, unlisted. The largest listed player is Idea Forge, got a big leg up after an IIFL upgrade. And of course, other large listed companies also looking at entering the space. Any thoughts on this area? I don't know if you have a view on Idea Forge specifically. If you will, if you do, that'll be great.
I think in the defense area, we've seen probably a year or so of significant flattening out of the excitement and the euphoria we saw the year prior to that, is when all of these companies came in contention for very large orders, etc. I think as reality sets in, we realize that this is not a one-way street. And as you mentioned, there are certain areas within the defense sector which suddenly come up as very attractive. And there are certain sectors which kind of go a little bit under the radar because either the lead times from order to delivery sometimes stretches. Sometimes there is also a preference for a certain ordinance or a certain level of defense supplies over some other priorities, and as a result of which there is volatility. But I think as a whole sector, I think one should be very confident that this is going to expand. Now, which exactly and which company within to focus, I think it's up to the individual investor to figure this out. But I think as an exposure in a portfolio, looking forward for the next 5 to 10 years, and of course, discounting for maybe some of the premium pricing today, I think this is a very exciting space to be. So I'm making the distinction between the prices that they trade at and the potential that these companies carry, because clearly there's a lot of business coming their way. And that makes that for a very, very robust model going forward. So I think it's an interesting place, clearly.
Very quickly, Tushar, before we let you go, since petrol, diesel, the shock is still moving across the nation on various parameters. On the autos front as well, there could be that high amount of shift towards EVs. Any theme that you're playing out there, the two-wheelers or maybe Mahindra, Tata Motors?
Yeah, but I think one is missing the whole picture as such, because local mobility is where EVs really dominate. But if you're talking about passenger vehicles, prestige, the SUV range, etc., I think the consumption pattern is leaning towards, more, I would say, discretionary, higher value products as well. So I think that the opportunity here really is not driven by EVs per se, and then start focusing only on the companies which have EVs. I think the entire space is likely to grow. We are also going to see a significant shift in the demographics, where a lot many more people are likely to be able to consume these products than ever before, which means that, again, sets it up for a very nice growth curve for the next 6 to 7 years at least. And within that, I think it's your choice to kind of put it across in a diversified fashion. Maybe some exposure to really nice, long-standing EV companies might be worthwhile.
Okay, all right. Let's just dive into this a little bit more, right? EV penetration, I think if you look at scooters specifically, it's what, 30% now? Sudha is standing by, and he's sort of, done some work with regards to that number, how it's come up to where we are now, and what the industry is doing to increase that further. So take it away.
So one theme or one topic that seems to have gained the traction most in the last few months is the use of alternate fuel. And on the same topic, government and all the other regulatory bodies have been pushing for the transition to electric vehicles. If you had heard the speech of Prime Minister Modi in Hyderabad and Gujarat, he has been urging and issuing the advisory to people to transition to electric vehicles. And recently we have seen the policy coming out as well. Central government did come out with the norm or draft norm of CAFE emission norm. Delhi government has come out with the draft of new electric vehicle policy, and all the maximum, I would say most of the state governments have been issuing advisory for the transition to electric vehicles. Two recent announcements. Haryana government has made the announcement that vehicles inducted by aggregators, e-commerce companies in NCR must be of cleaner fuel. Vehicles can be CNG, electric vehicles, battery-operated vehicles, or any other cleaner fuel. For three-wheelers, only CNG and electric three-wheeler auto rickshaws can be inducted into existing fleet. Another advisory that was issued by Finance Ministry, and this information we are attributing to sources, they have asked all the banks, financial institutions and the insurance companies to shift to electric vehicles in their branches and in the head offices. And for the existing fleet, it would transition to electric vehicles in a phased manner. So this was about the advisory. So now we'll try to understand how the trends have been for the electric vehicles if there is an increase in the penetration. So over the last few months, we have seen from the month of February, if you take a look, in Feb, total contribution of electric vehicles to the retail sales on a monthly basis in the month of February, it was 8.5%, increased to 10.7% in March. Again, in the month of April and May, it's in the range of 9.6 to 9.8%. For the month of May, we have the data till yesterday. Now, how the four-wheelers have been doing on the EV front. Everyone knows that Tata Motors has been leader in electric vehicles over the last few years, and that's the reason for them, contribution of electric vehicles to total sales has been in the range of 14 to 19%. M&M is the second because they had recently launched two electric vehicles. Now their contribution is in the range of 6 to 10%. For Maruti Suzuki, they had launched e-Vitara. Their contribution is 1 to 2%. And for Hyundai Motor, they had launched Creta EV, and their contribution is 1 to 1.5%. But if you come to electric vehicles, because of the trend of scooterization, the increase in the penetration has been seen significantly higher. And TVS Motor, Bajaj Auto have been leaders in the market share as well. TVS Motor holding the market share of around 25 to 26%, followed by Bajaj Auto. Third is Ather Energy, followed by Hero Motor and Ola Electric. For TVS Motor, their contribution for electric vehicles to total sales is in the range of 8 to 10%. For Bajaj Auto, it's 6 to 8%. For Hero Motor, it's 2 to 3%. And Ola Electric and Ather Energy too have been seeing an increase in the auto sales on a monthly basis, especially Ola Electric over the last few months has seen a significant increase. Now, what's going forward? Now, considering the push that we are seeing from government and all the regulatory bodies, all the OEMs are going aggressive even on new launches. Tata Motors is going to launch Sierra electric vehicle, Avinya electric vehicle, even the facelift of Punch. Coming to Maruti, they are going to launch new EV on the Auto Expo in 2027. Even Maruti's M&M is going to launch the variants of BE6 and XEV9, even the expansion of Inglo platform. And talking about the Hyundai, they are looking at the launches of even Creta EV, or basically going to scale up the Creta EV. Even in two-wheeler space, we'll see the maximum launches. Talking about TVS Motor, new electric scooter platform, and they are going to launch even three-wheelers as well. Bajaj is going to looking at the launch of new Chetak variants. Even similar launches we can see from Ather Energy and Ola Electric too. So now, considering the push all around, this segment will be tracked very closely. So far, the penetration has been stagnant in the range of 9 to 10%, but seeing the push, we won't be surprised if the penetration increases.
All right, so thanks very much for that. So that's a pretty comprehensive read-through of what's happening in the EV push. It's being encouraged, of course, by the government in a big way, and companies are taking up to it as well. Nimesh is now with us with an insight into what dealing rooms are doing, what they're talking about. Markets not doing very much. Rupee still center in front. Nimesh, take it away.
Hi, Prashant. Quite a day of trade. The Nifty is trading in a very narrow range throughout the day. And on the upside, looks like, 23,900 will act as a bit of a resistance. On the downside, 23,400 is a bit of a support as well. So it's going to be in that 500, 600 point range in the very near term. For the second day running, the technology stocks are doing good. The IT index has gained another 3%. And this is backed by not only short covering, but some buying as well from larger institutions. Even yesterday, there was a sense that some domestic mutual funds bought names like Tech Mahindra. Even today, there is a buying into select technology names from larger institutions. From a flow perspective, yesterday we saw the positive number from both DIs and FIs, largely because of the block deals as well. But even today, looks like it's a positive day of trade. But do remember, there's going to be a large block trade of ICICI Bank. I'll highlight that. But that might have a bit of an impact on the FI number. But largely, it's a positive day, and there is a small MOC as well towards the end in some select names. So strong day in terms of flows, but from a Nifty perspective, extremely range-bound throughout the day.
Hey, got that. Individual stocks, Nimesh, what are you picking up?
So as I said, the one for the FI data perspective, the stock to watch is going to be ICICI Bank. There was a very large block, nearly 2 crore shares got changed hands in the morning trade. My sense is that one of the leading long-only fund was a seller in today's block deal. So if there is a disclosure, you'll get a sense on how much they've 2 crore shares is basically 2,500 crores worth of stake they've sold. So that will get reflected in the FI numbers. So that's something to track. And on the buy side, though, my sense is that the domestic funds have bought into ICICI Bank today. So that's the first name. The second stock is Granules India. Within the pharma name, this is actually standing out, and there is accumulation happening in this particular name. Post the numbers as well. In fact, I understand some domestic mutual funds are accumulating granules at current levels. So that's the second name. Last couple of stocks where there is delivery-based buying today, and both stands out, which are IT names. Tata Technologies, which is not in FNO now, it's only a cash stock, as well as Coforge. Both are going to see very high delivery-based buying in today's market. So as I said, in technology, it's not only short covering, but buying as well from larger institutions.
Beautiful. Thanks a lot for that, Nimesh. Well, we'll slip into a short break. As always, on the other side, we'll tell you what to buy today for a reverse trade. Stay tuned. Welcome back. Let's get in Mitesh Thakkar to help us out with a couple of trading ideas. Mitesh?
So as I said, it's a very dull market. Trading, maybe some top trades will still trigger some kind of movement, and that's where I think the action is. So we'll take STBT trade on Indigo. I think that's a STBT with a stop at about 42.50, 42.55 can be a good stop, and a target of 4,200 can be looked at. And Infi on the BTSC side, keep a stop below 1188 for targets of around 12.15.
Okay, all right. So those are some calls. By the way, PB FinTech, Policy Bazaar, we were discussing it right in at the top of the show. 8% 2 days. Mitesh, any thoughts here?
It's actually, one of the stronger charts in the markets. And I looked at the chart some time back, and the medium-term trend has also moved on the upside. I think the next target area should be close to about the recent highs of 1920, 1930, which were made in December 2025. So I think the stock has got potential to go over there. After 3-4 days of rally, you might want to buy partly now and add more on declines, say closer to about 1770, 1765, and keep a stop below 1745 here.
Okay, got that. Mitesh, thanks very much for that. Well, just a quick word on the, monsoon season. So Skymet's, the private weather forecaster's founder and chairman, Jatin Singh, we spoke to him earlier. This is his assessment. We, of course, heard from the IMD saying that the monsoon onset over Kerala perhaps 26th of May, plus minus 4 days. This is Skymet.
I think the hot weather will continue. There are no interruptions by any further summer thunderstorms that I can see. So yes, I think the summer, and frankly, it all has to even out. Your first fortnight of May was cool because of these rainfall and summer thunderstorm events and that. So this will even out. We're looking at, heat waves happening. Actually, IMD has come out to 26th and yes, technically it probably is a good date for an onset, but it will be a very weak onset.
Good time to welcome Jay Bala of CashTheChaos.com then. Hi Jay, how are you feeling about the markets? There is an optimist who would say that the KOSPI has started correcting. In the last, I think, 10 days, it's down close to 10%. Anyway, the FIs were sellers out there. But since they're raising money, the hope is maybe they come out here. That's a hope. What's the structure looking like on the Nifty?
Hi, Nigel. Hope is not a strategy for me. I believe on the market structure. So the market structure has been bullish, and it's come to a very important low, 23,262. And the very short term is not clear that if it's got one more low, but or the low is done. But in either of the cases, the markets are going to turn bullish. Anticipating 24,600 to get taken out in the short term, and markets once does that would confirm it's heading to record highs once 24,600 is crossed. The Nifty IT index, which has been a laggard, has put on a very important low last week, and it's promising to be a candidate for turnaround. We'll watch for it. So it's a bit early, and you don't stand in the front of a freight train so that you don't get run over. So there are early signs that this can be a turnaround possibility. So if Nifty IT is turning around, then we're getting a new leg for this bull rally. So watch out for it. We want to see a higher low of the Nifty IT index come through, and then we can turn bullish on the frontline IT names too.
Sorry, above what IT index level will you start to look for longs there in the space?
It's more a structure, Prashant. The low that registered last week has come in a long-term trend line. If you connect the 2009 low and the 2020 COVID low, the low falls exactly on it on the monthly time scale. And the retracement is a very perfect Fibonacci retracement. And we want to see a higher high form. It's not a level. We won't know which level it can go to. But once the form takes hold, we can turn very bullish. We can at least anticipate the 50% retracement of the all-time highs to the May 2026 low. If not a record high. So we'll take it conservatively. At the first point, we'll take it as a pullback rally, and then we can decide once the structure evolves. So TCS has probably got one more low to come through, but Nifty, Nifty and then within the Nifty IT, Infosys and Wipro are looking promising. Wipro is slightly better than Infosys. There's a possibility of a double bottom here. So I'm watching these stocks very closely.
Actually, it says a March 2009 low was about 2,000. March 2020 low was about 11,000. And yeah, it's on the monthly time frame. And then, of course, we are now We kind of broke below it last week, and then we're trading slightly above it, right, Jay?
That's right. And that's typically what markets do. It doesn't do an exact, break and exact stop too. So that way, it traps the weaker hands, and trend followers tend to get shaken out in this fashion. And this is typical of markets behavior. So we want a small 5 up, like we call in the electrical parlance. That's still on the hourly time frame. It's there, but I want to see it on the daily time frame. So yeah, it's looking quite promising. Other technical factors are also lining up pretty well. So I will see how this behaves from here on, but looking quite promising.
Okay, all right. What about the rupee?
Nigel, I've been pointing to the rupee coming to 96.35 to 96.75 from 2019. At that time, it looked pretty staggering and unreasonable call to make, but here we are. And I don't want to see the rupee close below 96.75. If it does that, it opens the door for 101 to 103. But the bull market is not tethered to the weakness or strength of the rupee. It'll do what it wants to do, and we have seen. It's not got anything to do with the Iran war. It's not got anything to do with the tariffs. The rupee has been clocking secular lower lows for quite some time. So we can attribute reasons to it, but the rupee will do what it wants to do. But 96.75 is a very, very important support for the rupee.
96.75.
96.75, 96.35 to 96.75 is a very important level. I don't want it to close below those levels. Intraday can overshoot it, but a close below those levels will definitely, I would say definitely, it's very likely to bring in a triple-digit figure for the US dollar rupee cross.
Okay, all right. So we'll keep an eye on that, Mark. Jay, I guess most of your money you must be holding in dollars, right? So for you, you must be quite happy.
Not for me. Most of my friends, I've advised them since 2012, 2013. My Singapore friends, my UK friends, I've told them to borrow in the Indian rupee and then pay it back in the other currency. That way, you're making a lot of money.
Okay, all right. For us, the foreign trips are getting a little bit more expensive, and at this juncture, I'd rather not look at that. Okay, let's get back to markets and levels that we're looking at. What about crude? I think the call you had made earlier was crude is going to correct. That showed signs immediately that it was going in that direction. It did 90, and then quickly it rebounded as well. Where is that headed?
That's right, Nigel. See, the 117.60 on the WTI crude is a very important level. I think it's already clocked a secondary top at 110 odds. I'm talking about NYMEX, not Brent. But even Brent, it's from the March high levels. It's signaling that it's turning around, and there have been some indications that the markets are heading lower. But I don't want to see WTI cross 117. If it does that, it'll damage the thesis that I hold that Brent is going to crash. But if it holds below 110, that's an even stronger signal. And yesterday's low, or the last week's low of about 99 odds, once that's taken out, I think the next one is about 88 and change. Below 88, it's game, set, and match for the bears.
Okay, all right.
For the crude bears, yeah.
For the crude bears, got it. All right, stay with us. Jay, we've got BL's numbers and two numbers that are flashing on the screen. They look pretty much in line. Top line, a small beat out there, and I think the bottom line as well, a very, very marginal beat on that front. The stock is holding more or less steady from the lows. In fact, it's seen a bit of a spike up because the surprise has come on the EBITDA front, which would mean that margins actually are much better than what we are working with. Close to around 150 crore beat on the absolute EBITDA number means the margins have come in close to around 29%. That compares with our poll, which was sub 28%. A bit of a spike on the stock. Take a break, come back. We'll wind down the conversation with Jay, and also we'll wind down the markets. All right, Jay, you want to give us any other, stock besides the two tech names that you've mentioned?
Two calls. One is on Tanla platforms. It's seemed to have bottomed for the medium term, and it's turning around from the recent lows of 2026. And the short-term pullback is also a near-perfect Fibonacci retracement, and hence bullish on this with a stop loss of 481, possibly crossing 695, and it can do much more in the medium term. There's another call on PCBL. PCBL, similar structure, and it's the stock is likely to cross 320 odds from current level of 274. So a stop loss of about 245. And again, this stock too has got a medium-term bullish potential.
Okay, all right. Thanks, Jay, for that one, PCBL and Tanla. Got it. Let's do a quick wind down then of the markets. Today we ended at the low point of the day, 23,000, beg your pardon, 23,600 after going to around 23,770. The 50 DMA got rejected in today's trading session. Individual stocks, they did a thing of their own. Dredging was up close to around 15%. Yet Somani Ceramics was up more than 10%. Rishabh Instruments was up also more than 10%. Chemcon was another stock that was up and about. Hind Rectifiers, the stock in a matter of 24 hours has done 800 to around 1,000 rupees. So the Tata Mutual Fund putting in money clearly excited the investors out there. Purvankara, numbers look good. Street rewarded it. As was the case with Dhanuka Agritech as well. Numbers look quite good out there. And that stock was up close to around 8.5%. So brilliant move on that particular name. In today's trade though, there were a few casualties as well that were losing out, and did pull back. Case in point being a Cupid that was down close to around 5%. Gale was down close to around 2.5%. You had HFCL that's seen a bit of a correction from the recent top. So that stock as well did lose out in today's trade. A few more losers to mention. Astral, the numbers look disappointing out there. So that came in for a bit of a knock. TD Power for the big run that I'd seen, that came in for some profit taking. Net, this was a day when in fact the Nifty did take a bit of a downtick. But that was predominantly because of the expiry-related factor. Otherwise, individual stocks and the breadth of the market was in favor of the number of stocks advancing. We'll wrap up on this edition of Closing Bell. You stay with us. The team of Markets Forward comes up next.
IT stocks, they extend gains as the Indian currency continues to weaken against the US dollar. A positive note from CLSA also lift the mid-cap names.
Well, market fails to hold on to gains. Benchmark indices end lower amid volatility. Nifty bank ranks. Mid-caps outperform.
Oil marketing companies push up petrol and diesel prices by less than a rupee in what seems to be an effort to pass on some of the crude inflation in a calibrated manner. The stocks gain.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Vivek Iyer and with me is my colleague Mangalam Malu. Good afternoon, Mangalam. Well, we've had a very choppy trading session, last couple of sessions. In fact, yesterday we managed to hold on to the flat line, today a little bit below that. But apart from IT, broad-based weakness.
Broad-based weakness, but it was an interesting day of trade, Vivek, because yesterday we didn't hold on to the lows, we actually moved higher, and today we didn't hold on to the highs, and we moved lower, which only tells you that perhaps we're in a bit of a consolidation zone between 23,300 to about 23,750, that broad 450-point band on the Nifty. But I take your point entirely on the IT pack, doing extremely well, up 6% over the last two trading sessions for that index. And the broader markets today were a lot better than yesterday. We had about 2,000 stocks declining in yesterday's trading session. Today, we flipped that with about 2,000 stocks advancing. So every two stocks in the green for each stock which was in the red. That tells you the story of the day. Let's tell you what we have lined up for you on the show today. The big news, key developments on D Street, top corporate voices, and most importantly, the events to track ahead as well. But let's kick off the day with all the movers and shakers. We do have, Sudarshan who joins in. After that, we speak about the IT stocks as well. We'll decode some of the key fourth quarter earnings and the key market events to watch out for. Sudarshan, take it away.
Amid big downtake we have seen in rupee, one segment that has been moving higher is the IT names for the second straight day. In the last 2 days, Nifty IT index is up almost 6%. Today we have seen a big move in all the names. Infosys was top Nifty gainer. Coforge from mid-cap space, LTM, Emphasis, all these stocks were up somewhere in the range of 4 to 5%. And stocks reacting to earnings. Astral has seen a big downtake. All the headline numbers were below expectations despite plumbing business. Volume growth was much better than estimates, but at the end, the stock was down 6%. And all the other names, Apollo Microsystem, Kirloskar Industries, Spark, all these stocks have reacted very positively to earnings and up in the range of 9 to 15%. OMCs after several days has seen an uptick, and that's mainly following the news of price hike for petrol and diesel. HPCL, BPCL, IOC closed the day with a gain of 2 to 3%. Some of the stocks that have been reacting to news flows and the earnings, Gland Pharma, for the second straight day, the stock has moved higher. Today also closed with a gain of 4%. Ola Electric, considering the EV push, the stock was up 5%. Case International has seen a downtick for second straight day after the earnings, and today also it has fallen almost 4%. Capital market names and exchange names have been moving higher. MCX and BSE for the continuously have been moving higher and hitting the 52-week highs. And today also both these names had hit 52-week high, and Grenus India too was at 52-week high.
Well, thank you so much, Sudarshan. A neat wrap of all of the top movers and shakers in today's trading session. But one particular sector that stood out was the IT pack. IT stocks extended gains as the Indian rupee continued to weaken against the US dollar. The index is up nearly 7% in just 3 trading sessions. What's behind this rally? Rima joins in with more details.
Well, yes, indeed. But let me broadly talk about the IT sector and the up move that we're seeing today. So reason number one is the INR tailwind. When we ended Q4, the average rupee rate between the Jan to March quarter was about 91.5. Now we're looking at a rupee level which is below 96.5 nearly. So straight away, you've got a 5% rupee depreciation, which benefits the entire sector. Maybe it doesn't reflect completely in the P&L because generally we have that math. 1% rupee depreciation benefits margins by 15-20 basis points. It may not reflect directly, but it acts as a cushion to absorb any cost pressures. So INR is acting as a tailwind. So even if the rupee, the top line growth may be flat for the company, as has been the worry, maybe the EPS growth looks a lot better with that. Secondly, as we know, IT stocks have been ranked underperformers till just 10 days back. The index was at a 3-year low, and individual stocks are down 35-40% in the last 1 year. And thirdly, the TCS price hike, the wage hike, right? It's caused a lot of anxiety amongst employees. Maybe employees are disgruntled because at an average level, Money Control reports, TCS has doled out a hike of nearly 5%. The top performers have got, just about 10%. Some of the lower end, the underperformers maybe have got no hike. People are complaining that actually because of the new labor code, my CTC appears to be on the lower side. There's a Mint report that talks about TCS asking managers to classify 5% of their employees as underperformers. But what it means perhaps from a stock market point of view is that IT companies are showing pragmatic cost discipline. They know the environment is tough, and which is why if you see the last 3 years, many companies have chosen to even defer their wage hike cycles by a couple of months. So TCS had deferred it between April 2024 to September 2025. It was a 17-month deferral. For Wipro, it was a deferral from September 2024 to March 2026, so nearly 18 months over there. Infosys has still not announced a wage hike for FY27. So yes, from an employee point of view, confidence point of view, it's not great, but from a company point of view, this does show some sort of a cost discipline. Back to you.
All right, Rima, take that point. But, that's about the large caps, the big caps. What about the other IT mid-cap names, Coforge in particular? There were brokerage notes coming in. This one, a positive one from CLSA.
Thanks so much for that. Well, as you said, the entire IT pack is doing. Coforge is leading. CLSA high conviction outperform. Target is 2075. They see the company as the top beneficiary of the AI cycle. Strong execution reflecting in a better than expected FY27 margin guidance. And exiting the government project has helped the company improve the FCF, that's free cash flow to PAT conversion guidance that the company had given out post their quarterly numbers. So the company has been delivering well. The company was very confident about their FY27 guidance. They'd upped the free cash flow to PAT conversion guidance, and CLSA once again is reaffirming their faith in the company.
I think next 3 years, the PAT number, whatever we have today, it should be broadly 75% higher than that. Now for 75% higher PAT, even if you don't get any benefit of rupee, then also, any benefit of re-rating, I think, the stocks can move up 75% in next 3 years. That is the way I look at it, which is a very good return from a mature sector and a good cash generating sector, good corporate governance and all those perspectives. So I think good money will be made in next 2 to 3 years.
Well, that's the word coming in as far as the IT pack is concerned. Coforge amongst the mid-cap names doing very well. But to take the discussion forward, we are now joined by Nagaraj Shetty, who's a senior technical analyst at HDFC Securities, and Sudeep Bandyopadhyay from IndiTrade Capital. Thank you so much, gentlemen, for joining us. First up, let me come across to you, Nagaraj. Let's look at the IT pack. Number one, where do you see the most alpha being generated within the IT space, and your top picks as far as the IT pack is concerned?
Yes, IT sector has been continuously underperforming recently, showed some promising bounce back from the lower levels. The overall chart pattern is improving, and looks like the bottom formation is happening in the IT pack. I think more upside is likely for the IT prominent IT sectors, IT participant, and as well as the mid-cap IT sectors in the near term. I have 2 stocks from the long side from overall broader markets. First one is Sumitomo Chemicals. Chartically, this stock price has been in a consolidation phase after a downward correction, bounced back very well. The overall chart pattern is looking positive. Higher tops and higher bottoms is intact, and currently close around 469.40, 470. One can look to buy at this point of time. Immediate target would be around 495, and one can place a stop loss at 450. Second one is from IT front, Tata Technologies. Tata Technologies has been showing a range-bound action over the last couple of weeks. Today witnessed a decisive breakout of the range somewhere around 635, 640, moved above the crucial 200-day EMA and closed higher. The overall chart pattern is looking very positive for this Tata Technology, and I'm expecting more upside in the next, at least 1 or 2 weeks. Currently trading around 669.50, 670. One can look to buy at this point of time. 705 is going to be the target for at least 1 to 2 weeks, and one can place a stop loss at 650.
All right, take that point. Thanks a lot for that. Nagaraj, let's welcome Sudeep on the show as well. Sudeep, I won't ask you IT, I'll ask you banks. While IT is outperforming, banks which were, darlings of everyone, serious underperformers of the last few trading sessions. Do you think that there is a worry in the near term, or maybe these are times to accumulate?
Well, Mangalam, I think there is definitely some worry in the near term, and that may give an opportunity for a long-term investor to pick up good quality banking stocks for the portfolio purposes. Look what's happening around us. The West Asia conflict is leading to a lot of challenges for domestic economy, which may lead to demand destruction as far as credit is concerned. And asset quality also at some stage may start reflecting, challenges because if the demand scenario in the overall economy continues to shrink, I think there will be challenges on asset quality as well. So I think for the short to medium term, I'll be a little cautious. I'll be extremely careful in picking up banks. But if I have to look up from the long-term perspective, I think some of the good banks which have corrected is definitely a good buy. I do like SBI at current levels. I do like, some of the smaller private sector banks, including IDFC Bank at current levels.
All right, SBI and IDFC are some of the banks that you like at current levels, even though there is short-term volatility. But there were a lot of broader market stocks, the likes of Astral, Deepak Nitrite, many others who were active in today's trading session on both up and downside on account of their fourth quarter earnings. The earnings season is a long one, this one. Upasana joins us with a wrap of all those stocks which were on our radar.
Well, first up, let us look at Dhanuka Agritech. Overall, it was a strong Q4 for the company. It was better than estimates on all fronts. Q4 revenue saw an uptick of 9% and margins also expanded by nearly about 109 basis points at 25.8%. But if we look at the full year performance of the company, it remained muted, but it was much in line with the guidance provided by the company after its Q3. Revenue saw flat growth on full year basis, and on full year basis, margin saw a downtick of 50 basis points versus the guidance of nearly about 100 basis points decline given by the company. And the key highlight was the board has approved nearly 1.1% of the equity share capital buyback at 1400 per share, which was certainly at a premium at an aggregate value of 70 crores. Next up is Deepak Nitrite. Revenue was down nearly about 3% on YoY basis. Operating margin stood at 17.7 versus 14.5%. PAT saw an uptick of 8.6% on year-on-year basis, and management has guided for a better Q1 and Q2 FY27. Next up is Astral. Overall, the Q4 numbers were below the pole on all the fronts. That's why we certainly saw the stock taking a beating down. Net profit up 20%. Revenue growth came in at 24% versus what the street was anticipating, nearly 30% of the revenue growth. Margin stood at 18.3 versus the poll of 19.2. So certainly it's a miss on that front as well. And the plumbing business FY26 volumes here saw growth of nearly about 16% on year-on-year basis. And lastly, coming to Afcon's infra, overall it's been a weak quarter for the company. Revenue has seen a downtick. Margin stood at 1.6% versus 9.1%. The company has lodged a net loss this time around at 89 crores versus the net profit seen last time, same time around. And overall, if you look at the order inflow, the company has missed its order inflow guidance as well as the revenue growth guidance given by the company. So it's a big miss on that front as well. So all in all, these were the stocks that remain on our radar today. Stock moves here.
Well, thank you so much, Upasana, for joining in and giving us a comprehensive overview of all of the top movers and shakers as far as the trading session today was concerned. Well, Sudeep, let me come across to you first. You heard Upasana, quite a few stocks on our radar. Want to ask you specifically about some of the agrochem names, some of the fertilizer companies, a name like Dhanuka Agritech, actually coming out with a good set of numbers, also confidence to go ahead and do a buyback. Within the agrochem space, do you have any picks, or would you at this point of time stay away on account of all of the worries we are facing, especially as far as escalating gas prices are concerned?
At this stage, look, if you are looking at a very, very short term, I think there is too much of volatility. And you're absolutely right. A lot of West Asia war is creating a lot of challenges as far as supply chain is concerned. And raw material prices also at different levels are going up and becoming difficult to procure. So short term, I don't think I will like to buy. But if I'm looking at a medium to long term, some of these agrochemical companies do look very promising and very good. I think what's happening is globally, I think the overstocking is over. The China-related challenges are also to a great extent subdued at this stage. But the China plus one logic for procurement by global buyers do remain. So under the circumstances, if I have to buy one agrochemical company, I will go to the leader one, which is UPL. That's probably the fourth or fifth largest agrochemical player in the world. And there are some restructuring they're doing, but UPL at current level definitely is a good buy from a long-term perspective.
Well, thank you so much, Sudeep. Our view on UPL is what you have in a positive manner. But moving on, market veteran Ramdev Agarwal believes it's time for policymakers to put the focus on bringing FIIs back to India. Meanwhile, the MD and CEO of BSE said he expects India to be a growing destination for FPIs once the global scenario normalizes. Let's listen in.
We have been seeing very sustained outflow out of India. One, of course, because of the very strong local buying, which is going to become even bigger as we go forward. So the government, the policymakers, they have to think in the backdrop of very strong local buying, how do we console? And my local buying is decadal in the sense that next 20 years, 25 years will become even bigger. In that backdrop, what do I do for the FIIs or FPIs so that they have a little more positive view of India? They might be having some small demand about capital gains tax. Worldwide it is not being charged. Why we are being taxed out here? Why we are being charged capital gains tax? So whatever their demands are, I think the authorities should look at it very intensely, because it's a very changed environment.
Somewhere it used to hover around 2 digits. 10 to 12% used to be the domestic one, and 15% used to be the FPI holding, 15 to 20. Today it is reversed. If you look at last year, given the global situation, there has been an outflow, net outflow of around $36 billion by FPIs. But to compensate it, the net investment by the domestic institutions has been 91 billion. This has not only taken care of the outflow, but also strengthened the Sensex to a great extent, and has prevented it from a free fall, notwithstanding the severe geopolitical tensions. So it's a very healthy mix at this point of time.
All right, we've got the fundamental views for the market for the long-term and the near-term individual stocks as well. So let's wrap this conversation with Nagaraj. Nagaraj, you've spoken about the IT space. We've discussed stocks and sectors with both of you all. But leave us with the view on Nifty and Nifty Bank.
Yes, Nifty has been moving in a range-bound action. We all know that last 3-4 session, a narrow range has been fixed on the upper side, 23,800. At the lower side, 23,200, 300 has been a range for the market. And similar kind of a symmetrical pattern has been forming. Few days back, we also seen Nifty witnessing selling pressure from the to a 23,800 hurdle. Again, today also we have seen similar kind of selling pressure emerge from the higher level. I think more consolidation is likely. I'm not expecting this to 23,800, 900 is going to be broken decisively on the upper side very soon. And it will be a range-bound action, choppy trend, at least for the next 1 to 2 sessions. The Bank Nifty as well moving in a range at the lower levels around 53,000 is offering support. At the higher levels, 54,500 is offering support. Within a range, I'm expecting Bank Nifty to oscillate in the next few sessions.
Thank you so much, Nagaraj, as well as Sudeep, for joining us, giving us your view on the markets as well as individual stocks. With that, it's time for a short break. We'll get you the top corporate voices along with the key market events to watch out for on the other side.
Welcome back. It was a volatile session, but today we do have a lot of corporate voices that spoke to us on the channel. Let's start with IGL. The management told us that nearly 50% of its gas sourcing currently comes from spot LNG, while about 2/3 of its long-term contracts remain linked to the Henry Hub prices. They said that pricing pressure persists due to a sharp increase in domestic new well gas prices, and that the company will take a call shortly on pricing as and when required.
The management of Uno Minda says it remains confident of sustaining growth momentum into FY27 after delivering a strong performance in FY26. The company expects to continue outperforming the broader automobile industry in FY27 with a margin guidance of 11%.
We also had the management of Hind Copper, where the chairman and MD expects a sharp ramp-up in production and profitability in this fiscal FY27. That is, with copper-owned production projected at 4.7 million tons in FY27 compared to about 3.7 million tons in FY26. EBITDA margins likely to remain above 40%.
And before we wrap, we bring you the key market events to watch out for. Upasana Bhatt is standing by the wall with all the key events to focus on tomorrow's trading session.
Well, first up, let us look at some of the key important results for tomorrow. Apollo Hospitals, Grasim, Bosch, Honeywell Automation India, Samvardhana Motherson International. Along with its result, the fundraise plan and also scheduled for this one. Jubilant Foodworks and even Whirlpool India, all these counters will be reporting their Q4 FY26 numbers tomorrow. Now, ICI, that is the index of 8 core industries, that is for April 2026 will be released tomorrow at 6 p.m. And also the most important, that is PM Narendra Modi scheduled to hold high-level delegation bilateral talks with Italian Prime Minister in Rome tomorrow. Now, on the flip side, let us look at some of the global economic cues in terms of Europe. Q1 GDP data will be out tomorrow, UK CPI data, and when it comes to US, the PPI data will be out tomorrow. And also, the most important, that is the FOMC meeting minutes will also be released tomorrow. And in terms of global results, mind you, tomorrow, past midnight, NVIDIA's results will also be out, so we'll be keeping an eye out on that as well. So all in all, looks like quite a power-packed day tomorrow.
Power-packed day indeed, Upasana. Thank you so much for bringing that list for us. With that, we're out of time on this edition of Markets Forward. But you don't go anywhere. Stay tuned to CNBC TV 18. More news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The rupee hits a record low of 96.60 against the dollar, plummets by 7% since the start of the year. Market fails to hold on to gains. The Sensex and the Nifty end lower amidst a volatile session. The Trump administration renews sanctions relief on Russian seaborne oil for 30 days. Says this will provide additional flexibility to energy-vulnerable countries. Indian OMCs hike fuel prices by about 80 paise per litre, marking the second increase within a week. President Trump postpones his planned attack on Iran less than 24 hours after claiming that the clock was ticking. Says he was approached by the leaders of Qatar, the UAE and Saudi Arabia. Tehran says Pakistan has shared Iran's latest proposal with Washington. New York Times reports that U.S. officials fear Iran's defense against future American attacks will be stronger, as it may have figured out flight patterns of fighter jets. China gets ready to host Russian President Putin barely a week after the high-stakes Xi-Trump meet. Kremlin signals that it expects tangible outcomes, including a serious oil and gas deal. This would be the second in-person meeting between Xi and Putin in less than a year. Prime Minister Modi is in Norway for the second last leg of his five-nation trip. The two nations agree to cooperate in space tech, ocean energy and renewable energy, among others. The Prime Minister will fly to Italy later tonight after attending the third India-Nordic Summit. Standard Chartered is likely to exit bank assurance tie-up with ICICI Prudential Life Insurance. Sources say the bank may partner with Bharti Life. That's an exclusive. The Supreme Court refuses to recall its November 2025 order on removing stray dogs from public spaces, directs all states to take urgent measures for expansion of shelter, sterilization facilities. The Apex Court also slammed what it called discernible absence of efforts by states, empowers authorities to take measures to euthanize rabid and incurably ill stray dogs. A federal jury dismisses Elon Musk's $150 billion lawsuit against Sam Altman and OpenAI, rules that Musk waited too long to sue. Musk, one of the early investors of OpenAI, had accused the company of drifting from its original non-profit mission after its partnership with Microsoft. The verdict removes a major legal hurdle for OpenAI as it eyes a potential public listing. All of that is coming up for you, but let's start with the day's market action. The markets failed to hold on to their gains. The Sensex and the Nifty closed lower today amidst a volatile session. In fact, the Nifty Bank slipped about 355 points, finally closing 120 points lower, 918 points higher. That was the Nifty IT index. So the rupee's depreciation is actually working to the advantage of the IT stocks. The Sensex and the Nifty closing just about in negative territory, coming off their intraday highs. Prashant is here to wrap up the market action for us. Volatile, coming off their intraday highs. Prashant, sum up the market action for us.
Well, it has been a two-way kind of street for equities, up, down, up. For the dollar rupee, it's basically been one way. And that is the story yesterday. That is the story today as well. Yesterday, the Nifty recovered 300 points from the day's low. Today, of course, we lost about 100 points from the highs of the day. We were up till the last hour, we were up about 60, 70 odd points, and finally we ended 40, 50 points lower as far as the index is concerned. You know, the sole winner was, of course, the IT services index, which was up 3%. Last week, the IT index lost 6% in value, and so far it's kind of made up for all of those losses. But you know, it's been bounces, but sell-offs as well. That's been the story for many months now for the IT index. Now, look at where else there was action. Capital markets index was up about 1.5%. Real estate index was up about 1.33%. The small cap index, after being down 1%, was up 1% as well. You know, even for the real estate space, the index lost 8% last week. So, you know, some small bounce is par for the course in that sense. Let's look at the Nifty now. So Kotak Bank was the big loser, 2.5% lower. Titan, Ultratech were some of the others, which were down about 1.75%. I said IT has been the stronger part of the market. So Infi, TCAS, Tech Mahindra, TCA, and HCL Tech, all up between 2% to 5%. Infi, of course, being up 5% today. The other two names were Tata Motors Passenger Vehicle, which was up 2.25%, and Eternal, which is back at close to about 250 odd levels.
All right, Prashant, thanks very much. That was the equity market action, but let's talk about the currency market. The rupee slipping to another record low of 96.60 against the dollar. The currency is now weakened by over 7% so far this year. Ritu joins us now with more. Ritu, the rupee continues to fall, but what were the specific factors today?
Well, the rupee continues on a record-breaking slide. We started 2026 with the rupee at around 89.97 to the dollar, and since then we've seen a 7% depreciation. And since the start of the West Asia conflict, the rupee has fallen by nearly 6%, making it one of Asia's worst-performing major currencies this year. What's also worrying the market is the speed of that fall. Now, the move from 90 against the dollar to 95 took less than 5 months, and from 95 to 96, barely 15 days, whereas historically we've seen a 5 rupee move against the dollar take as much as 5 years. So the depreciation is clearly accelerating, and that tends to trigger panic hedging and speculative pressure. 3 forces are driving this, call it the unholy trinity of elevated crude prices, the foreign outflows, and a strengthening dollar. The biggest factor, of course, remains oil prices. With the West Asia conflict dragging on, Brent has remained above $100 a barrel for nearly 2 months now, and that is inflating our import bills significantly, directly pressuring the rupee. At the same time, the dollar itself has strengthened. You have higher US bond yields, rising safe haven demand. All of that has boosted the greenback. Foreign institutional investors have also been selling Indian assets. We've already seen more than 20,000 crores of outflows just in May so far, and more than 2 lakh crores for the year. And these outflows are hurting the rupee further. Add to that the widening trade deficit, renewed concerns around the current account deficit, and the pressure on the currency has intensified. Now, RBI and the government have moved on multiple fronts to stem this slide. The government, for instance, has hiked duty on precious metals. It has undertaken 2 fuel price hikes now. RBI has been intervening both in the forward and the spot markets. It has capped the net open position at $100 million a day for banks to curb any speculation. And as we've been reporting here, more measures could be considered if the slide continues.
Many thanks, Ritu, for joining us. Now, the U.S. has extended a sanctions waiver allowing countries to purchase Russian oil for another 30 days. The U.S. Treasury Secretary said the license will help stabilize the physical crude market and ensure oil reaches the most energy-vulnerable countries. Remember, the U.S.'s previous waiver lapsed on Saturday. This is the third time that we've seen the U.S. give this temporary waiver to buy Russian crude at sea. Bassett had earlier said that the U.S. was not planning an extension of the sanctions waiver, but it has now come in for another 30 days. Now, petrol and diesel prices have been hiked by around 90 paise per litre, marking a second fuel price hike in the last 1 week. Now, last week, the government had hiked fuel prices across the country by 3 rupees a litre, making it the first price hike in 4 years. So those are the prices now in Delhi at 98.64, 97.77 for diesel. Mumbai, almost 108 rupees for petrol. Kolkata, 110 rupees almost. And Chennai, 105 rupees almost for a litre of petrol. The top global story that we continue to track: President Donald Trump has threatened to restart military action against Iran, but backed down soon after as the stalemate between the two nations continued. Now, Trump said in a post on Truth Social that he had planned a major attack against Iran, but then he delayed it because the heads of states of Gulf nations asked him to hold off, in his words, for 2 to 3 days. He claimed that Qatar, Saudi Arabia and UAE requested more time to work out a nuclear deal. The New York Times, meanwhile, reports that U.S. officials feel Iran's defense against future attacks will now be stronger, as Iran may have figured out flight patterns of American fighter jets with Russia's help. So for now, Trump deciding to hold off on any military action.
We've had very big discussions with Iran, and we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that, where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also. We've informed Israel. We've informed other people in the Middle East that have been involved with us, and it's a very positive development, but we'll see whether or not it amounts to anything. We've had periods of time where we thought pretty much getting close to making a deal, and it didn't work out, but this is a little bit different. Now, we're ready going tomorrow, very big, and not something I wanted to do, but
Well, that's President Trump saying he's holding off on a military attack in the hope that there will be a deal with Iran at the behest, he claims, of Qatar, Saudi Arabia and the UAE. Now, Russian President Vladimir Putin is all set to arrive in Beijing on Tuesday for a two-day summit with President Xi Jinping. This is the second time the Chinese and Russian leaders have met this past year. The Kremlin has signaled it expects tangible outcomes, including a serious oil and gas deal. Prime Minister Modi is in Norway for the penultimate stage of his five-nation tour. The Prime Minister held wide-ranging bilateral talks with his Norwegian counterpart, Jonas Storr. Both leaders discussed boosting overall trajectory of bilateral relations. Later, he held an interaction with Norwegian business leaders after inaugurating the India-Norway Business and Research Summit. Speaking at the event, the Prime Minister urged business communities of both countries to forge new partnerships and strengthen economic cooperation.
आप में से कई CEOs भारत के वाइब्रेंट गुजरात और अन्य इन्वेस्टर समिट में भी बड़े उत्साह के साथ हमेशा भाग लेते रहे हैं। अब हमें इस पार्टनरशिप को, इसकी इंटेंसिटी बढ़ाकर इसे न्यू फ्रंटियर की ओर ले जाना चाहिए और हमें अब एक एक कदम से चलने से कोई बात बनने वाली नहीं है। हमें जरा गति भी बढ़ानी होगी और लक्ष्य भी बहुत ऊंचे तय करने होंगे।
Prime Minister Narendra Modi is going to take part in the India-Nordic summit today. He's also slated to meet several counterparts from Nordic countries. He's slated to leave for Italy later in the day, which is going to be the fifth country as part of his five-nation tour which he's undertaking. And as part of the Prime Minister's tours, India has already upgraded its bilateral ties with the Netherlands and Sweden to a strategic partnership. The Prime Minister's visit started with the UAE, where an agreement was signed for a framework of strategic defense for bilateral security, on maritime defense. Also, agreements were signed for strategic petroleum reserves and for LPG supply to India. Apart from this, there were investment commitments of around $5 billion which were made in Indian infrastructure. Subsequently, the Prime Minister went to the Netherlands, where he and his Dutch counterpart oversaw a ceremony where a pact was signed between ASML and Tata Electronics to support semiconductor fab in India. Also, bilateral dialogues focused on green hydrogen, clean technologies and advanced manufacturing. Now, subsequently, he went to Sweden, where a joint innovation partnership was undertaken for AI, 6G, critical minerals, space and life sciences. He also held a roundtable with several top CEOs from European businesses. He urged them to invest in India for a better value for money. He subsequently headed towards Italy. It remains to be seen how early these investments and these pacts are going to fructify into on-ground work and on-ground generation of jobs in India.
All right, Abhimanyu, many thanks for joining us. On to CNBC TV 18 exclusive. Standard Chartered is likely to exit its bancassurance partnership with ICICI Prudential Life Insurance. Sources say the bank may establish a new distribution arrangement with Bharti Life Insurance. Yash joins us now with the details. Yash, plenty going on in the insurance space. What are your sources telling you?
Well, certainly a lot of movement. Yesterday's decision of Prudential exiting ICICI Prudential Life Insurance did put some supply overhang on the stock. And today, the latest development that we've been given to understand from our sources put some, business overhang as well. What we've been given to understand is that Standard Chartered is likely to exit the bancassurance tie-up, which it has with ICICI Prudential Life Insurance. This is, of course, post-Prudential's decision to exit ICICI Prudential Life and, of course, establish that new JV or acquiring that 75% stake in Bharti Life Insurance. This is important because Standard Life gets about 5% of the annualized premium equivalent and 6% of the retail annualized premium equivalent as part of business to ICICI Prudential Life Insurance, and that exit of Standard Life could have an impact on that portion of the business. We've written to all parties involved in this particular story, ICICI Bank, ICICI Prudential Life, Standard Chartered Bank. A response from all of them is awaited. In fact, Standard Life got back to CNBC TV 18's query saying that they declined to comment on this particular development. Separately, we've been given to understand that IRDAI is likely to consider, giving about 12 to 18 months to Prudential to sell that entire 12% stake which it intends to do in ICICI Prudential Life 2% out of that entire 12% is likely to be bought by ICICI Bank, and that 10% balance is likely to be sold through various block deals in that time period, which IRDA is likely to give, that is about 12 to 18 months to Prudential PLC.
All right, Yash, many thanks for joining us. Air India has confirmed that fuel switch module of Boeing 787 Dreamliner will undergo further testing at the company's Seattle facility. This confirmation comes after a Reuters report indicated that India's air safety officials are set to travel to Seattle to observe Boeing's testing of the switch panel. The airline added that the module had earlier been cleared as fully functional by Boeing and the DGCA. Remember, concerns were raised about the fuel switch panel after Air India 171 flight crashed in Ahmedabad last year, so that is expected to take place in June. The Supreme Court has refused to recall its November 2025 order to remove stray dogs from public spaces. The top court has directed all states to take urgent measures, including expansion of shelters and ramping up sterilization efforts. Ashmit joins us now with all the details. Ashmit, so no modification to its November 2025 order, but, you know, what has really changed on the ground? Did the Supreme Court even ask states whether any changes have been made since its order last year?
Well, in fact, that's one of the aspects that the Supreme Court dwelled on, that as far as the situation on the ground is concerned, despite Apex Court directions, there has been no change on the ground. And that's, in fact, what the Apex Court began with, that there's been a spectacular failure on part of states, on part of municipal bodies, that there is a statutory mandate for ensuring that there are animal birth control centers, or ABC centers, as they are called commonly, that they're just not enough to keep pace with the stray dog population, going on to say that this is an infrastructural issue, that there's been a lackadaisical approach by state and municipal authorities, and that there is a need for augmenting this infrastructure. But while on one hand, the Supreme Court makes a note that there is an infrastructural deficit, that it cannot support the large populations of stray dogs for sterilizing them, for vaccinating them, for sheltering them, despite that, the Supreme Court has remained firm on its November directions that stray dogs need to be cleared from public areas. By public areas, the Supreme Court means hospitals, educational institutions, colleges, schools, railway stations, airports. In fact, speaking of airports, the Supreme Court had cited specific incidents about the Delhi airport itself, saying that stray dogs need to be removed. For these cases, the Supreme Court has said that once they're removed, they cannot be vaccinated and released back to the same location. Additionally, there are three key directions that, in fact, we're watching out for. Number one direction is that there is a direction given to state and municipal bodies to ensure that there is at least one animal birth control center for every district. Number two, and interestingly, the Supreme Court has allowed for euthanizing aggressive and rabid dogs. This is the first time such a direction is coming in from the Supreme Court, euthanizing dogs which are aggressive or rabid. And number three, there has been a legal immunity granted to municipal officers. The Supreme Court has essentially said that while they're discharging their functions, while they're performing their functions, there can be no legal action taken against them, much less an FIR. So no legal action, immunity being granted, and essentially the Supreme Court saying all public spaces need to be free of stray dogs.
All right, Ashmit, many thanks for joining us. So no reprieve there and no answers. Where are these dogs supposed to go? We don't know. Time for us to head into a short break, but up next, the US federal jury dismisses Elon Musk's $150 billion lawsuit against Sam Altman and OpenAI. That and more when we return. Elon Musk's $134 billion lawsuit against Sam Altman and OpenAI has been dismissed by a federal jury. The jury ruled that Musk waited too long to sue. Rachna joins us now with more details. Rachna, what could this verdict mean for OpenAI and Musk's SpaceX?
Well, it was billed as the trial of the century, and on Monday it ended in under 2 hours. A 9-member federal jury in Oakland threw out Musk's lawsuit against Sam Altman and OpenAI unanimously. The finding was that Musk waited too long to sue. The judge agreed on the spot and dismissed every single claim made by Musk. The case goes back to 2015 when Musk and Altman co-founded OpenAI as a non-profit. Musk donated $38 million. He left the board in 2018. OpenAI then built a for-profit subsidiary, took $13 billion from Microsoft, launched ChatGPT, and is now valued at over $850 billion. Musk called it all a theft. He sued in 2024, seeking $134 billion in damages and demanding Altman be removed. 3 weeks of testimony followed. Musk told the jury repeatedly, "You cannot steal from a charity." But he also admitted he had grown uncomfortable with Altman's behavior as far back as 2017. And that admission handed the other side its winning argument on the statute of limitations. Brockman's own diary was used against him, a 2017 entry asking, "Financially, what will take me to $1 billion?" Microsoft CEO Satya Nadella also testified, and he said Musk never once called him to raise any concerns. And Altman, under cross-examination, was asked if he had ever been called a liar. His answer, "I've heard people say that." Well, the jury heard it all and still took less than 2 hours. Musk called this a calendar technicality and said he would appeal. But the verdict has already done something significant. It has cleared the biggest legal cloud over what could be the most consequential IPO season in tech history. SpaceX, which now includes Musk's own AI venture xAI, targets a public listing on June 12. Anthropic eyes October, and OpenAI is targeting the fourth quarter, though its own CFO has privately flagged it may not be ready until 2027. Now, bankers have told both OpenAI and Anthropic directly that whoever lists first will capture the market. So Musk lost in court, but the bigger battle for investors and for market narrative for who defines the AI decade is just getting started. And with SpaceX listing first, Musk may have found a way to defeat OpenAI that no courtroom could deliver.
All right, Rachna. Yes, indeed, it will now be a battle in the public market, and there SpaceX has the lead. Airlines are set for some big savings as VAT cuts in 2 major aviation hubs have made jet fuel cheaper. Delhi and Maharashtra are looking at cumulative loss of approximately 1,000 crores over the next 6 months. Shivani joins us now to decode how the VAT cut will help airlines. Shivani.
Well, this is potentially a big boost for airlines because aviation turbine fuel, or ATF, is their single largest cost component, making up nearly 30 to 40% of operating expenses. And now, with Delhi and Maharashtra cutting VAT on jet fuel, airlines operating out of these 2 India's biggest aviation hubs could see meaningful savings. Let's break down the maths for you. In Delhi, ATF prices have fallen from roughly 1,05,000 crore rupees per kiloliter to a new 89,900 per kiloliter, which means a saving of around 15,100 per kiloliter. In Mumbai, the reduction is smaller but still significant. Prices have dropped from nearly 98,250 per kiloliter to 89,050 per kiloliter, which means a total saving of around 9,200 rupees per kiloliter. Why does this matter though? Because airlines buy fuel in massive quantities every day. Even a few thousand rupees saved per kiloliter quickly compounds into crores across hundreds of daily flights. And remember, these are approximate prices, with the revised VAT structure expected to remain valid for only 6 months from here on, giving airlines a sustained window of lower fuel costs. Now, let's translate that into an actual flight. We're taking the Delhi-Mumbai route only as an illustration, with the standardized assumption that an aircraft burns roughly 4 kiloliters one way and another 4 kiloliters on the return leg. If an airline fuels up in Delhi, saving of roughly 15,100 per kiloliter translates to nearly 60,000 rupees saved on one flight. On the return leg, refueling in Mumbai, where savings are about 9,200 per kiloliter, adds another 37,000 rupees saved. Put this together and an airline could save nearly 1 lakh rupees on a Delhi-Mumbai round trip under these assumptions. Of course, a caveat here, aircraft fuel capacity is much larger and airlines may choose to tank up more fuel at one airport, which could alter actual savings. Now, the interesting part, the Delhi-Mumbai route sees nearly 130 to 140 flights every day. That means industry-wide savings on this corridor alone could be around 1.3 to 1.4 crore on a daily basis. On a monthly basis, that rises to nearly 40 to 50 crore rupees. And over 6 months validity period, community savings on just this one route could touch 240 to 270 crore rupees for airlines. But cheaper fuel for airlines comes at a cost. Delhi, as a government, could take a revenue hit of nearly 985 crore rupees over the next 6 months, while Maharashtra may lose roughly 500 to 600 odd crores due to the lower VAT collections. So while airlines gain from lower operating costs, Delhi and Maharashtra are betting that stronger aviation activity and airport competitiveness will offset some of the tax sacrifice. For passengers, though, whether any of this saving translates into lower airfares, that still remains up in the air. Back to you.
Well, relief more than a bonanza. Shivani, many thanks for joining us. The union government is making a push for electric vehicles amidst tensions in West Asia. Sudarshan joins us now with how several state governments are adopting electric vehicles and what that means now as far as EV penetration is concerned. Sud.
So over the last few weeks or say months, we have seen the one topic that's been gaining the traction is the use of alternate fuel. Even just few weeks ago, even Prime Minister Modi has issued advisory requesting people to have the increased usage of electric vehicle. And recently we had seen the draft of CAF emission norm from central government and Delhi government too issuing the draft of new electric vehicle policy. And just two days ago, Haryana government has issued advisory to all the e-commerce companies, aggregators to induct electric vehicles or CNG vehicles in their fleet. Now, Finance Ministry too has issued advisory to banks, financial institutions and insurance, we understand from sources, to have the increased usage of electric vehicle and reduce the usage of petrol and diesel cars. So this was about the advisory, how the trends of electric vehicles to the total volumes of the companies. So just we have taken the data of last few months. In the month of February, the penetration was in the range of 8 to 9%, and that had seen a sharp increase to more than 10% in the month of March. But in the last 2 months, April and May till yesterday, the penetration is in the range of 9.6 to 9.8%. Now, if you take a look and go into the translation of this penetration to the contribution to the volumes of four-wheeler companies, Tata Motors has been the leader over the last few years, and their contribution for electric vehicles is in the range of 14 to 19%. For M&M, it's at the number 2 spot, range is 6 to 9%, Maruti 1 to 2% because they had launched e-Vitara, and Hyundai Motor, the range is 1 to 2%. But if you come to the two-wheelers, penetration and the contribution has seen a sharp increase because of scooterization trend. Currently, 1 out of 5 scooters are electric vehicles. For TVS Motor, which is the market leader with market share of almost 26%, contribution is in the range of 8 to 10%. Bajaj Auto with market share of 24% has the range contribution of 6 to 8%. Hero Moto 2 to 3%. Ola Electric and Earth Energy have seen an increase in the sales, monthly sales over the last few months too. But what about the going forward? Now, with the push that we are seeing from government and the regulators, all the OEMs are going for aggressive EV launches. Tata Motors is looking at the launch of Sierra EV, Avinya EV, Punch EV facelift. Even we are going to see several launches for Mahindra and Mahindra. Maruti is going to launch even new version of e-Vitara, or say new version of in the Auto Expo of 2027 new EV that you will see. Even Hyundai is going to launch the facelift of Creta, and several launches that we are going to see even from two-wheelers. TVS Motor is going to launch a new platform. Bajaj Auto is going to launch a new version of Chetak, and similar kind of launches that we'll see from Ather and Ola Electric. So with the push that we are getting to see all around, even though till now the penetration has been stagnant in the range of 9 to 10%, this push will help to see the major launches, and this segment will be tracked very closely going forward.
All right, so many thanks for joining us. Well, the EV penetration finally starting to pick up, at least as far as the two-wheeler side is concerned. Much faster adoption rates there, as Sud was pointing out. With that, it is time for us to wrap up this edition of Business 360. The news will continue here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. India could soon take a major step towards higher ethanol blended fuels. The government has proposed fresh norms allowing ethanol blending levels between 85 to 100%, paving way for a flex fuel ecosystem similar to Brazil's E100 model and America's E85 compatible network. The draft proposal has now been open for public feedback and is aimed at enabling testing, certification and phased adoption. Not an immediate nationwide rollout, though. The move could give a significant boost to India's agriculture sector while also looking at reducing dependence on conventional fuels at a time when West Asia tensions continue to weigh on global energy supplies. Under the current framework, the petrol sold across India carries up to 20% ethanol blending, with India already accelerating nationwide E20 adoption ahead of its original 2030 targets. Globally, more than 65 countries now have operational or binding biofuel blending mandates, covering over 80% of global transport fuel demand. So to understand where India's ambition in biofuel blending mandates and the impetus it will give agriculture sector, we speak to Ravi Gupta, his chairman at Sugar Bioenergy Group at the India Federation of Green Energy. Mr. Gupta, hi, thank you so much for joining in. A lot is happening when it comes to biofuel and ethanol blending in India, but various other countries have various mandates as well. But talking specifically about India, we are dependent on fossil fuels, 85 to 90% of our requirement. 60% of our cooking gas also is imported. Would you say this is the time that we look more inwards than out?
Thank you, Manisha ji, for having me on your channel. Pleasure. Of course, the time is now and the time is running out. This is what we have been saying since quite some time. And I think, India needs to be congratulated, Government of India needs to be congratulated for the efforts they have done on Indian ethanol blending program. Today, in last few years, our ethanol program has been the fastest growing program in the world. We have reached the 20% ethanol blending in no time, in a very, very short period of time. Imagine if we were not 20% today. What I was reading in the papers today, that the oil OMCs are losing around 750 crore rupees per day. I don't know how much is the petrol in that, but imagine that loss would have been occurring if ethanol was not there. So 20% ethanol is a great achievement. But a lot to be done, because India is in the right position to increase its ethanol blend. India is in the right position to shift to flexi-fuel vehicles. And when I say flexi-fuel vehicle, for your viewers, flexi-fuel vehicles can alternative run on ethanol or petrol. And that is what the model which Brazil has adopted. So flexible vehicle is definitely, the time has come that we start planning for our energy independence on the long term, medium to long term basis. And so that when such kind of event happens, we do not do the quick fix, but we do our energy planning in advance.
Oh, well, absolutely. Mr. Gupta, in earlier conversations with you as well, I do understand that investments when it comes to biofuels, capacity creation when it comes to that also has been done. What we really are waiting for a policy that really enables us in that sense.
So, Manisha ji, as far as 20% ethanol blending is done, we are already done. Now, the next forward is that we should go for the flexible vehicles. E85 draft rules have been launched, and to launch the flexible vehicle, there are a couple of steps which are required. Number one is that flexible vehicles are a little expensive than the normal ICE engines, and so for that, there is a GST deduction required, or there is some kind of incentive which are required to make flexible cars more lucrative for the customers to buy. And also, along with that, we have to see that the ethanol prices are commensurating with the mileage, which 100% ethanol will come, because at 20% there is no mileage concern, but 85 mileage will reduce. So that is the second thing which is to done. And third is that the distribution infrastructure for distributing E100, E85 and E100 petrol at the pump station. So these are the three things which are required. And once all this is done, it will not happen it will not happen immediately, but it will gradually bring the FFEs, and we will also start getting traction towards it.
Mr. Gupta, the other concern really from the naysayers is that we're looking at the food prices going higher. With the kind of situation that we are in right now, the fertilizer also seems to be bringing a concern. And biofuel, ethanol, all comes in from food. How are you looking at that debate? Never dying debate, by the way.
Manisha, you rightly used the word naysayers. I would say that the able experts in the industry talk about the food versus fuel. But look at what is happening today. India produced 39 million tons of sugar just 3 years ago, right? And today we are 31 million tons. So the capacity to produce 8 million, and there is no reason that production will not come back, right? And in last 5 years, I was just doing this number. India exported 20 million ton of sugar, which itself is equal to, give and take, around 1,200 crore liters of ethanol. Then India exported maize equal to 7 million tons. India has exported rice. Roughly, we export around 20 million tons. Out of that, leave it on the basmati, around 70 million tons of rice. So where is the shortage of food in India? In fact, conversely, we have excess of food as far as India is concerned. Our rice stocks are 3 times the buffer stocks. This year also we exported sugar, and maize also now is getting surplus. If you look at it, because of the ethanol demand, I would say the maize prices are down by 13%. So it all reflects the surplus in the country. I think these concern that India may not have sufficient feedstock may not be the right thing. And one thing I would like to add, Manisha ji, that flexible vehicles give you optionality. We should also be mindful of the fact that we are talking about all agriculture-based feedstock. But the best part which has happened in India that we have created multiplicity of the feedstock. We are making ethanol from rice, we are making ethanol from maize, we are making ethanol from sugarcane. We are also evaluating ethanol from sweet sorghum. So with this multiplicity of stock, even if one crop fails, other will do. So that has basically de-risked our feedstock availability also. So I would say that rather than there is a concern on the feedstock, there is a surplus feedstock in the country in all manners.
How are you looking at India, let's say 5 years from now, with the kind of policies and the kind of investments that we are working with right now? And what policies would we need to get there as well?
See, the most important is that we, in terms of energy policy, I think we are dependent by 90% on our transportation fuel. So all energy can play its role. It is electric, it is hydrogen, it is ethanol, all energies together. So as far as ethanol is concerned, once we bring the flex fuel vehicles, it will be a gradual progression. And on ballpark number, I was saying that we sell around 2.7 million ton of 2.7 million vehicles in India. And on an average, even if 20% of those vehicles are flex fuel vehicles, we will have a demand of 100 crore additional from ethanol. And by 2030, we will need around 500 crore liters of ethanol, which is nothing as compared to the feedstock which we have. So gradually, we must shift to flex fuel vehicles, and that's the way our country should run, because this will provide us energy independence, topmost thing, and this will also bring a lot of farmer prosperity. I would like to bring you back to where we started for ethanol. Remember, we had this surplus of around 14 million tons of sugar into the country. And that time we decided to use this sugar for ethanol. And that time the cane areas were running into 20,000 crores. Today, with this ethanol blending program, it is a proven fact that it is absolutely farmer friendly. Cane areas are virtually next to the nil, whatever little bit there are there. Farmers of MSP are getting, farmers who are producing maize are able to get MSP. So it is not only the energy independence. The biggest driver for this in India is energy independence along with farmer prosperity. And I'm not touching the point of employment which it generates, because when you have these factories, when you have the distribution system, then all this create a lot of employment as well.
Mr. Gupta, one final question then. As farmers, we've ticked all the boxes there. It is very, very positive for them and for the agriculture as well. For the industry, apart from flexi fuel, what more is desirable? Because as you mentioned, the price revision in ethanol is one part of it. We haven't even seen a sugar price revision as well. Going forward, what would you say are the three major priorities that the government perhaps needs to work upon?
See, purely from sugar industry, I would say, if you look at it, 2019, the government had declared the minimum selling price of sugar. Since then, the sugarcane prices has gone up roughly around 30%. And whereas sugar prices has only increased by roughly 18%. So there is a dire need to give a boost to the sugar prices by declaring either minimum selling price or finding the ways so that the sugar prices are commensurating with the sugarcane prices. I'll just give you an example today. In spite of whatever is happening, the prices of sugar today, year on year, there is no increase at all. It was down a month ago by 2%. So if the sugarcane prices keeps on increasing and sugar prices do not increase, then there is a problem. Second biggest thing which has happened is that the ethanol prices have remained stationary since last 3 years, right? Whereas the sugarcane prices have been moving up. So ethanol prices should also move up. And today is the right time. Government, the oil marketing companies themselves are claiming that there is under recoveries in petrol, and they have been increasing the petrol prices by 3 rupees, and today I heard it is by another 1 rupee. So obviously the ethanol prices need a boost up, which is very much required. And third most important, which we should plan our energy independence on the medium to long term basis, for which flexi fuel vehicles is the ideal situation as far as India is concerned. So these are the three major things which India should drive as far as sugar and ethanol sector is concerned.
All right, we've noted that down. I hope the government is listening too. Those are the three important points that we need for one, energy dependence, and flexi fuel perhaps is the number one onto that list. Mr. Gupta, as always, thank you so much for joining in. Appreciate your conversation on that very important topic there. And on that note, it's time for a short break, but don't go anywhere. We discuss the impact of West Asia tensions on commodities on the other side with Ole Hansen. He's head of commodity strategy at Saxo Bank. Stay tuned for that conversation. Welcome back to Commodity Champions. Well, the commodity prices have surged sharply in 2026 thanks to the West Asia war and the Strait of Hormuz crisis. The WTI crude and Brent have surged 82% in this year amid supply fears, while Russia Ural crude has doubled in value. Gold is up 5%, silver 7%, as investors turn to safe haven assets amid geopolitical and economic uncertainty. However, metals like palladium and platinum are under pressure due to weak industrial demand, and the base metal prices are trading off highs, but still in green so far. Aluminum has jumped 20%, zinc is up 13%, copper up 10% in this year, driven by demand linked to the global energy transition. But the biggest concern may be agriculture. Wheat, cotton, soybean, palm oil, corn prices have also risen sharply. Extreme weather, supply disruptions, and higher input costs are pushing food commodity prices higher, raising fears of sticky global food inflation. Joining us to discuss all of that is now Ole Hansen. He's head of commodity strategy at Saxo Bank. Thank you for being with us, Ole. And I want to start with crude oil prices first, with what's happening in West Asia, and it continues to go on. When it started, everybody thought it was for a week, 10 days, maybe a month. We're into the fourth month right now, and the crude is holding that $110 a barrel mark. How are you looking at the situation from here on?
Well, good afternoon, Manisha. I think we can only look at it as a market that is jumping from one news cycle to the next, basically responding or trying to respond to the news flow we're getting out of Tehran, but obviously also Washington. And the sum of all these right now basically tells us that we are not anywhere near a peace deal just yet. So that basically means that the global market continues to tighten. The fact that we're not higher is probably threefold, simply, and I think they're probably well known by now, simply the fact we've seen an explosive increase in exports from the US, lower imports into China, but also demand destruction. I think the last one is really the one that might be a bit of a surprising in terms of the size of it, that is keeping the market reasonably balanced, but still tightening. But it doesn't remove the fact that if we get a peace deal tomorrow, then it will still take months before we've depleted global inventories of crude and fuel stocks to the extent that they need to be rebuilt. So looking for a much lower prices in a peace deal is probably something we should not be looking out for.
I wouldn't ask you for a price target, Ole, but what is your range that you're working with?
I think it's in the short term. If we continue to see the market tighten, then there will be an inflection point where at some point we could suddenly see a spike in prices. That's not my base case. I still believe that we are moving. Both sides are starting to get worn out and pretty tired of this war, and obviously also the rising and surging gasoline price and energy price and cost of everything in general. The bond spike we saw, bond yield spike we've seen in the U.S. is most certainly not helpful at a time where we had fiscal debt focus already. So I think I've ruled that out, but keep it as a risk. But if we should get a peace deal, then the new floor in the market, which was 60-70 in Brent, will most certainly have moved higher by at least $10 to $15. So 85-95 could be the new floor in the market for the foreseeable future, when we get the reopening of the Strait of Hormuz.
Point taken. How are you also looking at the gold and silver prices from here? Because gold clearly hasn't been much in favor, as money seems to be flowing, one in crude and then, of course, in the US dollar index.
Yeah, it's almost a perfect storm of headwinds right now, Manisha. We saw last week the spike in bond yields after that inflation shock. We've seen the dollar strengthen to a certain extent as well. And that's just keeping investors sitting on the sideline for now. We also got the continued stories about central banks, some reducing their holdings in order to either prop up their currency or in order to fund the increased cost towards energy. So we're going through this transition period here, I'd say. Overall, looking where the price is, I think we're actually holding up quite well so far, above that 4,500 level, and still quite a bit above the 200-day moving average, which is key support to the downside. So I think we're just in a situation right now that high oil prices in the short term means lower metal prices, simply because of the inflationary impact and what it does to central bank thinking and bond yields. But I think when we get on the other side as well, I just put out a note today. I think the long-term reasons for holding gold has not changed. I think there's a universal agreement that is the case. The question is really then obviously whether investors will come back to the market when we see some stabilization. But my call is still for higher prices in the coming months.
And how high prices can that be for gold and silver both?
Come again, sorry?
How high can the prices go?
Oh, well, gold could, in theory, and well, not this year or next, but over time, gold could, in theory, go to 10,000 because it is a monetary metal. It's not one that it totally rely on physical demand. Obviously, India is. I should not say that to when I'm on Indian television. Obviously, you are massive gold buyers, and that will obviously hurt. But a lot of the investment demand will continue to come in if we are looking at the deglobalization and the de-dollarization and the fiscal debt worries, then gold could go high. But in the short term, let's say the next 12 months, back to where we came from, so a new record high and potentially as high as 6,000. I think silver will be struggling if we move towards the $100 level. I think the investment demand is starting to show some signs of slowing down. Also, the physical or the industrial demand may suffer from these higher levels. So. From a long-term perspective, long-term hold perspective, I still continue to like gold more than silver, simply because silver is much more impacted by the industrial side of things.
The base metal prices have been all over the place as well. Very recently, last week itself, we saw copper in US hit an all-time high. Pardon me. Not so in case of LME, but aluminum continues to outperform because of the energy intensity therein. How are you looking at copper, aluminum, both of these going forward?
Well, you mentioned at the start, it is part of the energy transition. That is a transition that will continue. It will probably continue to strengthen. We've got an energy shock right now, which is basically the fossil fuels that we once again highlighting the reliance of those. That basically means that the energy transition will continue to move forward. It will continue to be a major source of demand for copper and to a certain extent aluminium as well in the coming years. So we're seeing a correction right now. Inventory levels are still reasonably high, and that potentially could weigh a bit on prices. But generally, it is a long-term hold for these metals.
With the way the inflation is and the bond yields have risen, there almost is a 50% probability right now, all that we could be looking at a one rate hike before this year ends, maybe in December. How are you reading that?
Well, I'm reading it as the new Fed chairman has got a job on his hand. He's been appointed by President Trump. Trump clearly wants lower interest rates, but his actions in Iran has made that literally impossible. So how he managed that gap, bridge that gap between a market screaming or at least starting to call for a rate hike, and the administration looking for easing easing funding. I think right now the key is really how the long end of the bond market behaves, because if there any talk about cutting rates at this point in time, the long end would really fall quite significantly further. So price and yields would spike, and we know with all the refunding that's coming in the U.S. over the coming 24 to 48 months, that would just add further strain on the U.S. economy and their fiscal debt concerns. So it's so with that in mind, I think they'll bump along for now. If the economic data starts to deteriorate further, then potentially the focus could start to switch from addressing inflation to supporting the economy. But then they would be stuck because basically cutting rates, as I mentioned, in a rising inflation environment is really something that could hurt the long end of the bond market, and that's really where all the refinancing and financing is being used as a benchmark.
Oh, absolutely. One final question, and this one is on agriculture part of it, because looking at the fertilizer prices surging higher, and many of the agri commodity, whether it's about cash commodities, industrial commodities, all of that seems to be rising up as well. How are you looking at the food inflation part of this?
Well, I just listened to your interview before on sugar, and that's really a fascinating area as well, because sugar is part of this whole biofuel and biodiesel move that we're seeing, where soy oil, palm oil, and some of the others have been supported very strongly with the rise in gasoline prices and diesel prices. I just read last week that the producers in Brazil, they are looking the current price levels around 15 cents a pound. Is almost 3 cents below their break even because of the rising fertilizer and diesel cost. So we will see prices eventually move high. Otherwise, production will get hurt, and production is needed right now for the ethanol and for these blending plants. But it is a potential troubled season or months we are facing now with the planting now done in the northern hemisphere. Now we look through the growing season. But the lack of fertilizer or the high cost of fertilizer obviously means that the farmers will be pressurized, and that the risk of that points to higher prices in the autumn. Wheat has been a main driver. For now, there's still quite a big contango in the wheat market, basically meaning that there's still ample supply if you look from now to the next harvest. But generally, it was metals last year. It was energy at the start of this year. Potentially could be, and I'll say unfortunately, agriculture when we come into the second half of the year.
All right, so inflation all the way does not sound so good, but thank you so much for laying that out for us. Saul, as always, a pleasure talking to you. Thank you so much for your time today with us. And with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.
Hello and welcome to News Center. I am Ashmit Kumar. Now, in significant ruling on public safety, the Supreme Court has refused to modify its earlier order directing for the removal of stray dogs from public places such as hospitals, bus stands and schools. In November of last year, the court had ruled that stray dogs, even after sterilization, cannot be released back into the same areas where they were found. The Apex Court has now dismissed all pleas challenging those directions, citing Article 21. The bench said, and I quote, the right to live with dignity under Article 21 of the Constitution necessarily includes the right of every citizen to move freely and access public spaces without constant apprehension of physical harm or life-threatening events, such as dog bites. End of quote. Now, the court has also authorized authorities, that's the municipal authorities, that they may carry out euthanasia of rabid or aggressive stray dogs in areas reporting a high number of attacks. It further clarified that municipal officials will receive legal protection while carrying out these duties. The court also ruled that no FIR shall be filed against officials implementing its directions unless there is an abuse of authority. The bench also pulled up states for failing to follow the statutory framework to control stray dog population. All states have now been directed to ensure that they have to take urgent steps to expand shelter and sterilization facilities. The court has also directed that every district must have at least one animal birth control center. The ruling has reignited the debate between public safety concerns and animal welfare groups. And well, joining us now to discuss this further is with us Menaka Gandhi, animal rights activist. Ms. Gandhi, thank you so much for joining us. First question, your first thoughts on the Supreme Court ruling. I want to get your perspective on how the Supreme Court records at length that there has been a spectacular failure on part of the states to have enough capacity, sheltering capacity, vaccination capacity, but in the same breath has remained firm on its order that stray dogs in public areas, especially hospitals, airports, railway stations, should be rounded up.
Yes, unfortunately, we are dealing with two problems. The main problem is the lies being spewed by the media at the moment. I'm sorry to say this. The Supreme Court has said nothing of the sort. They have simply said that our order of November 7th stands. And that's fine. And secondly, they've said, in future, don't come back to us. Simply go to the high courts because we wash our hands of the matter. Now, let's start with the first one, that the media are. Can you hear me?
Yes, Ms. Gandhi, please go ahead.
Hello?
Yes, Ms. Gandhi, please go ahead.
Yeah, so the first thing let's take up, which is what you have said, that they have ordered euthanasia. They have not said that. They have said, euthanasia has always been a law, always, since 1960, when the act was passed by Parliament. But it's very specifically bound by rules. And the Supreme Court has merely reiterated that the government may consider, they have not said do it, they've said they may consider euthanasia according to the existing laws. Now, the existing laws are, A, that it can only happen with rabid dogs or dogs who are incurable. Secondly, it can only happen if 3 vets are consulted and they give it in writing that this is sick. So they have not said anything else. They have not said, oh, aggressive dogs can be euthanized and stuff. And I wish you wouldn't keep repeating this lie because it'll just lead to more problems. Number 2, they have said they passed an order in November, which you should know. They've said 6 things. One is make shelters, make ABC centers, remove the dogs from hospitals, remove from colleges, and remove from railway stations and remove from bus stops. Now, in 7 months, not a single state, not a single municipality has done any of these 6 things. No shelters have been made. No ABC centers have been made. No dogs have been removed from colleges or hospitals because the hospitals and colleges have given in writing that they can't do it until you have shelters and an infrastructure. If they remove the dogs, where will they put them? On the road? In which case, again, Article 29 will have to be referred to, that the right to life for people on the road. Now, the last thing I want to say is that when you have referred to Article 21, which is the right to life and protection, it's not just dogs. 10,500 people are killed every day by cars. Don't they have a right to life? 16 lakh people are killed by bad air. Any number are killed by lead poisoning and chemicals in their food. Don't you think that that is also right to life? Article 21.
Sure.
So just concentrate on dogs would be foolish. Now, the Supreme Court had said, sorry, should I continue or would you like to ask something?
No, Ms. Gandhi, actually just wanted to also get your thoughts on one specific direction that grants legal immunity to municipal authorities. The question that many now are raising is that with this additional legal immunity that no FIRs can be filed, there is a grave potential for misuse, especially when it comes in the case of interest of stray dogs, who of course can't speak.
No, you're so right. But let me tell you, again, Supreme Court has said nothing new. You cannot file an FIR against a government servant, full stop. There has never been a case in India where we have been able to file an FIR against any government servant. So this is not new. However, there is a huge amount of illegal work going on. To give you two examples, which I've used frequently, of just yesterday, the municipal commissioner of Warangal picked up 300 dogs from Warangal city and threw them into 6 villages. Now, I can still not file an FIR against him, even though he has created a situation in which those 6 villages will be swamped with dogs and they will kill. The dogs will bite them, they will kill the dogs. You have created a problem and it's illegal. The second thing was yesterday, in the Prime Minister's own constituency, a senior electrical engineer in the colony of electrical engineers said, in the where the government servants live, said that we will not tolerate dogs in a government colony. They picked them all up at night in private vans and threw them into a slum. Now, did the slum people, do they deserve this? Suddenly to have 100 dogs or 50 dogs jump on them and in a panic bite children or old people. So what should we do with these government servants? So the Supreme Court has said nothing new, Biti. They have not said that they must be protected. Nobody is allowed in any case under the law to file a case against a government servant. So what is new?
Right. One final question to you, Ms. Gandhi, that in hindsight, the Supreme Court saying that public areas need to be cleared, but that's the exception that the Supreme Court has carved. In hindsight, does it give you reason for hope and optimism now that the Supreme Court has granted its approval for the broader ABC framework, the Animal Birth Control Rules framework?
They had always insisted on it. I'm saying today, the Supreme Court has said nothing new, nothing. So the media has been, wanting to find something that will give them headlines. So they've seized upon euthanasia when there is a no euthanasia order given at all. What the Supreme Court has said and what we are saying all along is that this problem is a very simple problem. 780 districts need 780 ABC centers. Out of 780 districts, in 25 years, the maximum number of ABC centers that have been set up are less than 100. Out of these, only 16 are working properly. Only 16 out of 780. The rest of them are run by mafias, illegal people who simply bribe the local municipality to pretend to sterilize. In actual fact, relocate dogs, throw them out, and take money. Now, if the Supreme Court really wants a solution, we can give them a solution in 2 years. And it's quite simple. 2, 780 ABC centers. 2, 780 NGOs to be trained in the 4 training centers that already exist in Delhi and which are lying empty, not in Delhi, in India. Uti, Lucknow, Dehradun, Jaipur. If you want to do that, in 2 years, I guarantee that what will happen is that you'll have 50% of the dogs you normally have as of today. And 2, your bites will come down to just 10% of what they are. That's all. And that's what you and I want.
Well, that's, of course, the solution the Apex Court itself has proposed, saying that there needs to be one ABC center for every district. Ms. Gandhi, thank you once again for joining us for your insight. But we also have with us Ms. Nanita Sharma, a petitioner in this case as well, advocate of the Apex Court. Ms. Nanita Sharma, again, the solution that the Supreme Court seems to be running with is that, look, one ABC center for every district will do the job. Do you think that will help address the issue of a stray dog population in a way where we are not being inhumane with the stray dog population?
Thank you for inviting me on the show. First of all, tell me one thing. The ABC program started in 2001, right? Till today, what has changed? That strict implementation, has it happened ever? This is almost more than a decade that whatever is happening under the nose of the authorities. Now, Menka ma'am was talking about these ABC centers. ABC centers have been functioning for years now. The 16 centers that have been functioning, has there ever been any strict implementation? What is the effective, what is the guarantee that today, when the Honorable Supreme Court is passing these directions, the same will take place? You know, this program has been in, it has been going on since 2001. Then 2023 they came up with these amendments. What have they done? The authorities have not done anything. They have not done their basic statutory duties. So what guarantee that this is, they are going to again, they will go for any effective implementation? They have been granted funds since years now. Where is all the money going? 16 years.
Fair enough.
I'm fighting cases again in the High Court and in the Honorable Supreme Court, stating that where is all the money going if not being utilized for the purpose for which it was being given? So these authorities, I'm talking about the MCD, the Animal Welfare Board, they're all the same. So what do you expect? I mean, this implementation of the programs, if it is done, if they had any intention to do these programs consistently and seriously, nothing would have stopped, the crisis that we are in today.
So
it's all because of these people.
To implement,
there is no political will, there's no intent. Absolutely.
Political will either is what you're saying. Let me then also ask you, just help us understand and appreciate this order. The Supreme Court carving an exception, saying that as far as public areas are concerned, that's where all the stray dogs need to be cleared. What about the other areas? What about our communities? What about our housing societies? Is the order applicable in those areas as well? Can the municipal bodies come and round up the stray dogs in every community, including your residential societies, housing societies?
No. They haven't said anything about that. Today they haven't said, I haven't gone through the judgment yet, but they have not said anything about the RWAs and, the other public places. Now, but there will be full misuse. Why? Because now they have come up with this order. The people will be misusing this order. I'm not saying the Honorable Supreme Court has stated anything about this, but people have been misusing this order for months now. Since the 7/11/2025 order, people are picking up dogs from everywhere and mistreating them, and in a very cruel fashion they're picking them up and then relocating the dogs at the highways, at the jungles. So it is not a very correct statement that nothing has been done since then. Lots has been done. Day before yesterday, so many dogs were thrown in the fire. I mean, so much animal cruelty and not a whisper about animal cruelty in this order. And they're just talking about human cruelty. Right, I am not saying it's very important. Humans are very, very important for me. But at the same time, this Mother Earth is for everybody to exist on, not only human beings.
Ms. Sharma.
Yes.
Right, Ms. Sharma, I'll just have to interject there for want of time, but we'd appreciate the insight and perspective you've given us on this latest Supreme Court ruling, confirming its November 2025 order that all public areas, hospitals, schools, colleges, railway stations, airports need to be cleared of Stray Dogs. Ms. Sharma, thank you once again for joining us. But with that, it's time now for slipping into a very short break. We'll come back on the other side. Leading American nuclear energy companies are eyeing a multi-billion-dollar opportunity in India amidst the country's nuclear push. We get you a chat with Maria Konski, President and CEO of the Nuclear Energy Institute. Stay tuned. Welcome back to News Center. Now, with India passing the Shanti Act, leading American companies in nuclear energy are keen on partnering with India companies for multi-billion-dollar opportunity. I spoke with Maria Korsnick, President and CEO of the Nuclear Energy Institute. She said that India's aim to build 100 gigawatts of nuclear power requires immediate action. She confirmed that American companies saw great potential in India, not just as a market, but also as an exporter of nuclear tech to the rest of the world. But she also said that there are some teething issues. Listen in.
So back in 2005, we did that civil nuclear cooperation deal, and yet we didn't complete all of the issues and the conversations. And that's what the Shanti Act has done, right? It has dealt with the nuclear liability. That was one of the biggest sticking points, if you will, back from the 2005. In fact, we're here on a trade mission, and I have a couple of delegates that were here on the 2006 trade mission. Okay. So we actually did a trade mission right after that civil nuclear deal. And now here it is 20 years later, right? And it's beautiful that we have the Shanti Act, but there's still going to be some things yet to figure out as we put these deals together.
Three key areas, perhaps if you could identify for the government to work on to take this aspiration forward. Is it land? Is it taxation? Is it labor? What would you identify as the big three?
Foreign direct investment, I think we have to really work into that. What's the right piece? If you look in general at financing these kinds of projects, nuclear is a long-term project. 100-year asset. If you look at some of the financial game plans, they don't really imagine building something for 100 years. And so we have to look at some of the game plans that we could put together because the first couple that you build, they're going to need a little bit of additional assistance, first of a kinds, and then it comes down that cost curve and then it becomes more efficient. So I would say some of the financing pieces of this, ultimately probably a conversation around tariffs and foreign direct investment.
Fantastic. Let's talk about India as a market first. When you look at India as a market, how big is this market that we're potentially looking at? Of course, India has aspirations to have 100 gigawatt capacity, but that's some time out in 2047. In the near term, any assessments that you're working with as to the size and the scale of the India market, the opportunity?
Well, let me go to the U.S. first, and then we can come back and compare to India. But JP Morgan recently did an assessment and said between now and 2050, $2.2 trillion market in the U.S. for nuclear. And then I would come back to India, and actually globally, much bigger than that. And so, you know, I would just say, oh my gosh, this market globally is in the trillions. And this isn't a flash in the pan, isn't for the next 2 or 3 years. This is a long-term build-out for nuclear. And why is it? Because nuclear is clean, because nuclear brings you energy security, that energy security brings you national security, and it's highly reliable. And those are all very interesting from an energy perspective.
In the context of this opportunity, let me get your thoughts in. For the benefit of our viewers, tell us what are SMRs and why is it catching the attention now? And when you look at a longer-term approach, would you have Indian policies aligned towards more conventional, the big ticket projects that we see running into several hundred megawatts? Or would you have Indian policy more curated towards SMRs or smaller reactors?
Yeah, so I'll answer the second question first and say yes, all of the above.
Okay.
You should create a market for all of them. So if you think about, again, the nuclear of yesterday, gigawatt size nuclear, that gigawatt size is large, it's beautiful, but it doesn't fit all of the different problem statements.
Okay.
And so nuclear wasn't considered in some cases, whereas now you have the large, you have the medium, you have the small. All of a sudden, if you have an energy need, nuclear can be your answer. Do you want to have something that just goes for your manufacturing place, as an example? Well, there's probably a 1 megawatt reactor that might be just fine for you. Do you want to have a small city? Maybe you need 30 megawatts, right? Do you want to have a small town? Maybe you need 500 megawatts, 300 megawatts. And so if you just think about the future, again, I want to think even broader than India. Think about all of the different places. You might be someplace that doesn't have a lot of water supply. There's a nuclear model that can fit for that. You could be in the desert. You might have a view that you want to move this around. I would say from our defense perspective, they're interested in mobile reactors, and they're looking at that. You might want to have the large ones because you have an established grid. That's great. The large reactors are there for you. You have some manufacturing that wants behind the meter. In other words, they don't want to go on the grid. They just want to directly power their source. And so there's so many different opportunities. That's why having nuclear come in all these different shapes and sizes is helpful and beneficial, because it can be part of the solution. That means you can end up with a backbone of your electricity supply that's clean and reliable and always there. And that's beautiful. Now it can pair with wind and solar when they're available. It can pair with these other things, but at the end of the day, we're going to have that clean background grid that we'll have from nuclear.
Let's talk about the appetite here in the India market. While there may be a clear policy intent by the government, is it also being responded to by private enterprises? Is there an appetite? Is there core capabilities to take these aspirations forward? I'll ask you this in context of a recent report which indicated that the capital required would be massive. We're looking at somewhere in the neighborhood of 23 to 25 lakh crore rupees. With that kind of capital that's required, do you see an appetite in the private sector?
I do. I see an appetite beginning, but again, you don't have to do it all overnight. Think about this as this is a long-term relationship that we're talking about, right? So we can work together a couple of projects, get the skill set, get an understanding of the supply chain that's needed, yeah, I think it's a perfect marriage, honestly, between the skill set that is already here in India and the potential for the manufacturing that can happen here in India with the innovation that's coming from the United States. We have a lot of different makes and models that can make this work. Think about instituting this now in India for generations to come. Generations. Like, I know you guys maybe several years ago began building a car, I think might have been from Japan, and now you're exporting, right, many of these. It's the same kind of thing, right? It's like, start now, build this infrastructure, build this manufacturing base, get engaged in the supply chain. You already have a great workforce. You know, it's something that will be paying off for many generations here in India.
I want to bring your thoughts in on the AI story. AI story for the last couple of years has very closely aligned itself in terms of power availability. We're seeing a data center build out here in India as well. There are large commitments that have been made stretching across billions of dollars. Is this also perhaps a key which nuclear power can help unlock in terms of data center capacities, data center capabilities, which of course are very power hungry?
Absolutely. AI is a thirsty technology. In the United States, we're expecting to triple the power to data centers by 2030. I think worldwide it's expected to double by 2030. And it's only going to grow from there. And what has then brought in is relationships with Meta and Google and Amazon and all of those hyperscalers, because to your point, they don't just want power, they want really reliable power. And that's what nuclear brings. Again, I'll reflect on statistics in the United States. We've had a greater than 90% capacity factor for our nuclear fleet for over 20 years. So these are very highly reliable sources of energy, and it's clean energy. And so there's a perfect marriage between this new AI hungry power source that's needed and bringing nuclear in. And it's not just here in India. Again, it's around the world.
I just want to look at this nuclear power from a slightly different perspective, from the lens of geopolitics. There has been a great push for India-US cooperation, but is it important to see this in context of the relations that, say, a country such as China has with Russia? China, of course, as we know, is seeing the largest nuclear build-out ever. Russia, of course, being a very established, known exporter of nuclear technology. Is this something that we need to consider about India needing to align with the US, or US perhaps needing India to counter the Russia-China ties?
I think so. I mean, we're very interested as we look across from a geopolitical perspective. I think it does matter who you do business with, and I think U.S. has demonstrated technology and expertise in this area, and I think this is a great opportunity for India and the U.S. to have a strategic partnership in this way. And I think our technology is proven, and as I mentioned, a lot of innovation now coming into the marketplace, and I think really well timed for this partnership to grow.
That's a wrap on this edition of News Center. More news and updates will continue right here on CNBC TV 18.
Hello and welcome to the Global Dialogue. I'm Shireen Bhan. Two sets of headlines have dominated the narrative in 2026. The war in West Asia, which continues, and of course all things related to AI, but specifically the prediction of the SaaSpocalypse and what that will mean, not just for Indian IT services companies, but for SaaS companies globally as well. Let's just put some data on the table now. In light of this narrative, we've seen companies here in India, but globally as well, lose significant amount of their market cap. Year-to-date, Salesforce down 31%, SAP down 28%, ServiceNow down 35%. That gives you a gist of what I'm talking about. But to help make sense of where we are today, and more importantly, what the future looks like, joining me now is a man that I last spoke to in 2024, the Chief Digital Evangelist at Salesforce. Vallabh Shah, always great to have you. Thanks very much for joining us here in India.
It's a privilege. It took too long. It's been 2 years since we spoke last.
And the world has changed in 2 years.
Changing. Quite a bit.
So what has surprised you about the pace, the momentum of the change, Vallabh? I mean, we did talk about the fact that AI is going to accelerate the tech adoption. It's going to accelerate change as we know it. But this, this stage and people talking about the fact that 18 months on, people sitting in front of a computer are going to be redundant. I mean, did you anticipate this?
We spoke in the middle of 2024, and since then, Salesforce has become an agentic enterprise. We have 25,000 plus customers around the globe, including incredible innovation happening here in India, becoming agentic, becoming autonomous businesses. I've been in tech 30 years, so I've had the fortune of experiencing certainly the cloud revolution, which Salesforce pioneered when we launched in 1999. We've watched and enabled the mobile revolution. Some argue 2007 with the birth of the iPhone, or the social revolution, the Internet of Things, data and advanced analytics. I have never experienced the velocity, the speed and direction, which has led to the fastest growing product in my company's history is our Agentforce product, our agentic AI solutions capability, and also our incredible opportunity to feed agents with trusted data. So when I look at our data and our agentic business, it's our most successful product lines in the history of the company, and now tens and thousands of companies using it. So yes, you and I think, we did a good job of predicting this agentic future. I think we both talked about the fact that, this could be electricity for the 21st century when we talk about. And it's clearly true that it's the most impactful. Some would argue when we talk about AI, specifically agentic and physical, it could be the impact 10x bigger than the Industrial Revolution at 1/10 the time. That's a profound statement in terms of what's ahead of us. And I think it's only the beginning. So, one of the reasons why I'm so delighted to be here is tomorrow I get to spend time with 2,000 men and women who are changing the landscape of not just India, but the globe in terms of adoption of innovation, adoption of new business models, and really finding ways not only to be relevant, but also thriving and growing in this hyper-converged sense of uncertainty that we're all part of. You mentioned in your opening. I also, as much as I'm excited about the technology, when I think about converged uncertainty, tariffs, multiple wars, climate change, powerful new technology, questioning future of business and future of work, this is a time where you need to be grounded in your core values. You need to learn by first principles, and you need to adapt as fast as you can.
And you have previously said, and we talked about this as well, that if you're not on the forefront of adopting AI, then you do have an existential question to deal with. At this point in time, given where we find ourselves, do you believe that more companies are at the risk of being not just left behind, but facing an existential uncertainty, an existential question than they were 2 years ago?
I do. Right after our conversation, I was inspired to work on my next book.
I'm holding it up here, Autonomous.
You're holding it. And the subtitle of the book says, "The Fittest Companies." I'm reminded by Darwin, survival of the fittest. Darwin didn't say you had to be the strongest. Darwin said if you had thick fur, you're more likely to survive the winter. So it was about adaptability. Subtitle says, "The fittest companies," because I believe now we're talking about digital Darwinism, fittest companies adopt AI-first strategy and digital labor. You're not an autonomous business, you're not an agentic enterprise if you don't have digital labor. So today when we talk about hybrid work, maybe perhaps in the past that would reference where you worked, home or office. Hybrid work today is humans and AIs co-creating value at the speed of need. Your ability to anticipate, your ability to scale, and the level of intelligence that's introduced with an AI system. And again, I'm very deliberate when I say system because this is not a discussion around language models alone. Language models is a component in the system that agents use to create and to be able to reason and to execute complex tasks in business workflows, to adapt and learn with every iteration. That requires a system. Salesforce, that system consists of 4 subsystems, but there's more than just one component that brings this incredible capability to life. And to get back to your question, you're either an agentic business or you're a dying one. You are on a path to irrelevancy if you don't take advantage of this technology. And that's my belief is, rooted in evidence. But I also, being in technology for 30 years, building technology for majority of that, I've never witnessed technology as powerful, as impactful as these waves that we see in artificial intelligence, the predictive use of machine learning, the generative use of machine learning, and now agentic and physical. And what I mean by physical, smart drones, autonomous vehicles, robots, humanoid robots, even smart wearables. Everything I can do with my Salesforce platform, I can do with smart glasses. I can just speak to it, and I can look at my customer service cases, my marketing opportunities, my sales leads. So things are now conversational, multimodal, and you can literally wear your agent today, which is not something I thought was possible only a few years back.
Lots of very important statements coming from you there, and I'm going to have to unpack each one of those because I think they're each individually complex issues to get into. So let's start with digital Darwinism, and to your point about if you're not agentic, then you're a dying business. What is it going to mean in terms of workforce? When you talk about a hybrid workforce where you have digital labor and human labor working together, what are we talking about in terms of numbers? Because there's mixed messaging, for instance, from Salesforce. Mark Benioff says, look, we're hiring 1,000 graduates and interns and so on and so forth. But at the same time, you have also restructured and laid off a couple thousand people in the last 2 years. We're seeing tech companies globally at this point in time talk about restructuring, not hiring as much, or laying people off in thousands. So what does it mean in terms of the human workforce to start with before we talk about digital labor?
No, it's a great question, and it's top of mind for everybody. Again, you and I spoke 2 years ago. I think Salesforce is 20,000 plus more in terms of employees from 2024 to 2026. I believe we're around 85,000 employees globally. I joined 10 years ago, we were 15,000. So the company continues to invest in human capital, human labor, human talent. But having said that, I think there are certain R's, you mentioned a few of them in your question, that businesses will face for the next decade. When it comes to this capital T transformation, it's not just modernizing legacy processes. Becoming an agentic enterprise is a major transformation. The first is redesigning your processes. It's really wasteful to have humans working on repetitive, highly deterministic, low-value work. So we're going to see massive redesign of processes across entire business. When you successfully redesign and deploy an agent, one of the first realizations, this is a good one, you freed up your human talent to now be assigned to high-value work. But sometimes that high-value work is outside your current domain. Like at Salesforce, when we decided to redesign our help.salesforce.com, which is the website that everyone around the world that uses Salesforce goes to for help. When we onboarded agents, and we saw agents very successfully, unlike anything we've ever experienced in the 27-year history of Salesforce, properly resolve cases. We've resolved over 3.5 million cases in the last 16 months with Agentforce. We were able to free up the men and women that were doing that function. That led to an internal hiring of about 3,000 individuals. Those individuals became forward deployment engineers, solutions engineers, architects, sales professionals, programmers, professional service and technology training leaders. Some could immediately make the transition because they had fantastic skills. Majority required reskilling. So the second R, redesign, reskill. You get to a level where the person has the skills to do a new job. So what do? You redeploy them into a new role. By the way, they're excited. Very often it's a highly more compensated role. It's new, more creative, more complex work that could require strategic thinking, something that they weren't able to do because they were assigned to low-value deterministic work. Redeployment of talent in business has financial implication. You have to restructure your finances. Budgets move from customer service and support to maybe sales or engineering or marketing. You even restructure your organization from, you may need less middle management.
talking about agents now blackmailing people who actually created them, fearing that they're going to be shut down.
Yeah.
Who designs the playbook in an agentic world?
That's a great question, and I will say, I'm not aware of many businesses, if any, that have relationship design as a formal practice. But I will say that, when I think about Salesforce, we were the first company in tech that I'm aware of to hire an ethical and humane use of software senior executive, Paula Goldman. I think it was 8 years ago, but I'm not quite sure. But I think it was close to a decade ago. To think about, before we write the first line of code, we want someone that understands human biases and ethics and understand laws and governance to challenge us in terms of should we be building this capability. Now we have 6 research teams. We have ethical humane office that's involved with every piece of code, every functionality, every feature that we bring to market. And if we don't believe it's betterment of society, we stop building it. And this is before,
Have you stopped building anything recently?
We have stopped building many things along the way. We have a sandbox where we can test, not just A/B test, but test in the thousands of scenarios, capabilities that we have powered by agents. We have dashboards that actually look at a rubric of certain business outcomes we want the agent to be able to produce, and we actually stack rank our agents. Like, I know our quota crushing agent is our #1 producing agent. We have 300 of them. So when you have 1 or 2, well, maybe you can do it manually. When you have 300 active agents for a $40 billion, 85,000 employee company, Fortune 150 company, you better be able to, just like athletic, you have a scoreboard. You know the points, the rebounds, the assists, the fouls, you know everything about your players. We are managing our agents just like professional athletes, Olympic athletes. We know exactly when we are deviating from our plan and how well we're doing. So you have to test these scenarios, you have to score these scenarios, and sometimes you fire agents, sometimes you promote agents. Promoting means give it more data, give it more rules, give it more energy. The currencies that matter most in the future are energy, power, and data. So it's exactly how you onboard humans. It's exactly how you promote humans. It's exactly how you demote humans. All of those rules are now just happening at a different scale in terms of speed, personalization, and performance. In terms of your question, setting these guardrails, I believe, has to be a team sport, from your board to your CEO to the leadership to even single contributor. We have mandatory courses at Salesforce in terms of ethical training, in terms of understanding the security threat vectors that have emerged as a result of AI. Again, these are mandatory many days of training. I think the deliberate way we have educating our employees, which, by the way, translates how we educate our partners and customers, is extraordinary, unlike anything I've experienced in my career. It's a team sport. It's a team sport. And, but it has to be reflected in your leadership. It has to be reflected in your leadership. And that's something that I can say with great pleasure and delight that I see that in our leadership. We live our core values. It's not just a signature or fancy posters hanging on a wall. It's not just the perks we have, nice latte or, dry cleaning service or whatever it may be. Perks are not your culture. It's your core values. And it's never been more important. This technology is more powerful than any technology we've ever had in humanity. So if you don't, if you're not guided by a good culture, good core values, it could be, you could find difficulties. You could find difficulties.
Let me end by asking you about India. You gave us a glimpse of what excites you about the business that Salesforce has in India. You've already touched $1 billion here in India. But
super proud of you.
So Salesforce in India is one aspect. But I think the larger question that people are also asking is that what role does India play in an AI world, given the fact that, as far as the infrastructure build-out is concerned, the large language models, that race has, there's a long distance between what's happening in the US and China and where India finds itself. Can India play in the application space and still emerge the winner, is the question being debated.
My personal belief is you can't lose by betting on India. A $5 trillion economy by next year, by 2030, $1 trillion digital economy. That digital economy is growing 2 times faster than any other sector in the country. Stanford rated India #1 globally in terms of AI readiness. You're graduating 3 million STEM graduates. That's 3 times more than the US, just STEM, 10 million in total. 161 unicorns. We're investing in unicorns in India. We've invested in nearly, I think, a dozen startups in India, AI startups, and we'll continue to do that. Our investment in India speaks for itself. I mean, from Salesforce Tower, that will be revealed in the very near future this year, and our Center of Excellence that's 10 years old, just the population of employees here. So I think that, the world knows where we're betting in terms of, but again, 3rd largest economy in the world in the very near future. So when I think about infrastructure, not just 5G, but AI, 160 some odd AI unicorns or startups, talent, the fact that the private and government sector are working more closely than ever before. We launched our public sector 2 years ago when we spoke, because of realization that this is a big enough transformation that you need private and public working in concert. So, in every measure that I can see, India is positioning itself already as a leader or to become. And that's super inspiring. That's super inspiring. And it's when I think of the makeup of my company, long before the AI journey, by the way, we opened up our office here in 2001. So we've been here for 25 years. And all we've seen is incredible growth. So we'll continue to do that. I'm hopeful that I can continue to learn and be inspired by the trailblazers from India. And of course, some of the top leaders at Salesforce, frankly, some of the top business leaders in the world are from here. And that's also a strong indication that not just the spirit of India, but the capacity to learn, to adapt, and to grow is perhaps unlike anywhere else in the world.
So let me end by getting a forecast from you, just like we did in 2024. So what are you going to leave us with now, Vala, in terms of what we can expect? Hopefully, we won't have to wait for another 2 years before we have a conversation, but 12 months out, what is the world likely to look like in the world of technology?
That's a great question. Again, as I said, experts of the past are not necessarily experts of tomorrow, and I'm not a futurist, but I do have a lot of futurist friends, so I benefit from their shared wisdom. We'll have a better understanding of the physical world in the next 1 to 2 years. Digital twins of businesses will become prominent. We're active in building digital mirrors of our world, partnering with companies like NVIDIA using their Omniverse platform. Not just digital twins of manufacturing facilities, but it could be airports, hospitality, retail outlets, banks. So that will lead us to another significant area in terms of innovation, and that's multi-agentic orchestration. So consumers agents working in concert with business agents, negotiating contracts, figuring out where to vacation, where to send kids to school. We've had a very asymmetric conversation around agents and business benefits, forgetting the fact that there's 8 billion people. Today only, sadly, 5.5 billion have access to the internet. But still, it's 5.5 billion. Every one of those individuals will have their own agents. So multi-agentic orchestration is going to play a key role in terms of shaping how businesses build their modern tech stack and how we advise companies. You have to have proficiency understanding the agentic ecosystem and its landscape. And so the digital twin and multi-agentic orchestration will lead to a third phenomenon, which I would call ambient computing. Computing is becoming smaller. Computing is getting closer to our senses, to our mouths, to our ears, to our eyes, to our nose. So if it's up to some folks, we could have small implants that can help shape folks that may have disabilities, that can take advantage of technology. Ultimately, the best use of technology is to improve quality of life. So you're going to see anything that can connect, will connect. We've been talking about Internet of Things. But all these things that connect in any shape, your car, your refrigerator, your coffee maker, your home, will have reasoning and agentic capabilities. So we're not just electrifying and connecting our world, but our world and everything that's connected will have agentic capabilities, which means it can reason, it can adapt, it can personalize. Combination of ambient computing, digital twin of the world, and multi-agentic orchestration are three big bets that will shape the next decade.
Three big bets that will shape the next decade. That's a pretty good forecast that you leave us with, Vala. And I look forward to being able to have this conversation with you on how that shapes up and pans out over the next 12 to 18 months. But always a pleasure. Many thanks for joining us here on CNBC TV 18 on the Global Dialogue. We look forward to the next book. Since we've had conversations about the previous two, we look forward to the next one as well. Thanks very much for joining us on the channel today. With that, it is time for us to wrap up this edition of the Global Dialogue. You heard it from the man himself. That's the agentic future that Salesforce is betting on. Digital Darwinism is going to have to be the key. Agility is the mantra for survival. From all of us here for now, goodbye. Many thanks for watching. Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The rupee hits a record low of 96.60 against the dollar, plummets by 7% since the start of the year. Market fails to hold on to gains. The Sensex and the Nifty end lower amidst a volatile session. The Trump administration renews sanctions relief on Russian seaborne oil for 30 days. Says this will provide additional flexibility to energy-vulnerable countries. Indian OMCs hike fuel prices by about 80 paise per litre, marking the second increase within a week. President Trump postpones his planned attack on Iran less than 24 hours after claiming that the clock was ticking. Says he was approached by the leaders of Qatar, the UAE and Saudi Arabia. Tehran says Pakistan has shared Iran's latest proposal with Washington. New York Times reports that U.S. officials fear Iran's defense against future American attacks will be stronger, as it may have figured out flight patterns of fighter jets. China gets ready to host Russian President Putin barely a week after the high-stakes Xi-Trump meet.
Kremlin signals that it expects tangible outcomes, including a serious oil and gas deal. This would be the second in-person meeting between Xi and Putin in less than a year. Prime Minister Modi is in Norway for the second last leg of his five-nation trip. The two nations agree to cooperate in space tech, ocean energy and renewable energy, among others. The Prime Minister will fly to Italy later tonight after attending the third India-Nordic summit. Standard Chartered is likely to exit bancassurance tie-up with ICICI Prudential Life Insurance. Sources say the bank may partner with Bharti Life. That's an exclusive. The Supreme Court refuses to recall its November 2025 order on removing stray dogs from public spaces, directs all states to take urgent measures for expansion of shelter sterilization facilities. The Apex Court also slammed what it called discernible absence of efforts by states, empowers authorities to take measures to euthanize rabid and incurably ill stray dogs. A federal jury dismisses Elon Musk's $150 billion lawsuit against Sam Altman and OpenAI, rules that Musk waited too long to sue. Musk, one of the early investors of OpenAI, had accused the company of drifting from its original non-profit mission after its partnership with Microsoft. The verdict removes a major legal hurdle for OpenAI as it eyes a potential public listing. All of that is coming up for you, but let's start with the day's market action. The markets failed to hold on to their gains. The Sensex and the Nifty closed lower today amidst a volatile session. In fact, the Nifty Bank slipped about 355 points, finally closing 120 points lower, 918 points higher. That was the Nifty IT index. So the rupee's depreciation is actually working to the advantage of the IT stocks. The Sensex and the Nifty closing just about in negative territory, coming off their intraday highs. Prashant is here to wrap up the market action for us. Volatile, coming off their intraday highs. Prashant, sum up the market action for us.
Well, it has been a two-way kind of street for equities, up, down, up. For the dollar rupee, it's basically been one way. And that is the story yesterday, that is the story today as well. Yesterday, the Nifty recovered 300 points from the day's low. Today, of course, we lost about 100 points from the highs of the day. We were up till the last hour, we were up about 60, 70 odd points, and finally we ended 40, 50 points lower as far as the index is concerned. You know, the sole winner was, of course, the IT services index, which was up 3%. Last week, the IT index lost 6% in value, and so far it's kind of made up for all of those losses. But you know, it's been bounces, but sell-offs as well. That's been the story for many months now for the IT index. Now, look at where else there was action. Capital markets index was up about 1.5%. Real estate index was up about 1.33%. The small cap index, after being down 1%, was up 1% as well. You know, even for the real estate space, the index lost 8% last week. So, you know, some small bounce is par for the course in that sense. Let's look at the Nifty now. So Kotak Bank was the big loser, 2.5% lower. Titan, Ultratech were some of the others, which were down about 1.75%. I said IT has been the stronger part of the market. So Infi, TCS, Tech Mahindra, TCA, and HCL Tech, all up between 2% to 5%. Infi, of course, being up 5%. Today. The other two names were Tata Motors passenger vehicle, which was up 2.25%, and Eternal, which is back at close to about 250 odd levels.
All right, Prashant, thanks very much. That was the equity market action, but let's talk about the currency market. The rupee slipping to another record low of 96.60 against the dollar. The currency is now weakened by over 7% so far this year. Ritu joins us now with more. Ritu, the rupee continues to fall, but what were the specific factors today?
Well, the rupee continues on a record-breaking slide. We started 2026 with the rupee at around 89.97 to the dollar, and since then we've seen a 7% depreciation. And since the start of the West Asia conflict, the rupee has fallen by nearly 6%, making it one of Asia's worst-performing major currencies this year. What's also worrying the market is the speed of that fall. Now, the move from 90 against the dollar to 95 took less than 5 months, and from 95 to 96, barely 15 days, whereas historically we've seen a 5 rupee move against the dollar take as much as 5 years. So the depreciation is clearly accelerating, and that tends to trigger panic hedging and speculative pressure. 3 forces are driving this, call it the unholy trinity of elevated crude prices, the foreign outflows, and a strengthening dollar. The biggest factor, of course, remains oil prices. With the West Asia conflict dragging on, Brent has remained above $100 a barrel for nearly 2 months now, and that is inflating our import bills significantly, directly pressuring the rupee. At the same time, the dollar itself has strengthened. You have higher US bond yields, rising safe haven demand. All of that has boosted the greenback. Foreign institutional investors have also been selling Indian assets. We've already seen more than 20,000 crores of outflows just in May so far, and more than 2 lakh crores for the year. And these outflows are hurting the rupee further. Add to that the widening trade deficit, renewed concerns around the current account deficit, and the pressure on the currency has intensified. Now, RBI and the government have moved on multiple fronts to stem this slide. The government, for instance, has hiked duty on precious metals. It has undertaken 2 fuel price hikes now. RBI has been intervening both in the forward and the spot markets. It has capped the net open position at $100 million a day for banks to curb any speculation. And as we've been reporting here, more measures could be considered if the slide continues.
Many thanks, Ritu, for joining us. Now, the U.S. has extended a sanctions waiver allowing countries to purchase Russian oil for another 30 days. The U.S. Treasury Secretary said the license will help stabilize the physical crude market and ensure oil reaches the most energy-vulnerable countries. Remember, the U.S.'s previous waiver lapsed on Saturday. This is the third time that we've seen the U.S. give this temporary waiver to buy Russian crude at sea. Bassett had earlier said that the U.S. was not planning an extension of the sanctions waiver, but it has now come in for another 30 days. Now, petrol and diesel prices have been hiked by around 90 paise per litre, marking a second fuel price hike in the last 1 week. Now, last week, the government had hiked fuel prices across the country by 3 rupees a litre, making it the first price hike in 4 years. So those are the prices now in Delhi at 98.64, 97.77 for diesel. Mumbai, almost 108 rupees for petrol. Kolkata, 110 rupees almost. And Chennai, 105 rupees almost for a litre of petrol. The top global story that we continue to track: President Donald Trump has threatened to restart military action against Iran, but backed down soon after as the stalemate between the two nations continued. Now, Trump said in a post on Truth Social that he had planned a major attack against Iran, but then he delayed it because the heads of states of Gulf nations asked him to hold off, in his words, for 2 to 3 days. He claimed that Qatar, Saudi Arabia and UAE requested more time to work out a nuclear deal. The New York Times, meanwhile, reports that U.S. officials feel Iran's defense against future attacks will now be stronger, as Iran may have figured out flight patterns of American fighter jets with Russia's help. So for now, Trump deciding to hold off on any military action.
As we've had very big discussions with Iran, and we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that, where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also. We've informed Israel. We've informed other people in the Middle East that have been involved with us, and it's a very positive development, but we'll see whether or not it amounts to anything. We've had periods of time where we thought pretty much getting close to making a deal, and it didn't work out, but this is a little bit different. Now, we're ready going tomorrow, very big, and not something I wanted to do, but
Well, that's President Trump saying he's holding off on a military attack in the hope that there will be a deal with Iran at the behest, he claims, of Qatar, Saudi Arabia and the UAE. Now, Russian President Vladimir Putin is all set to arrive in Beijing on Tuesday for a 2-day summit with President Xi Jinping. This is the second time the Chinese and Russian leaders have met this past year. The Kremlin has signaled it expects tangible outcomes, including a serious oil and gas deal. Prime Minister Modi is in Norway for the penultimate stage of his 5-nation tour. The Prime Minister held wide-ranging bilateral talks with his Norwegian counterpart, Jonas Støre. Both leaders discussed boosting overall trajectory of bilateral relations. Later, he held an interaction with Norwegian business leaders after inaugurating the India-Norway Business and Research Summit. Speaking at the event, the Prime Minister urged business communities of both countries to forge new partnerships and strengthen economic cooperation.
आप में से कई CEOs भारत के वाइब्रेंट गुजरात और अन्य इन्वेस्टर समिट में भी बड़े उत्साह के साथ हमेशा भाग लेते रहे हैं। अब हमें इस पार्टनरशिप को, इसकी इंटेंसिटी बढ़ाकर इसे न्यू फ्रंटियर की ओर ले जाना चाहिए और हमें अब एक एक कदम से चलने से कोई बात बनने वाली नहीं है। हमें जरा गति भी बढ़ानी होगी और लक्ष्य भी बहुत ऊंचे तय करने होंगे।
Prime Minister Narendra Modi is going to take part in the India-Nordic summit today. He's also slated to meet several counterparts from Nordic countries. He's slated to leave for Italy later in the day, which is going to be the 5th country as part of his 5-nation tour which he's undertaking. And as part of the Prime Minister's tours, India has already upgraded its bilateral ties with the Netherlands and Sweden to a strategic partnership. The Prime Minister's visit started with the UAE, where an agreement was signed for a framework of strategic defense for bilateral security, on maritime defense. Also, agreements were signed for strategic petroleum reserves and for LPG supply to India. Apart from this, there were investment commitments of around $5 billion which were made in Indian infrastructure. Subsequently, the Prime Minister went to the Netherlands, where he and his Dutch counterpart oversaw a ceremony where a pact was signed between ASML and Tata Electronics to support semiconductor fab in India. Also, bilateral dialogues focused on green hydrogen, clean technologies and advanced manufacturing. Now, subsequently, he went to Sweden, where a joint innovation partnership was undertaken for AI, 6G, critical minerals, space and life sciences. He also held a roundtable with several top CEOs from European businesses. He urged them to invest in India for a better value for money. He subsequently headed towards Italy. It remains to be seen how early these investments and these pacts are going to fructify into on-ground work and on-ground generation of jobs in India.
All right, Abhimanyu, many thanks for joining us. On to CNBC TV 18 exclusive. Standard Chartered is likely to exit its bancassurance partnership with ICICI Prudential Life Insurance. Sources say the bank may establish a new distribution arrangement with Bharti Life Insurance. Yash joins us now with the details. Yash, plenty going on in the insurance space. What are your sources telling you?
Well, certainly a lot of movement. Yesterday's decision of Prudential exiting ICICI Prudential Life Insurance did put some supply overhang on the stock. And today, the latest development that we've been given to understand from our sources put some, business overhang as well. What we've been given to understand is that Standard Chartered is likely to exit the bancassurance tie-up, which it has with ICICI Prudential Life Insurance. This is, of course, post-Prudential's decision to exit ICICI Prudential Life and, of course, establish that new JV or acquiring that 75% stake in Bharti Life Insurance. This is important because Standard Life gets about 5% of the annualized premium equivalent and 6% of the retail annualized premium equivalent as part of business to ICICI Prudential Life Insurance, and that exit of Standard Life could have an impact on that portion of the business. We've written to all parties involved in this particular story, ICICI Bank, ICICI Prudential Life, Standard Chartered Bank. A response from all of them is awaited. In fact, Standard Life got back to CNBC TV 18's query saying that they declined to comment on this particular development. Separately, we've been given to understand that IRDAI is likely to consider, giving about 12 to 18 months to Prudential to sell that entire 12% stake which it intends to do in ICICI Prudential Life. 2% out of that entire 12% is likely to be bought by ICICI Bank, and that 10% balance is likely to be sold through various block deals in that time period which IRDA is likely to give, that is about 12 to 18 months to Prudential PLC.
All right, Yash, many thanks for joining us. Air India has confirmed that fuel switch module of Boeing 787 Dreamliner will undergo further testing at the company's Seattle facility. This confirmation comes after a Reuters report indicated that India's air safety officials are set to travel to Seattle to observe Boeing's testing of the switch panel. The airline added that the module had earlier been cleared as fully functional by Boeing and the DGCA. Remember, concerns were raised about the fuel switch panel after Air India 171 flight crashed in Ahmedabad last year, so that is expected to take place in June. The Supreme Court has refused to recall its November 2025 order to remove stray dogs from public spaces. The top court has directed all states to take urgent measures, including expansion of shelters and ramping up sterilization efforts. Ashmit joins us now with all the details. Ashmit, so no modification to its November 2025 order, but, What has really changed on the ground? Did the Supreme Court even ask states whether any changes have been made since its order last year?
Well, in fact, that's one of the aspects that the Supreme Court dwelled on, that as far as the situation on the ground is concerned, despite Apex Court directions, there has been no change on the ground. And that's, in fact, what the Apex Court began with, that there's been a spectacular failure on part of states, on part of municipal bodies, that there is a statutory mandate for ensuring that there are animal birth control centers, or ABC centers, as they are called commonly, that they're just not enough to keep pace with the stray dog population, going on to say that this is an infrastructural issue, that there's been a lackadaisical approach by state and municipal authorities, and that there is a need for augmenting this infrastructure. But while on one hand, the Supreme Court makes a note that there is an infrastructural deficit, that it cannot support the large populations of stray dogs, for sterilizing them, for vaccinating them, for sheltering them, despite that, the Supreme Court has remained firm on its November directions that stray dogs need to be cleared from public areas. By public areas, the Supreme Court means hospitals, educational institutions, colleges, schools, railway stations, airports. In fact, speaking of airports, the Supreme Court had cited specific incidents about the Delhi airport itself, saying that stray dogs need to be removed. For these cases, the Supreme Court has said that once they're removed, they cannot be vaccinated and released back to the same location. Additionally, there are three key directions that, in fact, we're watching out for. Number one direction is that there is a direction given to state and municipal bodies to ensure that there is at least one animal birth control center for every district. Number two, and interestingly, the Supreme Court has allowed for euthanizing aggressive and rabid dogs. This is the first time such a direction is coming in from the Supreme Court, euthanizing dogs which are aggressive or rabid. And number three, there has been a legal immunity granted to municipal officers. The Supreme Court has essentially said that while they're discharging their functions, while they're performing their functions, there can be no legal action taken against them, much less an FIR. So no legal action, immunity being granted, and essentially the Supreme Court saying all public spaces need to be free of stray dogs.
All right, Ashmit, many thanks for joining us. So no reprieve there and no answers. Where are these dogs supposed to go? We don't know. Time for us to head into a short break, but up next, the US federal jury dismisses Elon Musk's $150 billion lawsuit against Sam Altman and OpenAI. That and more when we return. Elon Musk's $134 billion lawsuit against Sam Altman and OpenAI has been dismissed by a federal jury. The jury ruled that Musk wanted to waited too long to sue. Rachna joins us now with more details. Rachna, what could this verdict mean for OpenAI and Musk's SpaceX?
Well, it was billed as the trial of the century, and on Monday it ended in under 2 hours. A 9-member federal jury in Oakland threw out Musk's lawsuit against Sam Altman and OpenAI unanimously. The finding was that Musk waited too long to sue. The judge agreed on the spot and dismissed every single claim made by Musk. The case goes back to 2015 when Musk and Altman co-founded OpenAI as a non-profit. Musk donated $38 million. He left the board in 2018. OpenAI then built a for-profit subsidiary, took $13 billion from Microsoft, launched ChatGPT, and is now valued at over $850 billion. Musk called it all a theft. He sued in 2024, seeking $134 billion in damages and demanding Altman be removed. 3 weeks of testimony followed. Musk told the jury repeatedly, "You cannot steal from a charity." But he also admitted he had grown uncomfortable with Altman's behavior as far back as 2017. And that admission handed the other side its winning argument on the statute of limitations. Brockman's own diary was used against him, a 2017 entry asking financially what will take me to $1 billion. Microsoft CEO Satya Nadella also testified, and he said Musk never once called him to raise any concerns. And Altman, under cross-examination, was asked if he had ever been called a liar. His answer, "I've heard people say that." Well, the jury heard it all and still took less than 2 hours. Musk called this a calendar technicality and said he would appeal. But the verdict has already done something significant. It has cleared the biggest legal cloud over what could be the most consequential IPO season in tech history. SpaceX, which now includes Musk's own AI venture xAI, targets a public listing on June 12. Anthropic eyes October, and OpenAI is targeting the fourth quarter, though its own CFO has privately flagged it may not be ready until 2027. Now, bankers have told both OpenAI and Anthropic directly that whoever lists first will capture the market. So Musk lost in court, but the bigger battle for investors and for market narrative for who defines the AI decade is just getting started. And with SpaceX listing first, Musk may have found a way to defeat OpenAI that no courtroom could deliver.
The union government is making a push for electric vehicles amidst tensions in West Asia. Sudarshan joins us now with how several state governments are adopting electric vehicles and what that means now as far as EV penetration is concerned. Sud.
So over the last few weeks or say months, we have seen the one topic that's been gaining the traction is the use of alternate fuel. Even just few weeks ago, even Prime Minister Modi has issued advisory requesting people to have the increased usage of electric vehicle. And recently we had seen the draft of CAFE emission norm from central government and Delhi government too issuing the draft of new electric vehicle policy. And just two days ago, Haryana government has issued advisory to all the e-commerce companies, aggregators to induct electric vehicles or CNG vehicles in their fleet. Now, Finance Ministry too has issued advisory to banks, financial institutions and insurance, we understand from sources, to have the increased usage of electric vehicle and reduce the usage of petrol and diesel cars. So this was about the advisory, how the trends of electric vehicles to the total volumes of the companies. So just we have taken the data of last few months. In the month of February, the penetration was in the range of 8 to 9%, and that had seen a sharp increase to more than 10% in the month of March. But in the last 2 months, April and May till yesterday, the penetration is in the range of 9.6 to 9.8%. Now, if you take a look and go into the translation of this penetration to the contribution to the volumes of four-wheeler companies, Tata Motors has been the leader over the last few years, and their contribution for electric vehicles is in the range of 14 to 19%. For M&M, it's at the number 2 spot, range is 6 to 9%, Maruti 1 to 2% because they had launched e-Vitara, and Hyundai Motor, the range is 1 to 2%. But if you come to the two-wheelers, penetration and the contribution has seen a sharp increase because of scooterization trend. Currently, 1 out of 5 scooters are electric vehicles. For TVS Motor, which is the market leader with market share of almost 26%, contribution is in the range of 8 to 10%. Bajaj Auto with market share of 24% has the range contribution of 6 to 8%. Hero Moto 2 to 3%. Ola Electric and Eth Energy have seen an increase in the sales, monthly sales over the last few months too. But what about the going forward? Now, with the push that we are seeing from government and the regulators, all the OEMs are going for aggressive EV launches. Tata Motors is looking at the launch of Sierra EV, Avinya EV, Punch EV facelift. Even we are going to see several launches for Mahindra & Mahindra. Maruti is going to launch even new version of e-Vitara, or say new version of in the Auto Expo of 2027, new EV that you will see. Even Hyundai is going to launch the facelift of Creta, and several launches that we are going to see even from two-wheelers. TVS Motor is going to launch a new platform. Bajaj Auto is going to launch a new version of Chetak, and similar kind of launches that we'll see from Ather and Ola Electric. So with the push that we are getting to see all around, even though till now the penetration has been stagnant in the range of 9 to 10%, this push will help to see the major launches, and this segment will be tracked very closely going forward.
All right, so many thanks for joining us. Well, the EV penetration finally starting to pick up, at least as far as the two-wheeler side is concerned. Much faster adoption rates there, as Sud was pointing out. With that, it is time for us to wrap up this edition of Business 360. The news will continue here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to this special conversation. The person we have with us today has built one of the most talked about fintech companies in India, if not one of the more popular ones. And it's not by focusing on the next 500 million people, but it's by focusing very much on the top 20-25 million. Hot on the heels of getting a payment aggregator license and a whole lot more. We have a lot of questions for him. Kunal Shah of Cred joins us now. Kunal, always a pleasure to have you here on CNBC TV 18, and thank you for being generous with your time. Let me start with the payment aggregator, since that's something that's just come in last month. Strategically, into what we know of Cred, where does it fit in? Is it a cost angle because you're doing 8.5 lakh crores of payments annually? And you, of course, have to route it so far through third-party applicators, which means there's a fee involved. Does that reduce this friction now?
First of all, thank you so much for having me. It's always a pleasure. I think when you are building a large-scale fintech business, you start by kind of working with all the infrastructure that is available, but eventually kind of have to build a lot of stuff on your own infra. And own infra means own licenses and kind of build more reliable systems. And at scale, even smallest optimization, be it on cost or performance, makes a huge difference, right? Yeah. So I think it's a step in that direction. Today, we are one of the largest payments players, and the license enables us to kind of do more things. We already are prominent at many merchants. When you go online, you see Cred online already there. It's just that we're trying to build a fully integrated system where, at least for our members, it becomes a seamless experience to kind of experience Cred, not just on our app, but across the internet ecosystem, and create I would say, a significantly more robust experience, because we are living in a world of extreme impatience, and even smallest amount of microsecond delays is not tolerated anymore.
Yeah. But it's not just about experience, is it? You're also going to be going after merchant revenue. Is that something that will be the focus? Because that puts you in direct competition with a lot of neighborhood competitors you have here that have been in solely this business for a decade or more.
Yeah, I think our focus will remain consumer revenue. The idea of building the merchant leg is to kind of make the seamless experience of the consumers who are using Cred to kind of be seamless across all merchant ecosystems. At this point of time, we don't see ourselves becoming a merchant company at this point of time. The consumer business, the customer cohort we have chosen, continues to have very strong traction on customer revenue, right? And that's exactly what you see. Many internet companies started with solving for hundreds of millions of customers, realize it makes money on 25 million customers. Thankfully, we knew this by birth, and we've kind of stayed there, right? Yeah. So therefore, focusing on that allows us to kind of not distract ourselves in different types of revenue streams, but the consumer becomes our core focus.
So is the idea to be a full stack payments player? And I'm also asking in the context of your previous statements where you say your DNA at Cred is to be a distributor, not a manufacturer. Is this leaning towards that side? Is this a philosophical U-turn of sorts?
Absolutely not. We remain in that exact same thing. Payments experience is what drives the core engagement loop for us, right? A lot of people come to manage their credit card, make sure they have the thing. We now power UPI, do many other things. And a merchant transaction is just an extension of the same engagement thing, so that when they are using Cred, they're able to experience all the layers of payments or bill payments in a very seamless manner, right? On distribution, our stance remains the same. We believe that this exact engagement layer becomes the perfect destination for brands, merchants, financial services companies to cross-sell on top of our base. And that's what has been our business model. That will remain our business model.
Are you one of the most licensed fintechs? And what is the aspiration here? What are the white spaces you're still looking to fill?
I don't think we honestly track this as a metric, but honestly, when you are trying to be in a regulated business and provide a service that is consistently trusted, because what happens is in matters of money, right? The regulators across SEBI to IRDA to RBI are extremely prudent to ensure that the customer is consistently feeling safe in these ecosystems, right? What we enable through these licenses is that we are under the same regulatory coverage, so that any point of time that we are able to deliver the same level of trust. For example, not only we are audited by these regulators, we are audited by partners we work with. For example, banks who work with us audit us as well, because they have the responsibility. Yeah, absolutely. So I think what happens is we have to never forget that the business of money is business of trust. And business of trust is a place where everybody should be able to feel confident working with you. And if it means through licenses, if it means through audits, if it means through any prudent step that we can take in that direction, we'll keep doing more of it.
So, last time I asked you this question about what next, you hinted at secured lending. We haven't seen much on that front. I mean, in lending itself, are you looking at other avenues? So we have actually launched a loan against mutual funds. Mutual funds, that's one
scaling, of them. And I think we do have aspirations to kind of take it to more assets. We believe that in 5 to 10 years from now, every asset of this country should ideally be either get tokenized, and I think there is a vision from the government to tokenize many of these assets. And it allows customers to borrow at a significantly lower interest rates in, let's say, unsecured. Yeah. We do believe that a customer who has access to secured assets should probably find a way to borrow at a lower interest rate than higher interest rate through unsecured. And I think it may not be the most prudent financial cost because you make more money on unsecured, but I think it's the right call for the customer to have these options available for them to make that choice for themselves. Yeah. Right? Today, if I have 10 lakh rupees of mutual fund with me and I'm taking some money to borrow to for a vacation, we would want people to assume that there is a way you can access that. Today, no, we have billions of dollars available in mutual fund AUM. Less than 1% of that is levered for any kind of thing. And most of the growth has come from retail customers, right? So we believe that that format, and I think, see, if you go to most developed markets, it's a known thing that people borrow against their assets, right? This is the only first generation where we have some assets to start with, right? So I think we are going to go to the next 10 years would be about how to make these assets work for you and not just be purely work as an investment vehicle, right? And I think what we have noticed is that the historical behavior was, oh, let me break my mutual fund or borrow unsecured, but what if there's an option that can allow you to do both the things without having to cost any of the income growth that you're likely to get. So I think, again, same principle, make the money or compound interest work for you and not against you.
You know, you alluded to the fact that we're an aspirational country, we're starting to build this wealth, and how is that translating into business for you? Your last disclosed numbers are for more than a year back. FY25, you had 22,000 crores of a lending AUM book. That is one of your top 3 revenue generators. What else is growing faster, and do you see that mix changing where some of these newer businesses you're coming into will start to contribute more meaningfully?
Yeah, I think some of them will start showing some meaningful scale as time progresses. Many of the new bets right now take some time to fructify. Many of the businesses that we talked about earlier are like been around for 5-6 years, so they have their own timeline to kind of do that. But I do believe that financial services will probably remain like bulk of our revenue. There is no way we see ourselves to be kind of...
That's payments and lending distribution.
Payments, lending distribution, insurance distribution, wealth distribution, same category. And I think the share, hopefully, from lending will kind of move to other categories. But lending, we are a developing nation, right? So in a developing nation, lending remains large chunk of revenue, not just for fintechs, but for banks, for overall ecosystem, right? I wonder what % of public market PAT is around lending also, right? The thing is that these are categories are reflective of where the nation is at right now, right? And I think
it's also the most profitable.
I think financial services as a category are fundamentally more profitable categories versus, let's say, many of the consumer businesses and internet that exist. The thing is that it is also the most regulated category, which allows you to kind of grow at a certain rate of growth, but gives you a significantly higher runway. For example, an e-commerce getting disrupted through quick commerce is the norm in the consumer businesses. Like for example, an AI app, and let's say there's a new AI app, like kind of you'll see consumer shift. But in regulated businesses, what you see is that there's a compounding benefit for a brand to be around for 10, 15, 20 years, because when it comes to trying new things, you would be very happy to switch to a new fashion brand or a commerce brand and download an app. But when it comes to money, you believe, I think when companies get to 10, 15, 20 year mark, they actually start becoming more valuable.
Okay, speaking of that, you're 7 years old now. And you know, we've spoken about this IPO before, and you said the company's too young to do this. So what? I mean, does it have to be a teenager before you consider that? Do you have some number in mind, some milestone?
I think at this point of time, the company is growing in a very healthy manner. There is a very conducive market for good companies. And what we've seen in the last 5 years, or more recently in the last 2 years, is that companies with solid foundation, solid consumer love, are seeing good outcomes in the public market. So there is no reason for one to feel that rush towards the same thing, because ultimately markets are here to stay, right? They have lasted much before any of these companies existed, and they will continue to exist.
I'm only asking perhaps because there's a lot of interest in this company, and maybe investors want to be a part of it, not just
But I think we believe that we should feel confident where we believe that this is the right time to take the thing, and we should believe that whatever capital we raise should be kind of built towards kind of creating something bigger and larger. At this point of time, we feel confident today, like when we compare ourselves to, let's say, our peers in payments, like we already had a 12, 14x on ARPU, right? Like that already proves the hypothesis that we had, that if you focus on the right customers, right? It's a little bit like how Android and iOS eventually became as an ecosystem in some ways, right? Like they are both valuable in its own right, but eventually focusing on some customers. And we often joke internally that we are solving first world problems, right? Like it's a unique problem. When we built Garage, we didn't expect, like today, maybe 12, 14 million vehicles are parked on the platform right now. We have nothing to do with automobile, but we probably are the largest vehicle management platform in the country right now. I think as we can create focus on solving more first world problems, we are creating this unique place where if you are, let's say, credit-worthy, affluent customer of India, this becomes the place where you like to.
Sure. That doesn't answer the question on how long. I mean, teenager, adult, what is the
I
length?
heard that question more from you than my board. but at this point of time, not thinking about it actively, heads down, focusing on business. We are very excited about launching many new features that you will hear about, but build mode is the focus right now.
The other question you probably keep hearing from me is on profitability. We know you've halved your operating losses. Is FY26 any better? Are you closer to breaking even?
I think if you look at any internet company, the standard thing that you will see is that they start with investing towards building distribution, creating engagement, and eventually kind of those lines kind of go in the opposite direction. And that's no different for any company that has gone public to what we will also have the trajectory. It's just that we are not hyper focused on. Today there is a lot more opportunity on ARPU expansion for us. We believe that we can easily 2x, 3x, 4x our ARPU in the next decade or so, which very few companies have the clear opportunity to do that right now. So I think we look at the capital as a way to invest in many categories. For today, I would say 30-40% of our, let's say, payroll cost would be towards building new products. Right? If one had to say that, okay, let's not build new things, let's just monetize that, any company can be profitable. So that we are not thinking about this right now.
I know. So every time I've asked you this, I seem to get the sense that you have this philosophical comfort with a loss-making company. But I wonder if, you know, these institutional investors you raised more than $900 million from, do they share that comfort?
I think, first of all, companies who have gone public ahead of us have raised a lot more capital than us, number one. Number two, every company has to figure out a way to make the gradual growth of revenue and a reduction of profit to kind of be in a certain manner, right? And that's true for any company, maybe true for credit, maybe true for anything. And every now and then you also might find opportunities to go and build a business. For example, many companies that have gone public with profitability suddenly are realizing that, oh, we have an opportunity to kind of go aggressively, then they're investing in that. So I think we should look at what is the true potential and viability of a business to versus profitability being the core goal. Because if you have an ability to, how many companies in India, except the internet companies, have the opportunity to grow revenue by 5, 10x? I think that's the question. Today, investors have understood that path, and therefore even in public market, there is a tolerance for loss making because there is a clear revenue potential growth that you do not see in traditional non-tech companies. And I think that's the lens that we should be applying now.
But, you know, for any fintech business, capital is the raw material. You had your last round sometime last year. How much of a runway do you have before you have to go to the markets again? The reports suggest you were in talks to raise some money in the near future.
First of all, we were not in the market and we were not talking to an investor. We have enough capital right now to last us for as long as we want because we are kind of operating with a certain scale right now, right? Also, raw material for fintech is true if you operate a lot of business through a balance sheet.
Yeah, which you're not doing.
You're in the distribution business. So I think they're fundamentally different businesses. So the capital requirement in fintechs of our type is to kind of build distribution of growth of customers, which we've kind of captured a decent market share, and we continue to build with a lot of organic traction that we built, because now a lot of times earlier people used to come to credit for credit card bills. Now there are multiple reasons to come to credit, right? And we see that market share and cross-sell growing rapidly.
You know, Kunal, I follow you on social media. You post a lot about AI. You're quite AI obsessed. But tell me, within Cred, apart from improving the user interface, where is artificial intelligence, the newer technologies actually making a difference, you know, in your day-to-day operations in your business?
I think the first lens to apply is artificial intelligence or any technology's core purpose is to make things more efficient. When you have a technology that can make things dramatically more efficient, the first unit you need to apply this to is every individual. Every individual can, let's take an example of a journalist, right? There are like journalists who are leveraging AI, right? I've heard about journalists who have gone and using their AI avatars to be now telecasting
on TV,
stuff.
yes.
and you're also seeing people who are kind of not adopting AI, right? So you see that causes that level of shift. So I think first focus we had is that how do we make sure that every single individual who works with us is now becoming proficient at AI and enable them in a material way. Second thing is that a lot of our internal wiring and internal systems, right, are now moving the AI direction. Today, I would put a number, maybe 90-92% of all our code is written through AI now, right? So this is just many things that will eventually, every process, right? You will see, for example, one of our, an interesting story, one of our operations leader figured out a way to build significantly higher operational efficiency, and now they could do 10x work with the same amount of team, right? And these are real things that are happening all around us. But I think we are underestimating the quality of models that are coming in the next few years, which could unlock even bigger potential. See, a lot of times, let's say when GPS came, it was a certain thing. Yeah. Internet came, it's a certain thing. But this is one of the technologies that is exponential in nature, which means that the things it can do is growing almost on a daily basis.
Yeah, in leaps and bounds. But on that note, just hold your thoughts. We have to slip into a short break. Don't go anywhere. We're back in just a moment. Welcome back. We're continuing our conversation with Kunal Shah of Crude. Kunal, we've spoken about a whole length of things. I just wanted to end with a quick, maybe one-line rapid fire, if you'd call it that, to get your thoughts on a whole lot of things. One word for where we're at in the fintech cycle right now. I mean, is it a boom cycle? Are we getting started, or is it a reset?
I think we are going through a more calibration cycle.
Okay.
There are a lot of companies who have reached a certain scale are kind of getting to be more licensed, more regulated, kind of being more structured and organized, and they have become important part of the overall financial services ecosystem. Earlier, financial services were like, okay, there is something, but now they are a meaningful part of the infrastructure.
What is harder to build, trust or profits?
Always trust.
Yeah.
There are. In fact, it is significantly easier to build profits by letting go of trust.
Oh, okay.
But it is significantly
It'll come
harder
back to bite you then.
Yeah, because the thing is that you can take many shortcuts and take advantage of customers' lack of awareness and kind of make a lot of money. But if you're building an institution and you want long-term profits, the only currency that one has to be invested in is trust.
Okay, Crude in 5 years. Payment platform, lending platform, full stack bank?
A trusted ecosystem that allows people to transact without fear and a doubt of any reason.
No digital banking ambitions whatsoever.
At this point of time, we believe that the distribution model is the best thing that is suited for any tech company. We continue to be focused on that.
More than 7 years of building Crude before that free charge. Biggest learning?
Biggest learning, I would say, is that always one has to be realizing that the customer is evolving at a much faster rate than your ability to evolve.
Okay, the most overrated and the most underrated trend in fintechs right now?
Overrated is going public.
Underrated?
Underrated is building high trust institutions that will last all of us who are building it.
What's the tougher job, being a founder or being an entrepreneur and an investor?
Always a founder. It is easy to lose money as an investor.
Okay, one habit that you say will define you as a founder, if one were to look back?
Curiosity.
Curiosity. A contrarian belief you strongly hold about money?
It is a means to an end and not a goal one should be chasing.
And I don't know if I should ask you this, but a startup you wish you had built, not the global ones, we know there are far too many, but maybe in India.
I never think about that. What I do is I figure out a way to invest in them and still be part of the journey.
All right, Kunal, thanks very much for your time. It was a pleasure speaking with you.
Thank you so much for having me.
All right, on that note, we'll wrap up this special conversation. Thanks very much for tuning in. It's a goodbye, and thanks from all of us.
Hello and welcome to On the Record. I'm Shireen Bhan. My guest today is a man who has a pulse check on India's real estate market, but not just India. What's happening in the region is a question that will get addressed from his vantage point as well. $30 billion of assets under management in India since 2014, with a target of touching $100 billion by 2030. Ankur Gupta, thanks very much for joining us here on CNBC TV 18. It's great to have you back.
Thank you very much for having me again, and it's a great introduction. It's a timely topic for us to discuss what's happening across our region.
Absolutely. So let's get started with that. I mean, it's volatile. I think that is an understatement at this point in time. But the larger impact of that, not just on India, but on the West Asia conflict and what it's doing as far as West Asia is concerned, on Asia in general. What is the mood right now?
Yeah. So let's talk about volatility because that's where we start.
Yeah.
If you look at on a daily basis, everything seems always a little bit volatile.
Yeah.
But if you look at the trajectory in which economies, certainly the economies that you mentioned, from West Asia all the way to Far East, have moved in the last several years, you've had creation of a top 5 global economy in India. We've had a real emergence of the GCC region, the West Asia region, as a global powerhouse of both transactions as well as source of capital. Economies like Japan are seeing growth for the first time in several decades. Australia is on a 3-decade growth trajectory, very good demographics across the region. At the same time, infrastructure or hard asset creation is lagging the West. So if you compare the West versus the East, on a long-term basis, we are still underdeveloped and high growth. That is a perfect storm for any duration of capital to be focused on and to actually use opportunities like volatile markets of today to create large long-term businesses. So very excited about what's happening to the region on a long-term basis, on a mid-term basis, and on the short-term basis, some amazing opportunities coming our way.
So you're not deterred by the headlines at this point in time. You're not deterred by the nervousness. And I'll ask you this in the context of the fact that most people believe that, look, if oil prices continue to remain as high as they are, or perhaps even trend higher, the impact that that's going to have on growth. I get the point that you're making on the underpenetration and underdevelopment as far as hard assets and infrastructure is concerned. But if growth were to slow down in the region, what could that potentially mean for investors like you?
Fundamentally, what's happening to oil prices right now is a shock driven by certain geopolitical events. This is not a change in the way supply of oil should happen in normal course business. There's a lot of conversations around diplomacy, around pacts and deals being made, and it will come to a head soon. And when that is over, you'll have a lot of pent-up growth come through the business channels. So yes, if you look at the market today morning or the newspaper headline from yesterday, it all seems very, very volatile. But let me assure you, duration is what matters in our business. And oil prices will come to a level playing field like they were about 3 months ago. And hopefully in the next 3 months, because this is a geopolitical, it's not a global health crisis like we saw 6 years ago. There's a solution to this. And very soon we'll see the solution play out.
We're yet to see the solution play out. The blockade continues to remain in place. But then let's address the short term, because you said even in the short term, you see opportunities. Where do you see opportunities in the short term, specifically for a market like India?
So in the short term, what happens is people who do not have access to long duration capital need to take actions which they would not take in normal course operations. We invest capital in a large scale, and we have operating ability to back that capital. So what happens when there is global turmoil like this, what we see, your cost of capital goes up.
Yeah.
There is short-term inflationary pressures, and you have to make decisions if you don't have the benefit of large balance sheets to tide over the current prices. That creates opportunities for investors like us. I think that's what I mean, that in the short term, it's an exciting time to be in the market.
i.e. better valuations, more distressed assets that you can go out and pick up at a discount?
I would say we are able to pick up high quality assets at fair valuations.
At fair valuations, is it? What kind of discounts are you now looking at in comparison to the last deal that you just got done?
The markets overall have been soft. I'm not talking about the public markets because public markets are not necessarily always reflective of where large transactions happen. But in the last, I'll talk about the last 3 months. In the Asia region, we've completed more than $10 billion of transactions. We've just announced a very large GCC, built out of a very large GCC in Mumbai, the largest ever in Asia. Almost 3 million square feet of total area that we are going to construct for a very large US bank. Transactions like that don't always happen with players like us that have the wherewithal both in terms of capital as well as operating capability. I think that really gets magnified when there is overall dislocation in the market.
So do you believe that you're in fact going to see an acceleration of deals and deal making because there is this dislocation that you see today?
See, India is one of the top growth economies in the world. So we've been in the market for 10 years. Every year our business has expanded compared to previous years. And that's true for when markets were dislocated like they are today. And that has been true when markets were on a very smooth sailing. So we invest for long term, which means our programs are also long term. So I would say that nothing fundamentally has changed in the India growth story. In fact, I would say that with technology coming through the way it has, and the democratization of the technology and faster computing, faster access to large-scale models. With the workforce that India has, our median age is still in the high 20s. That population is more adept to using that technology as a tailwind than actually as a headwind. So today, I am more bullish about the prospects of India than they were 12 months ago.
And that's interesting because that is not the narrative at this point in time. Specifically, if you look at FIIs and FPI flows, I mean, it's been a one-way out of India. It's been exiting India as opposed to coming into India. But you're saying that you're more bullish on India today than you were when you first started investing in India 10 years ago. What are you seeing that others aren't?
See, firstly, we have thousands of people today in India that work for our business. So we get a real pulse from what's happening. 10 years ago, we were the early investors into the country. Today, we have a large business. We have some amazing talent that works for us. We have operating companies that employ thousands of people, as I mentioned. So we get real pulse on the ground. And today, India needs infrastructure build out. India needs real estate build out. India needs more office spaces. India needs more hotels, more warehouses, industrial parks, all of the above. We've had a few more events of global dislocation than you would have imagined, which has led to a global shortage of supply of real assets. Now that gets magnified in a fast growth economy like India. And today when valuations do become reasonable, i.e. transactions happen at reasonable numbers, investors like us can really push the pedal.
And you intend to push the pedal? So is the 100 billion by 2030 on track, target?
That hasn't changed for us. In fact, we might be doing it much sooner.
By when do you now get to 100 billion? What does by much sooner mean?
We said 5 years last year.
So
5 years from last year is 2030. But compounding effect of our business is amazing. Again, think about which country in the world today offers the compounding at the rate India does, and multi-sector story. India is a financial services story, India is a consumer story, India is a construction story, India is a technology story, services story. India is many sectors put together. Many other large countries have only one or two sectors coming their way. Yes, we can do a lot more in deep tech. We will do a lot more in AI as a country. But the infrastructure build out of that is something that investors like ours will play. I'll answer your question on FIIs.
Yeah.
Look, FIIs are trading in stocks. So they will obviously, because the barriers to FII movement are very limited, as they should be. Our form of capital is FDI, strategic capital.
Yeah.
We're not just investing. We are investing, we are developing, we are building, we are managing. And we are creating large businesses. And that is permanent capital. That will always create a multiplier effect on economy in the country. And once invested, this capital stays for several years.
I mean, it's actually in the ground.
It's actually really in the ground. So the returns of that, form of capital will change. Private capital will make its way into REITs and InvITs and so on and so forth. But the actual capital is in the ground. It's creating jobs to create the infrastructure, the real estate. Then it's creating jobs when people use that real estate. So it's a real multiplier effect. We saw that in China. Over 2 decades of large-scale development of the critical cities, real estate, malls, offices. That is what today has become the envy of the world in many ways, that it has one of the best infrastructure to push the economy in many different directions. And that's a global powerhouse that India is on its way to become.
And people are looking at factors like the currency depreciation, the swiftness of the currency depreciation, and so on and so forth. And all of those are being factored in as people make those investment choices and investment decisions. How are some of those issues weighing on your mind today?
Look, as I said, we are investing for a long time. Nobody would factor in that currency in India will not depreciate.
4 to 5% was the depreciation that was factored in typically.
And I would say that over the last 3 months, we've seen a real oil shock. as we talked about earlier, it will come to a head. It will hopefully, demand supply will determine the oil prices, then an economic blockade. At that time, the currency will go back to its normal 3 to 5% annualized depreciation, and that's just technical. That's just the differential in the interest rates between India and the currency that is benchmarked, which is the US dollar in this case, and that's fine. In fact, we should use this opportunity right now to really push the pedal on our exports and use the opportunity that the world is providing to us by way of a little bit of advantage on the currency side to push the agenda. We should never let a crisis go to waste. And this is our time for India to really, push its exports agenda beyond the services as well.
And you're right in pointing out that the depreciation has actually helped Indian exports become far more competitive. But, let's address the big bet that you're making in India, and that is the GCC bet, right? 2,100 GCCs in India today at last count. I don't know if they've added a few since I last looked at the numbers. You firmly believe that there is a structural move towards the offshoring model changing to an onshoring here in India, and that's the conviction clearly that's playing out for you, which explains the largest GCC that you've decided to do here in India in Powai. But again, there are question marks in light of AI or what happens to workforces in general, but specifically also what happens to these GCCs. Are you seeing any indications of a slowdown of growth plateauing as far as GCCs are concerned?
You have to differentiate between growth rate and growth, absolute growth. So absolute growth is on a very firm footing. We are seeing more demand from global companies to set up. I wouldn't distinguish between onshoring or offshoring. I would say global capability centers are about global delivery.
Right.
With AI, that model actually gets much more pruned, simply because you can deliver a lot seamlessly with better technology, which is explaining why companies are today more comfortable than setting up their own centers than relying on third-party operators. So that's a shift in the business model. The demand for quality workforce that's available from India has not slowed down. In fact, it's actually magnified. We haven't yet seen the large AI companies, the big sevens or the big 10 from the US, actually creating jobs for their AI businesses directly. Early green shoots. We still are heavily reliant on financial sector, large insurance companies, etc., medical companies, health companies, etc. But imagine the amount of job creation that the AI business directly will have with the trained workforce that we have in the country. While AI is an amazing term because everybody uses it right now, technological advancement has happened for the last 3 decades. It goes through ebbs and flows, but if you think about what Internet 1.0 did, the social internet that almost revolutionized the way people consume media, and this is another advancement in technology. It needs a massive build out because the compute capacity that was required has suddenly become many times over. But even that will come online over a period of time. It's a $7-10 trillion economy in the opportunity in the world. A large part of that will happen not just in the US, it will happen in other countries as well. So that will all create need for capital in the infrastructure real estate space. Using that is not just going to impact the country that the technology is based out of. It's going to impact the whole world. And India has always proven its mettle.
Do you need more workforce at work, or the work from home conversation is back? It's back after the pandemic because the Prime Minister has put out a nationwide appeal asking companies to consider work from home. It is not mandatory just yet, but we've seen many state governments now issuing their own advisories as well. If this were to translate into, at least for a period of a year, because that's the broad number that he's speaking of mandating work from home, or at least nudging, encouraging people to work from home, what could that potentially in the short term mean?
So again, we have to differentiate what happened 6 years ago with the pandemic to what the appeal was made. This was in response to what's happened in the geopolitical arena with fuel prices and shortage and the impact of all of that. And as I said, it will come to a head soon. we all went through a period of time where there was work from home. That was needed because of the pandemic. You needed to create social distancing. But almost all corporations today realize the benefits of working in an office setting. New models are being created. Businesses have been incubated. People have to work together. The way people worked in the past might have changed a little bit. In fact, I would say most organizations today need more square footage per person than they needed pre-pandemic. You have more dependence on social interactions in office today than they did pre-pandemic. So by and large, work from home, even if it was to be mandated in certain cases or encouraged, is a response to a very different aspect, which is about fuel, and that's specific to India again, because of the way our energy markets are today, and that will resolve itself.
So you're not seeing any nervousness at this point in time on account of that?
Absolutely not.
Even as far as the hospitality business is concerned, assuming that your conviction pays off?
We are now in the Leela business itself, more than 20 hotels, more than 10 in the pipeline. So we're going to probably be more than 30 hotels, and across the board, I would say we will do a lot more should the opportunities be available to us.
M&A there as well?
We are a large investor and developer, so M&A is always the way for us to grow, by step functions.
Let's talk about the REIT market as well, and of course that's been something that you've been championing. And 2025 was actually quite an inflection point as far as the REIT market in itself was concerned. What's the story, and how is that playing out, not just for you but as an industry as well?
Look. Our REIT is now more than 35 million square feet, a large enterprise. The regulations in REITs are very, very good in India. And we've always said it that they've taken the best from the world and implemented them in India. The fundamentals are very good. SEBI introduced the classification of REITs into equity, which was always the right thing to do. That led to an expansion of investor universe. We've raised more than $1 billion in our REIT in the last 12 months or so. And I think that program will continue. We'll probably raise capital because capital is the raw material for REITs.
How much are you looking to raise and when?
We just raised about $300 million this month, early part of this month or late last month. And as I said, the opportunity for the REITs for our REIT is immense. So the raw material is capital, and we look to either raise capital or issue units to expand. But the program will continue for decades. US established REITs in the 70s and 80s, and it continued for 4 decades, and we are in the first decade of the REIT market. I just characterize the market size. The size of global commercial real estate space, the rent-producing real estate space, is $60 trillion. In the US is $30 trillion, which is 1:1 their GDP. In India, our GDP is $4 trillion, and our commercial real estate space is probably $400 billion. So we are a tenth of our fair share of GDP. Our GDP will double and double again over the next 10 years, which means we have to first make up 10x and then double and double again. And that's the market potential that we see. We've only seen office REITs and retail come through. We're going to see hotels, either IPOs or through REIT channels. You're going to see more office REITs. You're going to see apartments, industrial. You're going to see warehousing, business parks, so on, and it's a big market. We can open up the market to talk about mortgage REITs as well, to create more financing sources for the real economy. So it's early days, very, very bullish on the REIT business. We've seen early days the government is thinking about creating sovereign programs for asset monetization or creation of holding companies which can become REITs in future. So I think the market just started off.
Specifically, since you brought up the government and the government's asset monetization plan, and I think, again, the pushback there has been that there's been a lot of talk but little action. We've seen some action, at least as far as the InvIT side is concerned, but, it could have been a lot faster, it could have been a lot more. What's the ask there, and what's the hope there, more importantly?
The ask is that we are here to help.
Have they asked for help?
In terms of policy matters, in terms of how to do the right things, I think the engagement with industry is very good. I can say about Brookfield and most of the government agencies are supporting the growth of our business, and as a result, supporting the growth of the country. And in that ecosystem, when they have their own programs to launch, it just widens the scope. How we can be helpful, that they have to decide. But I don't look at the past, whether the monetization could have been faster or quicker. That's, they're running a country. They have a lot more considerations to take. We are running a small corporation. So whenever they are ready, we are here to support.
With just a couple of hundreds of billions in asset under management, just a small corporation. But, we're also talking at a time where we've got Trump and President Xi in China, along with a whole host of top US CEOs. And since we're talking about comparisons and where India is and the potential for growth, let's talk about this India-China comparison, because very often we see long sort of, comparisons being made, and some of them perhaps don't even hold true in the form of the comparisons being made. But how do you look at the India-China story and how you expect them to play out?
I look at it like the interstellar model, where you have to almost change the time scale and then look at it. Why compare a more maturing demography with a younger country today? Let's look at what happened maybe 20 years ago in China. And that is more exciting. That can we be part of that journey for 20 years in India? Or if you take it back 20 years in the US. So, economies go through their maturity cycle. So what we sometimes do mistakenly is compare today's India with today's China, or today's India with today's US. I don't think it's a fair comparison. Free market came to India later than many of these countries. And whatever the reasons might be, as I said, I don't look back. The opportunity for us to replicate a China model, or any model that works for India, I don't think we should be replicating or copying models, but we can learn from these economies. US, China, you talked about the large engagement that we are seeing this week play out. I think India can only take inspiration from some of these things and fasten our reforms if we need to reform, and look at what the potential is, because we have a case study of almost eradication of poverty in China over the last 3 decades, creating a massive infrastructure push, lots and lots of cities, opportunities for business to flourish, industrial and manufacturing becoming world class. So all these are inspirations that we can take while keeping the virtues of India intact: democracy, federalism, etc. I think all of these are important, and we'll find our own way to grow. Hopefully the terminal value of that growth for a young country is probably higher.
So for somebody who is putting long-term capital to work here in India, what is the most exciting thing?
The compounding of growth. We are a young country. The terminal value of that growth, once compounded, is also very high. And it's a multi-asset, multi-sector, multi-pronged story. As I mentioned, we have so many things going right for India. We're not only a resource country. In fact, we probably are a net importer of resources, but we have 10 million college graduates a year. Most countries don't provide that ecosystem in the world. We are an established consumer story, established technology story. The world thinks India is still it's not the easiest place to do business, but once you establish your ecosystem, it's a very robust place to do your business.
What does that mean in terms of returns?
In terms of, again, it all depends on benchmarks. I would say in the real estate business, India has been a top market for us for the last decade. We believe in this story a lot. India has been a top market overall for us compared to, but again, it's all dollars invested, and we love to invest a lot more, and hopefully maintain our returns and do even better.
We talked about all the stuff that's good and all the stuff that's exciting and gives you hope and reason to be optimistic. The few things that you believe are constraints and are holding back growth that require intervention.
I would say pace of deployment, both of government projects, private projects, capital deployment. I think that's something which we have to just make sure that everybody's motivated, because time is the biggest factor in terms of the same growth, if it happens over 3 years versus 1 year, has a very different meaning. So I think if we can just push the timing of our execution as a country, and all of us, not just the government or the agencies in the government, etc. The world is rooting for our success.
Yes, we hope that more and more will root for our success as well. But Ankur, before I let you go, so almost the middle half of 2026. How do you see this year closing? And more importantly, as far as the next year is concerned, because you did say very specifically that you believe this is an opportunity to press the pedal, what can we expect from Brookfield in India?
No, part of being a long-term investor is actually being really bad at short-term. So if I were to guess what we'll be doing tomorrow, I'll probably be very, very wrong. But our target for doubling our business and making it more than $100 billion, I think the conviction today is bigger than ever before, and I'll just stick to that.
Well, all right, we wish you the very best of luck with that and look forward to having more conversations with you. Thanks very much for joining us here on The Record. Well, that is Brookfield continues to be as bullish on India as they were. In fact, perhaps even more is the message coming in from Ankur Gupta. $100 billion in assets under management, perhaps even earlier than the earlier estimate of 2030. That's the big headline coming in. From all of us here, for now, we'll take a break. There's a lot more coming up for you on CNBC TV 18. Stay tuned. We're back in a minute.